So hi guys. First of all, thank you very much for encouraging our institute's rest of our CA and CMA to this level. Anyhow, so here is a good news for all of you from Sresta. Again, in respect of November 2022 exams, we are going to upload again all updated marathon classes, revision classes. Okay, we are once again uploading the videos or revision videos for November 2022 exams, and we are doing it for all 8 subjects. So who are the faculties that first of all taking all these marathon revision classes? And myself, I will take audit, and I will take some 2 or 3 important chapters of company law. And so nothing but P5, mainly I'll focus on paper 6, and Satya Raju sir will focus on paper 1 and paper 5. So you will be getting approximately 20 plus 20, 40 hours of marathon for accounts and advanced accounts put together. Then Subramaniam sir will be taking paper 2 part A, company law main chapters. And Harish Krishnan sir will be taking paper 7, which is EAS and SM marathon. And Vikita madam is taking paper 2B, other loss marathon. And Samba sir is going to take paper 4, income tax, separate marathon for 12 hours. GST some 10 hours, separate marathon. And Srinivas Reddy sir, paper 3, costing marathon, approximately we are going to upload for 15 hours. And coming to our another faculty, paper 8 part B, Naga sir is going to take economics marathon. And same Samba sir is going to take paper 8 part A, financial management marathon class. So from the entire Sresta team, we are going to give you all 8 subjects revision marathon classes on YouTube. Now, first thing that you might get a doubt. So what are the things or what are the materials that you are going to use for these marathons? So before that, where you will find this marathon on the YouTube? Very simple. You just open caramharsha. Okay, there is a YouTube channel. So go to that home videos and there is a playlist. Here you will find a playlist separately for November 2022 marathons, revisions, CA, Inter. So in this playlist, you will find all 8 subjects. Now immediately you might get a doubt. Are all 8 subjects uploaded right now? No. By 10th of the September, you may be watching this video. On the date on which it was uploaded, or even maybe later. I don't know. Getting it? By 10th of September, all subjects except auditing, we will upload. Audit subject new marathon, we will upload after September 20. After September 20, audit related subject marathon will be uploaded. And you know what? The all revision classes, entire revision marathons are absolutely in English. Because this rest of is having 1500 plus students across 20 states in India. Not 20, I can say 26 states I think we have covered. Some 2 or 3 northeast states only we have not covered, but 26 states we are having admissions. So obviously, for us, the students across India, we can't use any particular regional language. So we have to stick to English. So entire explanation will be in English. Now, coming to a few questions which you need to understand. Okay. One. We have uploaded in May 2022 exams some video classes, marathon classes. And I'm telling you, the same revision classes with slight modifications we are uploading. Some for few chapters we re-recorded like 1 or 2 chapters wherever there were amendments. But actually speaking, for May attempt and November attempt, the subject, the material, everything is exactly same. Because right now you are in September month 2022, right? If at all you go and check icai website, what is the latest material available? November 2021 edition, October 2021 edition. So typically for May attempt, whatever material we are using, the same material we are going to use for November. I hope you are getting it. And now so we are using a particular material, right, for marathon, where you can download this marathon, where you can download this particular material which is used in the marathon classes. So there is an app in Sresta for SHRESHTA, Sresta for CA and CMA. There is an application called Sresta for CA and CMA. you will find right side, above me, there are two logos. First logo, is there no white color logo? That logo. If you type this name in the Play Store, you will get that logo. Getting it? Only from Android you can download the material. Suppose if you do not have an Android phone, please use somebody's Android phone and download the material. Okay, so in this application, you just download and log in. We have given in the main menu. If you go to the application, there is something called main menu. Just after opening the app, left side top, you will find main menu. Click on that, you will find study material. Inside that, November 2022 and May 2023, there are materials. Please download the materials. PDF copies, please download and keep it with you, so that it will be useful when you're watching the revision class, so that whatever faculty is actually using the material, so it is with you in hand. That's it. If at all you want to have a hard copy, you can buy that hard copy on the same application. But I don't think you require a hard copy, because it's a revision class. So whatever you already have gone through, whatever material you already learned from, please stick to that material. Take our revision classes as a additional guidance, and I'm telling you, you're going to enjoy the subject like anything from see, generally in YouTube you'll find many subject related marathon, but for all 8 subjects at a single place with a particular standard, uniform standard, you'll rarely find. So here our institute's rest of a CA and CMA is giving you that option. Getting it? So I hope you understood what we are going to deliver. Now, what are the topics that we are going to cover approximately, if at all you ask me? So if you look at paper 1, accounting, we are going to upload 2 videos. Approximately both the videos put together will be 20 plus hours. So these are the chapters: fundamentals, incorporation, introduction to accounting standard, frameworks, AS2 and AS12, financial statements of company, bonus, investment accounts, redemption of debentures. That's it. We are not covering anything else from accounts subject. And paper 2A, company law, if you look at, me and Subramani sir, both of us are taking in this case the classes. Like if you look at accounts of companies and dividend, audit and auditors, these 3 chapters related revision I will take. Rest of the chapters, basic, incorporation, share capital, deposits, charges, these chapters revision will be handled by Subramaniam sir. Then other laws, all these topics are being covered by Vikita madam. And paper 3 costing, all these topics, 100% of all the chapters are being covered by Srinivas Reddy sir. Okay. Then part 2, see, costing video will be uploaded in 2 parts. Both together will be 15 to 16 hours. Then paper 4A, income tax, we are going to cover 5 heads of income, clubbing provision, set up and carry forward, chapter 6A, return of income, TDS and TCS. And GST, we are going to cover almost all the chapters. Then advanced accounts, introduction, few accounting standards, amalgamation, reconstruction, liquidation, partnership, consolidation. All these topics we are going to cover as part of revision. And accounting, advanced accounting is also being uploaded in 2 parts. Accounts, you will have 2 parts videos. Advanced accounts, you will have 2 parts videos. Sorry. Company you will have 2 parts. Sorry. Costing, you will have 2 parts videos. Then coming to auditing, ignore auditing right now, because I have not yet uploaded the marathon. Then paper 8A, financial management, these chapters. Paper 8B, these chapters. Even paper 7A, paper 7B also, we are going to upload all the subjects. I told you where you will find all these videos. You will find that in the Play Store. Open caramharsha, open playlist. Inside that you will find November first playlist, November 2022 marathon. So in that playlist you will find all the 8 subjects video. By the way, you will find all these videos by 10th September maximum. Getting it? So actually I'm recording this video on 4th September. So right now after this video I'll be uploading the marathon videos. And this video will be a common video in all in all marathon videos, whatever I'm going to upload, 12 hours videos. In all the videos, this video right now whatever I'm recording will be a common video, so that every time whoever is watching a new revision class will not miss all this. Now one more important thing. Now who should not watch this marathon class? If at all you are a first time learner. Now many people will ask me, sir, is it useful for a first time learner? No. This is not for first time learners at all. This is for those who are going to write exam. Okay. Those who are just about to go and write the exam. No, for them only this is. See, a subject is completely covered in 20 hours. 100 marks paper is hardly being covered in 20-24 hours. A regular course will be 120-150 hours. Imagine we are reducing 1/5 time. It's a revision. First of all, understand. Revision is useful. Revision class will be useful only for those who already prepared the subject once. You may have prepared in self-preparation method, or you may have taken coaching. That doesn't matter. That doesn't matter. But those who already prepared ones, only for them this is useful. For others, strictly I'm saying not at all useful. Because don't waste your time. But I'm telling you, those who already have gone through books, who already wrote one or two attempts, getting it, or who are first timers, maybe you are first time you're writing in November, but you already gone through the coaching. For you, these marathons are going to be a best, thing, in your preparation. Definitely, after watching this marathon, you will definitely get a new look on the subject, new idea, new perspective on the subject, so that within next 1.5 month, you can plan your preparation perfectly. That's it. Okay. Take care. Have a nice time. So continue the classes. Getting it? So this is an intro video. First I'll upload this normally. Then again I'll upload this as part of the revision videos. Getting it? So continue. Thank you. Have a nice time. Bye bye. So hi guys. Welcome to the marathon lectures from Sreshta for CA and CMA by Sreshta faculties. Okay. So right now you may be watching the accounting or auditing or law, whatever the subject. Out of 8 subjects, you may be watching any subject. I don't know. This is just an introduction video from me. Now, what important thing that you need to do right now is don't directly skip to the subject. Don't directly fast forward the video. Please watch this video without any interruption. Even when you're watching the marathon, we have given below the description timestamps. If you click on a particular timestamp, you will go to that particular chapter. But what I sincerely advise you, please watch this entire marathon in the same order. Suppose we uploaded 12th hour, don't directly go to the 5th hour and start watching. Watch in the same order, because there is a structure that we follow so that you get the best understanding. Getting it? And further, after this 1 or 2 minutes, getting it, there is my another video which is merged, which is already merged. Please watch that also, because that is an instruction to be followed while watching the marathon, what material to be used, all that also I covered. So the initial 5-7 minutes of my content, please do not skip. Please do not skip. So you're going to get some guidance on how to watch this marathon. Then you can directly start with the subject. That's it. Getting it? So take care. Continue watching. And please do not watch at higher playback speed. Some students think watching at higher speed, 1.5 times, 2 times the speed, dangerous approach. See, your objective of listening to the marathon class is not to listen, but to learn something. Learning, you should not make it fast. If at all we can cover the video in 5 hours, we would have covered in 5 hours, no? See, suppose I uploaded 10 hours marathon. If at all we can cover it in 5 hours, we would have taken it in 5 hours, right? Why the hell we take 10 hours? Why the hell we take 20 hours? So if at all you're watching at 2 times the speed, 1.5 times speed, you are not actually learning. You're only listening to the words. You are not learning. You're not analyzing. Analysis will not transmit. Understanding, you'll not get the emotion exactly. Whatever the emotion, with whatever the emotion or intensity the faculty is teaching, if at all you're watching at higher speed, higher playback speed, you will never get that intensity. You will never get that connection. You just listen and leave. See, this is the reason why students, in spite repeat many a times, they still do not recollect. They still do not understand the content. Some students say, sir, some students may be faster in learning. If at all you are very fast in learning, try to listen the song at 1.5 times speed. Take any one particular song, try to listen at a higher speed. See whether you are connecting or not to it. You are listening, no? Music is audible, song words are audible, vocals and music, everything is audible. But why you are unable to connect? Connection is required with the subject. In order to establish that connection, please listen to the subject at standard speed. Even though you may be very smart, you may be very intelligent, just try that intelligence while listening to the songs also. Listen to a song at 2 times the speed. Emotion is important. In anything, any work you do, emotional connection is required. So please watch the entire content at standard speed. And I'm telling you, if at all you want to try 1 hour, if 1 hour you watch at standard speed, another 1 hour you watch at higher speed, you check back yourself where you are learning better. I think that is the best judge, that is the best decision. Just try that and then do. Because many people in YouTube are misguiding students saying, listen at higher speed, revise more number. No, that's not. Listen at standard speed. Your revision, number of times revision will naturally reduce. That's it. So continue watching the video. Thank you. Have a nice time. Bye-bye.
Hello soldiers, welcome to Advanced Accounting Marathon. Myself is Satya Raju. practicing chartered accountant out of my profession, faculty for accounting and advanced accounting, as well as faculty for financial reporting at CA final level. Without wasting much time, let us directly entering into the topic. But before directly entering into the topic, let me discuss two important issues. One is, sir, which resources we are going to follow for the entire marathon? Only two resources. One is my power notes. Another one is my main material. This is my main material. This is my power notes. Sir, where we can get it, these two resources? Don't worry, in the description, I will provide a link. You can directly click that link. You can download such material. One more. Sir, this marathon is useful to whom? This is useful exclusively for the students who already completed their regular course. I mean, this they can use it as a pure revision. This may not be suitable for the persons who first time they are watching their lectures, or they are not yet completed the regular course. It may not be suitable. The reason is we are trying to cover the major topics in a very short span. So a lot of issues we are going to discuss. And one more, sir, is it marathon try to cover all the entire 100% syllabus? No, it will try to cover as much as possible. And students where really feel difficult, a lot of technicalities are involved and certain gaps are there, I am taking such topics here. I can put like this. Definitely, I will try to cover in between 60 to 75% of the syllabus. That's not a small thing, guys. 60 to 75% of the syllabus means you should need to calculate such 60 to 75% on 120 marks, not on 100 marks, because the paper will be given for 120 marks, right, in the examination. So the total they are giving 6 questions, 6 into 20, which is equal to 120 marks. Out of the 6 questions, question number 1 is compulsory, which is for 20 marks. From the remaining 5 questions, that is from question number 2 to question number 6, from the remaining 5 questions, you can write any of the 4 questions. That is here 20 plus 4 multiply with 20, total it will be for 100 marks. But the syllabus which is designed for 120 marks. Am I right? So that's why you can calculate such 60 to 70% on the 120. It may be the approximately 80 marks. That means 80% of your questions you need to attempt. I'm trying to cover through this marathon. Okay, fine. Sir, first let me check with the blueprint given as per the ICAI. Why I'm discussing this blueprint? The questions, sir, which chapters have the more weightage, which chapters have the less weightage? Most of the students just regularly they are making text to me. I'm going to explain such a weightage through the blueprint. Sir, this blueprint is not given by me, not given by any private organization. This blueprint is actually released by the ICAI, Institute of Chartered Accountants of India. Like this, you can get the blueprint for each and every subject. There, if you want, you can download such blueprint document with the BOS knowledge portal. A separate link is there from where you can easily download it. Okay, coming to our advanced accounting, the entire syllabus is broadly categorized into 4 categories. Category 1, 2, 3, 4. Total 4 categories are there. Number 1, application of accounting standards. So here I told you question number 1 is compulsory, right? The question should be came from this category only. Sir, this application of accounting standards will try to cover total 13 accounting standards. In group 1, you may come across very few accounting standards, like I think so 7 to 8 accounting standards you may come across. But here in group 2, the syllabus of accounting standards is huge. Sir, what are the different types of accounting standards covered here, sir? AS4, 5, 7, 9, 14, 17, 18, 19, 20, 22, 24, 26, 29. Out of 13 accounting standards, I will try to cover 7 accounting standards. 7 accounting standards. Where 6 I will cover directly And the seventh accounting standards I will try to cover indirectly with another chapter. Sir, which accounting standards you are trying to cover, sir? 4 I will cover, 5, 7, 9. Then 20, 22. Here 4 plus 2, 6. And AS 14 I'll try to cover along with the chapter amalgamation. That's why I told total 7 accounting standards. Exclusive coverage will be there with respect to these 7 accounting standards. If time permits for me, then I'll try to cover others. Otherwise, I'll simply ignore. Next, come to category 2. Category 2 is with respect to company accounts. Here, there again, two subcategories are there, category A and category B. Category A is related to special aspects of the company accounts. That is like employee stock option plan and buyback of equity shares and equity shares with differential rights. Actually, as per the ICAI, those are two different topics. But for our discussion, in general, we are going to discuss buyback and equity shares with differential rights as a single topic, because equity shares with differential rights is very small topic. Okay, these are related to special aspects. And the other issues are amalgamation, internal reconstruction, liquidation of companies. So the name of the topic is actually reconstruction and liquidation. This is the name of the topic as per our ICA material, reconstruction and liquidation, which is the topic. So this is with respect to category B. Sir, out of category A and category B, which topics you are trying to cover, sir? Sir, I will not cover category A. I will try to cover each and every topic of category B here, because the topic ESOP and buyback are much more easy. So any student can easily understand such topics. So that is the reason first I don't want to take up the category A, but amalgamation, internal reconstruction, liquidation of companies are little bit technical. We are trying to cover each and every issue under category B. Next, coming to category 3, there are two topics exist. One is banking company and another one is non-banking finance companies. Sir, both the chapters are format based chapters, and certain prudential regulations are the provisions with respect to the Banking Regulation Act will be there. Those two chapters are completely depending upon such acts. Sir, whether we will try to cover such issues, sir? No, I didn't touch anything related to category 3 for the time being, because one more much more important category is there, which is category 4, which is related to consolidated financial statements and partnership accounts, where we will give our entire focus on such chapters. And one more thing, sir, why you are ignoring such topics, sir? Now, if I tell you the percentage of the marks, then you can clearly understand why I'm not touching that immaterial topics first, why I'm touching the other topics. You can easily understand. Sir, application of accounting standards will try to cover 20 to 26%. It's 20 to 26% of the marks means, you know one thing, it will be approximately 25 to 30 marks will coming from accounting standards. Company accounts total will try to cover 35 to 40 marks. 35 to 40 marks. Banking company will try to, banking and NBFC will try to cover 15 to 20 marks. And the last category, consolidated financial statements and partnership accounts, will try to cover 30 to 35 marks. Now, out of which I will take up more than 50%, like 60 to 70% of accounting standards. 60 to 70% of accounting standards. Here also, category B is very bigger category, well, very big while compared to category A. Here also we will try to cover 75 to 80% approximately I can put in category number 2. Category number 3, I completely ignoring. The reason is which only for 15 to 20 marks, I didn't touch at all. Category 4, completely I will take up. So total, if you check here, approximately 30 marks. Here approximately 25 marks. 35 plus 25, that is 60. 60 plus here approximately 20 marks, 80. That's what I promised to you. 80% of your question, 80% of marks you need to be attempted. I'm trying to going to cover through this marathon. Okay, so this is the plan of action. I clearly intimated my plan at the beginning of the session itself. That's it, guys. Now, let me directly entering into the topic with the main accounting standard, which is with accounting standard 20, guys. So first, so then how you will try to cover the order of the topics as well. I will tell you here. First, I will try to cover the accounting standards. Total, I told you now 7 accounting standards I'm going to try to cover. 6 I will first try to cover, and the other accounting standard amalgamation will directly start with the chapter amalgamation, followed by internal reconstruction, followed by liquidation of companies. Then I'll start with partnership accounts, then close the topic with consolidated financial statements. This is the order we are going to follow for the entire marathon. So first, out of all the accounting standards, we will start with our marathon is 20. Let me directly open accounting standard 20, earnings per share. Sir, before entering directly into accounting standard 20, first let us have discussion with respect to structure of an accounting standard. How we are going to learn any accounting standard topic. The accounting standard topic or the accounting standard itself is drafted by the accounting standard board of ICAI in this particular procedure. That means first they are started with objective. Objective means the reason for introduction of this standard, why this accounting standard is introduced, or from this accounting standard what they want to tell to the industry. Definitions, different technical terms used in such accounting standard. To appreciate the entire accounting standard in proper way, we need to understand the definitions of such technical terms they used. Scope, another name for the scope is applicability. Is this accounting standard is applicable to all type of industries? Is this part of the accounting standard is applicable to any situations, or is this accounting standard is non-applicable in any particular circumstances? All such things we are going to discuss through scope paragraph. Then these are the aspects of the accounting standards. Aspects of the accounting standard means the any accounting standard you can take, at least it should try to cover out of the below aspects, at least it will try to cover one aspect. It may try to cover regarding the measurement, recognition, presentation, disclosure. I'll give certain examples. For example, measurement concept is there, right? Sir, measurement, the AS20 itself is one of the objectives to try to cover the measurement aspect. At which value the earning per share should be measured. Or you may already come across the group 1 accounting standard like AS2 inventory valuation is based on the measurement concept. Recognition, AS9 revenue recognition standard is there. When you are going to recognize the revenue into your books of accounts. In case of AS7 construction of contracts, in case the books of the contractor, when he should need to recognize the revenue from such contract, that is with respect to the recognition aspect. Presentation, how you should need to be presented a specific aspect into the financial statements. Again, AS20 will also going to discuss about the presentation aspect, how the earning price per share is going to be presented. Is it okay, guys? Maybe the provisions, contingent liabilities, contingent assets, how it should be going to be presented in the financials. So one of the aspect of accounting standard is presentation as well. Disclosures, sir, as per the different accounting standards, we are going to disclose some other information in the notes to accounts. Various accounting standards are there. AS26, that is intangible assets. What are the disclosure you should need to provide as per AS26? Or maybe AS18 related party disclosures is there. What are the disclosures we are going to provide as per AS18? I mean, out of the below aspects, maybe all the aspects may be covered by each and every accounting standard, or at least it should be covered by one accounting standard. That is depending upon standard to standard. One accounting standard may try to cover more than one aspect, or certain accounting standards will cover at least one aspect. Do you understand? This is the structure of the accounting standard. Now, coming to AS20, what is the objective of accounting standard 20? The title of AS20 is, earnings per share. Earnings per share. To put it simply, the title itself clearly tells to us how much earnings we can attributable to each and every equity share. Here, share means equity share. For each and every equity shareholder, how much earnings he is enjoying in his point of view. That is the meaning of the title. Am I right? Now, what is the objective of introduction of this standard, sir? There are three primary objectives, sir. There are three primary objectives. One is determination and presentation of EPS. Determination means measurement. I told you now how to measure this EPS. That is one of the objective. And a presentation after measuring such EPS, where I should need to present. These are the two major objectives. One is measurement, another one is presentation of EPS related to basic EPS, related to diluted EPS. What is the meaning of basic EPS? What is the meaning of diluted EPS? We are going to try to cover with the below provisions. Okay, for the time being, I'm not discussing anything related to basic and diluted EPS. So simply the objective is measurement as well as presentation. I will give a small hint here, guys, regarding the presentation of EPS, where we are going to present such EPS in the financial statements, sir, in the statement of profit and loss account. On the face of the statement of P&L, as a last line item, we are going to present both basic and diluted EPS in the financial statements. EPS was not going to be presented in the balance sheet. EPS is going to be presented in the statement of P&L. In Group 1 Finance Statements of Companies chapter, you may already come across the format of Schedule 3 with respect to statement of P&L, where you can see clearly the EPS presentation under the last line item. If you want, I'll show here just a moment, which is the statement of profit and loss as per the Schedule 3. If you check here as the last final line item here, earnings per equity share, both basic and diluted, we are going to be presented. So the same issue is also discussed here as well. That is the first objective. And the second objective is, the objective of S20 is also for the purpose of inter and intra-firm comparison. Inter and intra-firm comparison. Sir, what is the meaning of inter and intra-firm comparison? For example, my company is a ROS Limited. I calculated my EPS for the current year, which is 3 rupees per share. Another company is there, which is X Limited. Another company is there, which is X Limited. They calculated their EPS, which is 4 rupees per share. Inter comparison means my company EPS is going to be compared with another company EPS within the same industry. Now, which company is performing in that better manner in such industry? X Limited is performing in the better manner while compared with the Raju Limited. That is for inter comparison, this EPS is highly useful. Next, what is the meaning of intra comparison, sir? Intra comparison means my company current year information is going to compare with my company previous year information. Sir, previous year EPS is 2 rupees per share for ROS Limited, and the current year EPS is 3 rupees per share. Now, while compared with the previous year, current year EPS is enhanced like anything. So, which is a positive note for the company point of view, or which is a positive note in equity shareholders point of view as well. Such inter and intra-firm comparison is possible through presentation of EPS in the financial statements only. And one more important objective I'm revealing here, concentrate. EPS is highly useful in deriving MPS. In calculation of market price per share, EPS plays a vital role. How, sir? Do you know the PE ratio? You might listen the PE ratio in your financial management topic. PE ratio, or this is also call it as PE multiple. PE multiple. P here, P stands for market price per share. E stands for earnings price per share. MPS divided by EPS is nothing but PE multiple. For example, if the PE multiple came it as 5, what is the meaning of that? You know, what is the meaning of that? No. For example, if MPS is 500 rupees and earnings price per share, which is 100 rupees, then PE ratio will come it as a 5. PE multiple will come it as a 5. What is the meaning of that, sir? Now, the market price will be 5 times of their earnings. The market price of that particular share will be 5 times of their earnings. That is the meaning of PE multiple. Now, if you make the cross multiplication, PE ratio into EPS, if you know the earning price per share and if you know the PE multiple, then if you can cross multiply one by one, then automatically you can derive the market price per share. So one of the method of calculation of market price per share is by using EPS in multiplication with the PE ratio, you can easily derive market price. Do you understand? So total 3 objectives are there. One is determination and presentation of EPS. and another one is inter and intra-firm comparison, and another one is for the purpose of calculation of MPS EPS plays vital role. This is with respect to objective. Next, sir, definition. Actually, in this accounting standard, we are try to cover the definition after explaining the scope. So that's why first let me explain the scope. After that, I will explain things related to definition. Now come to the scope. Come to the scope. Sir, basic EPS. Here, the standard objective is presentation and determination of two different EPS. One is basic EPS and diluted EPS. Presentation of basic EPS is a mandate for all entities. All entities. But presentation of diluted, that is measurement and presentation of diluted EPS is mandatory only for non-SMC and level 1. Non-SMC means in case of companies at the time of applicability of accounting standards, for the purpose of applicability of accounting standards, companies are divided into two types. One is non-SMC, another one is SMC. Non-SMC means big companies. SMC means small and medium sized companies. Level 1 enterprises, other than corporate entities, total 4 levels are there. Level 1, level 2, level 3, level 4. So earlier these are only 3 levels are there. Right now they are broadly categorized into 4 levels. Level 1 is the bigger enterprises. Level 2, level 3, level 4 are MSME, medium and small and medium, small and micro enterprises. Level 1 is a big enterprises. This is other than corporate, that is non-corporate entities. That means diluted EPS presentation is only applicable with respect to non-SMC as well as level 1 entities only. For the remaining all enterprises, no need to present the diluted EPS. They can simply measure the basic EPS as well as they can simply present such basic EPS in their statement of P&L. Next. Sir, definition. Here the definition and measurement are both are same, because if I reveal the measurement, automatically I am going to define earnings per share itself. So that's why I'm directly start with measurement. Measurement first, which measurement we are try to cover, sir? Basic EPS we are try to measure. Sir, basic EPS is equal to, I mean simply earnings available to each and every equity shareholder. Earnings available to each and every equity shareholder is nothing but the total earnings available to equity shareholders, EAESH. The full form is earnings available or attributable to equity shareholder. Once you find out the earnings available to equity shareholders, it should be multiplied with, it should be divided with number of equity shares. Number of equity shares. But what are such number? Is it I can consider the number at the beginning? I mean, we are going to calculate EPS as on the date of the financial reporting date. I mean, as on the last date of the financial reporting period. In general, we are going to calculate the EPS as on 31st March. Now, can I consider the number of equity shares existing as on 31st March? Or can I consider the number of equity shares at the beginning? Or can I consider the on average? I should need to consider the average number of equity shares. Such average is also weighted average. Weighted average number of equity shares, which is nothing but VANS. So the formula for basic EPS is equal to earnings available to equity shareholders divided by weighted average number of equity shares. Now, out of the entire AS 20 paragraphs, you know, each and every accounting standard is going to divide into different paragraphs. Out of the entire paragraphs related to numerator, that is earnings available to equity shareholders, only 2 paragraphs are going to discuss. Remaining all paragraphs are going to discuss about denominator factor, that is with respect to weighted average number of equity shares only. First, let me discuss what is the meaning of earnings available to equity shareholders. Please come below, all of you. Earnings available to equity shareholders. Sir, in point of view of equity shareholders, how much earnings are available? That is the meaning of earnings available to equity shareholders. That means current year we are getting certain profit. Out of such profit, first you should need to make payment to the taxation authority. Then you will get profit after tax. From profit after tax, you should need to make payment for preference dividend. Sir, out of the profits, if you are making transfer certain amount for general reserve, Out of the profits, if you are transferring certain amounts for the purpose of declaration of dividend for the equity shareholders, all are again belongs to the equity shareholders funds only. Am I right? So that's why related to preference shareholders, how much we are going to make a payment, you should need to the reduced while getting the earnings available to equity shareholders. That's why from profit after tax, you should need to reduce preference dividend. Preference dividend. Sir, whenever you are paying the dividend, dividend distribution tax is applicable. But here two scenarios are there as per the recent amendment. Which is the recent amendment, guys? Please all of you concentrate. What is that recent amendment, sir? Earlier situation, before coming to the amendment, I am telling you. There is one section in the Income Tax Act 1961, which is section 115O, which is exclusively discussed about dividend distribution tax. Whenever a company declared and distributed such dividend among the equity shareholders on behalf of the equity shareholders, the company itself reduced the dividend distribution tax and paid the remaining amount. Now such dividend distribution tax is ultimately paid by the company to the government. This is for the purpose of administrating issue. On behalf of collecting money from the each and every equity shareholder, it is better to collect tax by the government directly from the company, as like TDS. That is the intention of insertion of the provision with respect to DDT. That's why the dividend was already taxed in the hands of the company. That's why at the time of receipt of dividend in the hands of the shareholder, which is exempted under section 10 subsection 34, which is not the current scenario, which is the earlier scenario. That means earlier, at the time of paying dividend by the company to the shareholder, it was already taxable in the hands of the company under the section 1154 as per the dividend distribution tax rules, DDT. So in the hands of the shareholder or in the hands of the investor, which is exempted under section 1034. But as per the recent amendment, that is as per Finance Act 2021, yes, which is as per Finance Act 2021, DDT was abolished by the central government. Actually, DDT was abolished. Now there is a no concept of dividend distribution tax. If the dividend is not taxed in the hands of the company, then at the time of receipt of such dividend by the shareholder from the company, it was taxable in the hands of the shareholders or the investors. That's why 1034 exemption is not available right now, because such DDT concept is not applicable. That's why which is taxable in the hands of the investor. That is the current scenario. That means in the present scenario, dividend distribution tax is not applicable. But why still I am telling, in examination problem, if dividend distribution tax is given, then you should need to calculate dividend distribution tax on preference dividend as well to know the earnings available to equity shareholders. If such dividend distribution tax itself is not given in the examination problem, you can simply ignore. From profit after tax, you can simply reduce the preference dividend, then you will get the earnings available to equity shareholders. But to be frankly speaking, right now dividend distribution tax concept is not at all in applicable mode. The entire dividend which is received by the shareholder or the investor is taxable in his hands only. Section 1034 exemption is not applicable after amendment. Okay, next. Sir, one more doubt. You are telling that we can directly consider the profit after tax. Can I consider the abnormal profits here? Abnormal profits means one major fire accident occurred. The loss is 5 lakhs. But I get the claim with respect to that fire accident, I got in and around 10 lakhs. Now, which is an abnormal gain, or maybe abnormal losses, certain theft happened, sir, certain loss I got. Can I consider such all abnormal items in calculation of such profit after tax? Yes, you can absolutely consider along with the normal items, you can absolutely consider the abnormal items as well. That is, every income and expenditure, including abnormal items also, you can try to consider in such profit after tax. Next, sir, can I consider extraordinary items? Do you know the difference between extraordinary items and ordinary items? We are trying to cover through accounting standard 5, guys. Extraordinary activities are those activities which are clearly distinct from the ordinary activities. Yes, at this point of time, I can tell you only that part only. To put it simply, extraordinary activities means which in generally not occurred in the normal course of business activities, which can be directly identifiable. Maybe floods came, huge loss occurred. Maybe the pandemic situation was there, huge loss occurred. Maybe certain properties are attached by the government, yes, which is an extraordinary activity. Maybe we received certain government grants, but due to non-violation of such conditions, but due to violation of such conditions, we need to refund such government grant, which is also an extraordinary item. Sir, in detailed discussion will be there in accounting standard 5. So for the time being, I'm telling you, sir, can I consider the extraordinary items in calculation of such profit after tax? Absolutely. And one more important issue, the third important issue I'm going to discuss with respect to earnings available to equity shareholders. Sir, if the preference shares are the non-cumulative preference shares, whenever dividend is declared by the company with respect to such non-cumulative preference shares, then only I need to reduce. Then only I need to reduce the preference dividend to get the earnings available to equity shareholders. But if the preference shares are the cumulative preference shares, irrespective of the declaration, whether the company declared in the particular year or not, you can reduce the preference dividend for the purpose of calculation of earnings available to equity shareholders. One more time I'm repeating, sir, when actually there is necessary to reduce the preference dividend in evaluation of earnings available to equity shareholders, if the preference dividend is declared. If the company is not declared, then the entire profits are available for equity shareholders only. That's why it is clearly given that if the preference shares are the non-cumulative preference shares, non-cumulative preference shares means if a particular year company is unable to declare the dividend, then preference shareholders will not get any dividend in the future. That's why if the company declared the dividend, then only we need to reduce the preference dividend in evaluation of earnings available to equity shareholders. That's why it is clearly given that if declare, we can reduce in evaluation of earnings available to equity shareholders. But if such preference shares are cumulative preference shares, cumulative preference shares means if the company is having insufficient profits, that's why company is unable to declare in the current year, then the year in which the company is having the sufficient profits should need to compensate along with that year dividend, and the previous year dividends as well. That is nothing but cumulative preference shares. So that's why it is clearly given that in case of cumulative preference shares, irrespective of the declaration of the dividend, that means in the current year company attained the losses, but still you can reduce the preference dividend. In calculation of earnings available to equity shareholders. I'll give a small example here. Let us assume in the year 2021, we are getting a losses. Now in calculation of EPS, while evaluation of earnings available to equity shareholders, you can reduce the preference dividend, you can evaluate earnings available to equity shareholders, then you can calculate EPS. Now coming to the year 21-22, company is getting profits. Now if the company is getting profits, company should need to pay the preference dividend both for the year 2021, previous year, as well as 21-22. But now at the time of evaluation of EPS in the year 21-22, for calculation of earnings available to equity shareholders, I should need to reduce 21-22 dividend only. The reason is 2021 dividend I already reduced in the year 2021. Sir, declaration of the dividend is completely irrelevant in case of cumulative preference shares. Whether you declared or not, I don't mind, sir. I mean, in the current year, that current year dividend, for the purpose of calculation of earnings available to equity shareholders, I will reduce whether you declared or not. That's why I clearly told that irrespective of the declaration, in case of cumulative preference shares, we can reduce the preference dividend. But if the preference shares are the non-cumulative preference shares, the company declared, then only I can reduce. Okay. So total 3 important issues we discussed in calculation of earnings available to equity shareholders. The first important issue, from profit after tax, we can reduce preference dividend. And if DDT is applicable, then we can reduce. Otherwise, you can simply ignore. Then you will get earnings available to equity shareholders. Sir, in such profit after tax, can I consider abnormal items? Absolutely. Can I consider extraordinary items? Absolutely. with respect to the preference dividend, if the existing preference shares are non-cumulative preference shares, if preference dividend declared, then only we can reduce. If the existing preference shares are the cumulative preference shares, whether the company is declared the preference dividend or not, you can reduce the preference dividend for evaluation of earnings available to equity shareholders. That's it, guys. Now come to weights, weighted average number of equity shares. Weighted average number of equity shares. Now, sir, in the intro of this accounting standard, I told you average number of equity shares means we are not considering the equity shares at the beginning. We are not considering the equity shares at the ending. On average, how many number of equity shares we are going to continue. Such name is nothing but weighted average number of equity shares. Such number is nothing but weighted average number of equity shares. Now, about the weight, what component you can provide it as a weights are here. I'm going to explain things related to weight through different cases. Totally here I'm going to take 3 cases, guys. Case number 1, case number 2, case number 3. Please concentrate. According to cases only, I developed the illustration. Sir, I am in the year 2021. The financial year is 2021. Please, all of you consider my highlighted one only. As on 1/4/2020, at the beginning of the year, we are having 1 lakh equity shares. We are having 1 lakh equity shares. Sir, this information is not irrelevant for the time being. Something paid up value, something I given, that is not relevant for the time being, but relevant face value is 10 rupees. Just let us assume for the case number 1, face value is 10 rupees and all the equity shares are fully paid up. Case number 1, all equity shares are fully paid up. Let us assume this. So that's why paid up value is irrelevant for me. At the beginning 1/4/2020, I have 1 lakh equity shares, and 1/10/2020, after 6 months, the company issued 50,000 equity shares. And come to the last one, as on 31st March 2021, the total number of equity shares outstanding are 1,50,000. Sir, what about this 40,000 buyback, sir? For case number 1, there is no buyback. For case number 1, there is no buyback. Let us assume. Now, all of you, please concentrate. Only total 2 components are there. Beginning 1 lakh. After 6 months, I issued 50,000. At the ending, I have 1,50,000 equity shares. Now I need to calculate weighted average number of equity shares. Here the weight is period value weight. Weight is period value weight. How I should need to adopt the period value weight? Sir, at the beginning, how many number of equity shares you have? Excuse me. At the beginning, how many number of equity shares you have? 1 lakh. Such 1 lakh equity shares are there throughout the 12 months, right? Are there throughout the 12 months, because beginning 1 lakh, at the ending of 1,50,000, such 1 lakh is there. That's why the entire 1 lakh equity shares out of the 12 months, they're outstanding for the entire 12 months. That's why the weight I am assigning here is 12/12. Now coming to the 50,000 equity shares are not outstanding entire 12 months. Out of the 12 months, they're outstanding for 6 months only. That's why for 50,000 equity shares, I'm assigning only 6 months. That is 6/12 is the weight. Now I calculated weighted average number of equity shares. I got 1,25,000. This is method number 1. In another method also, the same weighted average number of equity shares you can calculate. That is, at the beginning, 1 lakh. Up to the date of next issue, how many number of months outstanding? 6 months. That is 1 lakh into 6/12. Plus, after issue of 50,000 equity shares, the number of equity shares will become 1 lakh plus 50,000, which is 1,50,000. Now 1,50,000, these 1,50,000 equity shares are outstanding for another 6 months period. That's why here I multiplied with 6/12. Here also I multiplied with 6/12. But here only 1 lakh, here 1,50,000. I got the same number of equity shares. In any method you can adopt for the purpose of calculation of weighted average number of equity shares. Either you can follow the method number 1 or method number 2. That is up to you. I'll add one more component here. What is that? As on 1/1/2021, company made a buyback of equity shares to the extent of 40,000 shares. Then how to calculate the weighted average number of equity shares? Please, all of you, concentrate here. Let us adopt method number 2 after adding this buyback. Beginning, we have 1 lakh equity share. from 1/4/2020 to 1/10/2020, 6 months, 1 lakh into 6 by 12 plus after issue of 50,000 equity shares, the number of equity shares will become 1,50,000. So 1,50,000 into up to the date of buyback. How many number of months are there? From 1st October to 1st January, 3 months. So 1,50,000 into 3 by 12 is the next component. Once buyback happened, 1 lakh 50 minus 40, it will become 1 lakh 10,000. These 1 lakh 10,000 equity shares are outstanding only for the remaining 3 months. So that's why 1 lakh 10,000 into 3 by 12. So then we are getting 1 lakh 15,000. I mean, whenever buyback is exist, then you need to reduce. Whenever issue is there, you need to add the number of equity shares. For that purpose only I added here. And the last case, guys, please all of you concentrate. Here I'm complicating the little bit. Now, for case number 1 and case number 2, our assumption is all the equity shares are fully paid up, right? Now, I am giving the newly issued equity shares at partly paid up. The face value is 10 rupees and the paid up value is only 5 rupees. But the existing equity shares paid up value is 10 rupees and the buyback is also 10 rupees. Only the newly issued equity shares are partly paid up. Out of 10 rupees face value, only 5 rupees is paid up value. Then how to calculate the weighted average number of equity shares? Now my question is, if you want to try to consider this entire 50,000 equity shares in calculation of gains, they are also getting the equal earnings as like 1 lakh equity shareholders. But that is not justifiable basis because 1 lakh equity shareholder are paid fully, but these 50,000 equity shares are only paid partly. In dividend calculation, I mean, for the purpose of payment of dividend itself, we are paying dividend on the basis of paid up value. That's why at the time of attributable at the time of attributing earnings as well, we should attribute the entire earnings available to equity shareholders among the equity shareholders by considering the paid up value as well. Apart from the period value weight, you should try to consider the paid up value weight as well. That means here weight means total two components. One is period weight, another one is paid up value weight. I mean, out of this 50,000 equity shares, I should try to consider 25,000 only because 50,000 into 5 by 10 means, which is nothing but 25,000. You can tell that 50,000 partly paid up equity shares or 25,000 fully paid up equity shares. 50,000 partly paid up equity shares as equal to the 25,000 fully paid up equity shares. So to consider that paid up value weight, now the measurement of veins will look like this. Now, please all of you concentrate. Initially, we have 1 lakh equity shares are there. 1 lakh period value weight. Sir, period value. So first let me work out the paid up value weight. Sir, face value is 10 rupees and the paid up value is also 10 rupees. That's why paid up value weight is 10 by 10. Next, come to period value weight. From 1/4/2020 to 1/10/2020, how many number of months are there? 6 months into 6 by 12. Am I right? Plus, next, you are issuing 50,000 equity shares, right? Now total number of equity shares are 1,50,000. But out of that, 1 lakh equity shares are fully paid up. 1 lakh into 10 by 10. And the 50,000 equity shares are partly paid up. 50,000 into 5 by 10. We should need to work out like this because 1 lakh are fully paid up and 50,000 are partly paid up. Now from the date of issue to the next date of buyback, how many number of months are there? 3 months. That's why here 3 by 12, here 3 by 12. Period value weight same. From the beginning to the, from that particular date to the next issue or next buyback, how many number of months you should need to consider. Next, after completion of the buyback, let us assume this buyback happened from the opening outstanding number of equity shares. Now 1 lakh minus 40,000, these equity shares will become 60,000. These are fully paid up into 10 by 10. Remaining number of months, how many number of months after buyback? Into 3 by 12. Now these 50,000 equity shares are partly paid up. Remaining number of months are 3 by 12. This is the computation of veins. Sir, what you are trying to telling from these different cases, sir? I will try to tell you only one thing. Veins is equal to equity shares outstanding into period value weight into paid up value weight. Period value weight into paid up value weight. Here period value weight is equal to outstanding months divided by 12 months. In the current year 12 months, how many number of months such shares are outstanding, which is nothing but period value weight. Paid up value weight is nothing but paid up value divided by face value. Paid up value divided by face value. Wherever you see paid up value divided by face value, paid up value divided by face value, paid up value divided by face value is the formula for paid up value weight. Sir, uh, to understand the better manner the paid up value weight, here I took another small illustration. This illustration is with respect to the paid up value weight, guys. Please all of you concentrate, because so many people may wrongly understand the paid up value weight component. So for that, to explain in the better manner, just I'm developing a small illustration. Let us assume the face value of the share is 100 rupees and the issue price of that particular share is 130, out of which 100 is the face value, 30 rupees is the premium. Now, amount collected from each and every shareholder is 70 rupees. Let us assume how much amount collected, 70 rupees, out of which 40 rupees is face value and the 30 rupees premium is there. In general, premium is collected along with allotment. So that's why that 40 rupees is towards face value and 30 rupees is towards premium. Now my question is, what is the paid up value weight here, sir? Sir, is it paid up value weight is 70 by 100, you thought? Because paid up value is 70 and the face value is 100. That is wrong. That is not the paid up value. I clearly already established here. Here 70 by 100 is not the paid up value. That is wrong. Paid up value means out of the face value, how much they paid. Out of 100, how much they paid? 40 only they paid. That's why paid up value weight means 40 by 100. That's why I clearly told you paid up value weight is nothing but paid up value towards face value divided by face value. Paid up value towards face value is 40. The total paid up value is 70. But out of such 70 towards premium is 30, towards face value is 40. I should only consider the paid up value towards face value divided by face value. That is the correct calculation of the paid up value weight. Do you understand? Sir, uh, the calculation or the measurement part of earnings available to equity shareholders over and weighted average number of equity shares over. The crux of EA, ESH and VANs I clearly established. So still the discussion is not yet over. We will try to consider certain other provisions in calculation of VANs. I already told you regarding the numerator, only 2 paragraphs they discussed, but regarding the denominator, much more paragraphs are there. So now, what is the next paragraph or the next issue with respect to weighted average number of equity shares, sir? Effective date. What is the meaning of effective date? When such equity shares we can assume to be effective in calculation of VANs. I mean, in calculation of the period value weight, outstanding number of months divided by 12 months is the formula. From which date such equity shares are coming into effect, I can assume. For that purpose, effective date concept is inserted. So based on the concept of effective date, we can easily calculate number of months outstanding in the current financial year, from which we can get the period value weight, from which we can get the VANs, from which we can easily calculate the EPS. Do you understand? So that means the effective date concept is highly interrelated to calculation of number of outstanding months for that particular equity shares. Now, if the equity shares are issued for cash, then when we can assume such equity shares are coming into effective in our company from the date as on which cash is receivable, not from the date on which cash is received, from the date on which cash is receivable. In case of convertible debentures, the effective date is date of conversion. In case of equity shares are issued as a part payment of loan, repayment of the loan, date on which interest ceases to accrue, because once you paid the loan, once you repaid the loan, then no party can recognize the interest in their books of accounts. If you already repaid the loan, we are not recognizing interest as an expenditure, and the other party is also not recognizing the interest as an income. That means the date as on which interest is ceases to accrue, interest doesn't accrue any further, such date you can consider as an effective date of equity shares. Next, repayment to the creditors. Sir, one supplier supplied certain raw material. As a payment to such supplier, you are going to issue your equity shares. Then what is the effective date of such equity shares? Date of settlement. Date of settlement to the creditors is the effective date. Sir, in purchase of assets, if you issued the equity shares, what is the effective date, sir? Date as on which such asset is recognized into your books of accounts is the effective date of equity shares. In consideration of services, maybe a chartered accountant provided certain consultancy services to you. As a consultancy charges, your company is going to issue the equity shares. Then what is the effective date of such equity shares? Date on which such services rendered. Date on which the services rendered. Next, in case of amalgamation, hope you already entered in the regular course, just you were watching as a revision process. You already know the basic meaning of the amalgamation. So in case of amalgamation, what happened? One company is going to absorb another company, or two companies are put together, it is evolving as a new company. Anything may happen. It is like a pure absorption or amalgamation. Anything may happen. Now, in case of amalgamation, the purchasing company is going to pay the purchase consideration to the selling company. Now, such purchase consideration is paid in the form of equity shares. Then what is the effective date of such equity shares? For example, two companies are there, A Limited and B Limited. Sir, A Limited is a selling company, B Limited is a purchasing company. Now, B Limited is absorbing the A Limited. Now, B Limited will pay purchase consideration to the equity shareholders of A Limited in the form of equity shares. Now, what is the effective date of such equity shares? That is depending upon the type of amalgamation. If the amalgamation is amalgamation in the nature of purchase, then the effective date is date of acquisition. If the amalgamation is amalgamation in the nature of merger, then the effective date is beginning of the current reporting period. Sir, what is the meaning of purchase? What is the meaning of merger? So here I can't tell you. In detailed discussion will be there in the near future. We are trying to cover the topic amalgamation definitely in the marathon session. So I'll clearly tell you what is the meaning of amalgamation in the nature of purchase, what is the meaning of amalgamation in the nature of merger. But it is purchase method, the effective date you can try to consider as the date of acquisition. If it is the merger method, the effective date is beginning of the current reporting period. Beginning of the current reporting period. That means for purchase, date of amalgamation is relevant. In case of merger, amalgamation in the nature of merger, date of amalgamation is irrelevant. We can consider whenever you are issued such equity shares as a purchase consideration to the selling company, we should consider that those are effective from the first day of the current reporting period itself. Do you understand? So total, sir, how can I easily remember the effective date concept, sir? You should not consider, you should not consider issue of equity share side. You can consider the other side. For example, equity shares are issued for cash. Don't consider the date of issue of equity shares. Consider the date on which cash is receivable. In case of convertible debenture, date of conversion. In case of repayment of loan, think in point of view of loan, when the interest ceases to accrue. Repayment of creditors, think in point of view of the creditors, when the actual settlement happened to the creditors. In case of purchase of asset, think in point of view of asset, when the asset is recognized into books of accounts. In consideration of services, think in point of view of services, when the data on which the services are rendered. Do you understand? If you think in the other angle side, that itself is the effective date of issue of equity shares. This is the concept of effective date, guys. Please consider all of you. Still, two more topics we need to consider with respective to EPS. Sir, the calculation of gains as well as calculation of earnings available to equity shareholders is over. Nothing is great. I told you the entire crux of the concept. Next, we are going to discuss two different types of EPS. When EPS is calculated in case of bonus shares, EPS is how to measure in case of right shares. So basic EPS we already calculated. The formula for basic EPS is very much easy, which is earnings available to equity shareholders by gains. Now still we are in the calculation of basic EPS at two different situations. In case bonus shares exist, how to calculate this basic EPS. In case right shares exist, how to calculate this basic EPS. We are trying to cover. Right, guys. First, let us calculate basic EPS in case of bonus shares. Please, all of you come here. Calculation of EPS in case of bonus shares. Let me explain the concept with a small illustration. In the year 2021 financial year, earnings available to equity shareholders are 10 lakhs. Gains, weighted average number of equity shares are 1 lakh, directly given. Then EPS is how much, guys? earnings available to equity shareholders divided by wins, which is 10 lakhs divided by 1 lakh, which is 10 rupees per share. Fine. Now come to the year 21-22. In 21-22, earnings available to equity shareholders are 12 lakhs, and equity shares at the beginning were 1 lakh, because the last year equity shares are 1 lakh, the same equity shares are there at the beginning. Now the issue is, as on 1/4/2021, that means in the current year beginning itself, company issued the bonus shares in the ratio of 1:2. What is the meaning of what is the meaning of 1:2? For every 2 existing equity shares, they will get 1 bonus share. That means number of bonus shares are 50,000. That is 1 lakh into 1/2 is nothing but 50,000 bonus shares. Am I right? Now let me calculate EPS now. Let me calculate EPS after issue of bonus shares as on 31st March 2022. Earnings are 12 lakhs divided by weighted average number of equity shares. Sir, beginning 1 lakh are there, at the same number of shares, 50,000 are also there at the beginning. So total 1 lakh plus 50,000, 1 lakh 50,000. So period value weight into 12 by 12. So the total number of veins are also equal to the 1 lakh 50,000. Now EPS is how much, guys? 12 lakhs divided by 1 lakh 50,000. EPS is how much? 8 rupees per share I got. Now, if you compare in case of intra-firm comparison, in case of intra-firm comparison, intra-firm means your company EPS of the current year, you can compare with the previous year. Now the current year EPS is 8 rupees and the previous year EPS is 10 rupees. What you feel? You can simply conclude that current year performance is dropped while compared with the previous year performance. Do you think that is it true? Because current year we earned the earnings of 12 lakhs, but in the previous year we earned the earnings of only 10 lakhs. To be frankly speaking, the current year earnings or the current year performance is enhanced while compared with the previous year, because earnings are increased from 10 lakhs to 12 lakhs. There is increase in earnings. The performance is increased. But while comparing the EPS, the conclusion may be the wrong. It is clearly shown that the EPS was decreased while compared with the previous year EPS. You know why it happened like that? Due to these bonus shares. Due to the bonus shares, there is increase in the denominator. So obviously, if there is increase in the denominator, the fraction value got decreased. Even though there is increase in the earnings, due to more increase in the veins, there is decrease in the EPS. That means it is not correct to compare the current year EPS with the previous year EPS directly. Whenever bonus shares are exist, we should need to compare the current year EPS with previous year adjusted EPS. You should need to revamp the previous year EPS, which is known as adjusted EPS. How I need to revamp the previous year EPS? That is, you can consider the previous year earnings. Sir, how to calculate the previous year EPS? Previous year earnings divided by previous year wins. That is previous year earnings, 10 lakhs divided by previous year wins plus, if at all bonus shares are exist in the previous year itself, what are the total number of equity shares? If at all such bonus shares are there in the previous year itself, what will be the total number of weighted average number? What is the total number of equity shares? You can find out. That is, if the same bonus shares are exist in the previous year, then the total number of shares in the previous year are 1 lakh plus 50,000, total 1 lakh 50,000. Then you are getting the EPS at the rate of 6.67. Now you can compare 8 rupees of equity share with 6.67 rupees of the equity share. Now there is a clear cut enhancement of the performance in the current year while compared with the previous year. The main objective of presentation of the EPS is comparison of the financial statements of our company with another company, or with the current year with the previous financial year. If such comparison itself give the wrong conclusions, then presentation of EPS is meaningless. That's why we are adjusting the previous year EPS on the assumption that if such bonus shares are exist in the previous year itself, what will be the EPS of the previous year? Such adjusted EPS you can compare with the previous such adjusted EPS you can compare with the current year EPS. In the current year, if bonus shares are there, then you will get the correct conclusion whether the real performance of the current year is enhanced or decreased. You can easily identify. So the conclusion is, whenever bonus shares are there, whenever bonus shares are there, you should need to calculate for the current reporting period along with the basic EPS. You should also need to present the adjusted basic EPS. Basic EPS you can calculate in the normal mode. Adjusted basic EPS is nothing but the previous year earnings divided by previous year earnings divided by previous year gains plus bonus shares. That is nothing but current year gains. Previous year gains plus bonus shares is nothing but current year gains. That is previous year earnings divided by current year gains. Then you will get the adjusted EPS. So the formula also same I given here. So adjusted EPS is equal to previous year earnings divided by previous year gains plus bonus shares, which is nothing but current year gains. One more important point here I want to tell you. Sir, in case of bonus issue, what will be the effective date of bonus shares, sir? Whenever such bonus shares can be issued, not at the beginning, whenever such bonus shares issued in the current reporting period, the effective date of the bonus shares will be first day of the previous reporting period, beginning of the previous reporting period, not of the current as well, beginning of the previous reporting period. The effective date of the bonus shares will be first day of the previous reporting period. That is the reason why in calculation of adjusted EPS, we consider the gains as 1,50,000. Because in calculation of adjusted EPS, we may assume that bonus shares existence will be there from the first day of the previous reporting period. That is the reason why I told you the gains will be 1 lakh plus 50,000 directly. Previous year gains plus bonus shares you can directly consider in calculation of adjusted EPS. You may ask a question, sir, why you are considering the effective date of the bonus shares will be the first day of the previous reporting period? The reason is, what is the meaning of bonus shares? You can tell me. Capitalization of profits. Capitalization of profits. Yes, bonus shares means capitalization of profits. Capitalization of profits means simply you are transferring funds from reserves to the share capital. That means reserves will be there in the previous year itself. Your reserves will be there in the previous year itself. Now you are considering the reserves into the share capital. That means the existence of reserves will be there in the previous year itself. That's why the effective date of the bonus shares will be beginning of the previous year reporting period only, because the bonus shares is nothing but conversion of reserves and surplus into the equity share capital. So here in the effective date calculation, you can add one more thing, which is nothing but bonus shares. The effective date of the bonus shares will be first day of the previous reporting period. And one more thing, whenever bonus shares are there in a particular financial year, along with the basic EPS, you should need to calculate the adjusted EPS as well. Adjusted EPS is equal to previous year earnings divided by previous year gains plus bonus shares. Is it okay to all of you? This is the concept of calculation of EPS whenever bonus shares exist. Next, very, very important topic. Regularly, they are testing problems from this topic. Please, all of you, put concentration here. Calculation of basic EPS whenever right shares exist. Calculation of basic EPS whenever right shares exist. I'll try to explain the entire topic with a small illustration. Please allow me concentrate here. Sir, we are in the year 2021. In the year 2021, earnings available to equity shareholders are 5 lakhs. How much, guys? Earnings available to equity shareholders? Let us assume which is 5 lakhs. Now, at the beginning of 2020, that is as on 1/4/2020, 1 lakh equity shares are there. How many number of equity shares are there? 1 lakh. All these are illusionary figures, just I am giving. Face value is 10 rupees. In the outside market, market price is 100 rupees. Now, as on 1/7/2020, company is going to issue right shares. So right shares, the terms are it's not set to be 2:1, it's set to be 1:2. So, sorry, wrongly written. It is 1:2. What is the meaning of 1:2? For every 2 equity shares, company is going to issue 1 right share. 2:1 means for every 1 share, they will get the 2 shares. But here the term is 1:2. 1:2 means 1/2. For every 2 equity shares, company is going to issue 1 right share. Total 1 lakh equity shares are there. For every 2 shares, 1 share means we are going to issue 50,000 right shares. Now, if this is the information, if nothing is available, then how we are in generally calculate the EPS? Can you please tell me, guys, all of you, how we are in generally calculate the EPS? First, we know the earnings available to equity shareholders. Let us calculate the veins. Veins. At the beginning, 1 lakh equity shares are there, right? 1 lakh into. Next, up to the date of issue of right shares, only 1 lakh equity shares are there. That's why the period value weight is 1/4/2020 1/7/2020, 3 months. That is 3/12. Plus, after issue of right shares, the number of shares will become 1 lakh plus 50,000, which is 1,50,000. So the remaining number of months in that financial year after issue of right shares, how many number of months? That is 1/7/2022, 31st March means total 9 months are there. That is 9/12. This is the normal calculation of veins. Do you agree? Whenever right shares are there or not exist, whenever the further shares are issued, this is the calculation of veins. Am I right? There is no special issue. We are also going to calculate the veins in the same manner. That is, number of equity shares at the beginning multiplied with number of months before issue of right shares divided by 12 plus number of equity shares are exist after right shares into number of months after rights issue divided by 12 months. That is the same formula. Same formula. Just here I put it in the figures where I spell out in the words. That is the only difference. Okay, fine. But my question is it in right shares any bonus shares are there? I mean, in these right shares, any bonus element is there? Any bonus element is there? Why you are asking that question, sir? Because whenever bonus shares are there, the effective date of the bonus shares will be first date of the previous reporting period itself. First, my question is, in these 50,000 right shares, any bonus shares are there? First, sir, if you want to know any bonus shares are exist in such right shares, first you should know at which price this right share is issued to the public. 75 rupees. In general, right share is issued at less than the current market price. The current market price is 100 rupees, but the issue price is 75 rupees. Now, is it any bonus shares are there, sir? Is there any bonus shares are there in the right shares? Now, please all of you concentrate. How we can find out bonus shares included on the right shares? I will tell you, sir. That and all is not necessary for the purpose of calculation of veins, but still in logically to explain all such things, I'll try to provide all such information. First, sir, bonus shares included in the right shares. How I need to check, sir? For example, right now, how much amount you are collecting from the right shareholders? I am collecting amount 50,000 equity shares I am going to issue. From each and every right shareholder, I am going to collect 75 rupees. Total how much amount, guys? Which is 50,000 into 75, which is 37 lakh 50,000. You are going to collect 37 lakh 50,000 rupees from the right shareholders. If the same amount, if you collect from other than the right shareholder, how many number of shares you would issue? Right now, you are collected such amount from the right shareholder. That's why you issued 50,000 shares. I do agree. But if the same amount, if you collected from the outside party other than right shareholder, how many number of equity shares you may would issue? Sir, if I collect the same amount from the outside party, I may issue each and every share for the 100. That means number of shares I can issue to the outside shareholders are 37 lakh 50,000 divided by 100, which is equal to 37,500. That means for right shareholder, you are issuing 50,000 equity shares. But if he is not a right shareholder, he is other than a right shareholder, then you can only issue 37,500 shares. That means excess how many shares you are issuing to the right holders? 12,500 shares are excess you are issuing to the right shareholders. Out of these 50,000 shares, 12,500 shares are bonus shares. Do you agree? That means in the right shares, certain bonus shares are also there. In the right shares, certain bonus shares are also there. That's why the effective date of the bonus shares will be first day of the previous reporting period itself. Now, out of this 1 lakh, I need to include bonus shares. I need to include bonus shares because even though right shares are issued as on 1/7/2020, out of these 50,000, 12,500 shares are bonus shares. Now, this 1 lakh plus bonus shares, I can assume that those are outstanding from the first day of the current reporting period itself, because the effective date of the bonus shares itself, we already seen that beginning of the previous year reporting period itself. Sir, bonus shares are exist in the previous reporting period itself means in the current year anyway such bonus shares are exist. That's why in considering the Vane's calculation, apart from the number of equity shares at the outstanding at the beginning, you can also include the bonus shares. Then you can multiply the period value weight plus 1 lakh plus total right shares. Sir, then can I include the bonus shares here as well? No, already included. No worry. 1,50,000 means 1 lakh at the beginning and 50,000 right shares. Now, in such 50,000 right shares, already 12,500 bonus shares are there. So that's why 1,50,000 into 9 by 12. That means the formula is very much easy. Whenever right shares are there, the formula is number of equity shares at the beginning plus bonus shares included in the right shares multiplied with number of months up to the issue of right shares divided by 12 plus number of shares after issue of the right shares multiplied with number of months after issue of right shares divided by 12. That is the formula for calculation of Vane's whenever right shares are there. Now I am revealing the same thing here. Please concentrate. Come down. What is the formula for EPS? What is the formula for EPS? Whenever right shares exist, this is same earnings available to equity shareholders divided by number of shares outstanding at the beginning into bonus element or plus bonus shares. You can write anything, sir, because number of shares at the beginning plus bonus shares or number of shares at the beginning into bonus element. Sir, what is this bonus element, sir? You can directly add the bonus shares now. Okay, for the time being, you can consider it as plus bonus shares included in the right shares. So number of shares at the beginning plus bonus shares included in the right shares plus number of shares after rights issue. Number of shares after rights issue, how many? 1,50,000. Here, how much, guys? 1,50,000. That is 1,50,000 multiplied with number of months after issue of rights divided by 12. Now, the total formula for Vane's number of shares outstanding at the beginning plus bonus shares into number of months before issue of rights shares divided by 12, which is simply 1 lakh plus bonus shares into 3 by 12 plus number of shares after rights issue into number of months after issue of rights divided by 12, which is 1,50,000 into 9 by 12. So the same computational figures what I put, I spell in the form of words. This is the formula for EPS when right shares are exist. The simple logic is whenever right shares are exist, there is certain bonus shares under such right shares along with the shares outstanding at the beginning. You should also try to consider the bonus shares included under such right shares also. That point, if you remember, then you can easily appreciate the entire concept of EPS when right shares are exist. The next question, please all of you concentrate. Sir, on behalf of adding the bonus shares here, you multiplied the bonus element, right? You can add the bonus shares, but why you multiplied the bonus element, sir? I will reveal that answer. Please concentrate, all of you. Please concentrate, all of you. The difference between bonus element and bonus shares, I will tell you. Okay. Sir, what I told here, I told you in the right shares, 37,500 bonus shares are there, I told you. Am I right? For example, if I tell the same thing like this, now on behalf of expressing in terms of number of shares, Now the number of bonus shares are 12,500. If I express it in terms of fraction, which is known as bonus element. For example, here bonus element is, sir, bonus shares are 12,500 shares, and the existing shares are 37,500 right shares. 37,500 plus 12,500, which is 50,000 shares. That means out of 50,000 shares, the bonus shares are 12,500, which is how much? Which is 0.25, which is 0.25. Am I right? How it is in generally expressed, which is expressed as 1.25. I mean, for every one right share, 0.25 bonus share is there. That is the meaning of this 1.25. Just give a second. I'll take another illustration for better understanding. Here itself it is there. Please all of you come below, come down. Sir, bonus element 1.05. What is the meaning of 1.05, sir? What is the meaning of 1.05? For every one right share, 0.05 bonus share is there. That is the meaning, 1.05. Here I told you now, simple, just for logically, I told you, sir, 1.25 means for every one right share, 0.25 bonus share is there. Here for every one right share, 0.05 bonus share is there. That is the meaning of bonus element. That means if you directly multiply with that 1.05, here two components are there, 1 plus 0.05. This is the existing share, this is the bonus share. That's why you can work out number of shares outstanding at the beginning plus bonus shares, or in another way, number of shares outstanding at the beginning into such bonus element, which is 1.05. Automatically you will get opening number of shares plus bonus shares. You can add the bonus shares, or you can directly multiply the bonus element. Now the next question is how to calculate this bonus element, sir? How to calculate this bonus element? Please allow you concentrate. For this purpose, I will try to discuss the calculation of bonus element completely in different direction, not in this manner, not in this manner. So just for the purpose of knowing the things in the layman approach, just I told you how to calculate the number of bonus shares. But you should not add the bonus shares directly in this formula. You should always multiply the bonus element only. Then automatically you will get number of shares at the beginning plus bonus shares. Now how to calculate this bonus element, I want to reveal. Please concentrate. Sir, whenever a company is announced right shares, whenever a company is made an announcement that our company is going to issue the right shares as on so and so date, then the company shares are increasing like anything, you know, because for example, we are in the financial year 2021, sir. We are in the financial year 2021. Company announced as on 1/4/2020. What is that? Company is going to issue the right shares as on 1/7/2020. Then every person is willing to buy your company shares. Your company shares are increasing like anything. Your company shares are increasing like anything. The reason is the shareholder who got the shares are who hold such shares as on 1/7/2020, he will definitely get certain right shares at less than market price. That's why the demand is huge. That's why the market price is increased like anything. Such a equity share before issue of right shares is known as cum right share, which is not a right share. The existing share before issue of right shares is known as cum right share. Why it is known as cum right share? Because if I hold such cum right share, then I got certain right shares as on the cutoff date. Am I right? Once the right shares are issued as on that cutoff date, the existing equity shares will become the X right shares. Now the company market price is start decreasing. Do you know the reason? Because once the right share is issued, nobody is interested to willing to buy because no one will get the right shares further. Am I right? Now the bonus element is nothing but after issue of right shares, how much price? Before issue of right shares, how much price? The fraction itself is the bonus element. The fraction itself is the bonus element included in that right share. That is cum right share price divided by X right share price is nothing but bonus element. So certain bonus amount included in such right share. Now how much bonus element, sir? The bonus element is nothing but before issue of the right shares, what is the market price? Use market price now divided by after issue of the right shares, what is the market price? The division itself is the bonus element. If you divide, if you will get which is 1.05, then the meaning of this 1.05 is nothing but, sir, out of this 0.05 is the bonus element. I mean, sir, if 1 lakh shares are there, out of which 0.05, 5,000 shares are bonus shares. That is the meaning. That's why you can directly multiply with this bonus element on behalf of adding the bonus share. That's why the formula is earnings available to equity shareholders divided by number of shares outstanding at the beginning into bonus element into number of months before issue of right shares divided by 12 plus number of shares after rights issue into number of months after issue of rights divided by 12. Don't by heart it, which is a simple calculation of wins as like in the normal way. The only difference is at the beginning of the equity shares, we are also including the bonus shares. On behalf of adding the bonus shares, I am multiplying the bonus element, remaining there is no change in the formula. Now, how to calculate this bonus element? The calculation of bonus element is nothing but cum right share price divided by X right share price. Cum right share price is generally given in the problem. Then how to calculate the X right share price is the another issue. X right share price is nothing but after issue of the right shares, what is the price of the existing share is nothing but X right share price. Now, let us come to the calculation of X right share price, which is also known as theoretical X right share price. T stands for theoretical X right share price. Sir, why it is called as theoretical X right share price, which is not a real real right price? Because after issue of the rights, how much is the price in real time scenario is different, which is the real X right share price. But here we are going to calculate in the theoretical mode, on the paper mode. That's why which is known as theoretical X right share price. How much, sir? Which is very simple, guys. Theoretical X right share price is nothing but before issue of the right shares, how many number of shares you have. Let us assume before issue of the shares, how many number of shares we have. In my example, the number of shares were 1 lakh, right? That is 1 lakh into how many number of shares we have. 1 lakh. Sir, each and every equity share before issue of right shares, how much? 100. Fine. Plus how many number of right shares you issued? 50,000 right shares I issued. How much amount you collected from each and every right share? Sir, I collected 75 rupees. This is the value of the existing shares, guys. Existing 1 lakh, value is 100. From the right shares, you collected 75 rupees each, which is the proceeds from the right shares, divided by total number of shares after rights issue. 1 lakh plus 50,000, which is 1 lakh 50,000, which is nothing but theoretical X right share price. So the formula for theoretical X right share price is number of shares before rights issue into market price plus proceeds from rights issue divided by total number of shares after rights issue. Now, how to calculate the EPS? Step number 1, first calculate the TERP. After that, calculate the bonus element. Then you can calculate the gains. Then you can simply calculate the EPS. First, you should need to calculate the TERP. How to calculate the TERP? Existing before issue of right shares, how many number of shares are there? Multiply with the market price of each share plus proceeds from the right share divided by total number of shares after rights issue. Then you will get theoretical X right price. They already given market price before the rights issue. Market price before the rights issue is nothing but cum right share price, which is nothing but cum right share price. Cum right share price divided by X right share price. You will get the bonus element. Then in calculation of the gains, because we can assume that bonus shares are exist at the beginning of the previous reporting period itself. So number of shares outstanding at the beginning, you can multiply with the bonus element into number of months before issue of right shares divided by 12 plus number of shares after rights issue. Sir, why you are not multiplying the bonus element in the second component, sir? You know already in the right shares, bonus shares are there, na? In such 50,000, already 12,500 bonus shares are there, na? That's why once you added the right shares, means automatically you included the bonus shares as well. Again, don't multiply one more time with the bonus element. Then the wrong calculation may occur. So number of shares after rights issue means automatically bonus element included in the rights issue also included into number of months after issue of rights divided by 12. Then you will be automatically get EPS. We can try to do one problem which is very much important concept. Regularly they are asking whenever they test question from AS20, they are directly picking the problem from on based on this topic only. So let me take up one problem for the discussion, and that is better idea. S20, right? Yes, please consider here. This is the problem. Problem number 4. Net profit for the year 2011, which is given at 11 lakhs. Net profit for the year 2012, which is given at 15 lakhs. Number of shares outstanding prior to rights issue 5 lakhs. Before issue of the right shares, number of shares are 5 lakhs. Right share issue price is 15 rupees. Last day to exercise the rights is 1st March 2012. Right issue is 1 new share for each 5 outstanding. That is 1 lakh new shares. Because existing shares are 5 lakh shares. 1 by 5 means 1 by 5 into 5 lakhs. Number of right shares are 1 lakh. Fair value of one equity share immediately prior to the exercise of the rights on 1st March 2012 will be 21 rupees. Compute basic EPS. Total here, 2 different years are there, sir. One is 2011, another one is 2012. Please all of you come to my solution here, which is there. Total here, 2 different years are there. You can easily calculate 2011 EPS. 2011 EPS is how much? Which is quite easy. Earnings are 11 lakhs divided by wins. Number of shares outstanding prior to right shares means in the previous year also we have same 5 lakh shares. In 2011 there are no right shares exist. That's why in 2011 EPS is how much, guys? 11 lakhs divided by 5 lakhs means which is 2.2 rupees per share, which is EPS for 2011. If you concentrate, the same thing is given. 2011 EPS is 2.2 rupees per share, which is 2011 EPS. Now come back, coming to the year 2012. Right now in the year 2012, right shares are issued, right? So whenever right shares are issued, then bonus element under right shares concept will be applicable. Now in calculation of wins, first I should multiply with the bonus element with the beginning number of equity shares. For the purpose of calculation of bonus element, I required cum right share price and ex right share price. Cum right share price means before issue of the right shares, I have the share price 21. After issue of the right shares, I should need to work out the theoretical ex right share price. I mean, the first step is calculation of the TERP. How to calculate the TERP? First, number of equity shares at the beginning. At the beginning, 5 lakh equity shares are there. Sir, each share price is 21 rupees. That is 5 lakh into 21. TERP calculation. TERP calculation 5 lakh into 21. That is the value of the existing equity shares plus proceeds from the right shares. How many number of right shares issued? 1 lakh. Each right share is issued at which price? 15 rupees. 1 lakh into 15. 1 lakh into 15, which is proceeds from right shares, divided by total shares after issue of right shares. 5 lakhs plus 1 lakh, which is 6 lakhs. Then the TERP is become 20 rupees. Then calculation of the bonus element, cum right share price, that is 21, divided by X right share price. X right share price is 20 rupees. So then the bonus element, we will get it as 1.05. So right, what is the meaning of 1.05? We already explained. For each and every one share, 0.05 bonus share is there. That is the meaning of bonus element. That means if you automatically multiply with 1.05 means you are including your bonus share, existing one share plus 0.05 bonus share. So you can directly multiply 1.05 with the beginning of the shares. So that's why in calculation of basic EPS, earnings are 15 lakhs. It is clearly given in the problem itself. Earnings how much, guys? For the year 2012, which is 15 lakhs. Okay, divided by number of shares at the beginning, which is 5 lakhs, multiply with the bonus element into number of months before issue of right shares. Because right shares are issued as on 1st March 2012. In the year 2012, before issue of the right shares, number of months outstanding are 2 months, that is 2 by 12, plus number of shares after issue of right shares, that is 5 lakhs plus number of right shares. How much, guys? 1 lakh. 5 lakh plus 1 lakh is equal to 6 lakhs multiplied with number of months after issue of right shares divided by 12 months. Then you are getting 2.55 rupees per share. Now, please all of you concentrate. In the year 2011, the EPS is 2.2 per share, right? Now in the year 2012, the EPS is 2.55 per share. You know that, right? Can you compare 2012 EPS directly with 2011 EPS? Do you thought it is correct? No. Whenever bonus shares exist, apply the previous concept, guys. Whenever bonus shares exist, at the time of comparing the current year EPS with the previous year EPS, the comparison may completely go into the wrong direction. You can compare the current year EPS with previous year adjusted EPS. That means previous year EPS, you can be restate. That is previous year earnings divided by previous year gains plus bonus shares. That is previous year earnings are 11 lakhs divided by previous year gains 5 lakhs into bonus element. If you automatically multiply with the bonus element, you can add the bonus shares itself. The bonus element is 1.05. That is 11 lakhs divided by 5 lakhs into 1.05, which is 2.09, which is known as adjusted EPS. That means whenever right shares are there, along with the calculation of the normal basic EPS, you should also calculate adjusted EPS. You can compare current year basic EPS with adjusted EPS, but you cannot compare the current year EPS with the previous year EPS because bonus shares are there. In right shares, bonus shares are there. Along with calculation of the basic EPS, you should also need to work out adjusted EPS for the purpose of intra-firm comparison. You can compare the current year basic EPS with previous year adjusted EPS, which is nothing but adjusted EPS to be reported in the current year. That's why if you observe 2011 normal basic EPS I calculated, 2012 normal basic EPS also I calculated. For the year 2012, I also calculated adjusted EPS. You can compare 2012 basic EPS with 2012 adjusted EPS. You cannot compare 2012 basic EPS with 2011 basic EPS. That is the concept of right shares. Hope everything is clear. I uh, I almost spent more time that as per my plan. Actually, I want to provide very less guidance here, but more than that, hope I explained. Okay, just leave it. Now come to the concept of dilutive EPS, guys. Till now we discussed multiple issues related to the basic EPS. Now I'm going to discuss about dilutive EPS. First, what is the meaning of dilution? What is the meaning of dilution? Sir, dilution means decrease. It's not increase, decrease. Decrease in basic EPS. Decrease in basic EPS. Dilutive EPS means decrease in basic EPS due to dilutive potential equity shares. Due to dilutive potential equity shares. First, here two different terms are there, dilutive and potential equity shares. First question is, what is the meaning of potential equity shares? Actually, in accounting standard, we are going to learn definition as well, nah? But I didn't explain anywhere definition separately. But now I'm going to explain the definition of potential equity shares. What is the meaning of potential equity shares? Potential equity share is a financial instrument where the holder of the contract is entitles or may entitle certain equity shares in the future. Potential equity shares are the financial instruments where the holder of the contract entitles or may entitle certain equity shares in the future. If I give certain examples, you can easily appreciate the concept of potential equity shares. For example, convertible debentures are there. Convertible debenture is a contract in between the holder as well as company, holder of that contract as the company, where such convertible debenture holder have an option to convert such debentures into the equity shares in the near future. Then now such convertible debentures are the classic examples for the potential equity shares. Convertible debenture is a holder of the contract, entitles or may entitle in equity shares, may entitle equity shares in future. Do you understand? In the same way, convertible preference shares is also a classic example for potential equity share. That means from these contracts, the holder of such contract may entitle certain equity shares in the future, but not right now. Dilutive EPS we are going to be calculated in future sense. I mean, in the current year we already calculated basic EPS, but in future, in the worst scenario, what will be how much? Sorry, in the future, in the worst scenario, how much decrease in the basic EPS is ultimately known from dilutive EPS, because we are not only taking the decisions in the current year information basis. We are not only taking the decisions based on the current year information, but also taking the decisions based upon the futuristic information as well. In future, in the worst scenario, how much decrease there will be exist in the basic EPS is ultimately known through the concept of dilutive EPS. Now, one more example is there, which is very much important. Bonus element included in options. Bonus element included in options. Separate discussion will be there. Just for the time being, you can just remember the remember the name, which is bonus element included in the options. So total 3 major examples are given here: convertible debentures, convertible preference shares, bonus element included in the options. Dilutive potential equity shares are the financial instruments of holder of that contract entitle or may entitle the equity shares. Why you are calculating the dilutive EPS? The reason I already told you. In future, in the worst scenario, how much decrease there in the basic EPS is ultimately known through the dilutive EPS, which is based on the futuristic information. Now, the question is how to calculate the dilutive EPS. Now, first, you already considered the basic earnings here in calculation of basic EPS. Basic earnings divided by basic gains, you already have. You already have, right? Now, due to this potential equity share, if there is a dilution in the basic EPS, then such potential equity shares are known as dilutive potential equity shares. Because maybe considering this potential equity shares, there may be decrease in the basic EPS or there may be increase in the basic EPS. If there is a decrease, then only you should try to consider it as a dilutive EPS. But if there is an increase in there, then there is no dilutive EPS. Basic EPS itself is a dilutive EPS. Do you understand what I am telling? After considering these potential equity shares, which ultimately lead dilution in the EPS, then such potential equity shares are known as dilutive potential equity shares. That's why in calculation of dilutive EPS, we should only use the dilutive potential equity shares, not all the potential equity shares. While adding these potential equity shares, rather than decrease in EPS, if there is increase in EPS, then how you can tell these potential equity shares as a dilutive potential equity shares? That's why in calculation of dilutive EPS, I should only try to consider the dilutive potential equity shares only. That means while compared with the basic EPS, if there is a decrease in the dilutive EPS, then I can set to be that EPS as a dilutive EPS. But rather than decrease, while compared with basic EPS, the dilutive EPS is more, then I cannot treat it as a dilutive EPS. The dilutive EPS itself is basic EPS. Okay, fine. Now, the next issue is, first, for example, if convertible debentures are there, then how to calculate dilutive EPS? Let us have a look. If convertible preference shares are there, then how to calculate dilutive EPS? Let us have a look. If bonus element included in the options are there, then how to calculate dilutive EPS? Let us have a look. Total 3 issues we are going to consider. Calculation of dilutive EPS in case of convertible debentures, in case of convertible preference shares, in case of bonus element included in the option. Now, first, we started our journey with the calculation of basic EPS. Let us assume basic earnings are 10 lakhs, basic gains are 1 lakh, basic EPS is 10 rupees per share. Now, we have 10% convertible debentures. The number of debentures are 1000, face value is 100, and the amount of 10% convertible debentures are 1 lakh. The amount of 10% convertible debentures are 1 lakh. Now, the issue is every one debenture, if I am going to convert in the future, I will get 10 equity shares at the time of conversion. At the time of conversion, I will get 10 equity shares. Now, all of you, please concentrate. First, let me calculate the gains for the purpose of dilutive EPS. Already we know the basic gains are 1 lakh, which are basic gains 1 lakh. Plus, if I will convert the debentures into the equity shares in future, I will get total for each debenture, I can get 10 equity share. That is 1000 into 10, I will get 10,000 equity shares. So, gains to be considered for the purpose of calculation of basic for dilutive EPS are 1 lakh plus 10,000, total 1 lakh 10,000. This is denominator part. This is denominator part. So then what about numerator part? What about the numerator part? You know the basic earnings how much? 10 lakhs. Now all of you please concentrate. Due to conversion of debentures into the equity shares, is there any savings or is there any increase in profit? Yes, there is increase in profit with respect to interest, because earlier debentures are there means interest expense is there. Right now, after conversion of debentures into equity shares, no need to make payment to the interest to the debenture holders. To that extent, there is savings in interest now. That's why savings in interest I need to add. How much interest saved, sir? 1 lakh into 10% is, which is 10,000. But one thing, guys, if earlier interest expense is there, there is savings in tax will be there. Do you understand? Interest expenditure is an allowable expenditure for the purpose of income tax. That means to the extent of 10,000, we are allowing as an expenditure for the purpose of calculation of taxable income. But right now the 10,000 is missing now. That's why we are not having savings in tax, because there is no interest expense, there is no savings in tax. That's why we are going to calculate savings in interest after tax. Interest is saved, that is 10,000, but we are not saving the tax on such interest, which is 10,000 into 30% tax rate year gain. I reduced to 3,000. That's why for this basic earnings, I should need to add savings in interest after tax. Then I will get earnings in calculation of the dilutive EPS. Then if I calculate the dilutive EPS, 10 lakh 7,000 divided by 1 lakh 10,000, I got 9.15 per share. If you check, the basic EPS is 10 rupees and the dilutive EPS is 9.15 rupees, 15 rupees per share, then I can consider this 10% convertible debentures as dilutive potential equity shares. But if I will get, for example, 11.2 rupees, then I cannot tell that these convertible debentures are the dilutive potential equity shares. Then at that point of time, dilutive EPS will also become 10 rupees only. That point actually I emphasized in the earlier discussion. Okay, let me take the second issue. Let us assume convertible preference shares are there. Then earnings, how it will become, guys? Basic earnings you can consider. Now, if the preference shares are converted into equity shares, then to that extent, no need to make payment to the preference shareholders in the form of preference dividend. That's why savings in preference dividend I can add. Savings in preference dividend I can add. If there is no preference dividend, no need to pay the dividend distribution tax on preference dividend. Right now, DDT is not applicable. I already told you. If at all given, you can consider. Otherwise, you can simply ignore. That's why if convertible preference shares are converted into the equity shares, then there is a savings in preference dividend and savings in dividend distribution tax will be there. I should need to add these savings to the basic earnings divided by, this is related to the numerator part. Denominator part, you know, as usual, that is basic variance plus. If I convert each and every preference share, then how many number of equity shares I will get, I should need to know. Then I add the potential equity shares. Then I will get dilutive EPS in case of dilutive EPS in case of convertible preference shares are exist. Next important issue is bonus element included in options. Now all of you please concentrate. This is very much important concept. If they're not tested problem from right shares in calculation of basic EPS, they might tested calculation of dilutive EPS from bonus element included under option. That much of important. You know the concept of ESOP, right? Employee stock option plan. Their separate chapter is there, but in marathon, we are not trying to consider that. In case of employee stock option plan, what will happen, guys? We are providing certain options to the employees. By that option, such employee may subscribe certain number of equity shares in future if they comply the conditions levied by the company. Such equity shares are offered to the employee at less than market price in the future. That is nothing but option, right? That is nothing but option. So options means simply you can consider in your mind which is employee stock option plan only. If we are announcing options to the employees under ESOP, then the employees, now you can treat like as a shareholder, they will get certain number of equity shares in the future. Potential equity share is a holder of the contract. Now the employee is holding that employee stock option as a contract in between the company and the employee. The contract is there. Now employees may entitle certain equity shares in the future. That's why option is a potential equity share and the option is a dilutive potential equity shares as well. I will tell you why. Due to the option, certain bonus element included in that option. Due to the option, certain bonus shares are included in that options. I will give one example. As like the right shares, I'll give an example here. Please concentrate. Now, in my organization, for employees, I issued 1 lakh options. 1 lakh options. So total, I issued 1 lakh options to my employees at the rate of 75 rupees per each share. Sir, but the market price is 100 rupees. But the market price is 100 rupees. Now, how many number of bonus shares included in that option, sir? How many number of bonus shares included in that option you need to calculate? As like earlier, I told you, right, in calculation of basic EPS, whenever right shares are there, under right shares, how many bonus shares are there? How you calculated? If the same number of shares are issued to the outside public, how many number of shares you may would issue? 1 lakh into 75 I'm getting. 1 lakh into 75 I'm getting means I'm getting total 75 lakhs worth. If the total 75 lakh worth I am collected from the outsider, then how many number of equity shares I may would issue? I can divide it with 100 rupees. I may would issue 75,000 equity shares. But for employee stock option employees, I am issuing 1 lakh options. How much excess number of shares I'm going to issue through ESOP? 25,000 equity shares. Such 25,000 equity shares are nothing but bonus element included in under the option. This is method number 1. Therefore, bonus element into the option is nothing but 1 lakh minus 75,000, which is nothing but 25,000. The same bonus shares included in the option, you can calculate it in another method as well. Bonus shares included in the option is equal to number of options into market price minus issue price divided by market price. Also, you are getting 25,000 equity shares. The formula is number of options into market price minus issue price divided by market price. At that time also you are getting the number of bonus shares included in the options of 25,000. Sir, any method you can use, that is up to you. But method number 1 is conceptual, method number 2 is formula based. That is up to you. Sir, if I know the bonus shares included in the option, then what should I need to do, sir? You need to calculate the dilutive EPS. Your issue is you need to calculate the dilutive EPS. How to calculate the dilutive EPS? Here it is there. EPS is equal to what EPS? Dilutive EPS is equal to basic earnings. Under the numerator, you can consider the basic earnings. Sir, due to this bonus element included in option, there is no increase in earnings, sir, in future. What you are doing here? In future, you are converting options into the shares. But out of the options, 1 lakh options, 75,000 equity shares, you are getting money as well. Nah? You are getting money, you are converting into equity shares. Such equity shares are not potential equity shares. Only additional shares are you are issuing na 25,000 equity shares. You are issuing at free of cost, na? Due to which there is increase in equity shares without increase of any further resource to the company. Those are only the potential equity shares. What is the meaning of potential equity shares? Potential equity shares is nothing but holder of the contract will entitle or may entitle equity shares at free of cost. Now here at free of cost, how many number of shares they are getting? 25,000 equity shares. Even though they are getting 1 lakh equity shares, out of that 75,000 equity shares, they are paying the money. So that's why we should only consider the 25,000 equity shares in the veins. That's why basic veins plus I will only consider bonus element included in the option. But due to conversion of option into the equity share with respect to these 25,000 equity shares, there is no increase or there is no decrease in the earnings. That's why the same basic earnings I need to consider in the numerator, but in the denominator, basic veins plus bonus element included in the options I need to consider. Definitely it will lead to a diluted EPS only. You know the reason? Denominator portion is more I'm adding while compared with the numerator part. That's why among all the instruments, which is the most dilutive instruments, the most dilutive instrument is bonus element included in the option only. Among the convertible debenture and convertible preference shares and bonus element included in the option, which is the more dilutive instrument, sir. Bonus element included in the option only the more dilutive instrument, because with the bonus element included in the option, there is no increase in the numerator, there is only increase in the denominator. So that's why out of the all the instruments, only bonus element included in the option is the more dilutive instrument. Next, sir, can I, if more than one instrument is there in my organization, then how to calculate dilutive EPS? That is not form part of your syllabus, but still I am providing an outline. If more than one instrument is there, then you should not calculate dilutive EPS by considering all the instrument at the same time. No, you should not do like that. What you should do, you should add one by one instrument. You should add one by one instrument. then you should calculate the dilutive EPS. Then which instrument I should need add first, sir? Then which instrument you should need add first, sir? For that particular procedure will be there. I don't want to cover such things in the marathon, but I entirely covered in my regular course. If you want, if you are enthusiastic to learn all such things, then you can watch my regular videos as well. Okay. So, but that is out of the syllabus. But in the examination, they are only giving only one instrument. If convertible debentures are there, then how to calculate dilute EPS you've seen. If convertible preference shares are there, how to calculate the dilute EPS you've seen. If bonus element included in options are there, how to calculate the EPS you've seen. I will close this AS20 with one problem based on the bonus element included in the option, which is quite important. That's why I want to add that problem as well. Just a second. Where it is there. Yeah. So please all of you come to problem number 6 here, guys. Net profit for the year 2011 given at 12 lakhs. Weighted average number of equity shares outstanding during the year 5 lakhs given. Fair value of one equity share during the year 2011 given at 20 rupees. Weighted average number of equity shares under option during the year 2011 are 1 lakh shares. Exercise price for the shares under option during the year 2011 is 15 rupees. Compute basic and diluted EPS. So basic EPS very much easy. You know, basic EPS is equal to basic earnings how much, which is 12 lakhs divided by basic wins, weighted average number of equity shares directly given, which are 5 lakhs. So 12 lakhs divided by 5 lakhs, how much, guys? Which is 2.4 rupees per share. Now, if you consider here, average fair value of one equity share during the year 2011, what is the meaning of this, sir? If an equity share is issued to the outside party, we are going to issue at 20 rupees. But under employee stock option plan, each and every equity share we are issuing at 15 rupees. How many number of shares we are issuing under the options? 1 lakh equity shares we are issuing under options. Out of this 1 lakh equity shares, I need to first calculate bonus shares included in the option. How I should need to calculate the bonus shares? 1 lakh into 15 rupees I am going to collect from the employees, which is 15 lakhs. The same 15 lakhs I'm collected from the outside party, I'm going to issue each and every share at 20 rupees. Then how many number of shares I would issue to the outsiders, which is 15 lakhs divided by 20 rupees, I'm getting 75,000 equity shares. That means for employees, I'm issuing 1 lakh equity shares, but as an outsiders, we only issue 75,000 shares. That means 25,000 shares are bonus shares. Now I can calculate dilutive EPS. Dilutive EPS is equal to basic earnings divided by 12 lakhs divided by basic wins 5 lakhs plus bonus element included under the option, which is 25,000. Now 12 lakhs divided by 5 lakh 25,000, which is 2.28 per share. 2.28 per share. This is the calculation of basic as well as diluted EPS when options exist. This is the closure of S20, guys. Still literally a lot more issues I intentionally ignored, but those are not relevant for examination point of view. Covered A to Z, except those things which might try to cover in your CA final syllabus. Okay, so we will continue our journey with another accounting standard in another video lecture. Let us start with the next accounting standard, guys, which is AS4, contingencies and events occurring after balance sheet date. Basically, before introduction of AS29, the entire content related to contingencies also dealt by AS4 only. But after introduction of AS29, the scenario of AS4 is completely changed. I mean, now the entire things related to contingencies is dealing with AS29. Sir, but still why the title was not changed? The reason is very less portion with respect to the meaning of contingencies is still discussed by AS4 only. That is the reason why still the title is continue as contingencies and events occurring after balance sheet date. Here, the main theme is we are going to learn the concept of events occurring after balance sheet date. Even though the main theme is events occurring after balance sheet date, still we are going to learn the meaning of contingency. Okay. Sir, what exactly contingency is? Contingency is a condition or situation. The outcome of such condition or situation may be either loss or gain. Such a loss or gain will be known occurrence or non-occurrence of one or more future uncertain events which are not wholly within the control of the enterprise. That is the exact definition of contingency. Sir, if I explain like this, then you may not appreciate anything. Let me give one simple example for better understanding. The situation is like this. What is that? Sir, one party or a company filed a suit on our company. What is the issue? On the allegation that we are manufacturing certain products by making theft of the other company patents, or the manufacturing process is as like same as the other company manufacturing procedure. That is the allegation made by the other company. Then, as on the balance sheet date, the situation is like this. The party only filed a suit which is in the court of law. Now, this is the situation or condition existing as on balance sheet date. The outcome may arise either as a loss or gain. If we lose the case, if the other party defeated in the court of law, then the other party can claim the damages from us. That's why which ultimately results, the outcome of that condition or situation ultimately results either loss or gain, which will be known either occurrence or non-occurrence of future uncertain events. Occurrence of future uncertain event means if we ultimately win that case in the court of law, then we may arise, then we may not arise any loss. But if the court decision is against our interest, then there may be a chance of getting loss. So that is occurrence or non-occurrence of future uncertain event, which is a future event. The court decree is a future uncertain event, which is not wholly within the control of my enterprise. Can you influence the court decision? No, because ultimately the judge will provide the judgment based on the evidences available at that particular point of time. It is the matter of justice. So court will not provide any decree in with biasness. Am I right? So that's why the occurrence or non-occurrence of future uncertain events which are not wholly within the control of enterprise. Now such a condition or situation exists as on balance sheet date is known as contingency. To put it simply, contingency means what happened nobody knows. That is the dictionary meaning of contingency. Am I right? Now, for that situation of contingency, what we can provide in our books of accounts. To be frankly speaking, the entire discussion we are going to make in very deeper mode in AS 29, but still we are not covering AS 29 through this marathon, but just the outlines I will tell you. If the contingency situation is ultimately impacting as a contingency loss, then you need to check the probability concept. If it is more probable, then we can create a provision. If it is less probable, then we may create a contingent liability. Sir, the contingency ultimately arises the contingency loss and the probability is very much high. Sir, occurring the damages, the probability is very much high. Then you can create a provision. No, the contingency may arise a loss, but the probability is less. There are very less chances. are there to claim damages by the other party, then you may create a contingent liability. No. The situation is outrightly gives contingency gain, then which is treated as a contingent asset, but such contingency asset we may not record it in the financial statements as per the concept of prudence. Now, the ultimate outcome of contingency concept. What exactly we are learning from the concept of contingency? Sir, contingency means uncertainty, which is a condition or situation, the outcome which ultimately may leads to the loss or gain. It will be known occurrence or non-occurrence of future uncertain events which are not wholly within the control of the enterprise, which is the definition of the contingency. Due to such contingency, contingency loss may arise or contingency gain may arise. If a contingency loss may arise, then you can check the concept of probability. If it is more probable, then we can create a provision. If it is a less probable, then we can create a contingent liability. Provision is recorded in the financial statement. The profit and loss account that are to provision account is the general entry. Provision in generally shown under the short-term provisions under the current liabilities in presentation of the financial statements as per schedule 3. But coming to the contingency gain, sorry, I'm so sorry. Coming to the contingent liability, that is less probability factor, which is shown as footnote to the financial statement, but which is not presented in the financial statements. That too, if that amount is material, if you feel that that amount is material, then only you can show it under footnote to the financial statements. Then come to the contingency gain, which outrightly not recorded in the financial statements due to the concept of prudence. But if you feel if it is material, then you may shown in the board of directors report. These are the accounting presentation issues with respect to provision, contingency, contingent liability, and contingent asset. Okay, just leave it. But sir, for this topic, do you explaining the standard AS4? No, not at all. The entire AS4 focus is with respect to events occurring after balance sheet date. Now, please, all of you come to the concept events occurring after balance sheet date. Events occurring after balance sheet date. What about this, sir? What about this? All is. Friends, before explaining things related to events occurring after balance sheet date, first you should know the compliance part in generally occurring in case of a company. Once, if you appreciate the compliance part, you can easily understand the concept of events occurring after balance sheet date. First, let me explain the compliance part in generally for each and every year. As a normal course of business, the company need to follow as per the Companies Act 2013. Let us have a look first. Sir, let us assume the financial year is related to 2020-21. So now, which is a financial year or an accounting period? The reporting period will be 31st March 2021. Do you think that the financial statements are make it ready as on the last date of the financial year? Practically, it is not possible because the company is engaged with their operating activities. So nobody knows all the components of the financials as on 31st March 2021. But definitely the financial statements are prepared up to that particular date. But such financial statements are in generally prepared after taking a gap of 10 to 15 days after finalizing of closing stock and certain events adjustments like depreciation. Okay, certain all other things they need to adjust. And all the entries also they need to pass. Then let us assume the financial statements are ready as on 15th April 2021. Sir, in a company whose responsibility to prepare the financial statements, it is ultimately the responsibility of the board of directors. Board of directors will delegate that responsibility to finance department, who is the head of CFO, chief finance officer. Let us assume CFO is come with the financials as on 15th April 2021. It is the responsibility of the board of directors. That's why board of directors will also approve such financial statements. Approval means they will make it sign on such financial statements. Because as per the Companies Act 2013, if any fraud or error occurred in such financial statements, who are the primary suspects. The primary suspects will be the board of directors. So that is the reason why after preparation of such financial statements by the finance department, such finance statement should be ultimately approved by the board of directors. Board of directors will conduct a board meeting at that particular point of time. How it is going, once the financial statements are make it ready, board of directors will assemble, they will conduct a board meeting, then they will discuss about the financial statements, then what are the decisions necessarily taken, they will discuss, then ultimately they will approve such financial statements. Along with that, they will also issue the board of directors report. In such board of directors report only, they will discuss what are our responsibilities actually. Okay, that is follow-up of accounting standards, preparation of financial statements at the accrual basis, all such things they actually make it presented under the board of directors report as well. Now, once the financial statements are approved by the board of directors by conducting a board meeting, then such financial statements are ultimately go to the auditor for the purpose of issue of audit report. You know, ultimately each and every company, whether it may be private limited or public limited, small company or a dormant company or a one-person company, whatever the case may be, it should be such company should be conduct the audit, statutory audit. It should be audited by a practicing chartered accountant. Then the auditor will issue the audit report. Now the issue is financials plus audit report plus board of directors report. Combinedly, we will put it at which is known as annual report, which is known as annual report. Along with such annual report, we will attach a notice as an invitation to the general meeting, as invitation to the general meeting to invite the shareholders for the purpose of conducting a general meeting. Now, annual report consisting of financial statements, audit report, and board of directors report, and certain all other explanatory information which is required is going to be discussed in the general meeting, along with that invitation to the shareholders to attend a general meeting. For this only, as per the statutory regulation, is that 21 clear days should be required to send that notice to the shareholders. Okay. After sending such annual report and invitation to the shareholder, then company will going to conduct a general meeting on that specific date. Then in the general meeting, what the company is going to discuss, they will discuss two different matters. One is general business matters, another one is special business matters. General business matters are with respective to declaration of the dividend, appointment of auditor for the next forthcoming year, and the appointment of board of directors, and the laying of books of accounts. Total 4 activities in generally going to be made in the general meeting. That is declaration of the dividend, appointment of auditor, appointment of board of directors, and laying of the books of accounts. I mean, declaration of the dividend means with respect to dividend concept, dividend is in generally proposed by the board of directors in the board meeting. So the board meeting was conducted as on 15th April 2021, right? Before issuing of the board of directors report itself, after making a detailed discussion, board of directors will propose the dividend, because who know the ultimate affairs of the business entity? Board of directors only. The dividend decision making process is also in the hands of the board of directors as per the statutory regulation, but they cannot declare. They cannot declare, just they can propose. Who ultimately declares such dividends, sir? And the dividend may be declared by the shareholders in the general meeting. The declared dividend may be less than the proposed dividend by the board of directors, but it should not be greater than the dividend which is proposed by the board of directors. You know how beautifully designed the vesting parts lying with the board of directors as well as shareholders with respect to the dividend, you can easily appreciate here. Okay, that is different story, just leave it. Sir, if any special matters, along with that annual report and notice, certain explanatory notes they will attach. Sir, which type of business we are going to discuss in the general meeting? Sir, are we opening any new offices, or are we entering into any new business activities, or is there any major changes, or is there any way of conducting the business activities itself is going to change in the near future? What are the different proposals with which we are coming? Such all explanatory statements, they actually attach on such business matters also. Shareholders are going to discuss in the general meeting, which are known as special business activities. That is different story, put aside. Now, after completion of this general meeting, still the compliance part is not yet over. After completion of this general meeting, within 30 days, the company should file AOC 4. Within 60 days, the company should file either MGT 7 or MGT 7A, depending upon the type of the company. If the company is a one person and the small company and the dormant company, then they can file MGT 7A. Otherwise, they will file MGT 7. What about this, sir? AOC 4 is with respect to financial statements. Sir, ultimately, the financial statements which are prepared by the company is available to public at large. How such financial statements are available to public at large? Such companies should file such financials with MCA, Ministry of Corporate Affairs, through a particular form, which is AOC 4 form. MGT 7 or 7A form is known as annual return, where the shareholders information, how much percentage they are holding, certain all other particulars are in generally entered in MGT 7 or 7A. So these two forms, after filing of these two forms, then the compliance of that particular financial year 2021 is set to be over. Do you understand how the lengthy procedure is in generally adopted by a company in complying the provisions of Companies Act 2013? This is basically in generally happening in any company after completion of a particular financial year with respect to compliance. Okay, just take it back all such concept. Now coming to the concept events occurring after balance sheet date. Sir, now what is the meaning of event occurring after the balance sheet date? Here event includes transaction as well. Event includes transaction as well. Any event or transaction occurred after balance sheet date, but before approval of financial statements by board of directors. Here in compliance system, in generally financial statements are approved by board of directors after preparation of financial statements. Am I right? That is up to that date. If any event or transaction occurred, such an event is known as event occurring after balance sheet date. Simply event occurring after balance sheet date means any event or transaction occurred after balance sheet date, but before approval of such financial statements by board of directors is known as event occurring after balance sheet date. Sir, what is the objective of this standard, sir? Why this standard is inserted? You know, right, in each and every standard, as like we already completed AS20, we already seen the objective. Then what is the objective of AS20, sir? It's quite simple. Event occurring after balance sheet date is broadly categorized into two events: adjusting event, non-adjusting event. Adjusting event and non-adjusting event. What is the meaning of adjusting event? What is the meaning of non-adjusting event? Before knowing that, if the event is the adjusting event, it should need to be adjusted in the current year financials, that is in the year 2020. If the event is a non-adjusting event, if it is significant, then it should be disclosed in the board of directors report. Here I'm not discussing when an event is said to be adjusting event, when an event is said to be non-adjusting event. First, my entire discussion is with respect to if the event is adjusting event, what you should need to do. If the event is the adjusting event, you should need to be adjusted in the current year financials. If the event is the non-adjusting event and if it is significant, and it should be disclosed in the board of directors report. I mean, if the event is the adjusting event, it should need to be reported in the current year financials. If the event is the non-adjusting event and if it is significant, we are not recorded in the current year financials, but we are going to disclose in the board of directors report. That is the accounting treatment with respect to AS4. Now the question is, when an event is said to be adjusting event, when an event is said to be non-adjusting event. Come here. When an event is adjusting event, when an event is non-adjusting event. First, whether the event should be adjusting or non-adjusting, first it should be event occurring after balance sheet date. You know already when an event is said to be event occurring after balance sheet date. It should occur after balance sheet date, but before approval of financial statements by board of directors. After that, Such event to qualify as an adjusting event, which provide further evidence to conditions or situations existing as on balance sheet date. Which provide further evidence to conditions or situations existing as on balance sheet date. If I tell like this, you may not appreciate anything. Let me explain the same with a small example. Please all of you concentrate. Sir, what happened? We are in the financial year 2021. As on Feb 5th, of 2021, our entity made a credit sale to a particular party at the rate of 10 lakhs. At the rate of 10 lakhs. Now, March 25th of 2021, what happened? The premises of our debtor, completely destroyed by a fire accident. Destroyed due to the fire accident. The premises of our debtor destroyed due to the fire accident as on March 25th. Now, what happened? As on April 15th, our debtor became insolvent. As on April 15th, our debtor became insolvent. Board of directors will approve the financial statements as on April 30th. And now the issue is, please all of you concentrate. Now the issue is, as on April 15th, our debtor became insolvent. As on April 15th, our debtor became insolvent. In generally, if any party became insolvent, we are unable to recover amount from the other party. Now, what is the impact due to the insolvency of our debtor? We are unable to recover amount from such debtor. Then you need to create bad debt, or you need to create provision for debtors. Am I right? That is the issue. But if the same insolvency position is occurred before the financial statements, then straight away I'm going to record it as an insolvency loss, which I can simply treat it as bad debt. There is a no dilemma situation arised at that particular scenario. But right now, the thing is, now he became insolvent, which is a transaction or which is an event occurred after the balance sheet date, but before approval of financial statements by board of directors. But before approval of financial statements by board of directors, then such event or transaction is said to be event occurring after balance sheet date, which is an event occurring after balance sheet date. After that, you need to check whether such event is an adjusting event or non-adjusting event. When an event is said to be adjusting event, an event is said to be adjusting event which provide further evidence to condition or situation exist as on balance sheet date. First of all, come to the balance sheet date. As on balance sheet date, what is the condition or situation? The condition or situation is the debtor's premises was completely destroyed due to the fire accident. Destroyed due to the fire accident as on March 25th. That means as on the balance sheet date, the situation or condition is the premises of our debtor destroyed due to fire accident, for which there is a further evidence. There is a further evidence which provide further evidence. Sir, for insolvency is a further evidence. Sorry, the becoming insolvency itself is a further evidence to condition or situation exist as on balance sheet date. What is the condition or situation? He may become the insolvent due to the occurrence of the fire accident. For such, the evidence is getting insolvency petition from the court. Getting insolvent petition from the court, he became insolvent, which is acting as a further evidence to condition or situation as on balance sheet date. Then such an event you can adjust it in the current year financials. I mean, in the current year financials itself, you can create it as a bad debt or you can create it as a PBD. Now the entire amount of 10 lakhs, you can represent it under provision for bad debts. Do you understand? So for example, if there is no condition or situation as on balance sheet date, there is no condition or situation as on balance sheet date, which are indicative of conditions that arose subsequent to the balance sheet date. Sir, a transaction or event occurred after balance sheet date, but before approval of financial statements by board of directors. But there is no conditions or situation existing on balance sheet date. That is nothing but which is indicative of the event occurred. Na? The event is the, or the transaction is the indicative of conditions that arose subsequent to the balance sheet date, then which is treated as non-adjusting event. Sir, in the same example, when it became a non-adjusting event, I don't want to take another example. For the same example, when it became a non-adjusting event, let us assume the fire accident was occurred not as on March 25th. The fire accident is occurred as on April 5th. The fire accident is occurred as on April 5th. And April 15th, he became insolvent. That is the only change. That is the only change. Then can you please, all of you, tell me, as on balance sheet date, is there any condition or situation? No. The condition or situation arose the subsequent to the balance sheet date, because April 5th means the condition is there after the balance sheet date. That means there is no condition or situation exist as on balance sheet date. At that particular circumstance, we can treat it as a non-adjusting event. So simply, when an event is said to be non-adjusting event, when an event is said to be adjusting event. First, let us take the discussion of adjusting event, which provide further evidence to conditions or situations existing as on balance sheet date, then such event we can treat it as an adjusting event. You know, when the event is the adjusting event, it should need to be reported in the current year financial statements. When an event is said to be non-adjusting event, which is indicative of conditions or situations that arose subsequent to the balance sheet date, which is known as non-adjusting event. If it is the non-adjusting event, if it is material, then we are going to disclose in the board of directors report in case of a company. Sir, if it is other than company, we are showing under the approving authorities report. Who is the approving authority? If it is the company board of directors, that is other than the company. If it is a partnership firm, then you may represent under the approving authorities report. That is that management committee report. Whatever the thing is, we can call as per that particular institution type. In that approving authority report, you may disclose. Okay, let it be. Sir, to complete all the problems, then what can I need to check, sir? Please, all of you, come to the last page of my power notes with respect to S4. To tackle the situation, the standard Trojans, how our thought process should be. First, what you should need to check, whether such event or transaction is after balance sheet date, but before approval of such financial statements by board of directors or not. Yes, sir, that is fit. Then the event is said to be event occurring after the balance sheet date. Then that event is said to be event occurring after the balance sheet date. Okay, next. Sir, whether such event is adjusting event or non-adjusting event, how I will know? If there is any further evidence to conditions or situations exist as on balance sheet date, because that party became insolvent, there is a condition or situation exist as on before balance sheet date or as on balance sheet date. That is nothing but fire accident was occurred in the premises of our debtor, which is a condition or situation exist, and the further evidence is becoming insolvency, will be treated as adjusting event, and the effect should be adjusted in the current year financials. And the second situation is which is indicative of conditions arose after the balance sheet date. Now, the fire accident was not occurred as on March 25th. The fire accident is occurred as on April 5th. Then there is no condition or situation existing as on balance sheet date. There is no condition or situation existing as on balance sheet date, which is indicative of conditions arose after the balance sheet date, which is treated as non-adjusting event, and it should be disclosed in the approving authority reports if the amount is material. Do you understand? That standard thought process you should need to be adopted whenever you are tackling a problem. Okay, still the provisions is not yet forward. Very few provisions are there. The standard is very small standard, guys. Now please, all of you, come to the main standard content. Okay, now hope you understand when an event is said to be event occurring after balance sheet date, as well as when you can treat it as adjusting event, when you can treat it as non-adjusting event. If the event is adjusting event, what is the accounting treatment? If the event is non-adjusting event, what is the accounting treatment? You know. Now let us see certain exceptions. And the first and foremost important, only one exception is there. Only one exception is there. The important exception is going concern assumption inappropriate. What is the meaning of exception, sir? Even though there is no condition or situation existing as on balance sheet date, still you can treat it as a adjusting event. That is nothing but exception. Exception means it is against to the provisions. It is against to the general provisions. That is nothing but exception. Even though there is no conditions or situation existing as on balance sheet date, still I should need to be adjusted in the current year financials. Let me take up one illustration. Sir, we are in the financial year 2021. Now, as on 31st March 2021, there is no condition or situation. As on April 15th, major fire accident was occurred in the premises of my customer. He is only one customer. Our entity is having only one customer. We are providing raw material to that party. Our business itself is providing raw material to the company. So for in that company, a major fire accident occurred. Major fire accident means entirely destroyed. The company premises and the manufacturing process entirely destroyed. Sir, if we are not having that customer, our business is also going to close. There is no option to continue our business operation. The going concern assumption itself is inappropriate. We are unable to continue our business activities in the near future due to occurring of this transaction. As on April 30th, that party became insolvent. As on May 15th, financial statements are approved by the board of directors. Now, the first and foremost issue is becoming insolvency is a event occurring after the balance sheet date. Before it occurred after balance sheet date, but before approval of financial statement by board of directors. Now, in general course, if you think, is it adjusting event or non-adjusting event? There is no conditions or situations exist as on balance sheet date, or is indicative of condition arose after the balance sheet date, because the condition is occurring of the major fire accident which was occurred as on April 15th. That's why in the general course we can simply thought it as it is a non-adjusting event. But the thing is, due to occurrence of the transaction or event, is it your going concern will impact? Yes, sir. If you feel like that, even though there is no condition or situation existing as on balance sheet date, still you can treat it as adjusting event. Adjusting event means for the year 2021, the financial statement should need to be prepared on realization basis, liquidation basis. I mean, sir, fixed assets at what value I can adopt at the rate of realizable value, at the rate of realizable value. Closing stock at what price I should need to record at the rate of NRV value. Do you understand? So even though there is no conditions or situations exist as on balance sheet date, still you are treating like as an adjusting event. This is the only one exception. So insolvency loss in 2021 should need to be insolvency loss arised due to such insolvent debtor should need to be reported in 2021 and prepare the financial statements on the liquidation basis, even though there is no conditions or situations exist as on balance sheet date, or even though conditions or situations arose after the balance sheet date, because the going concern assumption itself is inappropriate. Do you understand the exception, guys? Next, come below the dividend situation. I already explained this. This is I mean, I can tell you like ancillary thing. So just for knowing information, sir, proposed dividend in generally proposed in the proposed by the board of directors in the board meeting. This is after balance sheet date, but before approval by the board of directors. Even though this transaction is occurred before approval by the financial statements by board of directors, still in generally it is not reported in the financial statements. It is in generally disclosed under the notes to accounts. The proposed dividend is just disclosed under the notes to accounts. Proposed dividend never adjusted in the financial statements. Straight away the information is given. No need to check whether it is adjusting event or non-adjusting event. Even though it is an event occurred after balance sheet date, even though it is an event occurred after balance sheet date, no need to check whether it is adjusting event or non-adjusting event. It is always a non-adjusting event. I mean, not adjusted in the current year financials. It is simply just disclosed under the notes to accounts. This is a special accounting treatment we are giving for the proposed dividend. Coming to the declared dividend, sir, declared dividend, in general, dividend is declared in the general meeting by the shareholders. It is the liability in that year in which it is declared. In which year it is declared, it is the liability of that particular year. Sir, where it is shown, sir? Where it is shown, sir? Declared dividend, that is shown under current liabilities. If it is not paid at the time of preparation of balance sheet, under other current liabilities, that is dividend payable is there, na? Dividend payable is shown under other current liabilities. Now, even though proposed dividend is an event occurring after balance sheet date, we may not check it is a non-adjusting or adjusting event. It is always a non-adjusting event. Simply we are disclosing under the notes to account, special accounting treatment. If the dividend is the declared dividend, it should be shown as a liability of the particular year in which the dividend is declared, which is shown under current liabilities, under other current liabilities, under the name dividend payable. So those are the important issues we can simply discuss in accounting standard 4, guys. Sir, but even though the provisions of AS4 are is not lengthy, it's very much easy provisions, but unless otherwise, if you are facing certain practical issues, you may not appreciate the application part of such provisions. So that is the reason I'm going to take up certain problems in the marathon session itself. Please all of you concentrate. So one by one illustration, let me discuss. I don't want to give any problem. I will explain the illustration with the answer itself. I will explain the situation, then you can start your thought process in your mind. What is the situation, sir? Sir, we made a credit sales in a particular financial year, that is before 31st March itself. Now, certain checks we are collected from our debtors after 31st March. The checks we are collected from our customers after 31st March, but in the check, the date bearing is either 31st March or before. Our entity collected certain checks from the customers bearing the date either 31st March or before, after 31st March. But such checks are collected, but before approval of financial statements by board of directors. Now the question is, such checks, can we adjust or can we treat as checks in hand? Can we treat such checks as checks in hand for the financial year? That is the question. What he is indirectly asking you, can I consider such checks as an adjusting event? And can I decrease the debtors balance? That is checks in hands account debtor to debtors account. Can I pass that journal entry for the current financial year? That is the question. Now, you should start with the provisions. First, checks collected from the customers after balance sheet date. Is it event occurring after balance sheet date? If such checks are received by the entity after balance sheet date, but before approval of financial statements by board of directors, then which is event occurring after balance sheet date. Now, is such event occurring after balance sheet date is an adjusting event or non-adjusting event? You need to check. Is there any condition or situation exist as on balance sheet date? Do you receive such checks before the balance sheet date or as on balance sheet date? Then there is a condition. You are not receiving such checks as on balance sheet date. You are receiving such checks after balance sheet date. Maybe the check contains 31st March or before the date. The issue is, the condition is, do you receive such checks before 31st March? No. Maybe the check contains March 25th. Maybe the check contains March 20th date. But the thing is the check is in your control before 31st March. Is there any condition or situation? No. If there is no condition or situation, or the conditions are which is the indicative of the conditions or situations arose after the balance sheet date, which is treated as non-adjusting event. Then the checks collected after the balance sheet date, but the checks bearing 31st March or before the 31st March, we cannot adjust it in the current year financials if the entity passed the entry checks in hand to the debtors account, which is violation or against the provisions of accounting standard 4. The same thing here I explained. Conclusion, no need to report in the current year financials and no need to disclose in the board of directors report because it is immaterial. I told you, if the amount is the material, then only it need to be disclosed in the board of directors report, even though if it is a non-adjusting event. So accounting treatment is not at par with AS4. And one more thing, guys, one more thing. How you can tell, sir, checks are not within the control of your enterprise? When the check is said to be asset of the organization, when a check is said to be asset of the organization, if the other party issued the check and the check is received in my premises, maybe other party issued the check but still it was not in your premises means, can I treat the check as an asset? No, because to qualify a particular item as an asset, it should qualify the definition of asset as well. Asset is a resource which is controlled by the enterprise having the capability of generation of future economic benefits. But asset is a resource controlled by your enterprise. The controlling power itself is not in my hand, because if the other party can stop the check, then I may not receive the amount, even though the check contains the date as the 31st March or before the date. That's why the check is not in my control till the check is received my premises. So that's why the controllability is not in my hands. Asset is a resource controlled by the entity, occurred due to some past events, which have the capability to generate some economic cash flows or economic benefits. The controlling power is not in my hands, not in organization hands. That's why such checks collected after the balance sheet date are not in my control. That's why I cannot treat it as asset as well. So in two dimension, actually they given the answer. One is as per AS4, another one as per the definition of asset as well, which is the complete answer. There is a difference between correct answer and complete answer. You know, the correct answer is if you write the provisions of AS4 with this, then the answer is over. But when the answer is complete, if you provide the answer, if you provide or if you support the answer with the definition of asset as well, then only it will become the complete answer. Then you may have a doubt that, sir, in the examination, for which answer they will awarded the marks, for the correct answer or the complete answer. They will awarded the full marks for complete answer. Even you might wrote the correct answer as per the provision, but you didn't complete the entire answer. So only for the complete answer only they will awarded the good marks. So this is a classic example for difference between the correct answer and complete answer as well. Next, sir, in the same scenario, I will add one more thing. For example, our checks were collected by our agents before 31st March itself. Our agents, sir, collection of the checks we are assigning to one other party will collect checks on behalf of us. Our agents collected the checks before 31st March, but such checks are received by the organization after 31st March. Then what will be your answer, sir? Then there is a condition or situation existing as on balance sheet date. Because once the checks were collected by our agents means, in case of principal agency relationship, the principal is responsible for the agent action. Once the agent collected means the principal is also collected. Even though such checks are physically not received within the premises, our agents already capture such checks on their hands, and the controllability is within our hands. So that's why at that point of time, there is a condition or situation existing as on balance sheet date. Then you can treat such checks or checks in hand, and you can credit the debtors account, and you can show it as under asset in the balance sheet by treating it as an adjusting event. This is the ultimate conclusion of the first illustration. Next, let me explain the second scenario. This is very beautiful scenario. Please all of you concentrate. What happened first I will explain. We are in the financial year 2010-11. In 2010-11, cashier theft cash in the month of Jan 2011. But that fact is not known to the management till May 2011. In May 2011, actually the theft was detected. In May 2011, the theft was detected. You know, loss occurred due to theft is the abnormal loss. Now, my question is, such abnormal loss is going to be recorded in the financial year 10-11, or such abnormal loss is going to be recorded in the financial year 11-12? Now, the question is first, is it event occurring after balance sheet date? Yes, sir. The detection of theft occurred after balance sheet date, but before approval of financial statements by board of directors, sir. Then which is an event occurring after balance sheet date without having any second thought. Now, sir, is there any condition or situation existing as on balance sheet date regarding this theft? Yes. Cashier made a theft in the month of Jan itself. Sir, but the condition or situation not known to you now. Not necessary. Not necessary. Is there any condition or situation or not? Yes, condition or situation already exists in the month of Jan itself. But knowing such condition or situation as on balance sheet date is necessary, sir? Not required. Is there or not? Yes. Is it necessary to know that condition or situation exists as on balance sheet date? No. The same answer I wrote here. Condition or situation exists as on balance sheet date? The answer is yes, but not known. But not known. Yes, it is there, but not known. Not relevant for me. Knowing of such condition or situation as on balance sheet date, is it relevant? No. but condition or situation exists. Yes. Is there any further evidence? Yes, the theft was detected. There is a further evidence. Yes. That's why, which is an adjusting event. Abnormal loss of 5 lakhs due to the theft reported in the year 2010-11 itself, which is one more classic illustration just now we completed. So what we realized from this illustration, guys, knowing of that condition or situation is not relevant. Existence of such condition or situation is only the relevant to treat it as an adjusting event. Come to the next illustration. What is this, sir? Sir, in 2011-12, maybe we made certain sales. Now, as on 20th May 2012, a major warehouse of our customer is damaged due to the fire accident. Now the date of approval of financial statements is 30th 6 2012. Even though there is no condition or situation existing as on balance sheet date, which is a major warehouse, if the going concern is inappropriate, then you can treat it as a adjusting event, and you can create the entire loss in the year 2011-12 itself. Loss of 30 lakhs should be adjusted in the financial year 11-12. But if you are treating still the going concern assumption is appropriate, that depends, sir. Still, if the major warehouse is destroyed, still there is a chance of continuing your business operations, sir. Then, which is disclosed in the board of directors report if the amount is material. That is simply if the going concern assumption is inappropriate, then you may treat it as an adjusting event. If the going concern assumption is appropriate, you are still it is continuing as non-adjusting event. That we already discussed through illustration. Next, this part also I already given. Problem number 4 I already explained, so which I taken. This is important issue. Please concentrate. What is this? I'm going to explain. Sir, the issue is for the year 2010-11, as on 31st March 2011, the situation is we made a certain negotiation with the other company for the purpose of acquisition. That is putting the investments in the other company, which is nothing but acquisition of another company, which I made a negotiation. The price is still not yet fixed. The bargaining procedure is going on. Now, as on April 11th, we bought that company. We made an acquisition in another company. Now the issue is, can I adjust that investment in the year 2010-11 or in the year 11-12? First of all, is that acquisition of another company is occurred before approval of financial statements by board of directors? Yes, sir, absolutely. Which is event occurring after balance sheet date. Is there any condition or situation existing as on balance sheet date, sir? Negotiation is there, sir. But for you, I'm revealing negotiations we cannot treat it as a conditions or situations. Negotiations we cannot treat it as a conditions or situations. Condition or a situation is a concrete thing, should need to be happen. Is it, if you made the negotiation, that means that means you are buying that product? No. If you're already entering into the agreement, then which provides a condition or situation for buying that product. Negotiation we cannot consider as a condition or situation. Why? First, I told you negotiations are there. You may feel that such negotiations are conditions or situation. So conditions or situations as on balance sheet date, negotiations you cannot consider as a conditions or situations. That's why there are no conditions or situations. That's why which is a non-adjusting event. If you feel that if the amount is material, then you can be disclosed in the board of directors report. That's it, guys. Next, come to another issue. This issue also we discussed. I don't want to take up one more time. That's it, guys. So the important issues also I discussed. So what are the conclusions we made from such issues, sir? From the first one, from the checks issue, what we made, even though the checks bearing the date before 31st March, if such checks are not received by our enterprise, there is no condition or situation. In another case, theft happened in the year, but which is not known to you. Condition or situation exists, not knowing to you, which is irrelevant. Exist or not is only the relevant to decide the event is an adjusting event. Next, Sir, going concern assumption is inappropriate, even though if it is non-adjusting event, you need to be adjusted in the current year financial statements. The catchy points are major warehouse, major things are occurring. So like that, they are providing in the problems. With this, S4 is absolutely completed, guys. Most awaited standard and a confusing standard to all of the students is AS22, accounting for taxes on income. So the chapter title is AS22, accounting for taxes on income. Taxes on income is nothing but income tax. So this standard is with respect to accounting for income tax. Before directly proceeding with this standard, first just I want to give a very good introduction with respect to AS22. So the reason is this is not as like the normal standard. So the reason or the objective to understand this, it will take some time. To understand the reason or objective itself, it will take some time. So that's why first, before proceeding with the main content, let me give introduction issue. Sir, you know, coming to income tax part, there is a separate act called Income Tax Act 1961 is there. We will calculate tax based on the taxable income, not based on the accounting income. Accounting income means income calculated as per financial accounting is nothing but accounting income. Income calculated as per Income Tax Act 1961 is known as taxable income. Each and every SSC in India should need to adopt the provisions of Income Tax 1961 to calculate tax on taxable income. Am I right? But what is the meaning of income as per financial accounting, which is nothing but profit or loss as per statement of P&L, which is net profit before tax. Now the issue is, can I calculate tax on financial accounting income, or can I calculate tax on taxable income as per Income Tax Act 1961 is the question. For example, if you tell your answer that, sir, I will follow Income Tax Act 1961, then I will calculate the tax, which is a real tax I'm going to book as per the financial accounting. If your argument is like this, then immediate question will be, if you are not taking the income as per the financial accounting books of accounts, you are not following the concept of matching. Then the immediate argument is you are not following the matching concept, because if you take the financial accounting books, one rule is there in financial accounting. Whatever the expenditure you are going to book in the statement of P&L, the relevant income you should need to offer. But in the statement of P&L, the income you are offering is net profit before tax, but the tax you are offering is based on the taxable income. Is it true? Then do you following the concept of matching? No. Then to follow the matching concept, I need to book tax in financial accounting based on accounting income. There is no doubt about it. To follow the concept of matching, I need to calculate the income as per accounting records. I will book tax on such accounting records. Now, the tax which is going to be booked on accounting income is technically known as tax expense. In statement of P&L, you should need to book tax expense. If you want, I'll show the statement of P&L here, which is tax expense. Where it is there, here it is exist. The name itself is tax expense. Such tax expense you need to calculate based on the accounting income. There is no doubt about it. The next question is, sir, why actually tax calculated on financial accounting income and tax calculated on the taxable income will differ? If both are same, then any income you can consider, right? But why tax calculated as on financial accounting and tax calculated based on the taxation records will differ? The differences may be due to various reasons. The differences may be due to various reasons. I'll give one reason here. Please, all of you concentrate here. I'll give one reason here. Let me take the example of depreciation. Sir, I purchased a machinery for 50 lakhs. For the taxation purpose, I can claim the entire 100% depreciation in year one itself. There are certain sections are there. Maybe you are utilizing such machinery for research purpose. Then you can claim the 100% depreciation in year one itself. But for financial accounting, let us assume I followed the SLM basis. I'm going to claim the depreciation over a period of 5 years. Then if you check depreciation for accounting as well as taxation records separately, for year number one, depreciation with respect to tax is 50 lakhs and with respect to accounting is only 10 lakhs. For the remaining all the 4 years, accounting records depreciation will be 10 lakhs per annum, but for the taxation records, depreciation is nil because you already claimed the entire depreciation in year number one itself. Now, if you check the except this component, let us assume except this component, remaining taxable income and accounting income is both are same. Just let us assume. Now, due to this component of difference in depreciation will definitely arise, there is a difference in accounting income and taxable income. Now, how much difference is there in year number one? The difference will be 40 lakhs. In year number one, the difference will be 40 lakhs. What is the impact? You are claiming the less depreciation as per accounting means more accounting income is less than more accounting income while compared with the taxable income. That is, accounting income is greater than the taxable income. Am I right? In year two, what is happening, still the difference is continuing. The difference is 10 lakhs. Year three difference is 10 lakhs. Year four difference is 10 lakhs. Year five is difference is 10 lakhs. What happened, the difference is accounting income less than taxable income from year two onwards. From year two onwards, accounting income is less than the taxable income. Really, what happens, sir? The timing difference which is arised in year number one, which is accounting income is more than the taxable income, is reversal in the future periods. In the reversal in the 4 future years, that is accounting income is less than the taxable income. The 40 lakhs difference which was arised in year number one is going to be nullified year by year. After completion of the 5th year, the entire difference is nullified. If you consider the entire 5 years as a single period, let us, for the time being, you can consider the entire 5 years as a single time period. What is the total depreciation considered as per the accounting records? 50 lakhs. What is the total depreciation you claimed for the taxation record? 50 lakhs. There is no difference in between accounting income and taxable income. If you consider the entire year as entire period, if you consider the total number of years as a single period, but if you consider a single year, then there may be a chance of arising the difference between accounting income and taxable income. If that is the case, then the difference is said to be timing difference. If that is the case, the difference is said to be timing difference. Sir, why you are explaining all such things, sir? It's a very simple reason. We already concluded that in our statement of P&L, to satisfy the concept of matching, I need to book the tax expense based on accounting income, which is based on accounting income. Now, this accounting income we are going to present. That means the tax expense we are going to present in 2 different components. The tax expense, which is based on the accounting income, we are going to make it present into 2 different components. One is tax on taxable income, current tax, which is tax on timing difference, which is deferred tax. The component is tax expense only, guys. The component is tax expense only. Just a moment. So the component is tax expense only. The tax expense, how we are going to present, I'm representing here, concentrate. The tax expense is tax on accounting income. The same tax on accounting income are going to represent under current tax and deferred tax. What is this current tax, sir? Current tax is tax on taxable income. Deferred tax is tax on timing difference. Now concentrate here. For example, if you come to the first year, if you come to the first year, or let me take another example. Please all of you concentrate here. The example is here only. Please concentrate. Sir, as per the financial accounting, the income net profit before tax is 10 lakhs. But as per the taxable income, as per the taxation records, the taxable income is 8 lakhs. Now, first, if you go to a tax expense, as per the AS 22, based on the concept of matching, the tax expense is based on tax on accounting income, right? So tax on accounting income means accounting income is 10 lakhs. Let us assume the tax rate is 30%. 10 lakhs into 30%, which is nothing but 3 lakhs is the total tax expense. There is no doubt about it. So tax expense will be 3 lakhs, absolutely. Now such 3 lakhs tax expense is going to be divided into two different components. One is current tax, another one is tax on timing difference. What is this current tax? Tax on taxable income. Sir, here I decided taxable income as 8 lakhs, right? Now 8 lakhs into 30%, which is 2.4 lakhs, plus maybe you got the difference na, in between this 10 lakhs as well as 8 lakhs, you got certain difference. If that difference is the timing difference, then you need to add tax on such timing difference as a deferred tax. So the difference itself is 10 lakhs minus 8 lakhs, which is 3 lakhs. The difference is 3 lakhs. 3 lakhs into 30%, which is nothing but how much, guys? So difference is 2 lakhs, right? So 2 lakhs into 30%, the difference is 60,000. So the total tax is itself is 3 lakhs. I mean, what is the a concept involving inside that, sir? It's quite simple. What I am doing, I am booking tax on accounting income only in overall, but how the tax on accounting income I'm going to book, which is tax on taxable income. Along with it, I am adjusting the difference in between the taxable income and accounting income. One more time repeating. In overall, I am booking tax on accounting income to satisfy the matching concept. But how such tax expense, which is tax on accounting income, how I am going to book, which is tax on taxable income, which is current tax, as I am adjusting the tax on timing difference as a deferred tax. Do you understand? Next. Now, please all of you concentrate. The conclusions are, in our financial accounting books, I need to book the tax expense based on the accounting income. But such tax on accounting income, I'm going to represent in the two different components. One is tax based on taxable income with adjustment of tax on the difference of income in between accounting and taxable incomes. And that difference should be timing difference. When the difference is said to be timing difference, maybe for a particular accounting year, there may be difference in between accounting income and taxable income. But if you check the overall period, there is no difference between accounting income and taxable income, then the difference is said to be timing difference. Or you can put it in another way. Difference arised in one accounting period and capable of reversal in one or more subsequent future periods, then the difference is said to be timing difference. If you check here, the difference is arised in one accounting period and which is capable of reversal in one or more future periods, then the difference is said to be timing difference. Is it okay, all of you? Now, sir, as per your discussion, in the statement of P&L, I need to book tax expense, sir. The tax expense you told, which is the combination of current tax and deferred tax, which is the combination of current tax and deferred tax. Tax expense is nothing but tax on accounting income. That's okay, fine. Now the scenarios are like this. What is that? The first scenario, please all of you concentrate. For the current year, accounting income is greater than taxable income. That is accounting income, what I told in the earlier example, 10 lakhs, and the taxable income is 8 lakhs. Now you got the difference of 2 lakhs, right? The difference of 2 lakhs, let us assume for the purpose of depreciation, the difference may going to reversal in future periods, then the difference is the timing difference. Am I right? Now first, how I need to book tax on taxable income, which is current tax, 8 lakhs into 30%, which is 2.4 lakhs, plus Deferred tax. Deferred tax is the difference in tax in between accounting income and taxable income due to the timing, due to simple timing. Now the 2 lakhs into 30%, which is 0.6 lakhs, which is 3 lakhs, you are going to represent like this in the statement of P&L. Now the timing difference which is arised in the first year is known as year of origination. How much timing difference arised? 2 lakhs timing difference is arised. Am I right? Such timing difference is going to be reversal in the future periods. Then only the timing difference is known as, sorry, if the difference is going to be capable of reversal in the future periods, then only the difference is known as timing difference. Let us assume the difference is going to be reversal in year 2, year 3, year 4, year 5. How much, sir? 50,000 reversal in year 2, another 50,000 reversal in year 3, 50k, 50k. Like this, it is going to be reversal. Let us assume. Now, in the year of origin, accounting income is greater than taxable income. Then for this timing difference, I need to create deferred tax liability. Sir, why it is known as liability? I know, I understand one thing, which is a deferred tax, because which is occurred due to the difference, in between accounting income and taxable income, which is difference in tax. Now on such 2 lakhs, 30% is, I need to create a, one second. On the 30% is, that is 60,000, I need to create deferred tax. I know that. Then why again you are talking the word deferred tax liability? Why you are treating it as a liability? It's a very simple reason. You are telling that as per the taxation records, the liability is only 2.4 lakhs. But as for the accounting perspective, the liability will be 3 lakhs. That means still in accounting perspective, still 60,000 need to be reported as a liability. Then only the total accounting will become 2 lakhs. As per the taxation records, you are telling that the liability will be only 2.4 lakhs. But as per the accounting, you are telling that 3 lakhs means excess liability you need to be reported as a difference to the extent of 60,000. That's why which is treated as deferred tax liability in the year of origination, which is known as DTL origination. So then future periods, which is known as DTL reversal. The deferred tax liability which was arised in year number 1 due to excess of accounting income over taxable income is capable of reversal in future periods in the name of DTL reversal. DTL reversal. Sir, now what are the journal entries you are going to pass both for this current tax as well as deferred tax? Please all of you concentrate here. Accounting treatment for current tax, which is tax on taxable income. The entry is current to tax account debtor, to provision for tax. Current to tax account debtor to provision for tax. This is the accounting treatment. I'll already shown with my power notes. Just a moment, we can save some time here. Now, what is the journal entries you can pass, sir? In the year of origin related to deferred tax with respect to deferred tax liability. When deferred tax liability will come, if accounting income is greater than taxable income, then deferred tax liability will come. As per accounting, we need to report more. That's why the difference you should need to be adopted as a liability, which is a deferred tax liability. Am I right? But before explaining the journal entries for deferred tax liability, first I'm explaining the entries for current tax, right? What is the entry for current tax? Current tax account debtor to provision for tax is the journal entry. Expense to liability. Sir, if you want to report any liability, the entry is P&L to liability. That is expense to liability. The same entry you recorded current tax to provision for tax. Current tax will be charged to the profit and loss account. So profit and loss account debtor to current tax. So the net entry is actually P&L to provision for tax is the net entry. By the combination of these two entries, the net entry is P&L to provision for tax. Now, where this provision for tax you are going to show, sir? Under current liabilities, under short-term provisions, you will shown in the schedule 3 balance sheet. Is it okay, guys, all of you? Then come to the accounting treatment for this deferred tax. In the first issue, in the situation of DTL, deferred tax liability, when accounting income is greater than taxable income in the year of origination, again the entry is same, expense to liability. Expense is deferred tax to liability, deferred tax liability. Sir, this deferred tax liability where we are going to show, sir, it is shown under non-current liabilities. So you may come across this deferred tax liability and the deferred tax assets in the balance is schedule 3 format, where the deferred tax liability we are showing under the non-current liabilities. The first head is the long-term borrowings. After the deferred tax liability only we will represent. Now this deferred tax should be closed and transferred to the profit and loss account. Then in the year of reversals, this is in the year of origination. This is in the year of origination. But in the year of reversal, now the originated amount of 2 lakhs is going to be reversal now. Now in the year of reversal, the entry should need to be reversed. That is DTL to deferred tax. Entry DTL to deferred tax accounted are to profit and loss account. This is with respect to deferred tax liability accounting treatment. Now, if you check the statement of P&L, please all of you concentrate. If you check the statement of P&L, I started with profit before tax. Only which components I am going to discuss, concentrate on such components. Remaining you can simply left. Profit before tax I will start. Less tax expense, which is tax on accounting income, which is a combination of current tax, which is tax on taxable income. Sir, why you added current tax, sir? What is the entry for current tax? Current tax to provision for tax. P&L to current tax. Then in P&L, you should need to add it as an expenditure as current tax. So under that, the first component is current tax. Next, deferred tax liability, if it is the origination. Why I added the deferred tax originated amount? Sir, what is the entry for deferred tax here? Deferred tax to deferred tax liability, P&L to deferred tax. Under P&L debited means we are added to the expense, which is deferred tax liability origination. Then in the reversal period, what will happen? Deferred tax is credited under P&L. There is decrease in expenditure. That's why I need to reduce the deferred tax liability reversal expense. This is with respect to DTL. Then when DTA will arise, sir? Sir, in the same scenario, if you can imagine the opposite version, that is, if the accounting income is less than the taxable income, if accounting income is less than the taxable income, let us assume the taxable income will be 10 lakhs and the accounting income will be 8 lakhs. Now I need to book tax as per accounting income, but tax on taxable income, 10 lakhs into 30%, 3 lakhs is the current tax. 3 lakhs is the current tax, but tax on accounting income is only the 2.4 lakhs. Then 2.4 lakh is equal to 3 lakhs minus deferred tax here, minus deferred tax here. Now the deferred tax is treated as deferred tax asset, DTA. The deferred tax is treated as deferred tax asset when the accounting income is less than the taxable income. Sir, why you are representing it is under deferred tax asset, sir? It's quite simple. You are telling that tax on taxable income is 3 lakhs. But as per the accounting income, I need to report the 2.4 lakhs. Excess of tax you already reported as per the taxable income, right? The excess what you paid in the form of tax, I represented in the form of asset, which is the difference in between taxation records and accounting records, which is nothing but the difference of tax asset, which is DTA. So that's why if DTA origination, what is the journal entry I need to pass? If is the DTA origination, the entry is deferred tax asset account data to deferred tax account. Because if it is a liability, expense to liability. If it is asset, asset to income, asset to income. If it is a liability, expense to asset, you know the basic accounting equation approach, increase in expenditure should be debited, increase in liability should be created. Here increase in asset should be debited, increase in income should be credited. Here the deferred tax component is the credit aspect, which is an income. So deferred tax account data to profit and loss account. Now in the year of reversal, what is the entry? Entry should need to be reversed now. Deferred tax to DTA, deferred tax to DTA, and P&L to deferred tax. Now all of you please concentrate. Sir, in the year of origination, deferred tax is credited to the P&L. Credited to the P&L means you need to be reduced from expense. That is the reason why in statement of P&L, the deferred tax asset origination should be reduced. And in the reversal period, the opposite sign you need to be adopted. which is the presentation in statement of P&L as well as balance sheet. In balance sheet, how it is presented? Deferred tax liability is presented under non-current liabilities, and a deferred tax asset is presented under non-current assets. But one thing here I am revealing, you are not representing both DTL and DTA at the same time. Either you represent net DTA or net DTL only. For example, for a particular component, your DTL is erased. For another component, DTA is erased. Now DTL is knock off with DTA, then you are representing only net DTA or DTL only after considering the reversal items as well. Only either deferred tax asset or deferred tax liability, only one thing is shown under balance sheet. And a provision for tax with respect to current tax, where it is shown, which is shown under short-term provisions, but which is shown under either non-current asset or non-current liability, depending upon whether it is DTA or DTL. Okay, so this is the story, guys. The next question coming into my mind is, sir, you are telling that accounting, that is tax on accounting income, is equal to tax on taxable income plus tax on plus or minus, just it is an adjustment, tax on timing difference, right? This equation given by me, right? Tell me, guys, this equation given by me. Now tax on accounting income is nothing but, I told you, which is current tax expense. Tax on accounting income is nothing but tax expense, right? Is equal to tax on taxable income, which is current tax. Tax on taxable income is current tax. Why I wrote plus or minus, which is tax on timing difference. Such timing difference may be origination or the reversal. Such timing difference may be DTA or DTL. If the timing difference is with respect to DTL and the origination period, it should be added. If the timing difference is with respect to be reversal and which is DTL, it should be reduced. And which is DTA, origination period, which is reduced. Which is DTA with respect to reversal period, it should be added. So it's might confusing. You don't remember with respect to the reversal period, you can simply remember with respect to the origination period. In reversal period, you can simply adopt the opposite sign. But how your thought process need to be adopted here? If accounting income is more than the taxable income, you need to report much more tax based on the accounting. That's why which is deferred tax liability. But if the accounting income is less than the taxable income, you already paid more tax as per the taxation records. The excess amount you paid as per the taxation records, we may adopt it as a deferred tax asset. Like this, your thought process need to be adopted in identifying DTA or DTL in the year of origination. If you can able to identify in the year of origination, in the year of reversal, you can simply put the opposite sign. The next question coming into my mind is, sir, you are telling that the difference between accounting income and taxable income is due to the timing difference, then only we need to create the deferred tax. If the difference is the pure timing difference, if the difference is pure timing difference, then what you told, you can create deferred tax asset or deferred tax liability. If the difference is timing difference, you know the accounting treatment, which may be a DTA or DTL. Sir, but if the difference is not the timing difference, which is a permanent difference, sir, the difference is permanent in nature, which will not capable of reversal in one or more subsequent future periods. The difference is occurred in the current year, which will never capable of reversal. That means permanently it is different. Then what should I need to do, sir? You can simply ignore. For the permanent difference, S22 doesn't applicable. So once the accounting income and taxable income coming to takes place, then first you need to start your thought process like this. The difference, is it timing difference or permanent difference? It is a permanent difference, ignore. If it is a timing difference, then you need to check accounting income is greater than taxable income, then create DTL. No, accounting income is less than taxable income, then create DTA. This is in the year of origination. If it is capable of reversal in future periods, then it will become DTA reversal. In this case, it will become DTL reversal. In reversal, what happened? In reversal, accounting income is less than taxable income in this scenario. Here, reversal means accounting income is greater than taxable income here. It is accounting income less than taxable income. Here, accounting income is greater than taxable income in case of reversal periods. Now, in the statement of P&L, how I need to be presented? In the statement of P&L, we will start with a tax expense. Yes, we will start with tax expense. Tax expense is nothing but tax on accounting income, but it is represents two components. One is tax on taxable income, which is current tax, which is tax on taxable income. Then if it is DTL origination, then you can add DTL originated related expense. Sir, if it is DTL reversal, then you may reduce the DTL reversal. Sir, if it is related to DTA origination, you may reduce the DTA origination. If it is DTA reversal, then you may add to the DTA reversal. Then after adjusting all such deferred tax components, then you will get the total of tax expense. Now in the balance sheet, what is the treatment? In the balance sheet with respect to this current tax, you may represent it under as a provision for tax. Provision for tax, you may represent it under short-term provisions under current liabilities. Then what about this deferred tax asset or deferred tax liability? Either you may represent DTA or DTL, which is on net basis. If it is DTA net, you may represent under non-current assets. If it is DTL under net basis, you may represent under non-current liabilities. This is the treatment we can done. Then which differences are timing differences, which differences are permanent differences, that is your duty. I will give certain examples for permanent differences for better understanding. Please concentrate here, certain examples for permanent differences. Fines and penalties. Sir, fine is there. As per Income Tax Act, fine or penalty is not allowed as under P&L. But as per the financial accounting, we are treated as an expenditure. Agriculture income is exempted in taxable records, but which is treated as an income for financial accounting, which never, sir, if you consider under accounting income, but if you are not considered under taxable income, means which is a permanent difference, which will never capable of reversal in the future periods. Expenses which are disallowed forever as per the Income Tax Act. Example, section 40A of the Income Tax Act. I mean, if any cash expenditure paid in excess of 10,000 per day per transaction, then at that particular circumstance, that expenditure is straight away disallowed as per the Income Tax Act. But for financial accounting, whether it is paid in the form of cash or whether it is paid in the form of any other way, that is irrelevant for me. I will treat it as an expenditure only, which are permanently disallowed as per the income tax, but which is allowed as per the accounting records. That means as per the accounting, income is less, but as per the taxation records, the income is more, which is not disallowed now, then which is a permanent difference. Income taxes paid. Sir, taxes paid by your entity, which is allowed as per the accounting, but which is not allowed as per the taxation records. That's why accounting income is less than the taxable income, which create permanent difference. Donations not covered under section 80Z. I explained through my power notes this is important. Please concentrate here. What will happen? I'm explaining here. For example, Raj Limited is there. Raj Limited donated certain amount, that is 10 lakhs, to a trust. The trustees, which is not registered under section 12AA of the income tax, and if a trustee is not registered under section 12AA of the income tax, then whatever the amount donated to that particular trust will not be allowed as a deduction to that company, will not be allowed as a deduction to that particular SSC. If that particular trustee is covered under section 12A of the Income Tax Act, then if you made any donation to that particular trust, then the income tax, as per the Income Tax Act 1961, it will be allowed as a deduction under section 80Z. Now the trustee is not registered under section 12AA. That's why if you provide any donation to that particular trust, then which is not allowed a deduction for that particular SSE. So due to this, what happens, sir? If you made a donation for financial accounting, which is treated as an expenditure, but for income tax, which is not allowed as an expenditure, because ATG deduction is not allowed, because if the trust is not registered under section 12AA. Now the difference is erased, which is 10 lakhs, which is a permanent difference, which never capable of reversal in the subsequent period. But if you see my example of depreciation here, which difference is erased in a particular accounting period, but which is capable of reversal in subsequent periods, which is a timing difference, but which are a permanent difference. Hope you understand certain examples for permanent difference. Sir, in the same way, I'll try to give certain examples for timing difference as well. Please concentrate examples for timing difference. Most of the cases it will come. Sir, section 43B. What is the meaning of section 43B? As per Income Tax Act 1961, these expenses are allowed on actual payment basis. If you paid as per income tax, they are allowed. But for our financial accounting, we are allowing expenditure based on the accrual, not on cash basis. For example, taxes, duties, cess are there. They will be allowed as per the income tax, other than income tax. Out of this tax, income tax is anyway not allowed. Other than income taxes, any taxes, GST, duties, cess, okay, for such all things allowed as an expenditure as per the income tax on cash basis. But as per our financial accounting, we are not following the cash basis, we are following the accrual basis. Bonus paid to the employees, if it is really paid to the employees, then only allowed as an expenditure as per income tax. But in the accrual year itself, it is allowed as per the financial accounting records. Contribution to PF, superannuation funds, any amount related to the Indian Railways, payable to the Indian Railways. Indian Railways, that is as per the accrual concept, we are already allowing as an expenditure, but on the actual payment basis only for Income Tax Act, we are going to allow. Then what happened, here I gave an example, please concentrate. Sir, for financial accounting, in the year of accrual itself, I erased. But for the taxation, you are not paid, let us assume in the year 2021, that's when not allowed. Now there is a difference between accounting income and taxable income, which is capable of reversal in the next accounting period. Because in taxation records, the expenditure is allowed in the year of payment. Now in 21-22, payment was made. But in the financial accounting, not based on the cash system, we already allowed in the last year. Now here, the accounting income is less than the taxable income. The same is capable of reversal here, which is accounting income is greater than the taxable income. If accounting income is less than the taxable income, what happened? Here DTA is erased. The DTA is capable of reversal in the next accounting period, which is DTA reversal. Like this, you need to check, which is a pure example for the timing difference. Next, one more example here given. Certain expenses like preliminary expenses, amalgamation expenses, they can be allowed as per the taxation records for over a period of number of years, but as per the accounting records, we are treating as in the year of occurrence itself. So let us take the example of preliminary expenses. As per section 35D of Income Tax Act 1961, it is allowed over a period of 5 years, but as per the accounting records, it is allowed in the year number 1 itself, which is again pure timing difference. Because in year number 1, accounting income is less than again the taxable income, and which is capable of reversal in 1 or more subsequent future period of 4 years. Then in the over the 4 period years, accounting income is greater than the taxable income, which is DTA reversal. Okay, so the same example I continued here in the year number 1, which is a DTA origination, in the remaining 4 years, which is DTA reversal. Next, come to point number 3, maybe due to the depreciation amount. As per the accounting, depreciation is something, but as per the taxation, depreciation amount is something. The depreciation difference may arise due to rate of depreciation, because for accounting purpose, we will follow the Schedule T of the Companies Act 2013 depreciation rate, but as per the taxation, the rate of depreciation is quite different, which is offered in section 32 of Income Tax Act 1961. And the method of depreciation is also quite different. In most of the times taxation, we are following the WDV method, but for the financial accounting, we might follow the different methods like SLM and number of units of productions and the machine hours and such all other methods are applicable. Maybe in accounting, the depreciation may be provided on individual asset basis, but for the taxation, the depreciation is based on block of assets concept, which may also the one of the reason for getting the difference of depreciation in between accounting and taxation. And one more thing, usage. For the accounting purpose, we may provide the overall usage, but for the taxation, special circumstances are there. Special circumstances means for the research purpose, if you are use that asset, you may get year number 1 itself, but for the accounting, based upon the period of usage, you may provide it. Do you understand? These all factors are may cause for getting the different depreciation from accounting to taxation. And one more, guys, which is the last example for this marathon. I mean, in between the accounting and the taxation difference, which related to the timing difference for this, which is the last example. Okay, sir, as per section 33AB or 33ABA, what is there as per Income Tax Act 1961? If you made deposit under certain T-boards, or if you made deposit for scheme under restoration of certain activities, then as per the Income Tax Act, such donation will be allowed as an expenditure. So deposits made under scheme of T-board, if you made such deposit, then it will be allowed as an expenditure under section 33AB. Now, in the year of deposit, what will happen? Let us have a look. Let us assume 2010 level is there. Now we are making deposit in 2010 level as per the taxation, which is allowed as an expenditure, but which is not allowed as an expenditure in financial accounting. So deposit is an investment in case of financial accounting, but once you made the deposit, is allowed as an expenditure. So in 2010 11, what is the scenario? Accounting income is greater than the taxable income in the year of origination, due to which DTL will be created in the year of origination. Now, as per the financial accounting, if such deposit is used for incurrence of any expenditure, in the actual year of expenditure, it is allowed as an expenditure. So in the year 11-12 for financial accounting, if you really incur out of such deposits any expenses, then you may treat it as an expenditure. But in taxation records, we are not allowed, because we already allowed such deposit as an allowable expenditure in the year of deposit in the taxation, which is not an allowable expenditure. Now the accounting income is greater than taxable income, which is DTL origination, is going to be reversal in the future period, which is accounting income is less than the taxable income. So which is a pure timing difference, guys. So different examples also discussed by me with respect to timing difference and permanent difference. And the next question is with respect to recognition. With respect to recognition, when I should need to recognize such deferred tax asset or such deferred tax liability. Please concentrate. Sir, deferred tax liability, for recognition of deferred tax liability, no certainty is necessary. You can simply recognize the deferred tax liability in the year of origination itself. But for the purpose of recognition of deferred tax asset, for the purpose of recognition of deferred tax asset, reasonable certainty should need to exist. Reasonable certainty should need to exist. Sir, why for deferred tax liability reasonable certainty doesn't required, but for why deferred tax asset reasonable certainty is necessary? What is the journal entry for recording the deferred tax asset, guys? What is the journal entry for recognition of deferred tax asset in the books of accounts? Entry is deferred tax asset account data to deferred tax asset, deferred tax account, that is asset to income account, then income to P&L, deferred tax to P&L account. That is the entry for deferred tax asset, guys. I already explained the journal entry for deferred tax asset here. The same entry we passed. Deferred tax asset account data to deferred tax account, deferred tax account, deferred tax to P&L account. Am I right? Now the same entry repeated here. Nothing is great. The same entry repeated here. Now the issue is, due to recognition of deferred tax asset, there is increase in profits. There is increase in profits. Do you agree? But as per the prudence concept, you can anticipate all future losses, but not profits. I mean, whenever a particular component is causing for increase in profits, if certainty is there, then you can recognize. Unless otherwise there is no certainty, then you should not recognize such particular component into the statement of P&L. That is the meaning of concept of prudence. But you are thinking that due to excess of taxable income, over accounting income, in the year of origination, you recognize a deferred tax asset. Do you think that in future there is a scope of accounting income is greater than taxable income? The DTA recognized by you in the current year is capable of reversal in the future periods. If the DTA origination is accounting income is less than taxable income, then DTA reversal means accounting income is greater than taxable income. If you have a reasonable certainty that accounting income is greater than taxable income in the future periods, then in the current year you can recognize the deferred tax asset. That is the meaning of reasonable certainty. I clearly explained the same thing, guys. Here, to recognize the DTA, reasonable certainty of realization of that asset should need to be exist. When reasonable certainty should exist? In the year of origination, if accounting income is less than taxable income, then in future periods, is there any certainty is there for getting accounting income is greater than taxable income? Yes, sir, certainty is there. Then you can recognize the DTA in the current year. I don't know, sir. In future years, whether accounting income is greater than taxable income or not, I don't know. Then your recognition of DTA should be postponed. Up to which time period I can postpone the recognition of the DTA? Up to the period for which the certainty come to exist. Up to the period for which the certainty come to exist. For example, in the current year, there is no certainty. You postpone for recognition of DTA to the next year. In the next year, certainty comes. In the next year, certainty came. Then what should you need to do, sir? Then you can recognize the DTA. And one more thing I am telling you here, you recognized in the current year the DTA on the assumption that in the future years there is a chance of getting accounting income is greater than taxable income. But in the next year you realized that there is no chance. There is no certainty. There is no certainty that accounting income is greater than the taxable income. Then what can I do, sir? Already recognized a DTA, you should need to be cancelled. You should need to be cancelled. Now, the overall glimpses here just I want to provide before go to the next issue. Please concentrate. What is that? I am in the concept of recognition. So regarding the recognition of deferred tax liability, no certainty required. Just as like that you can recognize. That is by passing the entry deferred tax to DTL. You can simply make it transfer the deferred tax P&L to deferred tax because it doesn't increase the profit. The creation of DTL doesn't impact increase in profit. It rather than it creates decrease in profits. Am I right? So now, but coming to deferred tax asset, based on the concept of prudence, if reasonable certainty regarding accounting income is greater than taxable income in future periods will be exist, then you can create a DTA. If there is no certainty, then if there is no certainty, then what you should need to do? Then you should postpone the recognition. You can postpone the recognition into means there is no certainty. Okay. For example, created in the current year, but in future years, no certainty, because in the current year on the assumption that certainty will be there, then you created, but in future year you realized that there is no certainty. Then what you should need to do? You should cancel already recognized DTA. That's it, guys. Next, one more important point I'm going to discuss. This create a lot of difference here. Please all of you concentrate. This is very much pretty special item as well. Sir, as per the accounting books, in the year 2010-11, you are having a loss of 2 lakhs, let us assume. As per the taxation records, for the 2010-11, also the income is same. Accounting income is same as like taxable income. That is the point I'm emphasizing here. Now, by seeing these things, Do you think that if accounting income and taxable income both are same, then there is no need of creation of any deferred tax? Absolutely. Absolutely, there is no need of creation of deferred tax. But if you are thinking like that, then you may in the wrong direction. Now let me travel some more distance, then you can understand. In the year 2011-12, let us assume what happened. As per the accounting records, I am getting the income 1 lakh, but as per the taxation records, also I'm getting the same income. In the taxation records, also I'm getting the same income. Now, what will happen? Here 1 lakh, here 1 lakh, right? But as per the carry forward provisions, in the previous years, if you are ending with losses, you can carry forward such loss to the current year as well. Now, out of such 2 lakhs, you can carry forward the 1 lakh loss. Now the taxation income will be nil. But accounting, there are no provisions of carry forward as like income tax. Now in the year 2011-12, what happened? Accounting income is greater than taxable income. Do you think that this is year of origination? No, this is year of reversal. Why? This difference is arised 1 lakh and nil. The difference is arised due to carry forward of losses. Actually, in which year the loss is arised? In the previous year, which is the origination. That means the loss occurred year is, the loss arised year is, the loss originated year is 2010-11, which is the origination. Now, in reversal period, if accounting income is greater than taxable income, then in the origination period, accounting income is less than taxable income. In the origination, if accounting income is less than taxable income, which will be classic example for deferred tax asset origination. In origination, if it's DTA, in the reversal, which is DTA reversal. Now the same thing I explained here as well, if you observe. That means whenever carry forward of losses exist, even though there is no difference between accounting income and taxation income, but due to such carry forward of losses and unabsorbed depreciation, also the same thing is also applicable in case of unabsorbed depreciation. In future years, there may be a getting chance of difference between accounting income and taxable income, which is the reversal period. Even though literally there is no difference between accounting income and taxable income, you should need to create deferred tax asset in the year of origination. But one thing is sure, guys, when you can create deferred tax asset of origination, whenever you want to recognize the DTA into books of accounts, reasonable certainty is required, right? But here, not the reasonable certainty, virtual certainty supported by collaborative evidence is required. Virtual certainty supported by collaborative evidence is required. What is the, sir, reasonable certainty is enough now to recognize the DTA? Why he is talking about this virtual certainty supported by collaborative evidence? What is the meaning of virtual certainty? A concrete evidence should be required. For which purpose? In future periods, definitely accounting income is greater than the taxable income. If you have such concrete evidence, then in the current year you can recognize the DTA, even in the case where accounting income and taxable income both are same in point of losses. Why, sir? Why evidence you are asking? In all other circumstances, reasonable certainty is more than enough, you told. The reason I will tell you. For example, you are assuming that in the current year 2010-11, accounting records 2 lakhs loss, taxation records also you are getting 2 lakhs loss. Let us assume in the next year, the taxable income is again loss. Then can you carry forward unabsorbed losses? Or can you carry forward unabsorbed depreciation? No. That means in future, if there is a probability to occur certain taxable income, then only I can carry forward the loss which was arised in the current year to the next year. Then I will make it nullify. Then there is a chance of occurring difference between accounting income and taxable income in the future years. That means there is a virtual certainty supported by collaborative evidence is required for future taxable income will be evolved. Sir, in future, definitely certain taxable income will be evolved, due to which the carry forward losses I can nullify that. Then in the future years, there is a difference between accounting income and taxable income, which is cause for DTA reversal. That's why in the year of origination, I can create a DTA origination. For which purpose I required a collaborative evidence. In future, the taxable income will be evolved for which virtual certainty supported by collaborative evidence is there. Then I can recognize the DTA in the year of origination. Now, I will add one more point here to the recognition concept of the DTA. In generally, to recognize the DTA, reasonable certainty is more than enough, but whenever carry forward of losses and unabsorbed depreciation is there, to recognize the DTA, virtual certainty supported by collaborative evidence or concrete evidence. Collaborative means concrete evidence for evolving future taxable income will exist, then only I can recognize the DTA or origination. Next, sir, what is the meaning of collaborative evidence here? Collaborative evidence that on your hand, any certain projects are there. Yes, sir, I have certain projects due to which I will get certain income in future. So my taxable income will going to arise. Or certain agreements are there, sir. The government should need to give that project to me. Certain agreement was already entered, which shown as a collaborative evidence. Just as an imaginary factor, sir, I will get certain profit in the future, sir. Can I recognize the DTA origination in case of carry forward and unabsorbed losses? No. If you have the evidence, then only you can recognize. That is the point. Sir, why he is telling all such different issues with respect to DTA, sir? Because due to recognition of the DTA, your current year profits are going to hike, guys. That is the main reason. Okay. This is with respect to recognition. Now, all of you, please come to measurement issue, guys. Measurement. Measurement means at which value I can measure both current tax and deferred tax. Sir, measurement with respect to current tax is different and deferred tax is different. Current tax, you know, in generally how it is going to be measured. You know, I will tell you the practical measurement of the current tax. Let us assume, I'll come here. Let us assume, you know, the financial year currently already started. This video I am recording as on like April 12th, I think so. April 12th, 2022, I am recording. So today is April 12th, 2022, right? Now what happened, you know, already in the month of February 2022, the current finance minister, Nirmala Sitharamanji, already submitted her budget in the parliament. Okay. This budget is with respect to Finance Act 2022. You know, the act was already passed in both the houses, and it was already completed the assent of Rashtrapati as well. It already take the assent of President of India as well. Now it became an act, which is a Finance Act 2022. Recently, Finance Act 2022 was already enacted. Now, the thing why I'm discussing all such things, in Finance Act 2022, they are going to provide tax rates information for the previous year 22-23. Previous year 22-23. They will provide the tax rates for the previous year 22-23. Based on that, we will plan our entire earnings. We will pay the tax in the assessment year 23-24. That means to measure the current tax rates applicable to the relevant years, we need to check. Now, tax rate applicable for the relevant assessment year 23-24 is Finance Act 2022. Now, measurement with respect to current tax is nothing but tax rates applicable to the relevant assessment year. You need to check to measure the current tax. For example, if you are measuring the current tax for the financial year 22-23 or the assessment year 23-24, you should need to adopt the tax rates under the Finance Act 2022. For example, if you want to calculate the current tax for a particular financial year 23-24, which is the financial year, not the assessment year, then assessment year will become 24-25. Then which Finance Act I need to consider, sir? Then I need to consider Finance Act 2023. So based on the tax rate applicable to that Finance Act, I need to consider in evaluation of the current tax. That is the point he mentioned here. Tax rates applicable to the relevant assessment year, I need to consider. The same example I explained in the power notes as well. For the assessment year 22-23, Finance Act 2021 is applicable. That is for the financial year 2021, 21, 22, Finance Act 2021 is applicable. Hope you understand this. Am I right? One thing is sure, guys. For the year which you are calculating the current tax, the relevant Finance Act rates are applicable. That's it. Now coming to the deferred tax. The provisions are a little bit peculiar here. For the purpose of measurement of deferred tax, you can use enacted. Enacted means already act passed, or substantively enacted. Substantively enacted means the act had to be passed. The act, the Finance Act had to be passed. Rates of the period in which it is going to be reversal. Oh my God. Indirectly, he is telling that for the purpose of calculation of deferred tax, reversal period rate should need to be used. Yes. Reversal period rates should need to be used. Yes, sir. Let me take one example. I am in the financial year 2021-22. The timing difference arised in the year 21-22 is 1 lakh, which is capable of reversal in 22-23, 23-24. Now I am in the year 21-22, right? In the year 21-22, you know, in the month of February 2022, they are going to pass the Finance Act 2022, which is relevant for rate for 22-23. The Finance Act relevant rate for in the year 21-22 is 22-23 rate. I mean, even though you are as at 31st March 2022, you know already rate for 22-23. Do you agree? Which is known as substantively enacted rate, because as on 31st March 2022, maybe the act still is under the progress. Maybe it doesn't complete the assent of the president, but you can use, because 22-23 rate you already know through Finance Act 2022. Reversal period rate 22-23, you know, right? You can use that. Sir, but I don't know the 23-24 rate, sir. But I don't know the 23-24 rate, sir. Then what can I do, sir? You can use still 22-23 rate, because in India, 1 year ahead only you can know the tax rate. But in the European countries, you know the 5 years ahead tax rate itself. Like how the planning commission is developed in India, in the same way, the fiscal policy is also going to be developed in the foreign countries. Do you understand? That means, what are the tax rates I can know for the reversal periods? The oldest, not the oldest. What are the tax rates known for the reversal period? The tax rates you can be used for the remaining reversal periods as well, even though you don't know the tax rates for all the reversal periods. Now, in the current scenario, I know in the year of 21-22, at the time of measurement of deferred tax, I know only the tax rate of the reversal with respect to 22-23 only. I don't know the reversal period of 23-24. Then the same tax rate of 22-23 I can use it for 23-24 as well. That is the reason why he drafted the provisions like enacted or substantively enacted. Enacted means already act passed. Substantively enacted means yet to be passed. Any rates of the period in which it is going to be reversal. For example, you know both 22-23 rates, 23-24 rates ahead itself. Then you can apply to measure 22-23 deferred tax. You can apply that rates. For deferred tax with respect to 23-24, you can apply that rates. That is the essence of deferred tax issue, guys. Is it okay? Next, come to presentation and disclosure. Don't worry, guys. I will club all such things in a consolidated manner within quick 5 minutes. I'm going to explain through a small mind map at the end of the standard. Presentation. I already explained something related to presentation. If it is a current tax in profit and loss, it is treated as an expenditure. In where it should need to be report, I already shown, which is tax expense. Current tax you need to represent under statement of P&L. In balance sheet, which is shown under the current liabilities under short-term provisions. Is it right? Which is under provision for tax, I need to be represent. Next, coming to the deferred tax in the statement of P&L, if it is the origination period, it should be debited. It should be added. Deferred tax liability origination added. Sir, if it is deferred tax liability reversal period, it should be minus. Coming to deferred tax asset origination period, the deferred tax should need to be minus. If it is deferred tax asset reversal period, then I need to add. The same thing we already shown the presentation in the statement of P&L here clearly. Here clearly. This is the presentation of deferred tax. Next. Coming to balance sheet issue. In balance sheet, DTL is shown under non-current liability. DTA is shown under non-current assets. But in balance sheet, we are going to show under net basis, that is net DTA or net DTL. Okay, that's it. Next, two more important concepts are there to finish the accounting standard 22. Guys, here I am in the marathon. Don't expect each and every item in detailed way. If you already listen my regular courses, in the regular lectures, you will get each and every content in very deeper mode, in detailed way as well. Here I will only take the conclusions. If I took the conclusions itself, it will take that much of time period. We are in the process of revision. So that's why I will give more concentration on the things to tell in the revised way are the conclusions only. Okay. So to get deeper knowledge, to cover much more issues, you can simply watch my regular lectures. Okay, but definitely these are highly useful for the persons who are in the process of revision after watching the regular courses, who are going to appear in the examination, in the forthcoming examination, no doubt about it. Okay, come to the tax holiday period. What is the meaning of tax holiday period? So to tell in very simple manner, tax holiday period means the period for which no need to make any payment of tax to the government. That is nothing but tax holiday period. In Income Tax Act 1961, it will give privileges to certain types of entities who are covered under these sections. Entities covered under section 10A and 10B, and entities covered under section 80IA and IB. Sir, which type of entities are covered under 10A and 10B? If their business presence will be there under such special economic zones, in general, which are backward areas, just like that government announced such backward areas under such. If those persons who started their business activities under such, they will get certain tax exemptions. Tech parks, okay. It's always look like such only, the tech park as well. Now, the export turnover is completely exempted over a period of 10 years. The export turnover from the manufacturer, the out of the goods manufactured, if they have any turnover out of their exports, there is no need to make payment of income tax as per Income Tax Act 1961, then which are fully exempted. Then such entities are said to be under tax holiday period. Now coming to the entities under 80IA and 80IB, those entities under infrastructure sector, certain other sectors also covered. I basically here I wrote the infrastructure sector. I mean dams construction, roads construction, canals, that infrastructure sectors, for which out of the gross total income, they are made certain investments under 80IA and IB, na, they will get deductions from gross total income. They will get certain deductions under chapter 6A under section 80IA and IB. So whenever you are getting a deduction under chapter 6A, then your gross total income is decreased to the extent. Again, in that case, there is no need to make payment of tax by such type of enterprises. Now the question is, what is the impact of AS 22 to such type of entities who are running under the tax holiday period? There are two important provisions are there. So first, let me read such provisions. The impact of AS 22 for those entities. These provisions are not applicable to all type of entities. Those entities which are covered under the tax holiday period, what is the impact of AS 22? Timing difference originate in tax holiday period and a capable of reversal in tax holiday period. No need to recognize any deferred tax. No deferred tax is recognized. Tax timing difference arised in tax holiday period and capable of reversal in tax holiday period, no need to recognize any deferred tax. But timing difference originate in the tax holiday period, but reversal going to occur after the tax holiday period. For such timing difference, you need to create a deferred tax in the year of origination itself. Maybe you understand the provisions, but you may not know the reason. I'll simply explain the reason. Sir, for those timing difference which arise in the tax holiday period, which are capable of reversal in the tax holiday period, no need to pay any tax, because anyway the enterprise is under tax holiday period. The enterprise is there under the tax holiday period. If the enterprise is there under the tax holiday period, the tax on such taxable income is anyway nil. If you try to compare the accounting income with taxable income, you are always getting a difference. Don't take that difference. because the difference is not at all the timing difference. The difference is occurred due to the tax holiday period. The difference is occurred due to the tax holiday period. The difference is not the timing difference. At that point of time, you cannot check whether the difference is the timing difference or the permanent difference. The difference was occurred due to the tax holiday period. Do you understand? That's why the difference should not considered at all within the purview of AS22. Then which difference can I consider? Difference arised in tax holiday period, but capable of reversal in after tax holiday period. For that purpose, you can create a deferred tax in the year of origination itself. So remaining all in the normal cases, in which year you are going to recognize the DDR, DDL in the year of origination itself. In the same way you can create. I'll explain the same thing with a small illustration. Please allow you concentrate. What happened? So the company Raju Limited is there, which is running under the tax holiday period for a period of 5 years. Here two scenarios totally I am taking. First scenario is in black color and the second scenario is in red color. First you can only concentrate on the black color issue. Sir, in the year number 1, timing difference is directly given, which is 50 lakhs. Just is given in the bracket, the timing difference is accounting income is greater than taxable income. Now out of this 50 lakhs, which is capable of reversal in total remaining 10 years. So year 2 5, year 3 5, 5 lakhs, 5 lakhs, like that it is capable of reversal in the future periods. Now up to the tax holiday period, total how much is capable of reversal? Out of this 50 lakhs, total 20 lakhs it is capable of reversal. Timing difference arised during the tax holidays period and a capable of reversal during the tax holiday period. No need to create any deferred tax. Remaining amount is 30 lakhs, right? On the remaining amount 30 lakhs, you can create a deferred tax, which is 30 lakhs into 30 percentage, which is 9 lakhs. That is the application of the provision. Let me take the second scenario. In the year 1, timing difference is 10 lakhs. In year 2, timing difference is 40 lakhs. Till now, there is no reversal occurred, but the reversal is going to occur from year 3 onwards. During the reversal period, the total amount of timing difference is going to be reversal was 15 lakhs. Now, my question is, out of this 15 lakhs, in year number 1, 10 lakhs arise, na? That one first reversed. You should need to be assume FIFO method. FIFO method means first in, first out. First arise at 10 lakhs. Out of this 15 lakhs, that 10 lakhs was going to be reversal. Timing difference arised in tax holiday period and a capable of reversal during the tax holiday period. No need to recognize any deferred tax. But out of this 40 lakhs, only 5 lakhs was, out of this 40 lakhs, only 5 lakhs was reversal. What about remaining 35 lakhs? For the remaining 35 lakhs, you need to create a deferred tax. That is 35 lakhs into 30 percentage, 10.5 lakh. You need to create a deferred tax. That is the impact of provisions, guys. Sir, to put it simply, timing difference originate in the tax holiday period and capable of reversal during the tax holiday period. No need to report or no need to recognize any deferred tax. But the timing difference originate in the tax holiday period, but capable of reversal after the tax holiday period, for which you need to create a deferred tax in the year of origination. And the last special item in AS22, guys, which is impact of AS22 in case of MAT under section 115JB. First, before directly explaining the impact of AS22, first let me explain the provisions of MAT, because for CA inter syllabus, which is completely new to you, but for a CA final student, he already knows the things related to MAT. Sir, the MAT full form is minimum alternate tax. What is the provisions of this MAT is all about, sir? As per section 115JB of Income Tax Act 1961, as per section 115JB of Income Tax Act 1961, MAT calculated based on book profit is greater than tax calculated on taxable income by applying the normal provisions of Income Tax Act 1961. Then the company should pay MAT to the income tax authorities. This MAT is only applicable for companies. This MAT is only applicable for companies. It doesn't applicable to any other type of SSE. If MAT calculated on the book profit is in generally calculated based on section 115JC, section 115JC. If the book profit calculated on section 115JC, on such book profit you are applying the MAT rate, then you will get the MAT. MAT is equal to book profit under section 115 JC into MAT rate, then you will get MAT. If the MAT calculated as per section 115 JB is greater than tax on taxable income, then such company should pay MAT to the tax authorities in that particular year. You may feel that, sir, which is completely injustice. You are already calculating tax on taxable income, right? He is earning the taxable income, but that why that SSE is going to pay the higher amount of tax to the government? That's why government is telling that, sir, we are not having the sufficient funds in our hands. Just we require the money as early as possible. We are not making injustice to you. The excess amount you paid, right, over the tax on taxable income, the excess amount of MAT you paid over the tax on taxable income, we will be allowed it as a MAT credit. You will be allowed it as a MAT credit. Such MAT credit you can be carry forward for 15 years. Sir, how you can utilize the MAT credit? For example, in the future years, in any particular year, if the tax on taxable income is less than the MAT, then you should need to pay the tax now. At that particular scenario, you can use this MAT credit. That means in the next year, at the time of making payment of tax, simply you cannot utilize the MAT credit. But in the next year, if tax on taxable income is less than the MAT, then you should pay the tax as per the normal provisions of Income Tax Act. At that particular point of time, you can utilize this MAT credit. That MAT credit will be useful at the time of payment of self-assessment tax, the year in which MAT is less than tax on taxable income. One more time, the conclusions I'm drawn here, please concentrate. So the MAT concept is only applicable in point of view of companies. MAT is calculated based on section 115 JB. How we are going to calculate MAT? For MAT, we are not calculating on taxable income. MAT is calculating on book profits under section 115 JC. How we are going to calculate the book profits, all such things you are going to learn in your CA Final Income Tax Act 1961 in paper number 7 DT actually. On such book profits under section 115 JC, you should apply the MAT rate. Currently, I think so the MAT rate is running at 15% like that. Then you will get the MAT. Once you calculated the MAT, it should be compared with the tax on taxable income. If MAT is greater than the tax on taxable income, then the such company should need to pay MAT on behalf of tax on taxable income to the government. But the excess of MAT paid over the tax on taxable income, government will be allowed as MAT credit. And if you are unable to utilize such MAT credit within certain number of years, then not a problem. It will be carry forward for 15 years. Then in which year I can utilize such MAT credits, sir? The year in which the tax on taxable income is less than the MAT. On behalf of paying the tax to the government, you can knock it off the MAT credit. The remaining amount only you can pay to the government. That is the provisions behind the insertion of section 115 JB, which is nothing but MAT. Now the issue is not related to these provisions. These provisions I actually don't know. That's why first I explained the provisions of Income Tax Act 1961. But my issue is, what is the impact of AS 22 for that provisions? What is the impact of AS 22 with respect to the MAT? Now I know one thing, right? What is that? What we know? Current tax is tax on taxable income. In general cases, if MAT is not applicable, current tax is tax on taxable income. But if MAT is applicable, current tax is MAT. The year in which MAT is paid by the company, for that year, current tax is nothing but MAT. Because current tax is tax on taxable income. But for deferred tax, MAT provisions are not applicable. For the purpose of calculation of deferred tax, MAT provisions are not at all applicable. Only for the purpose of calculation, only for the purpose of measurement of the current tax, MAT provisions are applicable. Because current tax is the component based on the taxable income, but deferred tax is the component based on the timing difference. Do you understand? So that's why for the purpose of measurement of deferred tax, MAT provision should not apply. In the normal course only, we will calculate the deferred tax. Now, let us check with small illustration to understand such provisions in better manner. Let us assume in the financial year 2010-11, accounting income is 30 lakhs, taxable income is 10 lakhs, tax rate is 30%, book profit under section 115 JC is 50 lakhs, MAT rate is 15%. First, let us calculate MAT, all of you quickly. First, all of you calculate the MAT. So MAT under section 115 JB, 50 lakhs into 15%, which is 7,50,000, which is 7,50,000. Also calculate tax on taxable income. Taxable income is 10 lakhs. Tax rate is 30%. 10 lakhs into 30%, which is 3 lakhs. Now, MAT is greater than tax on taxable income. Therefore, current tax is equal to MAT is equal to 7,50,000. No doubt about it. Then what about deferred tax, sir? Deferred tax is the timing difference. For deferred tax calculation, you should not apply the provisions of MAT, right? Now, deferred tax is the timing difference, which is the accounting income and taxable income. The deferred tax is the timing difference in between accounting income and taxable income, which is 30 lakhs minus 10 lakhs, which is 20 lakhs. 20 lakhs into, you should apply the normal tax rate only. 20 lakhs into 30%, which is how much, guys? 6 lakhs. So deferred tax is nothing but 6 lakhs. You can calculate deferred tax in this manner, or if you want, you can calculate like this as well. Tax expense is equal to current tax plus deferred tax. Therefore, deferred tax is equal to tax expense minus current tax. Sir, why you current tax you taken here 3 lakhs, sir? Concentrate. Deferred tax is equal to tax expense 9 lakhs minus 3 lakhs. Why you consider 3 lakhs, sir? Deferred tax is nothing but MAT na. Sorry. Current tax is nothing but MAT na. But for the purpose of calculation of deferred tax, we should not apply the provisions of MAT. I told you, right? You can calculate deferred tax in this method, which is method number 1, or you can calculate deferred tax in this method. In the equation, you know, tax expense equal to current tax plus deferred tax. Here, deferred tax is equal to tax expense minus current tax. Tax expense is nothing but tax on accounting income. Accounting income is 30 lakhs, 30 lakhs into 30%, which is 9 lakhs, minus current tax. Current tax is tax on taxable income. You should not take tax with respect to MAT here, because we are in the calculation of deferred tax. In calculation of deferred tax, MAT provision should not be applicable, where current tax is nothing but tax on taxable income only. 10 lakhs into 30% only, 6 lakhs. In this method, we are all getting the 6 lakhs as deferred tax. In this method also, we are getting the deferred tax 6 lakhs. Now, presentation of tax expense whenever MAT is there. Now, tax expense is equal to current tax, which is MAT 7,50,000 plus deferred tax, which we are getting 6 lakhs. Now, this MAT is again, we can split into tax on taxable income and excess of tax paid over the excess of MAT paid over the tax, which is MAT credit. Tell me, guys, tax on taxable income is here 10 lakhs into 30%, which is 3 lakhs. But the MAT is 7,50,000. This 7,50,000 is divided into two types. One is 3 lakhs plus excess paid how much? 4.5 lakh, which is MAT credit. So 4.5 is MAT credit and 3 lakhs is tax on taxable income. So the total you are going to represent like this: 3 lakhs plus 4,50,000 plus 6 lakhs. 3 lakhs is tax on taxable income, 4,50,000 is MAT credit, and 6 lakhs is deferred tax. This is the presentation of tax expense whenever MAT is applicable. Tax on taxable income plus MAT credit plus deferred tax. Like this, you need to represent. Then what are the conclusions here, sir? Sir, in case whenever MAT is applicable, current tax equal to MAT, but for the purpose of calculation of deferred tax, you should not apply the provisions of the MAT. How you should need to be presented the tax expense? Tax expense equal to tax on taxable income plus excess of MAT paid over the tax, which is MAT credit plus deferred tax. That's it. Now, I told you, I promised you at the end of the standard, I'll give a quick mind map. This is very peculiar standard and little bit technical. Sir, the objective of insertion of accounting standard 22 is to providing the taxes on income, Different definitions actually we've seen. Okay, I'm explaining one by one. Scope I don't want to see. Definition: accounting income. What I told, what is the meaning of accounting income? That is net profit before tax. Taxable income. Taxable income is nothing but income calculated as per Income Tax Act 1961. Current tax, tax on taxable income. Deferred tax, tax on timing difference. What is the meaning of timing difference? Timing difference is the difference in between accounting income and taxable income originated in one accounting period and capable of reversal in subsequent accounting periods. Permanent difference originated in one accounting period and a not reversal in subsequent period, which is ignored for the purpose of calculation of deferred tax. Am I right, guys? Tax expense is current tax plus or minus deferred tax. Next, recognition of the DTA, not related to DTL, only DTA. By applying the prudence concept, reasonable certainty regarding realization of DTA should exist as on the balance sheet date. But in case of carry forward and unabsorbed losses, Virtual certainty supported by convincing evidence with respect to the future taxable income is necessary to recognize the DTA in that particular circumstances. Even though the taxable loss and the accounting loss both are same, you should need to recognize the DTA in that particular circumstances. We've seen already one illustration. Next, unrecognized DTA should be reviewed at each balance sheet. I already told you that. I mean, in the current year, if there is no certainty, then in the next year, you should need to be reviewed. Certainty is there, you can recognize. Coming to the measurement issue, current tax, we are going to measure it rates at which the tax is payable to the government. That is, for the relevant finance act applicable to that assessment year, you need to check. But the deferred tax is going to be measured at enacted or substantively enacted rates of the period in which such timing difference is going to be reversal. That means simply the reversal period rate should be useful. You can also use substantively enacted rates as well. So presentation, I already told you certain special issues, two special issues we discussed here. Impact of AS22 in case of tax holiday period. Sir, timing difference arised in the tax holiday period, capable of reversal during the tax holiday period, no deferred tax will be recognized. Timing difference originated in the tax holiday period, but reversal after the tax holiday period, deferred tax should be recognized in the year of origination. Impact of AS22 in case of MAT, current tax is equal to MAT, but for the purpose of calculation of deferred tax, you can use the regular tax rates. MAT rate should not be used. Presentation of tax expense equal to tax on taxable income, but MAT credit plus deferred tax. That's it, guys. This is the concept of AS22. Our next standard is AS5, net profit or loss for period, prior period items, and change in accounting policies. The title of AS5 is Too Lengthy, Friends. Sir, what is the objective of this standard? Why this standard is introduced? What are the different issues we are going to see in this standard? First, let me give a quick glance. We can check with that power notes. Just a second. Yeah. What is the objective? So the objective of AS5 is presenting as well as disclosing items in profit and loss account. I mean, we may present various items in statement of profit and loss account as per schedule 3 part 2. You know that, right? But out of that items, how we need to present, because the ultimate objective of preparation of the financials itself is to provide the valuable information to the stakeholders of the company. By seeing such financials, the stakeholders of company should able to take the right decisions. For that purpose, the information what we are giving in a proper manner, then only based on that information the investors can take the right decisions. With that context, AS5 is introduced. How you should going to present each and every item in the statement of P&L will provide the guidance through AS5. Now, the items in statement of P&L were broadly categorized into two types. Actually, the items in statement of P&L are broadly categorized into two types. Those are ordinary activities. And extraordinary activities. Only two types. The items in statement of P&L are broadly classified into two different types. One is ordinary activities, another one is extraordinary activities. What is the meaning of ordinary activity? What is the meaning of extraordinary activities, sir? Ordinary activities are normal business activities only, and which are furtherance and incidental to the business activities as well. I mean, sir, salaries paid, rental expenditure incurred, purchases made, sales made, whatever the activity you will perform with respect to your business in a normal course, as well as incidental to such business. Maybe incidental to such business, you need to incur certain advertising expenditure, sir. Incidental to such business, you may require certain transportation expenses, sir. Sir, incidental to such business, you may incur certain audit expenses, sir. Such all things are form part of ordinary activities only. For ordinary activities, no need to provide a separate disclosure in the statement of profit and loss account. Simply you can disclose in the as usual manner. No need to put the heading, these are ordinary activities. So that's why no separate disclosure is required in the statement of P&L with respect to ordinary activities. Then what about extraordinary activities, sir? What about extraordinary activities? Extraordinary activities are distinct, which are clearly distinct from the ordinary activities, which can be clearly differentiate from the ordinary activities. By seeing itself, we can easily identify that these are not ordinary activities. And the occurrence is irregular. Extraordinary activities are income or expenditure related to the current year, which are clearly distinct from ordinary activities. And the occurrence of such items are irregular. Sir, can you please give certain examples? First of all, if the particular activity is an extraordinary activity, what I should need to do while presenting such particular item in the statement of P&L? It should be separately disclosed in the statement of P&L. Separate disclosure you should need to provide in the statement of profit and loss account. Sir, can you please give certain examples for extraordinary activities? Why not? Attachment of the property. For example, if you took some loan and that loan is not repayable by you, then the banking company will attach that property. You cannot resell that property to any other party unless otherwise if you take the assent of the banker. That is nothing but attachment of the property. Refund of the government grant. Sir, you took the government grant, but at the time of initiation of such government grant by the government, it levied certain conditions. We are unable to fulfill such conditions. That is the reason we are making refund of such government grant. Such a refund of government grant is also a classic example for extraordinary activity. And I will tell you these, you already know, which related to the abnormal activities like loss arranged in case of earthquake, loss arranged in case of natural calamities like floods, maybe loss arranged due to the pandemic situations like COVID-19. All such things are coming under, again, extraordinary activities. If you observe, the extraordinary activities are not at all related to your business activity, which quite in common, which are not irregular, sorry, uh, which are completely irregular, which are not regular. So such type of activities are come under extraordinary activities. By seeing such activity itself, we can easily identify that which is not an ordinary activity. Then receipt of government grant in compensation of expenses. I mean, in the last year, in certain hilly areas, maybe the cyclones came. So due to which the entire crops of that particular parties are they lost. Then at that particular point of time, in compensation as an ex gratia, so government releases certain grants. So which is receipt of government grant in compensation of expenses. So such things are also coming under the categorization of extraordinary activities. So attachment of the property, refund of government grant, receipt of government grant in compensation of expenses, earthquakes, loss arranged due to earthquakes and natural calamities or the pandemic situations are coming under the extraordinary activities. Now, if you observe, for ordinary activities, no separate disclosure should be required, but for extraordinary activities, separate disclosure should be required in the statement of P&L. That means if any extraordinary activity takes place in the particular financial year, then the enterprise should need to disclose separately such extraordinary activities from ordinary activities. Why, sir? What is the reason? For example, in the current year, the operating profit is, let us assume, 1 crore. But due to earthquake, we lost everything. The loss is approximately 3 crores, let us assume. Now the profit of 1 crore is completely eroded by the loss of 3 crores and the net loss became 2 crores. If any person will see ultimately net profit before tax, then it is shown as 2 crores, right? Then it is shown as 2 crores. Then the stakeholder should thought that, sir, our company is not performing well. Our company is not performing well. They may take the wrong decisions. But rather than that, if you provide the information like this, sir, profit from ordinary activities, this much, and a profit from extraordinary or loss from extraordinary separately, then they can clearly identify that our company is performing well, but in the current year, due to certain extraordinary activities, our company may turn up into the loss situation. That is the reason why the accounting standard 5 is separately introduced. I told you clearly, which is presenting and disclosing items with respect to statement of P&L. Hope you understand now the clear-cut objective of AS5. Next, sir, one more item is there, which is exceptional items. Exceptional item is also an ordinary activity, guys, which is not an extraordinary activity. Exceptional item is also ordinary, but due to such a size, nature, or incidence of such transactions, a separate disclosure should required in the statement of P&L. Exceptional items are ordinary activities, but due to such a size, nature, or the incidence of the transaction, separate disclosure should be required in the statement of P&L. I'll give certain examples here. Concentrate. Sir, in the current year, I sold a particular PPE. I sold one building. So that building was purchased long back, 10 years back, which was purchased at 10 lakhs, which right now sold at 10 crores. Then I get huge profit in the current year. Sir, such a huge size, maybe the nature, maybe the incidence of such transaction, which is ordinary only. Sir, if any party is having the PPE, they may sold out for any reasons, which is ordinary activities only, which are incidental to business only. Those are ordinary only, but due to such a size, nature, or incidence of the transaction, we should need to provide a separate disclosure. So various examples are there. Let me explain one by one example. Written down value of the inventory and a reversal of such. Written down value of the inventory and a reversal of such. Sir, what it is, sir? What it is? Please concentrate, all of you. Sir, just a moment. Yes. Sir, let us assume as on 31st March of a particular year, the value of the inventory cost is at 1 lakh. Let us assume. And the NRV is at 80,000. NRV is at 80,000. Now, as per the accounting principle of AS2, inventory should be valued at cost or NRV, whichever is lower, that is 80,000. To value the stock at 80,000, you need to reduce 20,000, right? Written down value of inventory. What is the entry you should need to pass here? Profit and loss account data to inventory account. 20,000 you need to reduce from the cost, then only inventory is showing at 80,000. Now, how much amount you debited to the statement of P&L? To the extent 20,000 due to written down value of the inventory. Such a written down value of the inventory in the statement of P&L, you should shown under exceptional item. That is the meaning of exceptional items. And a reversal of such. When you would reverse such written down value, for example, the same stock is continued in the next year as well. Just for the time being, I'm telling you, the same stock is going to continue in the next year as well. In the next year, the stock was not sold out. Let us assume. Now, in the next year, what happened? The NRV value is 1.5 lakh. Net realizable value. Right now, in the outside, the market value is 1.5 lakh. But what is the original cost? Cost is 1 lakh. The same stock. I'm talking about the same stock. 1.5 lakh or 1 lakh, whichever is lower. Then the inventory should be shown at 1 lakh, right? The inventory should be shown at 1 lakh. That is cost to price. Earlier the inventory was carried at 80,000. From 80,000 to 1 lakh means you should need to make reversal of such written down. That means in the previous year, written down we already shown in the statement of P&L, and a reversal of such in the next year also we are going to shown in the statement of P&L by passing the entry inventory to P&L. Right now P&L is credited to the extent of 20,000. Now reversal of such written down should also going to shown under exceptional item. Next, provision for restructuring expenses and reversal of such. What is the meaning of restructuring? The way of conducting the business itself is different in future. Maybe earlier, which is completely man-based, right now we are running towards mechanization, or the manufacturing process itself may quite different. The nature of technology we are using in future, it is different, then which is nothing but restructuring expenses. Then any expenditure we are going to incur in future for the purpose of restructuring, you can create a provision as per accounting standard 29, that one. Such a provision what is at the time of creation of such provision, the entry is P&L account that are to provision for restructuring expenses. Then where I should need to show due to such a huge size and nature of the transaction, separate disclosure should be required. And a reversal of all such provisions, any provisions, reversal of any provisions. Sir, you created one provision, but the actual expenditure is less than the provision created. Then the excess of provision you created, you may reversal it. Such all reversal of provisions are chart again credited to the P&L under the exceptional items category. This one I already explained. Disposal of assets and a disposal of long-term investments. If you sold out any particular PPE, if you sold out any long-term investment, if you derived any profit or loss, such profit or loss again transferred to the statement of P&L under the category of exceptional item. Litigation settlement. Litigation settlement. Maybe certain disputes are there, maybe the land disputes or maybe any other disputes. Such litigation settlements, we are paying certain amount, it should be charged to the statement of profit and loss account. So under the exceptional item category. Legislative amendments having retrospective effect. Legislative amendments having retrospective effect. Maybe our company is a chemical manufacturing company, let us assume. So due to manufacturing of the chemicals, the nearby surroundings, the entire environment itself is damaged, let us assume. Due to the legislative amendments having the retrospective effect, I need to recover the entire environment as like in the previous mode. For that, I need to incur certain damages or I need to incur certain restoration expenses. I need to charge such expenditure into the statement of P&L under the category of exceptional item. I mean, if you check here, exceptional items are ordinary activities only, but due to such a size, nature, or incidents, a separate disclosure should be given in the statement of P&L. For ordinary activities, no separate disclosure, but for extraordinary activities, separate disclosure should be required. Even though exceptional items are also ordinary activities, but due to such a size, nature, or incident, separate disclosure should be required. So all examples also given by me. If you check the statement of P&L, guys, here, just a moment. Not there. One second. I'll open the statement of P&L. In schedule 3, if I open, this is the statement of P&L. Now, what is the application part of AS5? We can see here. Concentrate. Sir, if you check profit before exceptional and extraordinary items and tax represented. That means what are all the items you shown here? What are all the items you shown here? These are ordinary activities. I told you for ordinary activities, no separate disclosure should be required. Then profit before exceptional items, extraordinary items. Because for exceptional items, separate disclosure should be required. Then you will get profit before extraordinary items and tax. And for extraordinary items also separate disclosure should be required. So for exceptional items, we separately disclose in the statement of P&L, and extraordinary items also we are going to disclose separately in the statement of P&L. But for ordinary activities, there is no separate head. Simply we just shown as like that. Am I right? Okay. Come back, guys. So this standard is introduced. This standard is introduced not only for presentation and disclosure of ordinary and extraordinary and exceptional. This standard is also introduced to explain the items with respect to prior period items as well. Sir, what is the meaning of prior period items, sir? What is the meaning of prior period items? Prior period item is an expenditure or income recognized in the current year due to error or omission occurred in preceding financial years. Maybe a particular error or omission occurred in the previous financial year. At that particular point of time, that error or omission was not detected. That error or omission was detected in the current year. Then what I can do, at least I need to adjust in the current year. Under which head I need to adjust? Under the head of prior period items. One thing you need to remember at the time of adjustment of prior period items in the current year, it should definitely occur due to error or omission. It should definitely occur due to error or omission. I'll give a classic example here. Sir, for example, a cash theft was happened in the year 2021 by a cashier. but such cash theft was identified in the year 21-22. Now you know one thing. If that item is if that item is event occurring after balance sheet date, then you need to adjust in the year 2021 itself. Tell me, guys, we already seen in the last accounting standard AS4 at the time of discussing events occurring after balance sheet date, cash, the actual theft was occurred in 2021, but such theft was identified in the year 21-22. That theft was identified in the year 21-22. That means before approval of financial statements by board of directors, if it is identified, then which is an event occurring after balance sheet date, then it should need to be adjusted in the year 2021. Then in the year 2021, it is not a prior period item. In the year 2021, it is not a prior period item. Do you know that? Because 2021 abnormal loss, 2021 abnormal loss, we are recorded in the year 2021. That is not a prior period item. But let us assume the cash theft occurred in 2021, was identified in 21-22, not before approval of financial statements by board of directors, after approval of financial statements by board of directors, then which is non-adjusting event for the year 2021, which is non-adjusting event for the year 2021. Then in which year it need to be adjusted? Then in the year 21-22, it need to be adjusted. Then in the year 21-22, as which item it should need to be adjusted, sir? It should need to be adjusted as prior period item. Then the next question coming into my mind is, sir, prior period items, is it separate disclosure necessary, sir? Yes, absolutely. The prior period item should be separately disclosed. Do you know why? It is not at all related to the current year expense. It is not at all related to the current year income, but still we are recording in the current year statement of profit and loss account. The users of the financial statements can easily differentiate that these items impact we are considered in the current year, even though those items are not related to the current year, which was occurred in error or omission related to the previous financial years. And where it should need to be disclosed, sir? Is it disclosed under ordinary, or is it disclosed under extraordinary, or is it disclosed under exceptional? I mean, if the original expense or income is related to ordinary, such prior period item is also related to the ordinary. If the original expense or income is related to extraordinary, then prior period item is also related to the extraordinary. For example, earthquake occurred in the previous year, but the loss estimated due to earthquake was wrong in the last year, which was actually estimated at 2 CR, but the actual expenditure is 2.2 CR. Now the previous estimate is 2 CR, right? Now the excess of amount is 20 lakhs is there. Such excess of amount you need to be adjusted in the current year under which head, which is a prior period item, because the expenditure recognized in the current year due to error or omission made in the previous financial year. Then under which head I need to disclose under extraordinary activities, because the original expenditure is related to extraordinary activity. So disclosure separately after current year information in the statement of profit and loss account. After current year information in the statement of P&L account. I mean, in the statement of P&L, for example, if it is related to ordinary, let me come to the schedule 3. If it is related to the ordinary, first you can show the ordinary related to the current year information. After that, separately give the heading prior period items. Then you can provide the information. If it is related to extraordinary, first to provide the current year information, then give separate heading the prior period items. If it is related to exceptional items, first related to the current year information you can show, then prior period items information you can give. Do you understand? Okay. And the next issue is, still 2 more objectives are there for introduction of AS5. What are such 2 more objectives, sir? If any change in accounting estimate, if any change in accounting policy is there, how it should need to be disclosed in the statement of how it should need to be disclosed in the financials is another objective of introduction of AS5. AS5 is totally introduced with an objective of presentation and disclosures related to the 5 aspects. One is ordinary, which includes ordinary as well as ordinary but exceptional. Another one is extraordinary, another one is prior period items, and another one is change in accounting estimate and change in accounting policy. First of all, before discussing things related to change in accounting estimate, you should need to know one thing. What is the meaning of accounting estimate? What is the meaning of accounting estimate? Sir, accounting estimate is the concept completely based on judgment. In the business, we may not represent each and every item in the actual manner. Certain items required estimates. What is the meaning of estimate, sir? Estimate is not the actual amount, which is calculated based on certain assumptions, which may be calculated by experts. Sir, can you give certain examples of estimates we are generally using in our business, sir? Provision, whatever the provision you are creating as per the concept of prudence is completely estimate. Sir, depreciation, sir. Depreciation expenditure booked in the statement of P&L on the PPE, property, plant and equipments, is an estimate. Do you agree? Sir, what is the formula for depreciation under SLM method? Cost, virginal cost minus estimated residual value divided by estimated useful life. Estimated useful life. Provisions, estimated useful life of the PPE, residual value of the PPE, all are estimates. Sir, if the useful life is estimate, if the residual value of the PPE is estimate, then depreciation itself is an estimate. Inventory obsolescence. Sir, how much inventory is completely obsolescent, a complete obsolescence amount, sir? Due to change in technology, how much inventory is not useful, sir? That is also estimate. All these are estimates. So many different estimates we are using on the regular course of business. Now, what is the accounting treatment for such accounting estimate? For such accounting estimate, by making the lot of efforts, by making a proper judgment, we will derive a figure. We will derive a figure, maybe based on the past experience, maybe after taking the opinion of the experts, or maybe I mean the trend, or maybe the industry impact. Whatever the case, maybe we'll take a certain base. Based on that, we will make a certain accounting estimate. We'll make a certain accounting estimate. But the issue is, if at any point of time, if there is any change occurred in such accounting estimate, what is the accounting treatment? If any such change occurred in such accounting estimate, what is the accounting treatment? The accounting treatment should be provided prospectively. Prospectively. Or I can put in another way. Please concentrate. Whatever the estimate you made, that accounting estimate should be reviewed from period to period. That accounting estimate should be reviewed from period to period. For example, guys, sir, I created provision for warranty expenses. Provision for warranty expenses for 10 lakhs based on my past experience. Based on my past experience, I created for the current year 10 lakhs. Now in the next year, what happened? The actual expenses were incurred at the rate of 15 lakhs. The actual expenses incurred at the rate of 15 lakhs. Sir, I created a provision for 10 lakhs in the last year, but the actual expenses incurred in the current year was 15 lakhs. Why, sir? Maybe certain manufacturing defects are identified by us, or due to which the major warranty expenditure is going to incur by the enterprise. Then what I will do for the next year, still I am going to create a provision only for 10 lakhs? No. Now the actual expenditure in the current year become 15 lakhs. On the basis of this, the available information, I may create a provision for the next year at the rate of 15 lakhs. Then what I can need to do? Then I need to create P&L account data to provision for warranty expenses 15 lakhs I need to create. That means what I did, based on the prospective information, that is for the future, based on the future, I am providing the accounting treatment. That is nothing but prospective accounting. I'll give another example, guys. I can give another example. Sir, let me take an example of the PPE. Just I'm rubbing this. Please concentrate. I will take another example of PPE. What about the PPE, sir? Sir, initially a property, plant and equipment estimated useful life I taken at 5 years. And the residual value is, let us assume, nil. Residual value, estimated residual value is nil. So the cost of the PPE is 1 lakh. Now the depreciation for first 2 years, let us assume based on this, on SLM basis, that is 1 lakh divided by 5 years into 2 years. For 2 years depreciation, how much, guys? 40,000. 40,000. Do you agree? 40,000 is depreciation for the first 2 years. Now, after the second year, what we realized, the remaining estimated useful life is not 3 years. Based on this information, the remaining estimated useful life will be 3 years, right? But based on the available information, the remaining estimated useful life will be for 6 years, not for the 3 years. The remaining useful life will be 6 years. Then how to provide the depreciation, sir? So then depreciation for third year is nothing but 60,000 divided by, for the remaining estimated useful life are how many years, guys? Which are 6 years. That equal to 10,000 per annum. That means already provided depreciation we are not at all touching. Based on the futuristic information, based on the future figures, just we are making adjustment. We are not touching about the past information. That is the meaning of the prospective accounting. Prospective accounting means you can adjust in the future, but not in the past, if there is any change in accounting estimate. And one more thing is clearly given, if it can be quantified in the current year financial statements, then it should need to be adjusted in the current year financial statements. Sir, if it is related to the future financial statements, then you should need to be adjusted in the future financial statements, not in the current year financial statements. I gave the two examples. So that is provision for warranty expenses. I created provision for warranty in the current year itself because it impacted the current year financial statement itself. If it will impact the future financial statements, the depreciation, if there is change in estimated useful life, it doesn't impact in the current year, but it is going to impact in the future. That is the future financial statements it is going to impact. That means if there is any change in that accounting estimate, the change should be reviewed to the new figures, and the accounting treatment should need to be provided prospectively in the futuristic way. But already recognized expenditure with respect to that accounting estimate, we doesn't disturb. Do you understand? Next, come here, change in accounting policy. First, do you know the meaning of accounting policy first? What is the meaning of accounting policy? Accounting policy is an accounting principle. It is an accounting principle or methods adopted to follow such accounting principles in preparation and presentation of financial statements is known as accounting policy. So simply, accounting policy is an accounting principle and the methods adopted to follow such accounting principles in the presentation and preparation of the financial statements. Sir, can you give certain examples for accounting policies, sir? Why not? Do you know the principle of AS2, right? AS2 inventory valuation principle is, accounting principle is, it should be valued cost or NRV, whichever is lower, which is an accounting principle, as well as an accounting policy, because accounting policy includes accounting principle. So inventory valuation principle, it should be valued at cost or NRV, whichever is lower, is a accounting principle as well as accounting policy. To follow such accounting principle, I may follow FIFO method, or I may follow a weighted average method, or I may follow LIFO method, or I may follow any other method as well. Such all methods are purely accounting policies. Those are not accounting principles. To put it simply, please concentrate. Let me come to empty OneNote. Just a moment. Right. Sir, if you take a big universe, this is accounting policy. This is an accounting policy. If you take a small universe, then you can treat that which is an accounting principle, which is an accounting principle. What is the meaning of this, sir? Every accounting principle is an accounting policy, but certain accounting policies may not accounting principles. The same logic just now I proved. As per AS2 inventory valuation, inventory is valued at cost or NRV, whichever is lower, which is an accounting principle, You know, each and every accounting principle is policy as well. That's why it is also called as accounting policy. It is also known as accounting policy. But to follow such accounting principle, I may adopt FIFO method, or I may adopt specific identification method. Yes, that is also one of the method. Or I may adopt weighted average method. Now these methods are pure policies. These methods are pure policies. These methods are not principles. Policies may differ from one entity to another entity, but principles doesn't differ from entity to the another entity. That is the difference between principle and policy. And each and every principle is also known as policy, but each and every policy may not be a principle. Hope you understand first the meaning of accounting policy before discussing about change in accounting policy. Next question coming into my mind is first of all, can I change an accounting policy from one method to another method? I'm not talking about principle, I'm talking about pure methods. Can I change from one accounting policy to another accounting policy? You know the concept of consistency. You know the concept of consistency. As per the concept of consistency, in generally, same accounting policy should be followed from time to time. Same accounting policy should be followed from time to time. But certain exceptions are there. What are such exceptions are? If any statute prescribes, sir, in the Companies Act, it is clearly given that for the inventory, all the entities should need to follow FIFO method only. For example, if I followed previously weighted average method, then I need to convert it to FIFO method. So if any statute prescribes, then I can change. If any accounting standard prescribes, then I can change. Sir, it is not appropriate to follow the old accounting policy. If you change to the new accounting policy, it is appropriate. Then appropriate presentation and preparation of the financials to adopt the new accounting policy, then you can adopt the new accounting policy. If in these three circumstances, you can change one accounting policy to another accounting policy. But unless otherwise, these three circumstances is not coming into the picture, you cannot change an accounting policy. You cannot change an accounting policy. Okay, fine. Sir, then at the time of change in accounting policy, what is the accounting treatment we need to provide, sir? At the time of change in accounting policy, the accounting treatment is retrospective accounting treatment. What it means? Retrospective accounting treatment. Please concentrate. At the time of change in accounting policy, the accounting treatment is retrospective accounting treatment. Sir, earlier at the time of change in accounting estimate, we decided to follow the prospective accounting treatment, but at the time of change in accounting policy, the accounting treatment is retrospective accounting treatment. I will tell you what is the meaning of retrospective accounting treatment. For example, till now, for valuation of closing stock, I mean, you started your business 5 years back. Till now, you followed the method of valuation of closing stock on the basis of FIFO. Now, at the end of the 5th year, you are converted to weighted average basis, maybe due to any reason, due to the statutory requirement, or maybe due to standard requirement, or for better presentation of the financial statements. Now, what I should need to do, you know, if I would follow the weighted average method from the day one onwards, what is the value of the closing stock? If I follow the weighted average method from day one onwards, what is the valuation of closing stock? Let us assume the valuation of the closing stock is 1 CR. But actually I followed the FIFO method, right? Then the closing stock value is 1.2 CR. That means if I adopt the weighted average method from day one onwards, the closing stock will be 20,000 less than the actual closing stock on the basis of FIFO method. The 20 lakhs I need to be adjusted in the current year first by passing the entry profit and loss account data to inventory account. Profit and loss account data to inventory account. Do you understand? The change in accounting policy will provide the retrospective accounting treatment. The same point here I given. If you can able to quantify such a change, due to such a change, how much profit or loss do you derive? It should be identified in the current year financial statement. It should be adjusted in the current year financial statement itself. No, sir. It may not quantify the current year financial statement, but it may impact the future financial statements. then the fact should be disclosed, because it may not impact the current year financial statements, but it may impact the future financial statement. Then the same fact should be disclosed. What is that fact? Sir, there is a change in accounting policy is going to take place in the current year, but due to which the current year financial statement doesn't impact, but due to which the future financial statements are going to impact. The same fact you should need to be disclosed. This is with respect to the accounting treatment of change in accounting policy. Then one important issue, in two different circumstances, we may not treat that there is no change in accounting policy. People may feel that it is a change in accounting policy, but the standard will provide a pure guidance here. In these circumstances, it is not treated as a change in accounting policy. What are such circumstances, sir? An accounting policy related to transactions or events that differ in substance from previously occurred transactions or events. A policy which is related to transactions or events which differ in substance from previously occurred transactions or events. An example given, then you can easily appreciate. Sir, you know, at the time of retirement of the employees, employer will provide gratuity, right? Employer will provide gratuity. Let us assume till now in my organization, gratuity will be payable on ad hoc basis. Ad hoc basis means, sir, there is no proper formula. There is no particular procedure. If employer feels that, yes, he is very good person, you can give offer at 5 lakhs. Okay, he served for very lengthy time, you can offer for 10 lakhs. So that person is not working properly, just we can provide 3 lakhs. So just like that, at the discretionary powers of the management, they will provide the gratuity. That is nothing but ad hoc basis. Ad hoc basis means there is no criteria, simply just like that they are just providing. But now, for the purpose of providing the gratuity, a formal plan was make it ready. A formal plan is make it ready. Formal plan means maybe they take the certain criteria based on the last drawn salary, or maybe based on the long life. They take the certain criteria clearly, based on that they designed a formula. So their all figures they are putting in that formula, then they will derive the gratuity. Now, is it changing? Is that such change is treated as change in accounting policy? That is the question. Now, if you apply the provision, policy related to transactions or events differ in substance. Or previously there is no formula at all. Right now, formula based. In substance, which are differ, then how you can treat it as a change in accounting policy? In substance, such transactions or events are differ from previously occurring nature to the currently occurring nature. For example, if previously is also one formula is there, right now we are changing to another formula, then we can treat it as a change in accounting policy. But previously there is no formula at all, which is an ad hoc basis, but currently there is a formal gratuity plan is there. So formal gratuity plan on behalf of ex gratia gratuity payment to the retired employees. Ex gratia gratuity payment to the retired employees is a classic example for not change in accounting policy. Next, another one, introduction of policy for a transaction or event which was not occurred previously. Sir, till now the transaction or event was not at all occurred. Just now we started by adopting a policy, then which is an introduction of an accounting policy, but not a change in accounting policy. Introduction of pension policy to retired employees, which is not exist previously. Sir, till now in our organization, there is no pension policy at all. But from this era onwards, we decided to pay pension to the retiring employees. Now, which is treated as an introduction of policy for a transaction or event, which was not occurred previously, but not a change in accounting policy. Sir, this provisions are also much important. Previously, they tested certain questions out of this concept. Sir, now to put it simply, what we learned from accounting standard 5, sir, the base objective of AS5 is presentation and disclosure of certain items in the statement of profit and loss account. That is with respect to ordinary, extraordinary, prior period item, change in accounting estimate, change in accounting policy. Ordinary activities are normal business activities and which are further into and incidental to the business activities. No separate disclosure should be required with respect to ordinary activities. But certain ordinary activities are exceptional items. Due to such a size, nature, or incidence, disclosure should be required. The classic examples are written down value of inventory and reversal, and a provision for restructuring expenses and reversal of such provisions. All reversal of provisions are also examples for exceptional items. Disposal of property, plant, and equipment and the long-term investments are also examples for exceptional items. Litigation settlements and legislative amendments having retrospective impact, all such are examples for the exceptional items. Extraordinary items are not at all ordinary activities, which are clearly distinct from ordinary activities, and the occurrence of which is completely irregular. Sir, why you should need to provide a separate disclosure for extraordinary activities? Because the users of the financial statement should need to identify, should need to differ the profit or loss arised from ordinary and the profit or loss arised from extraordinary for better decision making. The examples are attachment of the property, refund of the government grant, receipt of government grant, income compensation of expenses. Sir, earthquakes are the natural calamities, losses, or what are the things we may incur, such all things we may put under extraordinary activities. Now coming to the special issues, that is prior period items and change in accounting estimates and change in accounting policy. Prior period item is recorded into the current year expense or income arised due to error or omission occurred in one or more preceding previous financial years, where it should need to be disclosed. A separate disclosure should be given after presenting the current year financial statements in the respective head. If the main expenditure is related to ordinary, prior period item is also shown under ordinary. If the main item is extraordinary, then prior period item is also shown under extraordinary. But after representing the current year information, we need to represent the prior period items. Then what about change in accounting estimate? Sir, certain items which we are going to provide in the financial statements is based on estimate, which is not the actual amount. Sir, for an accounting estimate, lot of judgment should be required. Certain items for the certain examples for the accounting estimates are provisions, inventory obsolescence, estimated useful life of the PPE, residual value of the PPE. If at the time of change in accounting estimate, the accounting treatment should be provided prospectively. We may not think about the past. We should not disturb already past recorded expenses or income. Coming to the change in accounting policy is nothing but accounting principle or method adopted to follow such accounting principles in the preparation and presentation of the financial statements. In general, as per the concept of consistency, we may not change one accounting policy to another accounting policy except in certain circumstances, if statute prescribes, if any accounting standard prescribes, for better presentation of the financial statements. At the time of change in accounting policy, the accounting treatment we need to adopt is retrospective accounting treatment. If it have impact in the current year financial statement, it should be quantified and the current year financial statement need to be adjusted. Sir, it doesn't have an impact in the current year financial statement, but it impacts the future financial statements. The same fact should need to be disclosed. Sir, certain circumstances may not treat it as a change in accounting policy. What are such circumstances? A policy related to transactions or events that differ in substance from the previously occurred transactions or event. The classic example I already given, a formal gratuity plan on behalf of ex gratia payments are the ad hoc basis. Introduction of a policy for a transactional event which was not occurred previously, which is introduction of a pension policy in our organization which is not there in past. These two are not change in accounting policy. One is change in substance, another one is introduction of an accounting policy. That's it, guys. Sir, I'll close this standard with a small two problems, but which provides a lot of confidence on your minds, because till now we discussed a lot of provisions with respect to AS5, which is the one of the previous examination question. Just let us check and confirm. State whether the following items are examples of change in accounting policy or change in accounting estimate or extraordinary items or prior period items or ordinary activity. So please all of you change the identify one by one. So then you can easily appreciate the concept of AS5 and your confidence will also enhance like anything. Actual bad debts turning out to be more than provisions. Sir, PBD, I created 5 lakhs, but actual bad debts occurred in the current year was 8 lakhs. Then I need to change the provision. Provision is an estimate, which is change in accounting estimate, which is change in accounting estimate. Change from cost model to revaluation model for measurement of carrying amount of the PPE. One method to another method, which is change in accounting policy. Government grant receivable as compensation for expenses incurred in previous year accounting period, which is an extraordinary activity. Tell me guys, for extraordinary activity, I already given certain examples now here. One of the example is receipt of government grant in compensation of expenses, okay, which is an extraordinary activity. Treating operating leases as finance lease, which was error made, which related to a prior period item. If this was made in the last year, if this error is related to the last year, which we are going to adjust in the current year, treated as prior period item. Capitalization of borrowing cost on working capital. So as per accounting standard 16, when you can capitalize the borrowing cost, if you incur such borrowing cost on the qualifying asset, working capital is not a qualifying asset. Working capital is not a qualifying asset. Then how you can capitalize? Error occurred in the previous year, which need to be adjusted in the current year under the head prior period item again. Legislative changes having long-term retrospective application, which is ordinary activity but exceptional. Tell me guys, ordinary but exceptional. Change in method of depreciation from straight line to WDV, which is change in accounting estimate, not change in accounting policy, guys, which is very much important, because the measurement of depreciation itself is an estimate. From one method of estimate to another method of estimate, if you change, which is known as change in accounting estimate, but not change in accounting policy. That is very much important. Government grant becoming refundable, which is an extraordinary activity. Applying 10% depreciation instead of 15% depreciation. Prior period item. Change in useful life of the fixed asset. Change in accounting estimate. So 10 questions, 10 multiply with 0.5, 5 marks, which was asked in January 2021 question paper under 1B. Question number 1 is compulsory now, where it was tested. Next, one more important question just I will show you. This was also previously tested. Explain whether the following will constitute a change in accounting policy or not as per AS5. Introduction of a formal retirement gratuity scheme by an employer in place of ad hoc ex gratia payments to employees and retirement. Sir, if policy related to transactions or event which substantially differs from the transactions or event occurred previously, which is not a change in accounting policy. Management decided to pay pension to those employees who have retired after completing 5 years of service in the organization. Such employees will get pension of rupees 20,000 per month. Earlier, there was no such scheme of pension in the organization, which is introduction of an accounting policy, but not a change in accounting policy. This question number of times tested in the examination. That's it, guys. This is with respect to AS5. And the next standard is AS9, guys, revenue recognition. Actually, as per our discussion, there are two more standards are pending. One is AS9 revenue recognition, another one is AS7 construction contracts. Both the couple of standards are with respect to revenue recognition only. Both the standards are related to revenue recognition only. AS9 as well as AS7. Except that one more standard also we are going to see in the marathon, that is AS14. I'm going to discuss along with the chapter amalgamation. I already informed at the time of introductory itself. Now, without wasting much time, let me directly entering into the topic, AS9 revenue recognition. Sir, in this standard, what you are going to discuss? Only one thing, guys. Timing of recognition. When we can recognize revenue. When we can recognize revenue into books of accounts. That is also revenue related to ordinary activities with respect to sale of goods, rendering of services, used by others of enterprise resources like interest, royalty, dividend. Only these aspects only we are going to discuss in AS9. The objective of AS9 is timing of recognition with respect to ordinary activities of business related to sale of goods, rendering of services, used by others of enterprise resources like interest, royalty, and dividend. For example, if the business person is a trader, then his ordinary course of business activity is sale of goods. Like me, a practicing chartered accountant, I'm not into trading. I will provide the services to my clients, which is rendering of services. And certain resources of the enterprise is used by the others, then the enterprise will get interest. The resource of the enterprise means if enterprise will provide investments in debentures, or if the enterprise is offering loans to particular people, then the enterprise will get interest as a revenue. Then when interest should need to be recognized into the books of accounts, we will discuss. If enterprise will use the resource like patent or the formula or the trademark by another enterprise, then we will get royalty on such patents. Then when you should recognize such royalty. And if your enterprise is make investment in equity shares of other enterprise, then dividend you may receive when the dividend is in generally recognized into books of accounts only related to the ordinary activities with respect to sale of goods and rendering of services, and this interest, royalty and dividend only AS9 is going to discuss. Sir, then what about other types of revenue, sir? AS9 doesn't discuss. AS9 doesn't deal. Other type of revenues, for example, in case of construction of contracts, a contractor will construct a building for their customers. Then for contractor, he will receive the contract revenue. When such contract revenue is going to be recognized, sir? For such AS7 is there. AS9 is not applicable to the below type of revenues. Construction contract revenues, AS9 doesn't applicable, AS7 is applicable. In case of lease transactions, for example, a building is there, that building is given to the other party. Now the owner of the building is known as lessor and the other party is known as lessee. From lessee, lessor will get lease rentals. These lease rentals are income to the lessor. Then how the lessor is going to recognize such lease rental, which is AS19 actually is going to deal, which is again group 2 standard, but in marathon I'm not taking into discussion. Next, sir, for the enterprise, government release certain grants. Then our enterprise received the government grant, which is actually a group 2 standard, AS12 government grant. When it should be recognized, what is the accounting treatment for such all things, AS12 is there. Government grant is also one type of revenue. It may be the capital type of revenue. I mean, if it may be the capital type of receipt or maybe the revenue type of the receipt, that is different story. Next, for insurance companies, if any revenue is raised, how it should going to be recognized, that is depending upon the IRDA regulations are applicable. Any accounting standard is not applicable. Sir, realized or unrealized gains due to the disposal or holding of non-current assets. I mean, a PPE is sold out, you derive certain profit, then how it should need to be recognized, when it should need to be recognized, AS10 is applicable. That is nothing but realized gain. Unrealized gain means revaluation profits, revaluation losses. For that also accounting standard 10 only applicable. Realized or unrealized gains due to discharge of obligation at less than the carrying amount or holding the liability. Simply liability is there, certain liability is there. For example, creditors are there at 10 lakhs. But as a full and final settlement, we are paying only 9 lakhs by taking the 1 lakh amount of the discount, which is discount received. For such thing, accounting standard 9 is not applicable. For exchange gains, accounting standard 11 is applicable. Again, accounting standard 9 is not applicable. That means even though the standard title is revenue recognition, AS9 will not discuss about the certain revenues like government grants and realized or unrealized gains at the time of disposal of fixed assets and the lease rentals in case of the lessor point of view, construction contract revenues in point of view of the contractors, or the exchange gains. For all such things, various accounting standards or the respect to industry regulations like IRDA regulations are exist. Do you understand? Okay, fine. Sir, now before discussing about the revenue recognition provisions with respect to sale of goods or rendering of services and interest and royalty dividend, first let me know what exactly the meaning of revenue. What is the meaning of revenue? Revenue is the gross inflow. Revenue is the gross inflow of cash or receivables or any other consideration in the ordinary course of their business activities with respect to sale of goods, rendering of services are used by others of enterprise resources yielding interest, royalty and dividend. First, let me explain the meaning of gross inflow. What is the meaning of gross inflow, sir? Sir, gross inflow means the total amount receivable or received from the other party, but it doesn't include trade discount. It doesn't include trade discount. Even though the word they are using as a gross inflow, it doesn't include trade discount. It doesn't include volume rebate. I mean, if any trade discount and volume rebate is there, we need to reduce. The reduced amount itself is only we can call it as a gross inflow. And one more question coming into my mind at this stage. Sir, is it gross inflow means, is it inclusive of GST or exclusive of GST? You know, in case of GST, at the time of sale of goods, GST is applicable, and at the time of rendering of services also GST we are charging. Now, my question is, the gross inflow means whenever we are selling the goods, we are collecting the output GST from the other party, right? Now, is it that output GST, that is maybe output CGST or output SGST or output IGST, is it inclusive of that revenue? No. Whatever the amount of the GST you are collected from your customers is ultimately payable by your entity to the government. Then how you can treat it as your revenue? It is actually your liability. So that's why GST on output, whether it is sale or service, is a liability. Gross inflow is the revenue without considering that output of GST. And one more important case, just I want to tell you here. Maybe most of the times you may come across this situation at the time of booking tickets. At the time of booking tickets, either for bus or either for train or either for air. What will happen? You may interact with a particular agent. For example, if it is related to the train, most of the times you may interact with IRCTC, right? Now, IRCTC will provide the train booking service to you. But the train fare, whatever they are getting, is it belongs to IRCTC? No, absolutely not. The train fare which was collected from the customer is ultimately payable by IRCTC to the government, which is the central government, Indian Railways. But IRCTC is getting certain commission. IRCTC is getting certain commission. Now, the gross inflow in case of IRCTC means that is not the amount collected from the customer. That is the amount they are getting as a commission. Amount they are getting as a commission from the government is only treated as the gross inflow. So that's why agency or brokers, gross inflow means which is a commission, not the entire amount. Do you understand this point? So gross inflow means after reduction of rebate, after reduction of volume, after reduction of trade discount, which is exclusive of the output GST. In case of brokers or agencies, gross inflow means only the commission, but not the total amount what they receive. Next, such a gross inflow they may receive in the form of cash, if it is a cash sales, if it is a cash service, or maybe if it is credit sales, they are getting the debtors, or maybe for any other consideration other than cash and receivables. Maybe they may sell certain goods and the other party may issue the equity shares. Still, it is considered as a revenue only. But the revenue will covers with the standard with respect to ordinary activities. So what is the meaning of ordinary activities? Just now we completed as per ordinary activities. Ordinary activities which are incurred in day-to-day life of your business practice. Sir, in which goods you are dealing on day-to-day business? Sir, I am in the steel manufacturer. I will ultimately sell that's a steel utensils. Sir, I am in the petroleum products. I will regularly make it trade in the petroleum products. Then such an ordinary activity is with respect to sale of such goods. Or you are not a trader, you are in the providing of services. You may an architect, you may chartered accountant, or you may financial advisor. Then you may provide a services which is happen in the ordinary course of your business. Or apart from that, you may get certain interest when such interest is need to be recognized as a revenue. You may get certain royalty at that point of time when it should need to be recognized. You may invest in investments in equity shares. Then when the dividend should need to be recognized, you may also going to discuss in this standard. That is the definition of the revenue given in AS9. Then next question is, when revenue is recognized at the time of sale of goods. When revenue is recognized at the time of sale of goods, please concentrate, all of you. Come to my empty OneNote, guys, all of you. When revenue is recognized in case of sale of goods. Just a moment. Yeah, fine. Concentrate. Sir, in sale of goods, what happened, you know? In sale of goods, seller will be there, buyer will be there. Now the question is, in point of view of the seller, when he can recognize revenue from such sale of goods, revenue from such sale of goods. To recognize revenue from such sale of goods, they should need to complete two conditions. Condition number one is performance should be achieved. Performance should be achieved. And there is no uncertainty regarding the collection of amount. There is no uncertainty regarding collection of amount. Collection of amount. If these two conditions satisfied, then seller can recognize the revenue in his books of accounts. What is the meaning of performance achieved? When the performance is said to be achieved, sir, the sale should occur at a consideration. That means at a certain price. It is not offered. It is not offered at free of cost. It should be offered at certain consideration. And the risks and rewards incidental to ownership are transferred from seller to the buyer. And the last one is there is certainty regarding measurement of revenue. I mean, there is no ambiguity in measurement of such price. If these three conditions are satisfied, then the performance is said to be achieved. Along with the performance achievement, there is no uncertainty regarding the collection of amount, then we can recognize the revenue. The same fact here I given through my power notes. If you observe, sir, in case of sale of goods, to recognize the revenue, two simultaneous conditions need to be satisfied by the seller. One is performance should need to be achieved, and it is not unreasonable to collect that amount from the customer. That is, there is no uncertainty regarding the collection of amount. There is no uncertainty regarding the collection of amount. When the performance is said to be achieved, the sale is occurred at a consideration, not occurred at free of cost. They occurred at a price. Risks and rewards incidental to the ownership are transferred from seller to the buyer. And there is no uncertainty regarding the determination of the revenue. If all these three conditions are satisfied, then performance is said to be achieved. Along with that, there is uncertainty. There is no uncertainty regarding the collection of amount, then revenue can be recognized. So various cases I need to explain here. The basic provisions only first I am discussing. Once the basic provisions is over, we are going to see the various cases based on these provisions. Next, coming to the rendering of services. Sir, in case of services, when revenue can be recognized? In generally, when the service performance is completed. If the performance of the services is completed and there is no uncertainty regarding the collection of amount, then you can recognize the revenue. Same fact here also, when the performance is achieved, here also when the performance is completed and there is no uncertainty regarding the collection, you can recognize the revenue. But the thing is, how you are offering that service, that is important. That is depending upon the type of service. If the type of service is offering in proportionate completion method, or is it in complete service contract method? I will tell you what is the meaning of proportionate completion method. For example, a client came to my office, let us assume. He required total 4 services. One is consultancy services, that is advisory services. He needs certain advisors. Another one is he required audit services. One is internal audit, let us assume. And another one is statutory audit, that is external audit services he required. But both the audits actually we should not conduct. Just for the time being, I told you. Or let me put, one is stat audit, another one is taxation services. And another one is project finance, that is loan related services. He total required 4 different services, guys. He total required 4 different services. Now the question is it proportionate completion method or is it completed service contract method? How we can recognize? Let us assume for each and every service we are provided a separate quotation. Sir, for this we provided a quotation of 1 lakh. For the taxation services, we provided the quotation of 50,000, let us assume. Then for stat audit, I provided the quotation of 2 lakhs. And for the project finance, I provided a quotation of 1 lakh. Am I right? That means if I provided the advisory services, then I can recognize the revenue with respect to the advisory services. And if I completed the taxation services, even though the remaining 2 services are pending as on the reporting date, then I can recognize the taxation services revenue. That means in case of proportionate completion method, having multiple acts proportionately with the degree of completion, I can recognize the revenue. Or if I will tell the consolidated amount, let us assume the consolidated amount I told you 2 plus 1, 3, 3.5 plus 1, 4.5. I told the consolidated amount of 4.5 lakhs. Out of this, these two activities are completed. Now, how I need to recognize report depending upon the degree of completion. I can recognize the revenue for that advisory services, consultancy, and the taxation services. That is the meaning of proportionate completion method. That means you need not wait for to complete the entire activities. If you complete a particular activity, regarding that particular activity, you can recognize the revenue. But in case of the complete service contract method, complete service contract method means unless otherwise, if you fulfill all the activities, the other party will not release the amount. Even though if you complete the consultancy services and the taxation services, the other party will not release. The other party will release if you complete all the activities. Then you cannot put that it is a multiple activities at that point of time. Then which you can treat it as a single act at that particular point of time. If it is completed or if it is substantially completed, substantially means almost all are completed. 90% is completed, 95% is completed, only formality activities are there. At that particular point of time, you can recognize the revenue. That is the only difference in between sale of goods and rendering of services. In case of rendering of services, if it is under proportionate completion method, based on the degree of completion, you can recognize the revenue. If it is complete service contract method, you cannot recognize the revenue unless otherwise the service is completed or substantially completed. Sir, one Ved mantra I'm telling you for the entire revenue recognition standards, whether it is AS7, whether it is AS9. This is a Ved mantra for entire revenue recognition. What is that Ved mantra, sir? Uncertainty regarding collection of amount. Uncertainty regarding collection of amount arised before recognition of the revenue. The revenue recognition is postponed to the extent of uncertainty. Sir, we are in the process of rendering of services or in the process of sale of goods, whatever the case may be. Before recognizing such revenue into the books of accounts, regarding collection of amount, if there is uncertainty exist, then to the extent of uncertainty regarding the collection of amount, the revenue recognition should be postponed. Then when you can recognize, sir, when you get a confidence to recover such amounts from the other party, then at that particular reporting period, you can recognize the revenue. No, not like that, sir. I already recognized the revenue. Then there is an uncertainty regarding collection of amount. Then what I can do, sir? You can create a provision, guys. Sir, for example, you sold the goods, right? Then at the time of sales, what is the entry? Debtors account, debtor to sales. You already recognized the revenue. Debtors to sales, sales was already closed and transferred to P&L. Now uncertainty exists. You are unable to collect amount from the debtor. Then what you can create? You can create a bad debt, or you can create a provision for bad debts. That is profit and loss account debtor to PBD account you will create, right? But already recognized revenue, we are not at all disturbing. So if you already recognize the revenue, create a provision to that extent of uncertainty involved, rather than reversing or adjusting already recognized revenue. Rather than disturbing already recognized revenue, you can create a provision if you already recognized the revenue. This is the Ved mantra for the entire revenue recognition standards as like AS9 or AS7. This provision is applicable in both the standards. That's why I may not repeat the same provisions in AS7 one more time. I may not repeat because this is the marathon, we need to save some time. Now, uncertainty exists before recognition of the revenue, then the revenue recognition should be postponed. After recognition of the revenue, if uncertainty exists regarding the collection of amount, then we need to create a provision rather than adjusting already recognized revenue. That's it. Now, different cases we are going to see in, guys. Now you can enjoy the AS9 like anything. Please, all of you follow along with me. Just now we completed the provisions. Sorry, except that one more provision is there, right? I'm so sorry. Related to use of resources by others, use of enterprise resources by others, interest, right? When interest should need to be recognized, guys, that is depending upon the time proportion basis on the outstanding balance. If you provide the loan to the others, outstanding loan multiplied with the number of years and multiplied with rate of interest. you know that I equal to PNR by 100 or PTR by 100. You are learning the same thing from your childhood onwards, which is depending upon the time proportion basis. That is not a new provision. Coming to the royalty. Sir, how the royalty cases are in generally occurring? First, let me explain here. I'll explain through booksellers actually. For example, I'm the author of a book. Let us assume I published accounting standards book, which is an accounting standard book by C.S. Satya Raju. Let us assume I published this book. Okay. Now, I may not known to the larger public, and the public also may not have a confidence on me if I am the new author. Even though if the public have a confidence on me, my duty is not to sell the books. My duty is writing the books or gaining the knowledge and providing the knowledge to my students. That is my objective. I'm not an expert in the field of sales. Then what I will do, I will approach a book publisher. I will approach a book publisher. Then publisher, what he will do, he will connect to the larger audience. His duty is only printing the books, publishing the books, and selling such books to the larger audience. Now, the agreement in between me and my publisher is like this. Let us assume whatever the books you published, you need to pay on such published books at the rate of 100 rupees per book, which is the royalty 100 rupees per book. If you published that book, you need to pay. Whether it is sold out or not, I don't mind. For example, if I am very good author, I already have a very good market in the society, then I will demand like that. That is one type of provisions. That is one type of agreement may entered with the publisher. And another type of agreement, how it look like this. If I am completely a new author, all-timely new author, then the publisher will also may not entering into such agreement, because if I publish all the books, if ultimately not sold out by me, if I already pay the royalty to the author of such book, then publisher may lose. Then if the author is the new author, how the publisher will agree the terms and conditions with the author, if I sold out such particular book in the outside public, then I will pay the royalty. Otherwise, I will not pay any royalty. That means when the author should need to recognize the royalty as the revenue is depending upon the terms and conditions agreed in between the publisher and the author. That is completely depending upon the agreement along with accrual basis. Why I used the word accrual basis? If publisher published, then I will get the royalty. One type of agreement. If publisher sold, then I will get the royalty. That is another type of accrual. That means depending upon the terms and conditions of the agreement along with accrual basis, author should need to recognize the royalty income. That is one type of example just I given. The same example you can extend it to any type of royalty income. Hope you understand. That means when the royalty income should need to be recognized in the books of the author or in the books of the owner, that is on terms and conditions agreed entered in between the author and the publisher along with the accrual basis. Next, coming to the dividend. Sir, most of the times we already discussed the concept of dividend. I think so in group 1 marathon I discussed. Maybe this is completely new to you, but you know such fact already. When dividend is need to be recognized, sir, ante, dividend is in generally declared in general meetings by the shareholders. Even though the dividend is proposed by the board of directors in the board of directors meeting, if the shareholders declared zero dividend in the general meeting, there is no obligation to pay any dividend to the shareholders by the company. That's why as a shareholder or as an investor, when you can recognize dividend as a revenue into your books of accounts, when the other company declares the dividend. If the other company declares the dividend, then you have a right to receive is established. If the other company declares the dividend, then the right to receive is established. That's why when the dividend is recognized into your books of accounts, that is when the right to receive established. When the right to receive established, if the other company declares such dividend. That's it, guys. But guys, these three are also very much important. They are regularly testing in the examination. Things related to interest, royalty, and dividend. Interest is on time proportion basis. Royalty is on accrual and agreement. Terms and conditions entered in between the persons, and the dividend is when right to receive is established. That is at the time of declaration of the dividend. Now this is the time to discuss about various cases. Once if we'll able to finish the cases as soon as possible, then standard is over. So this is your turn. Please all of you participate. You should need to think from your point of view. This is the application of the provisions what we learned till now. Case number 1. Sir, in 2020-21, as on March 31st itself, goods are sold by seller to the buyer. The buyer is X. Our customer is X. Our customer made a small request. The request made by the customer is delivery delayed up to the April. So maybe customer godown is not in vacant position and customer requested me that, sir, you can provide the delivery in the month of April, sir. Now my question is, when I can recognize the revenue? Because sales happened in the month of March, but the delivery is delayed at the request of the buyer in the month of April. Can I recognize the revenue in 2021? Or can I recognize the revenue in 21-22? Because delivery was made in the year 21-22. That is the question. Now, what is your answer? First, you need to check two things. To recognize the revenue, two conditions satisfied. One is performance should be achieved, and another one is there is no uncertainty regarding collection of amount. If these two conditions are achieved, then seller can recognize the revenue with respect to such sale of goods. When the performance is said to be achieved, it should occur at a consideration. Yes, absolutely, it was occurred at a consideration. And risks and rewards incidental to ownership. Risks and rewards incidental to ownership are transferred from seller to the buyer. Sir, is it risk and reward transferred, sir? Why not? Already sale made. Sir, when risks and rewards incidental to ownership is said to be transferred, invoice is generated by the seller and the price is already agreed. If there is any increase or decrease in the prices in further, it may not impact for such transaction. Then the risks and rewards incidental to ownership are said to be transferred from seller to the buyer. Am I right? And there is no ambiguity with respect to the determination of the price as well. Then performance is said to be achieved as on March 31st itself. And there is, let us assume there is no uncertainty regarding the collection of amount. Then in the year 2021 itself, the seller can recognize the revenue. But one thing you should need to be careful here, seller should identify such goods. The goods are in identifiable condition. I mean, such goods should not be sold to any other party. Such goods should already in the packed mode, in the proper mode. Once the buyer is made a call, we can make it sell, which are there in identifiable condition, which are there on hand with the seller, which are identified, which are in deliverable condition. If these conditions are satisfied properly by the seller, then seller can recognize the revenue. Sir, but if seller does not having such goods in his godown, first of all, those are not in identifiable condition, then he may not recognize the revenue. Hope you understand. Like this, you need to present the answer. So March 31st consideration is there, ownership regarding the risks and rewards already transferred, and there is no ambiguity in determination of the price. So that's why performance is achieved, and the common assumption is there is no uncertainty regarding collection of amount. That's why Raj Limited can recognize the revenue in his books of accounts in the year 2021 itself. Come to the second case. Sir, Raj Limited is in the process of manufacturing of the goods, and after completion of manufacturing, he will sell such goods to the outside parties. What is the good here? Electronic equipments like refrigerators, washing machine, and heaters. He is in the process of manufacturing of electronic equipments like ACs, okay, washing machines, heaters, refrigerators, like that. So the sale is inclusive of installation. The sale is inclusive of installation. Then when I can recognize the revenue? Then when I can recognize the revenue? After completion of installation only. Maybe in these days, most of the times the customers are making orders through Amazons and their websites. You know what they will do? Certain persons, they itself offer sale as well as installation. Certain persons, they offer itself sale as well as installation. Once the sale is completed, then the party cannot recognize the revenue. After completion of installation, only the party can recognize the revenue. In certain circumstances, what will happen? You know, sale will be made by one person, installation will be made by another person. You may come across this situation. Recently, actually, I installed an AC in my office room. Okay, what happened? I ordered the product in the Amazon. So in Amazon, the party who sold such AC is different and the party who installed such AC is different. Now the question is, at that particular circumstance, once the sale is made, the party can recognize the revenue because installation is not his headache. But the other party, coming to the other party who made the installation, when he can recognize the revenue with respect to the installation after completion of installation only. So that point also I covered here, which is covered in case of service. So here I gave this clearly. Amazon sold AC to the customers. Okay. So after that, in Amazon, one company sold that AC to us and another company provided the installation services, which is, let us assume, Lakshmi AC services installed that AC into my premises. Let us assume the same thing actually happened recently to me. So that is the reason why I'm telling. Then when we can recognize the revenue that is installation revenue in the books of Lakshmi AC services, which is a pure service. Once installation completed and AC is accepted by the customer, then only Lakshmi AC services can recognize the revenue with respect to the service. But with respect to the sale by the other company, that is the party who actually sold the Amazon to the customer, once the sale is over, that is performance achieved and there is no certainty regarding collection of amount, he can recognize. But if it is both inclusive of sale and installation, which is both inclusive of sale and installation, after completion of installation only they can recognize. Total three different scenarios I told you. Sale plus installation after completion of installation. Sale is different, installation is different. For seller, once the sale is completed, performance achievement and there is no uncertainty regarding collection of amount, he can recognize the revenue. For the person who offered the installation, once the installation is completed, once the service is performed and the customer accepted that AC, then only he can recognize the revenue. Okay, fine. Next issue. Concentrate. This is with respect to sale of goods on approval basis. I'll directly explain the provisions. No need to take up the case, which is very easy. Sold goods on approval basis means when you can recognize the revenue, date as on which approval received or last date of approval elapsed, whichever is earlier. Whichever is earlier. I mean, approval already came, which treated as a sale, or the last date of approval is elapsed, also you can treat it as a sale. But out of the two dates, whichever is earlier date, you can recognize for the purpose of revenue. But here I will tell you one different issue, guys. Okay, what is that issue? Please concentrate. What happened in the current year? Seller sold goods to the buyer on sale of goods to approval basis. Sold sale of goods on approval basis. Now the issue is with the buyer as on the reporting date. With the buyer, 1 lakh worth of goods are there. Still the last date to approve is not yet elapsed. Let us assume in the month of February the sale was happened and the terms and conditions for approval basis sales were the buyer should need to accept within 3 months, because as on 31st March the 3 months was not elapsed, the goods are still lying with the customer. Now the question is, can I treat such goods lying with the customer as a sales? Then can I treat such goods lying with the customer as a sales? The answer is no. The answer is no. Because when you can recognize the revenue in case of sale of goods on approval basis, that is date as on which approval received. Date as on which approval received, or the last date of approval is elapsed, whichever is earlier. Sir, here the date as on which approval received, approval not yet received, and the last date of approval is not yet elapsed. Then at that particular point of time, how you can recognize the revenue? Then what is the accounting treatment I can make, sir? On behalf of treating it as a revenue, what you can treat, if it is a trading account, goods lying with customers, you should need to write like this: goods lying with customers apart from the closing stock, because which is not form part of the closing stock, which is not there in your godown. Goods lying with the customers, you should need to represent at the rate of cost price. If these 1 lakh at the selling price, out of this 20% is the margin, then 80,000 you need to represent under goods lying with the customer at cost price, but you should not be added into the sales. Just that point I want to emphasize here, nothing else. Next, come down to the another case. In case of consignment sales, what happened? The owner of the goods, which is consignor, will sending such goods to the consignee. Consignee is the agent of the owner. Ultimately, consignee will sold goods to the customers. Then the question is, when revenue should be recognized? Is it at the time of delivery of goods by consignor to the consignee? No, I made a cross mark. When revenue can be recognized in the books of consignor? When consignee ultimately sold goods to the customers. Because there is no difference between consignee and the consignor. If consignor send goods to the consignee means, which is not treated as a sale, which is principal agency relationship, just goods are transferred from consignor to the consignee. If consignee sold goods to the customers means, as an agency relationship, consignor will think that it is ultimately sold out by the consignor only. So then only consignor will treat it as a revenue. So that's why at the time of sale of goods by consignee to the customer, only consignor will recognize the revenue. For consignee, which is commission, guys, which is an agency commission, when consignee will recognize such agency commissions are ante, once the consignee will send goods to the customers, at the same time consignee also will recognize the commission. But consignor will recognize sir ante when consignee send goods to the customers. I mean, to put it simply, consignor and the consignee both will recognize the revenue at the time of sale of goods by consignee to the customer. But for consignor, the revenue is the profit, but for consignee, the revenue is the commission. That's it. Next, come here. So which is quite interesting. Please allow me to check here. What is this? I will first let me explain the case. Sir, which is a garment trading entity. Garment trading entity means that shirts, pants, okay, clothes, maybe dresses, all those are just sold out in a shop outlet. The name is the Ross Garments. The condition or the terms and conditions at the time of making the sale is, if customers satisfied with such goods, they can use. Otherwise, they can return. Maybe most of the times in case of garments, what happen? Maybe they might liking the products at the time of making, making the general wearing in their trial rooms, but whenever it comes to their premises, they may not feel it's good. Maybe the fitting issues may will come. So within that some many number of days, they can be returnable. Yes, that condition is generally levied by each and every shopkeeper. These are not the type of the ordinary type of goods. This is one of the uh, decorative item for the human being, I can put like this way, or which can be a prestigious issue as well. Because a lot of times in case of females, what they will happen, if somebody is telling that, sir, this dress is not good, then they may feel like anything. So that is the reason why, to push up their sales, just they are simply putting one of the time that if you are not satisfied, not an issue, within so and so number of days, in the same condition, you can return back to us. This is the condition. Now the question is, when we can recognize the revenue? Most of the persons, they may thought that after expiry of the time period only we can recognize the revenue, sir. That is not the correct answer. Because if 100 customers buy such product, how many number of customers they may return such goods? Very few customers. That's why at the time of sale itself, 100% sales we can be recognized as a revenue. But based on our past experience, for worth of the goods which we may return in the future, for such things you can create a provision. Because if 100 sales are occurred, only 1 or 2 will come return back. Maybe due to the size issue, maybe the fitting issue, or if they are not interested, then they may will come return. But more than 90% or 95% goods are sold out like anything. That's why based on our past experience, we may create a provision, but at the time of sale itself, we can recognize the revenue itself, which is the peculiar case and the special case. Next. So this is very much important, guys. Please allow you concentrate. Already number of time tested in the examination. What is this, sir? A party A sold certain goods to the B. As on which date, sir? As on 1/1/2021. A is the seller, B is the buyer. Is it okay, guys? Now, exactly after 6 months, B again resells such goods to the A. B again resells such same goods to the A after 6 months at the rate of 11,000. Now, when revenue can be recognized in the books? When revenue can be recognized in the books? By seeing this transaction, you may thought that, sir, A, if performance is achieved and uncertainty regarding collection of amount, there is no uncertainty regarding collection of amount, then A can recognize, sir. Then B also, when he can recognize, sir, when the same performance is achieved and there is no certainty regarding collection of amount, B can recognize the revenue from sale of goods. You may thought like this, but the thing is, which is not related to sale of goods at all. which is not related to sale of goods at all. Just he may bluffing you. He may bluffing you because this transaction is a pure finance based agreement, which is a pure finance based transaction. Simply speaking, A required certain amount. The required amount is 10,000. Now A given the security as such goods to the B. Now after 6 months, after 6 months, A is repaying such amount to the B along with interest. That is nothing but 11,000. Then B should release such goods to the A. But the terms is looking like that this is sale and resale transaction, but which is not at all a sale of goods transaction, which is a pure finance agreement of the transaction. Now the excess of 1,000 is there now. 1,000 is interest amount. How the interest should need to be recognized? On time proportion basis. On time proportion basis. Such time proportion basis, that is use of resource by others. How such time proportion basis? Out of such 1,000, relate total 6 months now, 1,000 is related to 6 months interest now. The 3 months interest is related to 21, 22. The 3 months interest is related to 2021. Sorry, 3 months interest is related to 2021. That is 500. And the remaining other 3 months interest, that is 1/4/2021 to 1/7/2021. That should need to be recognized in the year 21-22. That is another 3 months interest, which is 500. So in 2021 500, 21-22 500, I need to be recognized, which is on time proportion basis. So this is most important issue, guys. Most of the times already tested. They may bluff you, but don't think that it is a sale and resale agreement. It is a pure finance agreement. The interest should need to be recognized in the books of B on time proportion basis. That's it. Next, coming to some small issues, guys, which is related to subscription of journals. Subscription of journals. The classic example is our CA students, our CA members itself. They might paying fees to the ICAI. The students are may paying the fees along with their registration, and members are paying fees on an annual basis. That is the only difference for the purpose of getting the journals. Now, how the ICAI will recognize the revenue on that amount, sir? They will recognize on straight line basis. If they offer the service for the first year, if they provide such journals in the first year, out of the 12,100, they will recognize the 100. If they offer the service for the second month, they will recognize the revenue for another 100. That is on straight line basis. Simply they will recognize that periodicals revenue. Next, this is nothing but related to hire purchase sales, guys. You know, in case of hire purchase sales, when the hire vendor will recognize the revenue, initially he will recognize the revenue of cash price. Then the excess of cash price over, excess of hire purchase price over cash price, he will recognize in the form of interest on time proportion basis. Only the initial cash price only recognized as a revenue. The excess of hire purchase price over the cash price, he is going to recognize in the form of interest. Sir, and the second one is related to pure services. This first related installation services I already explained. So this one, out of the services, this is another important area. This was already previously tested once upon a time. Once again, I'm repeating the same. Please all of you concentrate, which is related to advertising commission. How in generally advertising agency commission will going to occur? Let me explain through my empty OneNote. Please concentrate, guys. Just a moment. Right. Sir, let us assume it's not assumption, it is realistic only. IPL, you may see IPL, right? I don't know this time who sponsored the IPL, but in the previous IPL, who sponsored the IPL, sir? The IPL is sponsored by Dream11 actually. Dream11. Dream11 is a company actually. What it will do, Dream11 will buy time space, from BCCI. Who will conduct the IPL? In India only, which is BCCI. Now, Dream11 will buy time space from BCCI for the entire IPL matches. The time space is, let us assume, the time space charges are, let us assume 100 CR. Now, what Dream11 will do, you know, Dream11 can advertise their own company products, or Dream11 can sell such time space to different companies. Let us assume Dream11 is a advertising agency right now. Just for the time being, we can assume Dream11 is an advertising agency. So out of the time space, that is 10%, it is allocated for their own. Let us assume the remaining 90% is there now. Remaining 90% it is allocated to different companies. Maybe cred is one of the companies there which offering the credit services. Maybe different companies are there, maybe Stan Chartered Bank, SCB, certain foreign companies. Okay, maybe Barclays, certain companies, they are utilizing this advertising space. Now the question is, this advertising agency is there, right? Dream11, they will offer the time space, different time space for them. Different time space or the area space where they can advertise. All such terms and conditions entered between with the advertising agency as well as customers. Now the advertising agency can offer two different types of services. One is they can design the advertisements on their own. Customers, they can design, or on behalf of the customers, just that work is also allocated to Dream11. Maybe Sachin Tendulkar, they may take the brand ambassador depending upon the expenses, or maybe Dhoni, they can take the brand ambassador. Maybe Boost, another one product, another person may will come, Virat Kohli may will come. So like that, depending upon the persons and that, what is that, expenses, or maybe the cosmetics, what they are using products for, all such things, they may incur certain design expenses. Apart from the designs, they will also allocate time space. Now the question is, they are charging the amount for the design separately, they are charging amount for the offering the time space separately as an advertising agency Dream11. Now when Dream11 can recognize revenue in his books of accounts, the question is, for example, if credit is there, they already designed a particular advertisement, but such advertisement is not appearing into the public. Maybe suddenly IPL cancelled due to the pandemic situation, let us assume. Then do you feel that cred will offer amount to the Dream11? No, not at all. Not at all. Because you designed the advertisement, I do agree. Sachin Tendulkar came. He made a beautiful scene. He made a beautiful scene. Yes, it will definitely go into the public. Then cred will make a benefit out of that. But if the IPL is not at all occurred, then how the advertisement will appear before the public? That means even the design is completed, even the time space is offered, unless otherwise the advertisement is appeared before the public, advertising agency cannot recognize the revenue. The same fact here I given, that is production plus broadcasting charges. Broadcasting charges is nothing but that is broadcasting at the time of occurring that event. Production means for the purpose of design. Then when revenue can be recognized, when such advertisement is appears before the public, then only such advertising agency can recognize the advertising commission, which can be recovered from the customer. That's why irrespective of the fact whether the design completed, whether the time space is allocated or not, if the advertisement is appears before the public, then they can recognize, otherwise they can simply postpone. Next, non-trading concerns in case of clubs, okay, recreation clubs, all such times, entrance fee is a capital receipt. Membership fee that is they can recognize at the time of receipt at the beginning or on SLM basis, that is depends. If membership fee is different and the remaining services all are extra features, then at the time of receipt of membership fee itself they can recognize the revenue. No, after in the membership fee, if they provide, then they will provide the facilities itself, then that is the case, then they will recognize the revenue on SLM basis. That is not that much important, simply just at the time being I discussed. So the remaining all the cases what I discussed in case of sale of goods and in case of rendering of services are much more important. In AS9, the specialty itself is, rather than provisions, the cases itself is quite interesting. But if you understand the provisions, you can apply the provisions to the cases itself. That's it, guys. Then in accounting standards, one more accounting standard is there, which is AS7. We are going to start AS7 in the next slot. The final standard in the marathon is AS7 construction contracts, except AS14. Anyway, we are going to discuss AS14 along with the chapter amalgamation. AS7 is a little bit technical standard. This standard is also relevant in terms of revenue recognition concept. I already explained the same fact, the last standard AS9 revenue recognition itself. So then why already AS9 is there? What is the reason for introduction of AS7 construction contracts? You told that Both AS9 and AS7, both are relevant in terms of revenue recognition. Now, my question is, if already AS9 is there, what is the use of introduction of AS7? You know, one peculiar thing occurred in case of construction contracts. So first of all, before explaining things related to construction contracts and objectives and such all things, first let me explain only one thing. What exactly the meaning of construction contract in very layman way. I'm not defining the construction contract as well. We will see the definition of construction contract after progressing certain contents in the standard. First, let me explain in very basic layman approach what exactly the meaning of construction contract. Sir, if a customer or a person or a company wants a building or a bridge or a canal or a road, then it will definitely approach a contractor. What the contractor will do, contractor will provide a quotation price to the customer. If customer and the contractor in terms of construction contract, the customer is known as contractee. The customer is known as contractee. Now, the contractor and contractee agreed for a contract price, and they will enter into an agreement which is known as construction of contract agreement. Depending upon the terms and conditions in such agreement, contractor will provide the service as per the requirements of the contractee. Then contractee will pay the amount to the contractor. That is the thing in generally happen in case of construction of contracts, in case of construction contract. Now, let me explain the peculiar thing in case of construction contracts. It's not as like in the case of normal trading of the goods or normal service providing facilities. It is the combination of sale as service. It is a combination of sale as well as service, which is known as works contract. That is one peculiar thing. Another peculiar thing is construction contracts will not end within a particular reporting period, within an year. It will take more number of years to complete the construction contract itself. For example, let me explain why there is a necessity to introduce a separate accounting standard for construction contracts. After watching this example, or after seeing this example, you can easily appreciate why, even though AS9 is there, the reason for introduction of AS7 you can easily know. Sir, L&T, you know, right, which is Laston and Turbo, which took actually the metro project in Telangana in Hyderabad actually. Okay, so L&T is a contractor. The TZ Telangana government is a contractee or the customer. Now, the first phase of the metro project itself, it took in and around 5 years. This is only one of the phase actually. This is not the entire part of the metro project. Metro project was divided into a number of phases, and that first phase, it's run from 2015 to 2020 approximately, if I'm not wrong. It will take approximately 5 years. This was already done. So it took 5 years to complete the first phase of the metro project itself. So construction is continued for greater than an year in case of construction contracts. Now the question is, sir, if the construction is continued for greater than an year, now in the given case, it took 5 years. That means L&T will not recognize any profit or loss till the end of the 5th year. That is my question. That is the peculiar thing. No, nobody will do like that, because once you are progress with your work, then you are going to recognize your profit or loss over the period of construction as well. Up to the completion of the construction, nobody will wait for recognition of the revenue. But in case of sale of goods or rendering of services, it will complete within an year. But here, the peculiar thing, I already told you, the construction activity is completed for more than an year. That's why nobody will wait for recognition of the revenue till the end of the construction. Now, the next question is, how you can recognize the contract profit or loss with respect to the particular accounting period is the matter of discussion. How contractor should need to recognize profit or loss with respect to that accounting period, even though the construction of the contract is not yet completed, is the matter of discussion. For that purpose, the total contract revenue, sir, contract profit is nothing but income minus expense. Here income is known as revenue, expenses is known as contract cost. Contract revenue, contract cost. The contract revenue should be allocated to different accounting periods, and the total contract cost incurred on the total construction activity is also allocated to different accounting period. With respect to a particular accounting period, you need to identify contract revenue as well as contract cost. With respect to a specific accounting period, you need to identify. Then in that accounting period, if you compare the contract revenue of that accounting period with contract cost of that accounting period, then you can get the contract profit or loss. That is the reason why construction contracts are not clubbing with the general standard of revenue recognition. Here also what you are doing, sir, here also the provisions are with respect to recognition of the contract profit or loss only. That is with respect to the revenue recognition only. Do you understand? With respect to the contract revenue recognition only. But the nature of conducting business itself is quite different. That's why we are discussing with a separate standard. Okay, fine. Sir, one more thing. Under the scope or the applicability paragraph, it is clearly mentioned that construction contract is only applicable to contractor, but not to the contractee. Because for contractor, only when the revenue should need to be recognized, how much revenue it should need to be recognized, we are going to discuss in the standard. But coming to contractee or the customers, the relevant standard, that is accounting standard 10 pp is applicable, because it is a property, plant and equipment to us. Then at which value they need to measure such all things, AS10 is going to be applicable. Hope you understand. That's why it is only applicable in the books of contractor. Next, coming to construction contract. Sir, what is the meaning of construction contract? Now we are seeing the real definition of the construction contract. Earlier I already discussed the meaning of construction contract in very layman approach. Now we are going to discuss in technical way. Construction contract is a contract or is an agreement related to construction of a single asset, or maybe construction of group of assets. But such group of assets interrelated or interdependent in terms of either design, either usage, function, or technology. Construction contract is a contract entered between two parties. One party is contractor, another party is contractee. And that contract is related to construction of either single asset or group of assets, which are interrelated or interdependent in terms of design, usage, function, technology. Let me give one example for group of assets. For example, we are entering into a construction contract to construct factory. Factory is inclusive of buildings. Factory is inclusive of roads. Factory is inclusive of installation of machineries. Factory is inclusive of structures, maybe boilers, okay, different structures. All these are form part of construction. Now these are different assets. These are group of assets which are interrelated to one another, either in terms of design, usage, function, or technology, are interdependent in terms of design, usage, function, or technology. Now the construction of single asset or group of asset is said to be construction contract. So basically construction contract is inclusive of construction of buildings, construction of dams, construction of canals, construction of roads, construction of factories. Even the development of the software for a specific customer is also inclusive of construction contract. Yes, the development of software will also coming to take picture in case of construction of contract. But there are certain deviations in between accounting standard, because one more standard is the AS26, which discuss about intangible assets. That's why I don't want to discuss anything about software. So the major issues is with respect to construction of buildings, canals, dams, roads, etc. Okay, fine. Next, come below. Sir, types of contract. The contract may be fixed price contract, or the contract may be cost plus contract. What is the difference between fixed price contract or cost plus contract? In case of fixed price contract, the contract price itself is fixed at the inception of the contract. Contract price will be decided at the inception of the contract. In case of cost plus contract, contract price is nothing but contract cost incurred by the contractor after adding certain agreed percentage of profit, then contract price will come. In generally, when contractor will entering into fixed price contract, if contractor don't want to reveal the profit, how much he is deriving in front of the contractee, then they will enter for the fixed price contract. No, that is not an issue. We will enter for a certain percentage of profit. Then we are in generally entering into the cost plus contract. But you might listen the escalation clause in your costing subject, where the escalation clause is going to be applicable in case of fixed price contract or cost plus contract. In case of fixed price contract, contract is fixed. If rates are increased like anything due to the inflationary situation, then contractor may end up with losses. To compensate that, the contractor may entered by adding an escalation clause. So if due to inflation, if prices are increased, then contract price also will going to be increased according to the inflationary situation. That is nothing but escalation clause. But in case of cost plus contract, the type of problem not arise to the contractor. The reason is he will get the percentage of profit irrespective of the contract cost. He will get his decided profit. Am I right? This is with respect to the types of contract. Next, what is the objective? We discussed here in the objective what we discussed, how much contract revenue we need to be recognized, how much contract cost need to be recognized in a particular accounting period is the major discussion here, right? For that purpose, contract revenue recognized in a particular accounting period, the total contract revenue we know, but out of that contract revenue, how much we are going to recognize in the particular accounting period is by applying the percentage of completion method. By applying the percentage of completion method, you mean if you know the total contract revenue, on the total contract revenue, if you apply the percentage of completion, then you know the contract revenue to be recognized in a specific accounting period. Yes, but when you can apply the percentage of completion method, but when you cannot apply the percentage of completion method, let us have a discussion. When we can apply the percentage of completion method, if the outcome of the contract we estimate reasonably, if the outcome of the contract means profit or loss from such contract, if the total profit or loss from such contract, if you can estimate reasonably the total outcome of the contract, if you estimate reasonably, then we can apply the percentage of completion method. But if the outcome of the contract is unable to estimate, then percentage of completion method we cannot apply. We cannot apply the percentage of completion method. We will recognize the contract revenue in that accounting period in different manner. First, let me discuss when an outcome of the contract is said to be reasonably estimate. When an outcome of the contract is said to be reasonably estimate, the total contract revenue, if you can measure reliably, if the total contract cost occurred, you can measure reliably, and the percentage of completion, how much work was completed, also if you can measure reliably, there is a probability of inflows related to the contract will coming to the entity, then you can set to be the contract outcome is estimatable in reliable manner. One more time repeating. So simply when the outcome of the contract is said to be reliable, total contract revenue can be measured reliably, total contract cost is estimated reliably, and the percentage of completion, that is how much work is completed, if you can able to estimate reliably, and there is a probability to come inflows to the entity. I mean, we done work. You can measure the contract revenue reliably if you can measure the contract cost reliably. But if there is no certainty regarding the collection of amount, then we can't apply the percentage of completion method. That is the reason why he is telling that there is a probability of inflows related to the contract will coming to the entity. There is a probability, there is a certainty regarding collection of amount. Then you can apply the percentage of completion method. But if you are unable to estimate the outcome of the contract reliably, if you can unable to estimate the outcome of the contract reliably, we cannot apply the percentage of completion method. Then, you know, if percentage of completion method is applicable, then how much contract revenue we can recognize in the current year? Total contract revenue into percentage of completion. Then you know the contract revenue recognized in a specific accounting period. But if percentage of completion method we are unable to apply, then how to recognize or how to measure contract revenue related to a specific accounting period. If we unable to estimate the outcome of the contract, then contract revenue to be related to a specific accounting period is equal to contract cost incurred in that period. Contract cost incurred in that period, provided there is a probability to recover contract cost from the contractee. So to put it simply, I'll provide through a conclusion. Please concentrate, all of you here. This is very much important. Please, all of you concentrate. How you can measure contract profit or loss with respect to an accounting period in the statement of P&L. If the total contract revenue to be recognized in that period, total contract revenue to be recognized in that period minus actual contract cost incurred in that accounting period, the difference is nothing but contract profit or loss with respect to an accounting period. Am I right? What is the meaning of profit or loss, guys? Profit or loss is nothing but contract revenue minus contract cost with respect to that accounting period. Now, for this, there is no discussion at all. Actual contract cost incurred, you know. Now, how you can recognize the contract revenue is the matter of discussion. If you can able to estimate the outcome of the contract reliably, then contract revenue related to a specific accounting period we can measure by applying the percentage of completion method. That is total contract revenue into percentage of completion. No, if you are unable to estimate the outcome of the contract reliably, then which method you need to adopt? To the extent of contract cost incurred in that particular accounting period, you can measure it as a contract revenue, provided there is a probability to recover amount from the contractee to the extent of contract cost. To that extent of contract cost incurred in that period, you can recognize it as a contract revenue. I mean, what is the objective of the drafter here? You know, the objective is, if you can able to estimate the outcome of the contract, then you can recognize profit or loss. Then you can recognize profit or loss if you know the outcome. If you can able to estimate the outcome. But if you are unable to estimate the outcome, then profit or loss is equal to nil. Because in that case, he is telling that contract revenue to be recognized in that accounting period is nothing but actual contract cost incurred. Actual contract cost incurred minus actual contract cost incurred. Then profit or loss is zero. Am I right? So if there is no outcome of the contract, I mean, if the outcome of the contract is reliably not estimatable, then profit or loss is equal to nil. If outcome of the contract is reliably estimatable, then contract revenue into percentage of completion, you know the contract revenue to be recognized, it should be compared with the actual contract cost to be incurred, then you will get profit or loss to be recognized. Next. The next question coming into my mind is how to calculate the percentage of completion. AS7 provided 3 different methods for evaluation of percentage of completion, which is a popular method throughout all the problems. We are using method number 1 only. That is contract cost incurred till the reporting day divided by total estimated contract cost to complete the contract. For example, up to the current year, the contract cost incurred was 300 lakhs. But the total estimated contract cost to complete the entire contract will be 1000 lakhs. Now the percentage of completion is said to be 30%, which is the formula for percentage of completion. Next, that is one method. In another method, survey method. Survey method means a surveyors will be there. Those are the official surveyors. They will come. They are the experts in that field. They are using certain instruments. By using their knowledge, they will calculate, they will evaluate how much percentage was completed, depending upon if it is canal, how much percentage, if it is road, how much percentage is over, if it is building, how much percentage is over, because those are the civil engineers. They are having the proper knowledge in that field. So based upon their knowledge, they will simply give certain percentage of completion, which is based on report given by the surveyor. In case of physical proportion method means, just I want to give a small example here. Sir, let us assume the building is for a 5-storied building. 2 stores were completed. Out of 5 stores, 2 stores was completed, means the percentage of completion is 2 by 5. 2 by 5 into 100. That is how much percentage, guys? The percentage is 40% completion. That is nothing but physical proportion method. But most of the times, to evaluate the percentage of completion, we will use only method number 1, unless otherwise specifically mentioned. the survey method and physical proportion method in the problem. Do you understand? Because nothing is there to calculate here, but here certain calculations are involved. That's why in the examination as well as problems, most of the times they are providing the information based on method number 1 only. Now, you will have a clear-cut picture. Just let me go to my empty OneNote. Here, the objective is contract profit or loss to be recognized or to be measured with respect to a particular accounting period. That is the objective of AS7. That is nothing but revenue recognition. Now the question is, now the answer is how to get that profit or loss. Profit or loss is the difference between contract revenue and a contract cost with respect to a specific accounting period. With respect to a specific accounting period. Now, how to evaluate contract revenue with respect to a specific accounting period? That is, if outcome of the contract is reliably estimatable, then contract revenue with respect to a specific accounting period is nothing but total contract revenue into percentage of completion. Fine. Sir, if the outcome of the contract is not estimated reliably, then contract revenue related to a specific accounting period is equal to actual contract cost incurred in that accounting period. Provided there is a probability to recover such amount from the contractee. Fine. Once if you know the contract revenue with respect to a specific accounting period, then you can able to estimate contract cost with respect to a specific accounting period. That is nothing but actual contract cost incurred in that specific accounting period. Then you can easily know the profit or loss. Now, if the outcome of the contract is reliably estimatable, then to know the contract revenue of a specific accounting period, you should multiply with percentage of completion, right? Then how to evaluate the percentage of completion? Total 3 methods are available. One method is contract cost incurred till date or till reporting period divided by total estimated contract cost. Total estimated contract cost to complete the contract. And another method is survey method. And another method is physical proportion method. That is the major essence of AS7. Now with this background, let us see some more provisions in deeper manner. Out of that, first and foremost thing is what exactly we can include the components under contract revenue. What are the different components we can include under the contract cost? Now first let us evaluate the meaning of contract revenue. After that we will evaluate the meaning of contract cost as well. Now come to my power notes. What is the meaning of contract revenue? Contract revenue is nothing but initially agreed contract price. Initially contractor and contractor agreed one price, right? Which is initially agreed contract price plus or minus variations in the contract. Maybe there is a change in design. Maybe there is a change in structure. Maybe there is change in number of floors. Maybe there is change in length. Anything may cause variations that may be excess or that may be reduction. That's why plus or minus variations in the contract. Claims recovered from the customers. What is the meaning of claims recovered from the customers? For example, it is the responsibility of the customer to provide the raw material as per the terms and conditions entered into the agreement. But the raw material was not available as on that date, but the labor and the contractor are ready to construct the building. But due to which contractor foregone certain amount, due to which contractor incurred a certain amount, because labor is available now, irrespective of the fact whether they can use such labor or not, they need to pay to their labor. So that's why the contractor is asking claim some amount from the customer, maybe due to any reason, guys, maybe due to any reason. Those are the claims recovered from customers. Incentives. What is the meaning of incentives? If the contractee is satisfied like anything, then we'll provide certain excess amount over the contract price, which is nothing but incentives. Or maybe the contractor make it ready that entire contract at less than the targeted time period. then they may provide the incentive as per the agreement itself, which is nothing but incentive. Incentives are also form part of contract revenue. In the same way, penalties are also available, because if it is not completed within the time period, then penalties may also imposed. Whenever incentives are there, penalties are also form part, but incentives should be added, penalties should need to be reduced. Then you will get the contract revenue. So contract revenue is form part of contract price, variations in the contract, claims recovered from the customers, incentives, and a reduction of penalties. But here, certain important practical illustrations they might ask. That means when you can add variations into the contract revenue. To add variations into the contract revenue, we should satisfy two conditions. It is probable that customer should approve such variation and that amount of variation. Simply, you cannot directly add the variation amount to the contract revenue. There is a high probability that customer should approve that variation and that amount as well. Then only you can add it into contract price. And the variation related amount also you can able to measure reliably. If such two conditions satisfied, then you can include the variation related amount to the contract revenue. Then when a contractor can add claims into the contract revenue, claims is nothing but you are making certain dispute with the contractor. Sorry, you are making certain dispute with the contractee. Then only claim concept will come now. So due to certain terms and conditions, maybe the contractee may not provide the raw material, or maybe some other aspect is happening. Then you are fighting for certain things which are nothing but claims. When you can add claims to the contract price, the negotiations, you and your customer will sit and you are talking something. The negotiations should reach the advanced stage, and it is probable that customer will agree and the amount should be measured reliably. Then only you can add claims into the contract price. Otherwise, simply you cannot include the claims into the contract price. Next, which is very much important, when incentives you can include it into the contract price. There is sufficiently advanced that performance standards will met or exceeded. For example, guys, sir, I entered into a construction of a bridge. Let us assume, sir, for bridge construction, it will take 3 years. Now, after completion of 6 months, simply based on my past experience, in the past, for all my contracts, I completed the entire contract before the targeted time period. Based on my past experience, after 6 months, just I decided to recognize the incentives into the contract revenue. Is this is valid as per the AS7 construction contract? No, it's not valid. Here past experience doesn't matter, because is that construction contract is sufficiently advanced? Sufficiently advanced means out of 3 years, just 6 months completed. How you know it will be completed within the targeted time period or less than the targeted time period? If pandemic came, what you can do, your past experience doesn't use. So that's why, is that project is sufficiently advanced that performance standards will met or exceeded. So almost I 2.5 years exceeded, sir. 2.5 years is over. Within 1 or 2 months the contract is yet to be completed. Then at that point of time you can recognize, that is, the contract should be sufficiently advanced that performance standards will met or will be exceeded. Then at that particular point of case, you can add the incentives into the contract revenue. So maybe these issues they might ask in the practical questions. Okay, fine. Next, come to the components in case of contract cost. What are the different components we can include into the contract cost? Number one is direct expenses specific to the contract. Direct expenses means direct raw material, that is simply direct material. Just a moment. Direct material, direct labor, direct expenses, which are total direct expenses specific to the contract. Allocable cost, which are overheads. Allocable cost, maybe certain overheads may be directly identifiable, certain overheads may be allocable, which are nothing but overheads or indirect material. Specific expenses as per the agreement to the specific customers. Maybe specific expenses means if you are using certain jigs or certain molds with respect to that specific customer, as per the agreement, you may add it. You already informed that fact to the contractee or the customer, and the contractee agree further, then you can include such specific expenses. But exclusions, you should not add the following expenses: administration expenses, selling and distribution expenses, research and development expenses, depreciation on idle plant, to any of the contract. These are specifically related to the organization as a whole. These are not related to any specific contract. And one more important issue I'm going to explain here. This is very much important. Number of them already tested this adjustment into the examination. Please concentrate. What is this? Certain contract expenses already incurred by the contractor, but which are not related to the current year, which are related to the future activity. Can I include such contract expenses into the contract cost of the current year? If I tell like this, you may not appreciate in the exact manner. Let me give you a small example. Sir, raw material purchased for the purpose of construction of building in the current year is, let us assume, 10,000 units. Maybe this is 10,000 bags of cement or whatever the case may be. Let us assume which is 10,000 units. But out of such 10,000 units, I utilized only 9,000 units. Now, I already incurred the excess of 1,000 units as a contract expenditure, which is related to the future activity. These 1,000 units are derived as a closing stock for the current year, but such 1,000 units I may use in the next year. Now, such 1,000 units raw material, I should not include it into the contract cost of the current year. I should be excluded. It should be treated as asset in the balance sheet. Example, stock of materials at the end of the reporting period, advances to subcontractors. Because I'm the contractor, maybe I have some other workman force, maybe certain portion of the contract I may provide to the subcontract. For such subcontractor, I may provide certain advances, but which is not form part of the contract expenditure related to the current year, which is related to the future activity, which should be excluded from the current year contract cost. So closing stock of raw material and advances to subcontractors are not form part of the current year contract cost. You should please all of you remember. Based on this, actually, the last examination, one question also asked. Okay, we will derive. What is that? We will derive after end of this accounting standard. Okay, we will see certain questions for this accounting standard. Okay, fine. So right, come back to my empty OneNote. Sir, here I already told you the objective, and we've seen the components of the contract revenue and the components of the contract cost. What are the different components of the contract revenue we've seen, guys? Can you please just list out quickly? What are the different components of contract revenue we've seen? Contract revenue components are initial contract price, maybe, tell me guys, variations in the work, maybe claims, incentives, penalties. Penalties should be reduced, and the variation is also plus or minus. And the contract cost is inclusive of direct expenses, that is direct expenses, that is it is inclusive of direct material and direct labor as well as direct other expenses, and allocable cost and the special cost, but which is exclusive of selling and distribution, administrative expenses, and one more thing, contract cost incurred for the future activities like closing stock of raw material and advances to subcontractors. Am I right? Fine. Now, let me explain one important and special provision of AS7 here. Important and special provision. If total estimated contract cost exceed the total contract revenue, if the total estimated contract cost exceed the total contract revenue, which is known as expected loss, for such expected loss, we should create a provision as a separate expenditure in the statement of profit and loss account immediately, irrespective of work has commenced or not, percentage of completion, even though we will get profits from other contracts. What it is all about, sir? What it is all about? Let me explain this provision through a small illustration. This is the example. We are in the year 2021. As at 31st March 2021, this is the information. The total contract revenue is 10 lakhs and the estimated total contract cost is 10 lakh 80,000. And the contract cost incurred in the current year is 5 lakh 40,000. Now, please all of you concentrate here first. Sir, in generally by applying the provision of AS7, how much contract revenue to be recognized in the specific accounting period? That is the total contract revenue into percentage of completion. Total contract revenue into percentage of completion. Percentage of completion is how much, sir, here? Percentage of completion is nothing but contract cost incurred till date, which is 5 lakh 40,000. divided by total estimated contract cost to complete the contract, which is 10,80,000, which is 50 percentage, which is 50 percentage. So 10 lakhs into 50 percentage, which is nothing but 5 lakhs. Now all of you please concentrate. If this is the statement of P&L, if this is the statement of P&L, contract revenue to be recognized in that accounting period is 5 lakhs. Actual contract cost incurred that accounting period is 5,40,000. We know only that fact, right? If you ignore this provision, this is the information you need to present in the statement of P&L. Now, what is the current year loss? Current year loss itself is 40,000. Current year loss is 40,000. Now, if you check the above provisions, if total estimated contract cost exceeds the contract revenue, if the total estimated contract cost 10,80,000 exceeds the contract revenue of 10 lakhs, the excess loss, that is expected loss, the total expected loss is 80,000. The total expected loss is 80,000. Okay. It should be recognized. It should be recognized by providing a separate expenditure in the statement of profit and loss account immediately, irrespective of work has commenced or not. Sir, whether you started the work or not, irrelevant. You can recognize such loss immediately, irrespective of percentage of completion. So 20% completed, sir, 30% is completed, sir, still you can recognize the entire expected loss. Even though we will get profits from other contracts, still you need to recognize this expected loss immediately. Now, if you check here, the total loss will be 80,000. Out of the total loss, 40,000 is related to current year now already. Remaining 40,000 you need to be recognized as an expected loss, because the total loss is 80,000. Out of the total loss of 80,000, 40,000 is already there, which is a loss. Remaining 40,000 is an expected loss, for which you need to create a provision. That is P&L data to provision for expected loss, which is 40,000, and the total loss will be net loss 80,000. The same I represented here. Please all of you consider here. The foreseen loss is 10,80,000 minus 10 lakhs. The total loss is 80,000. Out of this foreseen loss of 80,000, current year loss is 40,000. Therefore, expected loss is 40,000, for which you need to create a provision. Therefore, expected loss is equal to foreseeable loss minus current year actual loss. If I present the same thing in the statement of profit and loss account, contract cost should be debited, contract revenue should be created. The same thing I already presented here. Now, you should need to create a provision for expected loss, which is of 40,000. Then the net loss total will be 80,000. The net loss total will be 80,000. Out of this 80,000, 40,000 is actual loss. Remaining 40,000 is the expected loss. That is the presentation of statement of P&L by applying this provision. This is very much important, guys. You should always check that if the total contract cost, if the total estimated contract cost exceeds the contract revenue, for the expected loss, out of the total loss, if you remove the current year loss, then you will know the expected loss. For such expected loss, you should need to create a provision in the statement of profit and loss account by providing a separate line item. Is it okay, guys? Next. Come down. Combining and segmenting of construction contracts. Combining and segmenting of construction contracts. When you can treat the group of contract as a single contract, when you can treat each and every contract as a separate contract. One more time repeating. When you can treat group of contract as a single contract, when you can treat the group of contract as each and every individual contract, when we can combine and treat it as a single contract if this satisfy these three conditions. Group of assets negotiated as a single package. Sir, for construction of building, for construction of roads, and for construction of the boilers, all we are negotiated as a single package, sir. Okay. Which are interrelated, completely completed either concurrently or in the continuous sequence manner. Concurrently or in continuous sequence manner means at the same time we can construct, or one another also we can construct. Then we can combine and treat it as a single contract. When we cannot combine, treat it as a single contract, when we can see each and every individual asset as a separate contract. Separate proposals we can given for each asset. Separate negotiation we can made for each asset. Contract cost and revenue can be measured reliably for each and every individual assets, and we can accept or reject any of the individual asset. That point also missed out actually. We can accept or reject any of the individual asset. Maybe one asset we may accept and another asset if you want you can reject. If that type of flexibility is there, then we can make it as a individual based contract actually. So based on this one question also asked in the examination, if time permits I will see that question as well. This is the combining and segmenting the contracts, and which are the final disclosures, guys. What you should need to disclose: revenue to be recognized in that particular current year, you should, that is contract revenue you recognized in the particular accounting year, you need to disclose. Method used for revenue recognition, that is, are you using percentage of completion method, are you using any other method? Because if the contract revenue is not estimated reliably, then to the extent of contract cost incurred you can recognize as the contract revenue now. So for that purpose is asking which method you are using. Then method used for calculation of degree of completion, for percentage of completion method, are you using method number 1, or are you using survey method, or are you using physical proportion method? Which method you are using also you need to provide a disclosure. Apart from that, the contracts under progress, that means the contracts are still under progress, certain percentage is completed, the following things you need to provide a disclosure: contract cost incurred till date, and a contract profit or loss till the reporting period is how much. Any advances we are received from our contractee, that is customers. Retentions, what is the meaning of retention? Okay, retention spelling is retentions. This is the retention. What is the meaning of retention, sir? Maybe we work done, but certain portion of the amount related to us is holded by the customer. That is nothing but retention. Why, sir? Why he holded? As a security, or maybe there need to be clarify certain things. So if I clarify such all things, then he will release such retention amount. That is nothing but retention amount. If any retention amount is there, I need to clearly represent that. Next, amount due from our customers or amount due to customers also you need to represent. How it should need to be represented, sir? Contract cost incurred till date. Sir, the total contract cost, how much we incurred till the accounting period, plus recognized profit or loss. This is nothing but amount to be recovered from the customer total, out of which already how much billing we made, which is nothing but progress billing. The remaining amount either we can recover from the customer or we can able to pay to the customers, because if progress billing is more than contract cost incurred till date plus profit recognized, then we are pending to our customers. That's why here it is clearly represented as due from customers or due to customers. If the figure is positive, which is due from customer; if the figure is negative, which is due to customers. These are the additional disclosures for those contracts which are under progress you need to represent. Now, let us see few questions, guys. We are in the marathon. I am unable to cover each and every question. Very few important question. Let me try to cover. Out of this, let us check the question number 1 first. Please consider all of you problem number 1, which will completely reveals the method of providing accounting treatment with respect to a construction contract. That's why I'm taking this question for discussion. A construction contractor has a fixed price contract for 9,000 lakhs to build a bridge in 3 years time frame. A summary of some of the financial data is as under. Year number 1, initial amount of the contract revenue agreed. Variation in revenue. In first year, there are no variations. In the second year, 200 lakhs is there. In third year, 300 lakhs is there. Contract cost incurred up to the reporting date. Year 1, 2093. Year 2, 6168. Year 3, 8100. Certain star marks are there. We will read and reveal such star marks information in further. Estimated profit for whole contract, here 950 lakhs, here 1000 lakhs, here 1000 lakhs. First star mark information, it includes 100 lakhs for standard material stored at the site to be used in year 3 to complete the work. That means out of such 6168, 100 lakhs was included as a closing stock. We already read certain provisions under contract cost which related to the future activity should not be included. That is like closing stock of raw material and advances to subcontractors. That's why in year 2, we should only consider 6068 only. Next is revealing the second star mark under this. it excludes 100 lakhs for standard material brought forward from year 2. The actual contract cost incurred in year 3 is not 8,400. Here it is 8,200. Because unnecessarily 100 they actually included in year 2. That's why they excluded in year 3. But it need to be excluded in year 3. That's why which is 8,200. Okay, fine. The variation in cost and revenue in year 2 has been approved by the customer. We told you na, to include the variations of the revenue, it should be ultimately approved by the customer. The amount and the change should be approved by the customer, and the amount should be reliably measurable. Then only you can include into the contract revenue. Indirectly, he is telling that you can take it into the consideration of such variation into the contract revenue. Compute year wise contract revenue, expenses, that is contract cost, and a contract cost to complete, and a profit or loss to be recognized in the statement of profit and loss as per AS7. It's quite simple. The ultimate objective is for year 1 profit or loss how much, for year 2 profit or loss how much, for year 3 profit or loss how much. For which first you need to identify contract revenue to be recognized in the particular accounting period. After that, you should need to work out the contract cost incurred in particular accounting period. If you compare the contract revenue and contract cost in that particular accounting period, then you will get profit or loss. Am I right? Fine. Now, to know the contract revenue to be recognized in the particular accounting period on the assumption that if you can reliably estimate the outcome of the contract, the total contract revenue into percentage of completion is nothing but contract revenue to be recognized in the particular accounting period. That means to know the contract revenue to be recognized in the particular accounting year, you should work out on the percentage of completion. First, let us start the entire problem with percentage of calculation working. Now, how to evaluate the percentage of completion is a matter of discussion. Percentage of completion method number 1 formula is cost incurred till date by total cost incurred to complete the contract. Sir, cost incurred till date was clearly given in everywhere. But do you know the total contract cost incurred, the total estimated contract cost to complete the contract? No. You may ask that, sir, the total estimated contract cost to complete the contract is 8,200 na. I too agree, but is when I know at the end of third year I know, but based on the year number 1 information, what is the total estimated contract cost to complete the contract? Based on the year 2 information, what is the total estimated contract cost to complete the contract? Based on year 3 information, the total estimated contract cost to complete the contract is 8,200. But I required the estimated contract cost to complete the contract at the end of each and every year. Then how do I work out, sir? I know the profit, right? Profit minus revenue is nothing but total contract cost. Revenue is 9,000. 9,000 minus 950 is nothing but 8,050. So total contract cost to complete the contract as per the year number 1 information is 8,050. And the actual contract cost incurred is 950. 950 by 8,050 into 100 is nothing but percentage of completion. The same thing I explained in my power notes. Please come below. First, I am working about the percentage of completion. Year number 1 contract revenue is 9,000. Profit is 950. Then estimated contract cost to complete the contract is 8,050. Now percentage of completion is nothing but 2093 divided by 8,050. So which is percentage of completion here is 26%, 1 by 2. In the same manner, if I work out, I will get the percentage of completion for year 2 74. For year 3, I got 100%. Once you know the percentage of completion, at the end of the year number 1, how much contract revenue you need to be reported? 9,000 into 26%, which is 2340. At the end of the year 2, the total contract revenue is 9,200. 9,200. You consider 9,200 into up to the second year, the total percentage of completion is 74%. So that's why up to the second year, the total contract revenue recognized is 6808. Up to the third year, the total contract revenue to be recognized is 100%. Sir, now in a particular period, how much contract revenue need to be recognized? First year, 2340. Second year, 6808 minus 2340. Already 2340 recognized in the first year, na? That's why I reduced 2340. Then I got second year recognized amount. Now in the third year, how much I need to be recognized? Out of the total 9,200, up to the second year, I recognize 6808. Now I am reduced that 6808. Then I need to know the third year contract revenue need to be recognized. Now this contract revenue related to a specific accounting period, I can compare with the actual contract cost. Then I will get the profit or loss. Now here I am working with profit or loss. These are the contract revenue related to a specific accounting period. Now the actual contract cost here 2093. Here, how much contract cost, guys? The total was 6068. Out of 6068 minus 2093, which is 3975, which is 6068 total minus 2093, which is 3975. Next, here 8200 is the total. 8200 minus 6068. So here how much we will get? 2132. Then you will get contract profit or loss to be recognized in a particular accounting period. Like this, you need to work out. This is the major area you need to focus from AS7. Sir, one more question just I want to reveal here. What is that question, you know? Just a moment. Yeah. So which is the last, I think so, or last before examination question, whether you can able to work out this question or not, let us check. The following data is provided for Mrs. Raj Construction Company. Contract price is given at 85 lakhs. Materials issued 21 lakh, out of which materials costing 4 lakhs is still lying unused at the end of the period. Out of this 21 lakhs, if 4 lakhs is still lying unused remains, which is the closing stock at the end of the accounting period. Labor expenses for workers engaged at the site is 16 lakhs, out of which 1 lakh is still unpaid. This 16 lakhs, 15 lakhs was paid, 1 lakh is outstanding expenses. Specific contract cost is 5 lakhs. Subcontract cost for work executed was 7 lakhs. Advances paid to the subcontractors was 4 lakhs. Further cost estimated to be incurred to complete the contract is 35 lakhs. You are required to compute the percentage of completion, contract revenue and contract cost to be recognized as per AS7. First, please all of you concentrate here. To know the percentage of completion, I required contract cost incurred till date divided by contract cost incurred till date plus further contract cost incurred to complete the contract. That you know, further cost you know, which is 35 lakhs. Further cost you know, 35 lakhs. First, I need to work out contract cost incurred till date. Sir, contract cost is inclusive of raw material, 21 lakhs. But out of the 4 lakhs is closing stock. If you remember the provisions of AS7, contract cost which related to the future activity like closing stock of raw material and advances paid to the subcontractors are not form part of contract cost. That's why 21 minus 4 lakhs only you should need to consider. So let me explain the contract cost till date with my power notes. Please concentrate here. So materials are 21 lakhs minus 4 lakhs, which is 21 lakhs minus 4 lakhs, which is 17 lakhs. Labor expenses, total 16 lakhs. Even though 1 lakh is outstanding, still we need to consider as per the accrual concept. That's why which is 16 lakhs only. Then specific contract cost is also inclusive of contract cost. Subcontractor expenses you can consider, but advances paid to subcontractor is not form part of contract cost. We already discussed. So that's why it was included. If you are not believe me, I'll open that contract cost is an exclusive of. We already discussed that. Where it is, just give a moment. Yeah, contract cost is exclusive of stock of raw material advances to subcontractors. Based on that, they actually developed that question. Okay, fine. Come below. 7 lakhs. That is a specific contract cost. Therefore, the total contract cost incurred till date we are getting as 45 lakhs. Now the percentage of completion is 45 lakhs divided by 45 lakhs plus 35 lakhs. Now percentage of completion came to 56.25 percentage. Once you know the percentage of completion, then you know the contract revenue to be recognized in that particular year. The total contract revenue is 85 lakhs. 85 lakhs into the percentage of completion, which is the contract revenue to be recognized in the particular accounting period, which is 47 lakh 81,250. One more question, contract cost to be recognized. Contract cost, how much you can recognize in the current year, how much you incurred. In the current year, I incurred 45 lakhs. The same 45 lakhs you can recognize in the current year, which I already worked out. That is the question actually they tested for 1A, which is for 5 marks, which is first and foremost question in your examination question paper, guys. Hope you are in detail explain things related to construction contract. Still, if I ignore certain questions, you can complete from your end. Okay. So with this, we completed the entire stuff with respect to accounting standards. Still, lot more are there, like 5 to 6 accounting standards are there, but we are not covering in our marathon. So the next chapter we can take up is amalgamation, followed by internal reconstruction, followed by liquidation of companies. So this setup is very much important. These three group of standards are in generally inserted as a reconstruction and liquidation of companies chapter as per the blueprint of ICAI. We are also dealing in the same manner. First amalgamation, then internal reconstruction, then liquidation of companies in all our further lectures. Now we are in the chapter amalgamation of companies. As I discussed at the inception of our marathon, we are going to discuss this chapter along with AS14. So before directly entering into the chapter, first let me discuss the concept of reconstruction. In very layman approach, the meaning of reconstruction is rebuilding of existing financial structure. To speak technically, which is known as restructuring of the existing financial statements. But before directly going to discuss in technical mode, first let me explain in very layman approach. Let me take a building. So whenever the word we are listening, a reconstruction, we always thought that which is a reconstruction of buildings, construction activities. Sir, if there are certain problems exist to use a particular building, then we have two choices or two options. One is we can demolish the existing building and rebuild a new building. That is one option. Another option is without demolishing the existing building, we can go renovation if it is possible. Am I right? There are two options. One is demolishing a new construction, and another one is without demolishing, we can go for renovation. Sir, for each option they having their own pros and cons. What is the advantage in case of option number one? Sir, due to construction of new building, it is altogether new brand image. By seeing the building, nobody can remember the old building because the new building is attracts like anything. The disadvantage is huge expenditure need to incur to construct the new building. Now coming to option number two, the advantage is, so if you go for renovation, while compared with option number one, the expenditure is very much less. But the disadvantage is whatever the renovation takes place, people can easily identify that still it is an old building only, just you renovated. That's why there is no brand loyalty. They can easily identify that which is the old building. This is in a pure layman approach if we can talk about the concept of reconstruction of buildings altogether in our society. Now, if I apply the same concept to a particular financial statements, if I implement the same concept to a particular financial statements, that concept is known as reconstruction of existing financial statements. Now, let me take balance sheet of a company. The company name is Ronnie Limited as at 31st March 2020. Now, what is the problem? Those financial statements are not depicting the true picture. Those financial statements are not in true and fair view. I mean, we are facing certain problems with existing building. In the same manner, we are facing certain problems with the existing financial statements. First, let us have a look into such financial statements. Then we can easily understand what problems are faced by the Rani Limited due to these financial statements. Sir, share capital given at 10 lakhs equity and a preference it is given at 5 lakhs, total 15 lakhs. Non-current liabilities 10% debentures, bank loan 2.5 lakh, current liability 2.5 lakh, and the total of the liabilities and equity is nothing but 27 lakh 50,000 given. In the same way, coming to asset side, PPE is given at 10 lakhs, intangible assets given at 4 lakhs, current assets are at 5 lakh, profit and loss account debit balance is given at 6 lakhs, miscellaneous expenditure not written off is given at 2.5 lakh, and total of assets is at 27 lakh 50,000. Do you think that the total of the real assets value in such company is at 27,50,000? That's not correct, because out of that huge P&L account debit balance and miscellaneous expenditure not written off is there. And one more thing, intangible assets are there. It is clearly unrepresented intangible assets because the company is a loss-making company. Maybe earlier goodwill is there, but right now there is no value for the goodwill because the company is a loss-making company. It is clearly given that the intangible assets are unrepresented. Now, due to which what happened, there is a overvaluation of assets occurred. The valuation of asset was showed at 27,50,000 in financial statements, but is it true? That's not true. Due to the overvaluation of assets, there is a overvaluation of net worth occurred. That is assets minus outside liabilities is nothing but net worth. So in the books of that company, the assets were overvalued and the net worth is overvalued. That's why the financial statements are not depicting the true picture. Then we can go for reconstruction. How we can go for reconstruction? Reconstruction is nothing but restructuring of the existing financial statements. It is a simple restructuring of your financials. Then we have two options as like discussed in above. In option number one, we can go for external, that is external reconstruction. In option number two, we can go for internal reconstruction. In case of external reconstruction, what happened? The existing building need to be demolished. The existing company need to be liquidated and a new company is incorporated to take over the existing company. A new building is constructed in place of the old building. The same thing is happened in case of external reconstruction. A new company is incorporated to take over the Rani Limited. Raju Limited, a new company is incorporated to take over the Rani Limited. That is nothing but external reconstruction. So then in case of internal reconstruction, what will happen? The same building we are going to continue, the same company we are going to continue, but we will make a lot of internal changes as like renovation. What are such internal changes are going to occur? What is our objective? Our objective is showing the financial statements in true and fair view. Am I right? For that purpose, what we will do in the process of internal reconstruction, we will revalue assets and reassess the liabilities. For each and every asset and liability, we will adopt the process of revaluation to depict the true picture in the outside market. Do you understand, all of you? So after revaluation, what will happen, sir? We may get certain revaluation profits or we may get certain revaluation losses. The profits or losses, whatever you are getting, you may net it off. The entire net profit or net loss occurred due to such reconstruction is going to make it set off with huge profit and loss account debit balance. Huge profit and loss account debit balance. That is our objective. Now we need to vanish this profit and loss account debit balance from the balance sheet. For that purpose, we will do certain activities in the process of internal reconstruction. Out of that, one activity is revaluation of assets and reassessment of liabilities. Apart from that, we will make so many compounding or negotiation activities with different shareholders and different liability holders. I mean, equity shareholders are there. Let us assume equity shareholders are there for the amount of 10 lakhs, that is 1 lakh equity shares at the rate of 10 rupees. Now we are making negotiation with equity shareholders that we are able to accept. We are asking the equity shareholders, or we are making a negotiation with the equity shareholders that you can accept each and every equity shareholder at the rate of 5 rupees only. The remaining 5 rupees you can forego. In the same way, preference shareholders also we will make such a negotiation. Maybe the preference shareholders are, let us assume 10% preference shareholder. But during the process of internal reconstruction, we are changing the 10% preference shareholders into the 6% preference shareholders. The reason why, if they are changing into the 6% preference shareholders, then the burden of the company with respect to payment of preference dividend is decreased in the future. What is our objective during the process of internal reconstruction? Now we want to reduce our burden, as well as if any profits we are getting during the process of internal reconstruction, we can make it set off with the debit balance existing under the statement of profit and loss account to depict the true picture of the financial statements. I'm not going into the deeper mode because we have a separate chapter so-called as internal reconstruction. We are going to take up such a chapter after completion of the chapter amalgamation. So that's why in case of internal reconstruction, we will set off P&L account debit balance and miscellaneous expenditure not written off with profits derived from change in paid up value of shareholders, or maybe due to reduction in capital, or maybe due to compounding or negotiation made with the different liability holders. Now the profits which is derived from the internal reconstruction is ultimately used to make set off with profit and loss account debit balance and miscellaneous expenditure not written off. That is fictitious asset, that is not a real asset. We will set off with that balances. After that, if you prepare your financials after completion of restructuring of the financial statements, if you prepare your financial statements, then such financial statements may depicting the true picture. That is the objective of doing the internal reconstruction actually. Sir, internal reconstruction is in generally done as per the various sections of the Companies Act 2013. Out of that, here two sections was mentioned. One is section 61 and section 66. External reconstruction is conducted as per section 232 of the Companies Act 2013. So then can you please elaborate the differences between external reconstruction and internal reconstruction? Why not? If you go to my main material, there I clearly established the difference between external reconstruction and internal reconstruction. Please all of you concentrate here. Yeah. Sir, in case of internal reconstruction, there is no liquidation of company. There is no liquidation of company happened. But in case of external reconstruction, I already told you the existing company is going to be liquidated and another company is incorporated to take over the existing company. Tell me guys, we already seen in case of external reconstruction, the Rani Limited is liquidated to take over by the Raju Limited, which is newly incorporated company. So that's why liquidation of existing company is going to occur in case of external reconstruction, but there is no liquidation occurred in case of internal reconstruction. And reduction of capital and varying rights. So reduction of capital happened in case of internal reconstruction, but not in case of external reconstruction, because we are making so many negotiations with various parties of the company. So that happened in case of internal, but not in external reconstruction. Legal position. So the legal position of internal reconstruction is dealt by section 61 and section 66. External reconstruction is section 232. And one more thing, sir, for the purpose of conducting the internal reconstruction, court approval should be mandatory. Sir, it is not the legal power directly given in the Companies Act 2013 to a company. No, it is not a legal power. It is the power given by the court to conduct the internal reconstruction process. If any company want to adopt the process of internal reconstruction to restructure their existing financial statement, first it should need to make a petition to the National Company Law Tribunal, NCLT, as per the Companies Act 2013. NCLT will check each and every provision of the internal reconstruction. If the scheme is very much, I mean, if the scheme is well established and which considers the interest of each and every party of the company, then ultimately NCLT will accept that scheme. Then the company can initiate the process of internal reconstruction. But to conduct the external reconstruction, nobody can take the court's approval. So that's why it is clearly given that court approval is mandatory in case of the internal reconstruction, but external reconstruction is effected without the approval of the court. That is the difference between internal reconstruction and external reconstruction. Now, sir, what are the advantages and disadvantages due to external and internal reconstruction, sir? You know, in case of external reconstruction, the advantage is high brand loyalty. I mean, the new company Raju Limited takes place on behalf of the Rani Limited, which altogether is a new company. People is feel like which is a separate and a different company from the Rani Limited. That's why high brand loyalty is there. But the disadvantage is to incorporate a new company, it took a lot of expenses, huge incorporation expenses. Maybe if the company shares are listed in the stock exchange, then again the Raju Limited share should be quoted in the stock exchange. To quote such shares in the stock exchange, we need to pay a lot of listing fees as well. Such all are additional expenditure we need to incur in case of external reconstruction. But coming to internal reconstruction, the expenses are less while compared to the external reconstruction. But the disadvantage is at the time of preparation of financial statements after completion of internal reconstruction procedure, we need to adopt the word and reduced while preparing the balance sheet. While preparing the balance sheet, in bracket, after completion of internal reconstruction, we will add the word and reduced. I already told you. So a lot of issues need to be discussed with respect to the internal reconstruction, but we are going to discuss in the next chapter. That's why only very few issues I'm going to discuss in comparison with external reconstruction. Okay, fine. So and reduced word we are adding after completion of internal reconstruction. That's why people can easily find that, sir, which is a loss-making company previously. To depict the true and fair picture, we completed the internal reconstruction process. So that's why the brand loyalty is not that much of good while compared with external reconstruction. That means both internal reconstruction and external reconstruction having their own pros and cons. Whichever is best, it is the management call. Accordingly, they will adopt the reconstruction procedure. Now, sir, we are in the chapter amalgamation. But why you are talking about the concept of reconstruction? One of the type of amalgamation is a classic example for external reconstruction. One of the type of amalgamation is a classic example for external reconstruction. So as per accounting standard 14, amalgamation in the nature of merger. But at this point of time, you may not appreciate what exactly the meaning of amalgamation in the nature of merger. But if you allow some time, after discussing the concept of amalgamation, you can easily appreciate what exactly the meaning of amalgamation in the nature of merger. So one particular type of amalgamation is a classic example for external reconstruction. That is the reason why actually I discussed the concept of external reconstruction. And one more thing, guys. First, let me open an empty. Just a moment. An empty note I'll open. Yeah, right. Now come here. What is that? What I want to discuss here. In the chapter amalgamation, so sorry. Totally, we will discuss three different issues. Totally, we are going to discuss three different issues. What are such three different issues? One is absorption. Another one is amalgamation. Another one is external reconstruction. Another one is external reconstruction. Please concentrate. In the chapter amalgamation, totally we are going to discuss three different concepts. One is absorption. Another one is pure amalgamation. Another one is external reconstruction. You know, first already things related to external reconstruction. Sir, in case of external reconstruction, what happened? Now the Rani Limited is a company which incurring huge losses since past few years. Now it adopted the process of external reconstruction. During the process of external reconstruction, a new company, Raju Limited, is incorporated, which is an existing company, which is a loss-making company, So now Raju Limited is altogether a new company is incorporated to take over the business of Rani Limited. Now the objective of external reconstruction is showing the financial statements at true and fair view. Am I right? Fine. Now coming to the concept of absorption, what will happen? Two companies they will take. One is X Limited, another one is Y Limited. Let us consider two companies are there. One is X Limited, another one is Y Limited. X Limited is existing company and Y Limited is also as an existing company. Now Y Limited want to absorb the X Limited. Y Limited want to absorb the X Limited. Simply Y Limited wants to take over the business of X Limited. Y Limited wants to take over the business of X Limited. Both the companies are existing companies. In case of amalgamation, what will happen? Two companies are there, X Limited and Y Limited. Both the companies will liquidate and a new company so-called as XY Limited is going to incorporate. Now here, X Limited is an existing company, Y Limited is an existing company, XY Limited is a newly incorporated company. Now, what is this all about, sir? The objective of external reconstruction is, I told you, to show the financial statements at true and fair view, but the objective of either absorption or the amalgamation may be quite different. Maybe the objective of amalgamation or absorption is to avoid the competition, because just they want to avoid the competition on behalf of the two companies. Only one company will be there. Now, to avoid the competition, Y Limited is going to take over the business of X Limited. Maybe to get the synergy benefit. Synergy benefits. What is the meaning of synergy benefits? Synergy benefits means 1 plus 1 is greater than 2, is nothing but synergy benefits. Do you understand? So that means if both the companies are clubbed together, then it may become the super economic company or super resourceable company. So that synergy benefits will be there. Maybe to get the economies of the scale, they may get amalgamated, they may get absorbed by one another. Do you understand? That means the objective of external reconstruction is quite different from objective of absorption and amalgamation. Do you understand, all of you? Then why you are discussing all these three concepts in the chapter amalgamation, you may ask. The reason is, whether it is about absorption or amalgamation or external reconstruction, there is no change in the accounting treatment, because here there are only two different companies are there. X Limited is a selling company, Y Limited is a purchasing company. Because Y Limited is going to purchase X Limited. Y Limited is a purchasing company, X Limited is a selling company. In the same way, the newly incorporated company XY Limited is a purchasing company. Here, both the existing companies X Limited and Y Limited is a selling companies. Am I right, guys? Next, in case of external reconstruction, the newly incorporated company is a Raju Limited, which is a purchasing company, and Rani Limited is a selling company. That means whatever the topic you can consider, whether it is absorption or amalgamation or external reconstruction, only two different types of companies exist. One is selling company, another one is purchasing company. The company who wants to take over another company is purchasing company. The company who wants to blend into the other company is known as selling company. Now, in the same way, in case of amalgamation, X Limited and Y Limited are the selling companies, XY Limited is a purchasing company. Now, coming to the external reconstruction, Raju Limited is a purchasing company, Rani Limited is a selling company. That means we will only see in the accounting treatment in two different companies. One is accounting treatment in the books of selling company, accounting treatment in the books of purchasing company. That's why in examination or in the syllabus, all the concepts are clubbed, whether it is absorption or amalgamation or external reconstruction. The method of accounting treatment we need to adopt it is same, but the objective of conducting such things may quite different from external reconstruction to absorption and amalgamation. Do you understand, all of you, this? So then what is the difference between absorption, amalgamation, and external reconstruction? In case of absorption, only two companies are involved, and are more than two companies may also involve, but all the companies are existing companies. One company is take over one or more companies, then which is known as absorption, but all the companies are existing companies. In case of amalgamation, a new company is incorporated to take over two or more companies, minimum two or more companies. That is nothing but amalgamation. In case of external reconstruction, a new company is incorporated to take over the existing company to show such financial statements by depicting the true and fair picture. The selling company is a loss-making company in case of the external reconstruction. That is the basic difference in between absorption, amalgamation, and external reconstruction. And but for the purpose of providing the accounting treatment, there is no difference. Only two different types of companies are there. One is purchasing company, another one is selling company. If you observe, the same I explained in my material as well. Just come below here. Now I given totally three examples. Company A and company B amalgamate to form a company C. company A and company B are called transferor companies, or you can also call it as selling companies. Transferor companies or selling companies, both the terminology is same. The company C is called the transferee company, or you can also call it as purchasing company. This strategy is called as amalgamation. Company A is taken over by the company B. Company A is taken over by the company B. Company B is a purchasing company. Company A is a selling company. Here, company A is called as transferor company and company B is called the transferor company, transferee company. This strategy is called absorption. An existing company will take over the business of another existing company. Company A has been suffering from losses for the past 5 years. A new company B is floated to take over the existing company A. Here, company A is the transferor and company B is the transferee company. The strategy is known as external reconstruction. Hope you understand, guys. Okay. And one more thing I already told you, external reconstruction is a classic example for one of the type of amalgamation as well, which is nothing but amalgamation in the nature of merger. Because in case of external reconstruction, what happened? All the assets and liabilities of existing company who's suffering losses is all together taken over by the purchasing company. Am I right? So you can understand why external reconstruction is so called as amalgamation in the nature of merger at later point of time. Okay, just leave it. Come back. Come back, guys. Right. So now here I explain the process of external reconstruction, absorption, as well as amalgamation. The same thing I established in my power notes as well. If you can check the external reconstruction, a new company Raju Limited incorporated to take over the Rani Limited. Rani Limited is a loss-making company. In case of absorption, both the companies are the existing companies. But in case of amalgamation, a new company is incorporated to take over the 2 or more existing companies. Okay, which company is known as selling company, which company is known as purchasing company, I already discussed. Another name for the selling company is the transferor company or the amalgamating company. Another name for the purchasing company is the transferee company or amalgamated company. Whatever the name they are calling, you can easily appreciate by this diagrammatic representation. And I told you the objectives as well. The objective of amalgamation may be to avoid the competition, or maybe to get the synergy benefits, or maybe for the purpose of expansion, or maybe for the purpose of getting economies of the scale, or maybe for the purpose of getting the taxation benefits, or maybe any other objective as well. Okay. Sir, do you know the recent amalgamation occurred in which industry? In the banking industry, lot of amalgamations are occurred. Okay, that Andhra Bank is merged into the Union Bank. Maybe the Corporation Bank is also merged into the Union Bank. So like that, certain banking mergers are actually occurred in the recent times. Okay, fine, let it be. Put it all aside. Now, please all of you concentrate with respect to the chapter amalgamation. Now we are in the actual amalgamation chapter. Amalgamation is broadly categorized into 2 types. Guys, whenever I am using the word amalgamation, it includes absorption as well as external reconstruction with respect to amalgamation in the nature of merger. So that's why for the time being, whenever I am using the word amalgamation, it includes amalgamation as well as absorption. You know the reason, because the accounting treatment doesn't change and the objective is also doesn't change, both from amalgamation and absorption. But what is the difference? In case of amalgamation, a new company is incorporated to take over 2 or more existing companies. But in case of absorption, an existing company will take over another existing company. That is the difference. Am I right? Fine. Now, amalgamation is broadly categorized into 2 different types. One is amalgamation in the nature of merger. Another one is amalgamation in the nature of purchase. First, apart from method of accounting, such all things, before discussing about all such things, when an amalgamation is said to be amalgamation in the nature of merger, when an amalgamation is said to be amalgamation in the nature of purchase, let us have a look. If all the below conditions satisfied as per accounting standard 14, then the amalgamation is said to be amalgamation in the nature of merger. We are discussing the chapter amalgamation along with the standard AS 14. I will not differentiate AS 14 and amalgamation, just I will club together whenever the AS 14 provisions necessary, just I will discuss. Okay. If all the below conditions satisfied as per AS 14, then the amalgamation is said to be amalgamation in the nature of merger. What are such conditions, sir? You know, two companies are there. One is selling company, another one is purchasing company. Now I am discussing with respect to these two companies only. To set an amalgamation is amalgamation in the nature of merger. All these below conditions need to be satisfied. All assets and all outside liabilities taken over by the purchasing company from the selling company. Purchasing company should need to take over all the assets and outside liabilities, all the assets and outside liabilities of the selling company by the purchasing company. All assets and liabilities taken over at book values only. Purchasing company should need to take over all assets as well as all liabilities at book values only. Next, purchase consideration. What is this purchase considerations are all about? Purchasing company is purchasing the business of selling company. As a result, purchasing company should need to pay certain amount to the selling company, which is technically known as purchase consideration. Purchase consideration payable by purchasing company to the selling company in the form of fully paid up equity shares only. The PC due to takeover of business by purchasing company from selling company, purchasing company should need to make certain amount to the selling company. That amount should not be paid in the form of cash. That amount should not be paid in the form of preference shares. That amount should only be paid in the form of equity shares only. So the purchase consideration should be paid in the form of fully paid up equity shares only. Next, concentrate. The next issue is shareholders holding not less than 90% of share capital of the selling company should become the shareholders of the purchasing company. What it is all about, sir? Sir, selling company having certain shareholders. Once the purchasing company is issuing the PC in the form of equity shares, such equity shares are ultimately belongs to whom? Equity shareholders of the selling company. Once the equity shareholders of the selling company will get the equity shares of the purchasing company, automatically equity shareholders of the selling company will become the equity shareholders of the purchasing company. Like that, he is telling shareholders holding not less than 90% share capital of the selling company out of 90% share capital of the selling company should become the shareholders of the purchasing company after amalgamation. Then only that amalgamation is said to be amalgamation in the nature of merger. And the last condition, purchasing company or the transferring company will continue the same business of the selling company after takeover. That means purchasing company will not conduct a different business. Purchasing company will continue the same line of business as like the selling company. If all these conditions, if all the below conditions satisfied, then the amalgamation is said to be amalgamation in the nature of merger. If any one of the condition is not satisfied, then the amalgamation is said to be amalgamation in the nature of purchase. This is the basic issue first you should need to know before directly knowing the accounting treatment. Sir, as per accounting standard 14, amalgamation is broadly categorized into two types. Yes, this types of amalgamation is as per accounting standard 14 only. As per AS 14, amalgamation is broadly categorized into two types. One is amalgamation in the nature of merger, another one is amalgamation in the nature of purchase. When an amalgamation is said to be amalgamation in the nature of merger, if all the five conditions satisfied, then the amalgamation is said to be amalgamation in the nature of merger. Sir, sometimes they already tested in the examination like this. What are the different conditions need to be satisfied? The amalgamation is said to be amalgamation in the nature of merger as per AS 14 for 5 marks. This question came from the AS 14 actually. The first and foremost condition, all the assets and liabilities of the selling company should be taken over by the purchasing company. All such assets and liabilities should be taken over at the book values. And the purchase consideration should be payable only in the form of fully paid up equity shares only. Shareholders holding not less than 90% of the share capital of the selling company should become the shareholders of the purchasing company after amalgamation, and the purchasing company should need to continue the same line of business as like the selling company which done previously. Now I will tell you here certain exceptional issues. What are certain exceptional issues? Please concentrate. Sir, in the third point, what they said, to satisfy amalgamation as amalgamation in the nature of merger, The purchase consideration should be paid in the form of fully paid up equity shares only, right? Let us assume PC is 1,05,074. Just certain figure given. The amount payable by purchasing company to the selling company was 1,05,074. Each and every equity share I'm going to issue at the rate of 100 rupees. Then how many shares I need to issue? 1050.74 shares. Can I issue 0.74 share to the selling company? No, I cannot issue zero point 0.7. I unable to issue 0.74. Fraction of the share I unable to issue to the selling company. Then what I can do? That fraction of the share I can pay in the form of cash. Sir, for fraction of the shares you paid in the form of cash. Due to that reason, you cannot tell that amalgamation is amalgamation in the nature of purchase. You are violating the condition, sir. No, this is not a violation of condition. If any fraction of the shares are there, we can able to pay in the form of cash. Still, it is said to be amalgamation in the nature of merger only. That is one exception. Next, one more exception I am telling you. That is not exception. That is clarification. Sorry, that is clarification. What is point number 4? Shareholders holding not less than 90% of the share capital of the selling company should become the shareholders of the purchasing company. I take an example. There are two companies exist. One is A Limited, another one is B Limited. Let us assume B Limited is a purchasing company and A Limited is a selling company. Now, before amalgamation itself, B Limited hold 10,000 equity shares as investments in A Limited. Before occurring of amalgamation itself, B Limited hold 10,000 equity shares in A Limited as investment. Now in the B Limited under asset side, investments in A Limited is 10,000 shares. Now the share capital of A Limited is, let us assume 10 lakh, 1 lakh equity shares are there. Now what is the condition here? Shareholders holding not less than 90% share capital of the selling company should become the shareholders of the purchasing company. Out of this 10 lakhs, to the extent of 10,000 shares, that is, I mean, to the extent of 1 lakh worth of share capital is already held by purchasing company. First, you should need to reduce such 10,000 shares. From the remaining 90,000 shares, now during the process of amalgamation, 90,000 into 90% means minimum 81,000 equity shareholders of A Limited should become the shareholders of the B Limited. 81,000 shareholders of the selling company should become the shareholders of the B Limited. I mean, this 90% share capital is after reduction of shares already held by purchasing company and selling company before amalgamation. That is the clarification given. Do you understand, all of you? Okay. Sir, this is the basic issue we discussed when an amalgamation is said to be amalgamation in the nature of merger, when amalgamation is said to be amalgamation in the nature of purchase. You may ask one question at this particular point of time. Why actually you are differentiating two different types of amalgamation, sir? The reason is to know the accounting treatment. The reason is to know the accounting treatment. That is also to know the accounting treatment in the books of purchasing company. To provide accounting treatment in the books of purchasing company, amalgamation is broadly categorized into two types: in the nature of merger, in the nature of purchase. If the amalgamation is in the nature of merger, then the accounting treatment need to be adopted in the books of purchasing company is pooling of interest method. Pooling of interest method. If the amalgamation is amalgamation in the nature of purchase, then the method of accounting to be adopted in the books of purchasing company is purchase method. Hope you understand now why you are differentiating the amalgamation is amalgamation in the nature of merger, amalgamation in the nature of purchase. If amalgamation is said to be in the nature of merger, then in the books of purchasing company, the method of accounting need to be adopted is pooling of interest method. If the amalgamation is said to be amalgamation in the nature of purchase, if any one of the condition is not satisfied, then which is amalgamation in the nature of purchase, na? Then in the books of purchasing company, the method of accounting is purchase method. Sir, then what about accounting treatment in the books of selling company, sir? Accounting treatment in the books of selling company, AS 14 doesn't applicable at all. That means you no need to check about the type of amalgamation. Now, if you come below, if you check the problematic areas first, then I can easily differentiate for which topics AS 14 is applicable, for which topics AS 14 doesn't applicable. Here two companies are given. One is A Limited, another one is B Limited. A Limited is a selling company. B Limited is a purchasing company. B Limited is acquiring the business of A Limited. As a result, B Limited is paying the purchase consideration to the A Limited. Now, totally problematic issues we are going to discuss. Three main concepts. One is accounting treatment in the books of selling company. That is accounting treatment in the books of A Limited. And another one, accounting treatment in the books of purchasing company, that is in B Limited. And another one is calculation of this purchase consideration. This also plays the crucial role, which is calculation of purchase consideration. Totally three issues we are going to discuss. Out of such three issues, for calculation of purchase consideration and accounting treatment in the books of purchasing company, AS 14 is applicable. But for providing accounting treatment in the books of selling company, AS 14 doesn't applicable. Generally accepted accounting principles are applicable. Gap is applicable. AS 14 doesn't applicable in the books of the selling company. That is the reason why at the time of providing the accounting treatment in the books of selling company, no need to think about whether the amalgamation is amalgamation in the nature of merger or amalgamation in the nature of purchase. But to provide the accounting treatment in the books of purchasing company as per AS 14, first you need to check the amalgamation is amalgamation in the nature of merger or amalgamation in the nature of purchase. When an amalgamation is said to be amalgamation in the nature of merger, when an amalgamation is said to be amalgamation in the nature of purchase. If the amalgamation is in the nature of merger, in the books of purchasing company, to provide the accounting treatment, we need to adopt pooling of interest method. If the amalgamation is said to be amalgamation in the nature of purchase, then the method of accounting we need to adopt is purchase method. Hope you understand. Okay, just leave it all such thing, guys. First, let me give my entire concentration on calculation of PC. Sir, first out of these things, first which topics you are going to take up, sir? First, I'm going to take up calculation of PC. I'm not going to take up accounting treatment in the books of selling company. I'm not going to discuss accounting treatment in the books of purchasing company. First, we are going to discuss calculation of purchase consideration, sir, which plays the crucial and vital role in the entire chapter. Please, all of you concentrate here to understand the things related to purchase consideration. I already told you purchase consideration AS 14 is applicable. Now I'm applying the provisions of AS 14. Concentrate. As per accounting standard 14, what exactly the meaning of PC, sir? As per AS 14, PC is nothing but amount payable by purchasing company to the shareholders of the selling company alone treated as purchase consideration. Alone treated as purchase consideration. As per accounting standard 14, amount payable by purchasing company to the shareholders of the selling company. Such shareholders may be equity shareholders, or such shareholders may be preference shareholders. Whatever the case may be, it doesn't create any difference. But the amount payable to the shareholders of the selling company alone treated as a purchase consideration. Sir, to explain this sentence, I'll give certain examples. Please concentrate one by one, guys, all of you. What are such examples? Let us have a look. Sir, case number one. I'm taking the case number one. This is there. Just ignore the same lines are pasted here. Purchasing company. Yeah, this is the first line. Sorry, this is the first line. Purchasing company issued 2 equity shares for every equity share in the selling company. Purchasing company issued 2 equity share for every equity share in the selling company. Amount payable by purchasing company to shareholders of the selling company, equity shareholders of the selling company. Is it form part of PC? Yes, absolutely, it is form part of PC. Next one, purchasing company issue 1 preference share for every preference share in the selling company. Amount payable by purchasing company to preference shares in the selling company is also form part of PC. Purchasing company issued 3 debentures for every 4 debentures in the selling company. Amount payable to debentures in the selling company, is it form part of PC? No. Amount payable by purchasing company to shareholders of the selling company. Debenture holders of the selling company is not the shareholders of the selling company. That's why which is not form part of PC. Now hope you getting the meaning of purchase consideration as per AS 14. What exactly purchase consideration is? Purchase consideration is nothing but amount payable by purchasing company to the shareholders of the selling company alone. Only we can treat it as a purchase consideration. Now let me check another case, guys. Please all of you concentrate. This is very much important to differentiate the or to identify the amount of PC. Concentrate. Purchasing company issued two debentures for every equity share in the selling company. Is it form part of PC, guys? Sir, whether you are issuing the debentures, whether you are issuing the cash, whether you are issuing the equity shares, whether you are issuing the preference shares, I don't mind. But if such things are issued to either equity shares or preference shares, which is form part of PC. Now the debentures are issued to equity shares of the selling company. That's why which is form part of PC. And in the second one, purchasing company also issued one preference share for every preference shares in the selling company. Amount payable to preference share in the selling company is form part of PC. Purchasing company also issued 3 debentures for every 4 debentures in the selling company. Amount payable to debentures in the selling company is not form part of PC. Then what you can made a conclusion here, sir? What you can made a conclusion here, sir? The amount payable by purchasing company is either in the form of equity shares or in the form of debentures or in the form of preference shares or in the form of cash or in the form of any other assets. But that amount should ultimately payable to whom? Shareholders of the selling company. Then we can call it as a purchase consideration. The same conclusion I made here. Amount payable to debenture holders of the selling company should not be considered as PC calculation. What the purchasing company paying is irrelevant. What we are paying is irrelevant. You can pay in the form of cash, in the form of equity shares, in the form of preference shares, in the form of debentures. That is irrelevant. But whom we are paying is relevant. Whom? If it is payable to shareholders, then only it is treated as purchase consideration. I hope you understand the real meaning of the PC as per AS 14. Amount payable by the shareholders of the purchasing company. Sorry. Amount payable by purchasing company to the shareholders of the selling company. A loan treated as purchase consideration as per accounting standard 14. What we are paying is completely irrelevant. To whom we are paying is only the relevant factor. So you may issue equity shares, you may issue debentures, you may issue preference shares, you may issue cash, or you may issue any other asset. But if such things are issued to the shareholders of the selling company, either it is equity shareholder or preference shareholder, which is form part of PC as per accounting standard 14. Okay, come down, guys. Still the PC issues is not yet over. Lot more issues need to discuss. Methods, different methods are available for calculation of PC. Different methods are available for calculation of PC. One of that method is lump sum method. Another method is net payments method, net asset value method, intrinsic value method. So let us have a look into one by one method, guys. Lump sum method. Sir, what is the meaning of lump sum method, sir? In the problem, they'll directly mention how much amount is payable by purchasing company to the shareholders of the selling company directly. That is nothing but lump sum method means ad hoc consideration, that is fixed amount. How that fixed amount is mentioned, that how that fixed amount is fixed, they will not mention in the problems. That is simply nothing but lump sum method. But most of the times, not most of the times, okay, nowhere they are following the lump sum method for all our problems. The reason I will tell you, if they directly reveal the purchase consideration amount, then most of the burden of the student got reduced. So that's why they'll never given the purchase consideration under lump sum method. When they will given the purchase consideration under lump sum method, if they want to test some other accounting treatments in the deeper manner, then they will simply give the PC amount. They will directly reveal the PC amount under lump sum method. Now coming to the net payments method. Coming to the net payments method, sir, how to calculate purchase consideration under net payments method, sir? That's very quite simple. Amount payable to equity shareholders of the selling company and amount payable to preference shareholders of the selling company If you can make it total, then which you will get the purchase consideration. Sir, why it is so called as net payments method, sir? Now, amount payable to equity shareholders, how much payment we are going to pay to equity, how much amount we are going to make payment to the preference shareholders. Payment, it is related to the payments. That's why the method is so called as net payments method. So the PC under net payments method is nothing but amount payable to equity, amount payable to preference shareholders of the selling company put together, then we will get it as PC. Next, come here, net asset value method. How to calculate the PC under net asset value method? Again, the method itself contains the calculation mechanism. Net asset. Net asset means assets minus outside liabilities. Assets taken over out of the different assets had by the selling company, which assets are taken over by the purchasing company at agreed values, not at the book value of the selling company. Maybe a building in the books of the selling company is shown at 50 lakhs. It is taken over at the rate of 1 CR, then you should need to adopt here 1 CR, which is nothing but agreed value. So assets are taken over at the rate of agreed value, less liabilities taken over at the rate of agreed value, which is known as net asset value of the business, which is equal to the purchase consideration in case of the net asset value method. Do you understand, all of you? Sir, any person at the time of making purchase, then they will think that how much amount need to pay means how much value we assign to those assets and liabilities. Those values assigned by the selling company are completely irrelevant in calculation of the purchase consideration payable by me to you, because how much value assigned from my point of view is important. How much value assigned from your point of view is completely irrelevant for me. That's why the assets taken over at the rate of agreed value you should need to consider, and liabilities taken over at the rate of agreed value you should need to consider for the purpose of making payment of PC by the purchasing company to the selling company. That's why book values in the books of selling company is completely irrelevant in calculation of PC here. Hope you understand. Next, come to the last method, guys, which is intrinsic value method. Sir, what is the meaning of intrinsic value, sir? The total intrinsic value is nothing but NAV of the selling company. There is no difference between NAV method and intrinsic value method. Basically, there is no difference between NAV method and intrinsic value method. But the intrinsic value method is another form of NAV method. Another form of NAV method. I will tell you how they are giving. The purchase consideration in case of intrinsic value method is nothing but intrinsic value of the selling company. What is the meaning of intrinsic value? Intrinsic value means, the meaning of intrinsic value is the real value, the fair value of the selling company. What is the fair value of the selling company? The fair value of the selling company is nothing but NAV. Because why you are adopted the agreed values here? Because that asset market value is how much, which is nothing but agreed value. The liability market value is how much, which is nothing but agreed value. Now the assets minus liabilities, which is nothing but NAV, right? That's why the intrinsic value of the selling company, the fair value of the selling company, as equal to the NAV of the selling company. Most of the times the agreed value assigned by the purchasing company are based on the market price. Sir, nobody is willing to buy at more than the market price or at less than the market price, because if you want to buy more than at market price, then the other party willing to sell, but you are not ready, right? But if you are buying at less than the market price, then the other party will not agree for that. Maybe you are ready to buy at less than the market price. That's why always in generally the agreed values are occurred at market values only. That's why the intrinsic value of the selling company as equal to NAV of the selling company. But how we are calculating the intrinsic value of the selling company, sir? In the problems, they are given that intrinsic value per equity share in the selling company, directly they will give intrinsic value per equity share in the selling company into number of equity shares in the selling company, then automatically we will get the intrinsic value of the selling company. What is the meaning of intrinsic value per equity share in the selling company? Which is as equal to NAV per equity share. One more time repeating. Intrinsic value of the selling company is nothing but number of equity shares in the selling company multiplied with each intrinsic value per share in the selling company. That is number of equity shares in the selling company multiplied with intrinsic value per equity share in the selling company. Intrinsic value per equity share in the selling company is nothing but NAV per equity share. So ultimately what you want to tell, sir, under intrinsic value method, PC is nothing but number of equity shares in the selling company into intrinsic value per share in the selling company is nothing but the PC, which is nothing but the intrinsic value of the selling company, which is nothing but total NAV of the selling company as well. Okay, fine. All of you come here. Therefore, the PC is equal to intrinsic value per share in selling company into number of equity shares of the selling company. For example, if you want to know how many number of shares we can issue, how many number of shares issued as PC by the purchasing company to the selling company in case of intrinsic value method. One more time I'm repeating. To know the number of shares issued as PC by purchasing company to the selling company. Now, till now, you work out how much amount of PC payable by purchasing company to the selling company. Now, the question is different. How many number of shares issued as PC by the purchasing company to the selling company? It's quite easy. PC divided by issue price. PC divided by issue price. So, number of shares issued as PC is equal to PC divided by, what is the meaning of PC? PC is equal to intrinsic value per share in the selling company into number of equity shares in the selling company divided by issue price. PC divided by issue price is nothing but number of shares, na? Number of shares issued as PC, na? Issue price. Issue price of whom? Purchasing company. Purchasing company, at which price it is going to issue, you know, if nothing is mentioned. Purchasing company is going to issue at their own intrinsic value per share. That is nothing but intrinsic value per share in the purchasing company. Now, just I'm opening the empty OneNote. Just a second. Yeah, please come here, all of you. Sir, whatever the method you are following, whether it is lump sum method, just a moment. Whatever the method you are following, whether it is lump sum method or whether it is net payments method or whether it is net asset value method or whether it is intrinsic value method, the method of PC may be different. The method of PC may be different. I mean, the quantum of amount you are assigning for the PC may be different from method to method, definitely. But number of shares issued as PC, number of shares issued as PC. How we need to calculate in any method, that is PC amount divided by issue price by purchasing company. Am I right or wrong, guys? How many number of shares issued as PC by purchasing company means amount of PC divided by issue price per share in the purchasing company. Issue price per share. Simply issue price per share in purchasing company. Now, like that, under lump sum method, how many number of shares issued as PC, sir? PC divided by issue price per share in the purchasing company. Under net payments method, PC under net payments method divided by issue price per share in the purchasing company. In case of NAV method, that is PC is nothing but NAV. In case of NAV, that is NAV divided by issue price per share in the purchasing company. Like that, in case of intrinsic value method, PC divided by issue price per share in the purchasing company. In case of intrinsic value method, issue price is nothing but intrinsic value per share in the purchasing company. Because purchasing company is also going to issue each and every equity share at their intrinsic value. Now, under lump sum method, PC is fixed amount. I'm talking about now the numerator factor. Under lump sum method, PC is fixed amount. Under net payments method, PC is nothing but amount payable to equity shareholders, amount payable to preference shareholders. If you make it total, then you will get the PC. In case of the NAV method, PC is nothing but assets taken over at the rate of agreed value minus liabilities taken over at the rate of agreed value. Then you will get the NAV, which is equal to the PC in case of NAV method. Now, in case of the intrinsic value method, PC is nothing but number of equity shares in selling company into intrinsic value per share in the selling company. Intrinsic value per each equity share in the selling company is nothing but NAV per share in the selling company itself. Hope you understand, all of you. Okay, come back. Now my next question is, next question coming into my mind is, how you can identify after reading the problem whether the method of PC is lump sum method or net payments method or net asset value method or intrinsic value method. Sir, if it is the lump sum method, no need to bother about identification of method because they are directly revealing the PC. That's why I don't want to discuss anything about lump sum method, put aside. If it is the intrinsic value method, again they will directly mention that we are discharging the PC at intrinsic value per share of the purchasing company. Like that they will mention. That's why to provide or to calculate the PC under intrinsic value method also there is no hesitation. But the only problem is identification of method of PC in between net payments method and net asset value method only. Identification of method of PC in between net payments and net asset value method is quite confusing. Then how I can identify the method of PC is net payments or net asset value method? Now there is a trick. The trick is while reading the information, that is while reading the problem, if we are able to ascertain amount payable to the shareholders of the selling company, by reading the information given in the problem, if you can able to ascertain amount payable to the shareholders of the selling company, that is equity shareholders and the preference shareholders, the straight away the method of PC you can be adopted as net payments method. No, sir, I unable to calculate amount payable to either equity shareholders or preference shareholders, then method of PC is not net payments method. Then straight away you can go to the net asset value method. So to understand or to appreciate in the better manner, let me take one example, guys. Just a second. So let me give an example here. Yeah. What is that example? One case, guys. The case is, all of you, please follow me, and you can tell from your mind whether the method of PC is net payments method or net asset value method. Purchasing company issued 2 equity shares for every 1 equity share in the selling company. For every 1 equity share in the selling company. That means if selling company one equity share is there, then purchasing company is going to issue 2 equity shares. Purchasing company issued 3 equity shares for every 4 preference shares in the selling company. I mean, for every 4 preference shareholders, purchasing company is going to issue 3 equity shares. Remaining amount will be issued in the form of cash to the equity shareholders. Still, apart from the equity shares, it is also going to issue cash to the equity shareholders. Now, equity shareholders of the selling company is getting 2 components. One is equity shares of purchasing company as well as cash. He is revealing how many number of equity shares of purchasing company is going to issue to each and every equity shareholder of the selling company through point number 1. But how much cash is going to issue to the equity shareholder of the selling company, is it revealed? No. Remaining amount, just they told that simply remaining amount will be issued in the form of cash to the equity shareholders. Then while reading the information in the problem, if we are able to ascertain amount payable to the shareholders of the selling company, then method of PC is net payments method. But right now we are unable to ascertain amount payable to the equity shareholders of the selling company due to non-knowing of the component of the cash. Due to not knowing the component of the cash, we are unable to ascertain amount payable to the equity shareholder of the selling company. Then method of PC is NAV method. Method of PC is not net payments method. Method of PC is straight away you can tell which is NAV method. Then, sir, under NAV method, how I can able to ascertain the amount of cash payable to the equity shareholders. First, you will calculate the net asset value under PC method, which is nothing but assets taken over at the rate of agreed value less liabilities taken over at the rate of agreed value. Then you will get the NAV. Out of such NAV, equity shares, you know already, because one equity share in the selling company will get two equity shares of the purchasing company. You will get how much amount of preference shares they are going to issue, because for every 4 preference shares in the selling company, purchasing company is going to issue 3 equity shares. Then preference shareholders of the selling company also, how much they will get, they know. In the form of equity shares, how much they are getting, no. To the preference shareholders, how many number of equity shares they are getting, they don't know. The remaining amount in the form of cash out of the NAV, we are issuing to the equity shareholders part payment in the form of equity shares. To the preference shareholders, part, the entire payment in the form of equity shares, and the remaining balance is in the form of cash. So NAV minus in the form of equity shares in the form of preference shares, and the remaining, NAV, out of the NAV, part payment to the equity shareholders and full payment to the preference shareholders, and the remaining balance is nothing but cash. Like this, we need to reveal how much cash component to be make it payable to the equity shareholders of the selling company. So it's very thin line, guys. People may feel that, or students may in generally may feel that, after seeing these sentences in the problem, just like that, this is method of PC is net payments method. But you need to check whether we can able to ascertain the amount payable to all the shareholders of the selling company or not. If we can able to ascertain, then the method of PC is net payments method, otherwise method of PC is net asset value method. Okay, that's it. Come below. So total, so much of discussion we made since past 10 to 15 minutes, things related to the method of PC. So PC can be calculated under lump sum method, or either under net payments method, or either under net asset value method, or under intrinsic value method. If it is lump sum method, PC amount is directly given in the problem. If it is net payments method, we need to able to ascertain amount payable to equity shareholders of selling company, how much amount payable to preference shareholders of selling company, how much. If you make it consolidate, then you will get the PC amount under net payments method. In case of net asset value method, assets taken over at the rate of agreed value less liabilities taken over at the rate of agreed value, which is nothing but NAV, which is equal to PC in case of NAV method. In case of intrinsic value method, PC is equal to number of equity shares in the selling company into intrinsic value per equity share in the selling company. Then if you want to able to ascertain number of shares issued as PC, then amount of PC divided by issue price. But in case of the intrinsic value method, issue price by the purchasing company is nothing but intrinsic value per share in the purchasing company. That's it, guys. Next, sir, which method of PC I need to adopt for this problem? How to identify? If it is lump sum method or intrinsic value method, they will directly given. If you have any confusion in between net payments method and net asset value method, by reading the problem information, if you can able to ascertain amount payable to equity as well as preference shareholders, then straight away you can adopt the net payments method. Otherwise, you can directly adopt net asset value method. That's it, guys. Come below. They are talking about certain special circumstances. What is the special circumstances, sir? The special circumstance is, I'll explain here. The purchase consideration may be recorded at either issue price or at par value. What is this, sir? PC is always recorded at issue price only, na? Why you are talking about par value? What you are talking? We can't understand. Please come to my empty note, guys. All of you, please concentrate here. Let me take one example for better understanding. What is that example? Yeah. The example is, so let us consider the PC method is net payments method. We are in the method of PC is net payments method. Number of equity shares in the selling company is 1 lakh. As per the terms and conditions of the PC is, each equity shareholders of the selling company will get 2 equity shares. For every 2 equity shares, we are going to issue 1 equity share. Now, this is the selling company. This is the selling company. The term is, in selling company, we have 1 lakh equity shares. Now, purchasing company is clearly telling that for every 2 equity shares in selling company, we are going to issue 1 equity share. Now, can you please tell me, purchasing company, how many number of equity shares going to issue as a PC? For 1 lakh equity shares, for every 2, 1 means 50,000 equity shares they are going to issue as PC. So number of shares issued as PC as 50,000. Now the question is, what is the issue price in the purchasing company? To know the total amount of the PC, number of shares issued as PC into issue price by the purchasing company, we will multiply, right? Let us assume issue price in the purchasing company is 20 rupees. The face value may be the 10 rupees, but the issue price is 20 rupees, let us assume. Therefore, then the PC is equal to 50,000 into 20 is equal to 10 lakhs. So the PC amount is 10 lakhs. Now, in the problem, it is clearly given that PC should not be recorded at issue price. PC should not be recorded at issue price. PC should be recorded at par value. What is the meaning of par value? At face value. If you want to record PC at par value, first you should find out the number of shares issued as PC. Number of shares issued as PC is 50,000. And each equity share face value how much? 10 rupees. 50,000 into 10 how much? 5 lakhs. That means whenever in the problem it is specifically mentioned that you can record the PC at par value, you can record the PC at par value, then how to calculate the PC, sir? If the PC is going to record at par value, first you need to work out number of shares issued as PC. Number of shares issued as PC. It should be multiplied with the face value per share. Then you will get PC recorded at par value. But if the PC is recorded at issue price, then how you can directly work out? In the normal course, simply if you can calculate PC, then which is nothing but PC is recorded at issue price. The PC method may be lump sum, or maybe net payments, or maybe net asset value, or maybe the intrinsic value. If you calculate in the as usual manner, which is nothing but PC recorded at issue price, but PC is recorded at par value, you should first work out number of shares issued as PC, then multiplied with the face value. Don't by heart it anything, guys. Just apply your logical mindset. Sir, PC is at issue price means in lump sum method directly amount is given. Under net payments method, that is number of shares issued to equity shareholders multiplied with issue price. Number of shares issued to the preference shareholders of the selling company multiplied with issue price. If you make it the total, you will get the PC under net payments method, which is at issue price only. Net asset value method, you already calculated assets taken over. My assets taken over at the rate of agreed value minus liabilities taken over at the rate of agreed value. Intrinsic value of the business is nothing but number of equity shares in the selling company into intrinsic value per each equity share, which is nothing but PC is recorded at issue price only. Now, whenever you want to record the PC at par value, first you need to work out number of shares issued as PC. Then it should be multiplied with face value. Now, the next question coming into my mind is how I can calculate number of shares issued as PC. We already discussed how to calculate number of shares issued as PC. Number of shares issued as PC is nothing but total amount of PC divided by issue price. Total amount of PC divided by issue price per share in the purchasing company. Tell me, guys, we already work out now. So first, what you should need to work out, number of shares issued as PC is nothing but PC divided by issue price in purchasing company. Then you will get number of shares issued as PC. Sir, PC, how to calculate PC? You know already. You know how to calculate PC. Then issue price in the purchasing company, if you divide the total amount of the PC, then you will get number of shares issued as PC. But if the PC is under intrinsic value method, in calculation of number of shares issued as PC on behalf of issue price, what you can use? You can use intrinsic value per share. Intrinsic value per share in purchasing company on behalf of issue price, at which price the purchasing company is going to issue in case of intrinsic value method, their own intrinsic value per share of the purchasing company. So that's why PC divided by intrinsic value per share in the purchasing company, you will get number of shares issued as PC. We already explained that fact as well. Number of shares issued as PC in case of intrinsic value method is intrinsic value per share in the purchasing company. That means, can you please tell me PC amount if it is recorded at par value under a different method, sir? Absolutely. Please concentrate. How we need to work out PC at par value under different methods. If it is lump sum method, PC lump sum amount divided by issue price in purchasing company. If it is under net payments method, PC amount under net payments method. You know how to calculate the PC amount divided by issue price in purchasing company. First, you will get number of shares issued as PC into face value here. Here also into face value. Then you will get PC is recorded at a par value. PC is recorded at a par value. Next, coming to the NAV method. First, you should work out the PC amount, which is NAV, divided by issue price on purchasing company. Then you will get number of shares issued as PC multiplied with face value. You will get PC is recorded under NAV at par value. Next, come to the intrinsic value method. How to calculate PC, which is going to be recorded par value? First, calculate the PC. PC is nothing but intrinsic value per share in selling company into number of equity shares in selling company, which is PC amount. Number of equity shares in selling company, which is PC amount, divided by issue price in the purchasing company, which is intrinsic value per share in purchasing company. Then you will get number of shares issued as PC multiplied with face value. Then you will get PC is recorded par value. To put it simply, if PC is recorded par value, the formula for calculation of PC is number of shares issued as PC into face value. Sir, why actually PC is recording at issue price? Why you are differentiating PC is recorded par value? Is it will create difference? To be frankly speaking, there is no difference. I don't want to confuse you. I will reveal whether you are going to record PC at issue price or whether you are going to record PC at par value. There is no difference at all. I will prove such thing after completion of the accounting treatment in the books of selling company as well as accounting treatment in the books of purchasing company. Till now or not yet started accounting treatment in the books of selling as well as accounting treatment in the books of purchasing company. Come back to my power notes. We are at discussion of method of calculation of PC. Sir, can you please draw the conclusion with respect to the PC amount? Out of the three problematic areas, the first problematic area we are touching the calculation of PC, right? What exactly the meaning of PC as per accounting standard 14? Amount payable by purchasing company to the shareholders of the selling company alone treated as PC. To whom we are paying is relevant. What we are paying is irrelevant. You may issue equity shares, you may issue preference shares, you may issue debentures, you may issue cash, or you may issue any other asset. But if it is going to issue to either equity or preference shareholders of the selling company, then I consider into the purchase consideration. Otherwise, I will simply ignore. That is the essence of AS 14 with respect to the calculation of PC. There are 4 different methods exist. One is lump sum method, another one is net payments method, another one is net asset value method, another one is intrinsic value method. In case of lump sum method, PC is directly revealed in the problem. In case of net payments method, amount payable to equity shareholders of the selling company, amount payable to preference shareholders of the selling company put together is known as the PC. In case of the net asset value method, assets taken over at the rate of agreed value less liabilities taken over at the rate of agreed value is nothing but PC. In case of intrinsic value method, PC is nothing but number of equity shares in the selling company into intrinsic value per each equity share in the selling company. In generally, if you are calculating PC like this, means PC is recorded at issue price. But whenever the problem clearly mentioned that you can record the PC at par value, then how to calculate the PC is the different task. First, you should need to work out number of shares issued as PC. If it should multiplied with the face value, then you will get PC is recorded par value. The same thing I explained here. PC is recorded at issue price in the as usual normal way. We already seen. If PC is recorded at par value, then the formula is number of shares issued as PC into face value in the purchasing company, face value per share in the purchasing company. Then how to calculate number of shares issued as PC? You know, PC divided by issue price in the purchasing company is nothing but number of shares issued as PC. But in case of intrinsic value method, PC divided by intrinsic value per share in the purchasing company. That point only I told you. And one more important point I explained, whether you are recording PC at issue price or whether you are recording at PC at par value, it doesn't create any difference. I'm going to prove such thing with after completion of accounting treatment in the books of selling company and accounting treatment in the books of purchasing company. That's it, guys. Next, come down. So same things, everything I explained, no worries. Okay, come down. Now, please come to the second problematic issue. What is the second problematic issue we seen here? So the first problematic issue is calculation of PC. Override. Second problematic issue is accounting treatment in the books of selling company. Now we are going to discuss accounting treatment in the books of selling company or transfer company. Is it accounting standard 14 applicable in the books of selling company? Not at all. Generally accepted accounting principles are only applicable. Generally accepted accounting principles are only applicable. Now, I'm going to explain the accounting treatment in the books of selling company through a small illustration. Please allow me concentrate. What is that illustration? Now I'm revealing first. This is the balance sheet of a selling company as at 31st March 2021. Under asset side, two different assets. Under asset side, PPE is there. Under PPE, plant and machinery is there. Land given. Intangible assets, goodwill is given. And a miscellaneous expenditure not written off is there, which is a fictitious asset. Remaining all assets are current assets, inventory, cash, trade receivables. Okay, so total of the assets is given at 100 lakhs, that is which is 1 crore. I think so, which is at 1 crore. Next, coming to liabilities, equity share capital given, preference share capital, under reserves and surplus, securities premium is there, general reserve is there, P&L account is there. Under non-current liabilities, 10% debentures and trade payables given, which is the existing balance sheet of a selling company. Now the terms were except cash. Cash is there now. Except this cash, purchasing company want to take over all assets and liabilities. Except this cash, purchasing company want to take over all assets. Liabilities means always outside liabilities. And the purchase consideration given under lump sum method directly 70 lakhs. PC directly given, because I don't want to test the calculation of PC at this stage, because we already done with the calculation of PC under different methods. Now our focus is towards knowing the accounting treatment in the books of selling company. That's why PC was directly given at 70 lakhs, which is under lump sum method. And one more important issue is given, which is liquidation expenses, because selling company is going to liquidate now once if it is taken over by purchasing company. Further, the liquidation expenditure incurred were 2 lakhs is given. Next, preference shareholders of the selling company. Here, preference shareholders of the selling company is there now. Preference shareholders of the selling company just given by the purchasing company their own preference shares. I mean, preference shareholders of the selling company will get preference shares of the purchasing company. That is the information. And one more important information I will reveal here in the problem itself. What is that? The information is, one second. Sir, how this 70 lakhs PC is given, sir? How this 70 lakhs PC is given? Out of this 70 lakhs PC, 15 lakhs is in the form of cash. 25 lakhs is in the form of equity shares, right? That is, sorry, preference shares. Let me put 25 lakhs in the form of preference shares. Remaining how much? 40 lakhs, right? 40 or 30? 30 lakhs in the form of equity shares. Sir, this 70 lakhs, just it is there. Just a moment. 25 cash, equity 30, preference 50. So just a small change. This 15 lakhs is in the form of preference, and this 25 lakhs is in the form of cash, and 30 lakhs in the form of equity shares. That point also I revealed. One more time repeating. The information given in the illustration, balance sheet of the selling company given, except the cash of the selling company, each and every asset and liability of the selling company is ultimately taken over by the purchasing company. PC is decided under lump sum method 70 lakhs, and it is clearly given in the problem itself. Out of this 17 lakhs in the form of preference shares, we are issuing 15 lakhs. In the form of cash, we are issuing 25 lakhs. In the form of equity shares, we are issuing 30 lakhs. And liquidation expenses is 2 lakhs. Preference shares of the selling company will get preference shares of the purchasing company. Okay, fine. Now, my duty is in the books of the selling company, AS14 anyway doesn't applicable. That's why I no need to think about method of amalgamation, whether it is amalgamation in the nature of merger or amalgamation in the nature of purchase. Now, no need to think. I can simply adopt a 5-step approach. Sir, what is the accounting treatment generally we need to adopt in the books of selling companies, sir, to close the books of selling company? Closure of books of accounts is the method of accounting. Closure of books of accounts. Sir, closure of books of accounts means simply what the selling company need to do. The assets and the liabilities simply transferred to the purchasing company. It will receive some amount from the purchasing company. That amount should need to be distributed among the liability which is not taken over by the selling company, the liability which is not taken over by the purchasing company, and to the shareholders of the selling company. One more time I'm repeating to put in very simple manner. The objective of the selling company is make it transfer the assets and the liabilities which decided to take over by the purchasing company. Maybe all assets may not be take over, all liabilities may not be take over. Whatever the assets or liabilities decided to taken over by the purchasing company, just to make it transfer such assets and liabilities to the purchasing company. Okay, sir, I transferred such assets and liabilities. As a result, purchasing company will pay certain purchase consideration, right? You can receive that purchase consideration. Now, in your company, you may distribute such purchase consideration to the remaining liability holders, which are not taken over by the purchasing company, as well as preference shareholders and equity shareholders. Automatically, your all accounts will going to be closed. For that closure of books of accounts in selling company, I'm going to adopt 5-step approach. What is that approach? 5-step approach. Under step number 1, the assets and liabilities which are taken over by the purchasing company should be closed and transferred to realization account at book values. Why you are transferring to realization account at book values, sir? You may have a doubt. Now, please all of you follow me. So this is a little bit tedious job, but once if you understand, you can able to create wonders. Please concentrate. Sir, let me take one asset, plant and machinery. So I'm considering the plant and machinery in your books of accounts. That is in selling company books of accounts. Plant and machinery is there at 20 lakhs, right? That is two balance brought down. 20 lakhs is there. In the same way, you can consider another liability, one liability, just one liability, 10% debenture, one liability is there, which is at 20 lakhs. That is by balance brought down 20 lakhs. What is your objective? Your objective is simply selling these assets and liabilities to the purchasing company. But you are not selling the individual asset and you are not selling the individual liability. The group of assets put together and group of liabilities put together, you are selling to the purchasing company. Now, first and foremost objective is I also want to club all those assets into a single account. I want to make it club all those different assets account into a single account. That's why this individual account should be closed and transferred to one single account, which is realization account. This individual liability is also going to be closed and transferred to a single individual account, which is realization account. That's why what are all the assets or what are all the liabilities taken over by the purchasing company should be closed and transferred to a single temporary account, which is a realization account. At which value? Book value. Because once if you make it transfer such account balance to the realization at book value, then only that account got closed. Am I right or wrong? That's why those assets and those liabilities which are taken over by the purchasing company should be closed and transferred to realization account at book values. Now, can you please tell me, as per the information given in the problem, except cash, all the assets and all the outside liabilities is taken over by the purchasing company or not? That's why all the assets one by one, two sundry assets, simply I make it transfer to the realization account at book values. All are at book values. All the liabilities, under liabilities 10% debentures is there, trade payables is there. Such two liabilities, 10% debentures, trade payables, just make it transfer to the realization account. Step number 1 not yet over. Step number 1 is dismantling of balance sheet, guys. Now I am revealing at this particular point of time, step number 1 is dismantling of balance sheet. After seeing the balance sheet, first assets and liabilities which are taken over by the purchasing company should be closed and transferred to realization account at book values. Next, if any particular asset or liability which is not taken over by the purchasing company, let us assume in the given case cash is not taken over, right? It should be separately opened. Cash account is separately opened by me. Cash account is separately opened by me. To balance brought down, which is 5 lakhs. Let us assume any other particular asset is not taken over. Then what I can do, sir? Let us assume plant and machinery is not taken over by the purchasing company. Open plant and machinery also separately to balance brought down. Sir, if any particular liability is not taken over, let us assume 10% debentures is not taken over. Open 10% as debentures account separately. Don't make it transfer to the realization. Okay. So assets are liabilities taken over by the purchasing company, close and make it transfer to realization at book value. Any asset or liability which is not taken over by the purchasing company, opened it separately. That's it. Now, preference share capital should be closed and transferred to preference shareholders. Equity share capital and the entire reserves and surplus, if any miscellaneous expenditure not written off, which is fictitious asset, which also belongs to equity shareholders, not only the profits but also losses also belongs to equity shareholders. So equity share capital, reserves and surplus, any miscellaneous expenditure not written off should be closed and transferred to equity shareholders account. You can open the equity shareholders account, transfer equity share capital, transfer reserves and surplus, and miscellaneous expenditure not written off also you can transfer to equity shareholders. Preference share capital, transfer to preference shareholders account. This is the step one, dismantling of balance sheet. If you see, the entire balance sheet items got dismantled. Step number one is the dismantling of balance sheet. Assets and liabilities which are taken over by the purchasing company should be closed and transferred to realization account at book values. I already transferred assets. I already transferred liabilities. Fine. Any asset or liability which is not taken over by the purchasing company separately open. Cash is not taken by the purchasing company. That's why cash was not transferred to realization. Cash account is separately opened. You can check any other asset or liability which is not taken over. You can open it separately. Next, preference share capital transfer to preference shareholders account. Opened preference shareholders by preference share capital. Open equity shareholders account and you can transfer equity share capital, reserves and surplus and miscellaneous expenditure not written off to the equity shareholders account. I transfer to the equity shareholders account. That is dismantling of balance sheet. Next, what is my next objective, sir? What you are doing, those assets and liabilities which you transfer to realization, right? Now, such assets and liabilities, you are selling to whom? Purchasing company. You are selling to whom? Purchasing company. Can you please all of you tell me, at the time of selling of any product in general course, what is the entry you may pass? Debtor to sales. Tell me guys, debtor to sales. Debtor to sales. Now in this case, who is your debtor? Purchasing company is my debtor. I need to recover amount from the purchasing company now. That's why you need to pass one journal entry. What is that entry? Purchasing company account debtor. Please all of you concentrate here. Purchasing company account debtor. For example, if you sell an individual asset, entry is the party account debtor to asset account. If it is a good, then we can put two sales. If it is an asset, we can put two assets account. But already assets are got closed by making transfer to realization. Asset was closed now. Asset was already closed by making to transfer to realization. Now on behalf of assets, I can write realization. I can write realization. That's why the entry is purchasing company account debtor to realization account at the rate of PC amount due. How much amount is PC due? How much amount of PC you can recover from the purchasing company? The entry is purchasing company account debtor to realization account. Not only assets. Now, by crediting this realization means it is inclusive of both taken over of assets and as well as liabilities, because the other party is paying the purchase consideration not only for the purpose of taking over of assets, both for the purpose of taking over of assets and as well as liabilities. So which is known as PC due entry. Entry is purchasing company account debtor to realization account at the rate of purchase consideration. Now, purchasing company to realization means in realization by purchasing company at the rate of PC. PC amount we already decided now. How much PC amount? PC amount is 70 lakhs. That's why in realization account by purchasing company account. If in realization by purchasing company, you need to open the purchasing company account as well. So I opened the purchasing company account here. That is to realization. That is to realization. This is step number 2. Step number 2 is for PC due. PC due. Next. Step number 3 is for PC received. I'll show you each and every step. There clearly I already given in my material, but I don't wrote in my power notes, which is there in my material. I'll show you, don't worry. Once after completion of all the steps, I'll go to my material. I will show the steps as well. Step number 3 is PC receipt. Now you wrote the entry purchasing company to realization. Now you need to recover amount of PC from the purchasing company. Now what you are recovering, I already told you, the PC amount is in the form of preference shares, in the form of cash, in the form of equity shares. Let us assume if you recover cash from the purchasing company, what is the entry? Cash account debtor to purchasing company account. If you receive amount from the debtor, what is the entry? Cash to debtor. But right now, on behalf of cash, you are receiving cash, preference shares of purchasing company, equity shares of purchasing company. That's why the entry will become like this. That is preference shares of, just a moment, change the color. The entry will be preference shares of purchasing company, equity shares of purchasing company, cash. No need to write cash of purchasing company. Simply you can write cash, because to differentiate your preference shares and equity shares, just you wrote preference shares of purchasing company, equity shares of purchasing company, cash to purchasing company account. This you are cancelling with at the rate of PC. You know, preference shares of purchasing company, you are getting 15 lakhs. Equity shares of purchasing company, you are getting 30 lakhs. Cash, you are getting 25 lakhs. Am I right? Total is equal to the 70 lakhs. Now the same entry you can give the posting in purchasing company account, buy cash, buy equity shares of purchasing company, buy preference shares of purchasing company. Already cash account is there. In cash to purchasing company 25 lakhs. You can open these two accounts as well. Equity shares of purchasing company, preference shares of purchasing company. The other posting you can give to purchasing company, 30 lakhs, 15 lakhs. This is the entry for PC receipt. Step number 1, we discussed about dismantling of balance sheet. Step number 2, PC due. Step number 3, PC receipt. Then what you can do, sir? Once you are getting purchase consideration from the purchasing company, what you can do, sir? In your balance sheet, you should need to make payment to the liability holders in a particular order. Once you are getting the purchase consideration, you should distribute to the remaining parties in the particular order. For example, all of you please concentrate here. After getting PC, first what you should need to check, once you are getting the PC from the purchasing company, if any of the asset is not taken over by the purchasing company is there or not, you can check. In the given case, cash is there. We may not sell the cash in the outside market. Cash was already in the realized form. Let us assume plant and machinery is not taken over by the purchasing company. Then at this particular circumstance, you can sell such plant and machinery as well. Because what is your objective? Closure of the books of accounts. Now you can sell your plant and machinery in the outside market. For example, plant and machinery is there at book value 20 lakhs, but you sold out at 23 lakhs. You are getting a profit of 3 lakhs, right? Now that is the reason why I told you in the step number 1, if any asset is not taken over by the purchasing company, you can open separately. You already opened separately 20 lakhs, to balance brought down, right? Now you are selling this plant and machinery by cash at 23 lakhs. Now, due to which you are getting a profit of 3 lakhs, na? Such 3 lakhs profit also you can make it transfer to realization. That means after getting the purchase consideration from the purchasing company, if any of the assets not taken over by the purchasing company or exist, you can realize it in the outside market. Due to which, if any cash balance is received, that cash balance also you can be added to the purchase consideration. Now, due to selling of such particular asset, if you derive any profit or loss, such profit or loss, you can make it transfer to the realization account, because there is no profit and loss account right now. Already P&L account itself is got transferred to the equity shareholders account. That's why any profit or loss occurred during the process of closure of the business, you can simply make it transfer to one temporary account, which is nothing but realization account. Do you understand? Now, for selling company, on their hand, purchase consideration amount is there, plus if any cash is realized from assets not taken over by the purchasing company, such cash balance is also available. Will you agree, all of you? Now, totally how much cash balance is there? How we know, sir? The total cash balance is 5 lakhs plus 25 lakhs. Total 30 lakhs cash balance is there, plus Preference shares of the purchasing company 15 lakhs is there. Equity shares of the purchasing company 30 lakhs is there, which is available for distribution. Now, at the time of distribution of PCE plus existing resources means existing cash, or plus cash realized through assets which are not taken over by the purchasing company, should be paid in the particular order. Number one, first you should need to make payment for liquidation expenses or the realization expenses. The same order in general we are following in the chapter liquidation of companies as well. At the time of closure of the company, which order you need to follow to make payment to the different stakeholders of the company? First, you need to make payment for liquidation expenses or the realization expenses, then secured creditors, after that unsecured creditors, after that preference shareholders, after that equity shareholders finally. Now, during this process of making payment, if again any profit or loss is derived, then such profit or loss also you can also make it transfer to realization account. Tell me guys, at the time of realization of any particular asset which is not taken over by the purchasing company, sold it in the outside market, any profit or loss is derived, you are make it transfer to realization. In the same way, during the process of making discharge of amount to the different stakeholders, if you derive any profit or loss, such profit or loss also you can make it transfer to realization account. Now first, let me explain one by one thing. For example, you are incurring the liquidation expenses. What is the normal entry for incurring the liquidation expenses? Expenses to cash. Expenses account data to cash account is the entry. In generally expenditure where you can generally transfer P&L account, but there is no P&L. P&L was already transferred to equity shareholders account. What are the expense or income, what are the profit or loss you will derive, it should make it transfer to realization, right? That's why this expenditure should also be make it transfer to realization. Entry realization account data to liquidation expenses. If liquidation expenses and crossover, the net entry is realization account data to cash account. That is simply P&L to cash, that is realization to cash. That means for incurrence of liquidation expenses, the entry is realization account data to cash account if anything is there. For example, sir, 10% debentures is there now here. Where it is? Balance sheet. Let us assume 10% debentures is not taken over by the purchasing company. Next, in order, what should I need to make payment? Secured creditor. Let us assume debentures is a secured creditor. Now, if such 10% debenture is not taken over by the purchasing company, what I should need to do? I should open separately, na? I should open separately, na? 10% debentures I should open separately if it is not taken over. But in this problem, it is taken over. That is different story. If it is not taken over, I will open separately. Let us assume for this 10% debentures as a full and final settlement, we are paying 18 lakhs. Now, for this 18 lakhs, let us assume you are paying cash, then 10% debentures to cash. In cash also, you should need to give posting. Then the profit or loss is how much? Profit is 2 lakhs. Such 2 lakhs profit also, you should need to make it transfer to realization. That point earlier, actually, I told you. But in this problem, no worries. All the liabilities are taken over by the purchasing company. That's why after making payment of, just a moment, after making a payment of liquidation expenses, then secured creditors, then unsecured creditors. Here there are no liquidation expenses, there are no secured creditors, there are no unsecured creditors which are not taken over by the purchasing company. That's why you can directly make it payment to the preference shareholders. It is clearly given in the problem that the preference shares which you getting as a PC from the purchasing company is ultimately make it payment to the preference shareholders of the selling company, right? How much amount of preference shares you are getting from the purchasing company? 15 lakhs worth of preference shares of the selling company. Sorry, 15 lakhs worth of preference shares of the purchasing company you are getting as a PC. Now such 15 lakhs, you can make it distribute to whom? Preference shareholders of the selling company. Where are the preference shareholders of the selling company? I opened separately. Then you can make a payment. Preference shareholders account data are, at the time of making payment, what is the journal entry? Preference shares of purchasing company account data to preference shareholders account. That's why in preference shareholders buy preference shares of purchasing company, which is how much, guys? 1 second. So sorry. At the time of making payment, what is the journal entry, guys? We are already having preference shares of purchasing company for 15 lakhs. Now you can give such preference shares of purchasing company to the preference shareholders. What is the entry? preference shareholders account that are two preference shares of purchasing company. That's why in preference shareholders, two preference shares of purchasing company, in preference shares of purchasing company by preference shareholders, then automatically preference shares of purchasing company account got closed. Now, if you observe the preference shareholders account, the liability is there at 20 lakhs, but you made full and final settlement at 15 lakhs. Now you derived the profit of 5 lakhs. Such 5 lakh profit also you can make it transfer to realization. That's why in realization, you are clearly given that uh, by preference shareholders 5 lakhs. In preference shareholders to realization, in realization which is by preference shareholders. Do you understand? And just I assumed that liquidation expenses are there for 2 lakhs na realization to cash account. That's why I wrote the entry realization account that are to cash account as well. Just if liquidation expenses are there, if I assume. Okay, now in the order of settlement, the full and final settlement belongs to equity shareholders na. The full and final settlement belongs to equity shareholders na, which is final step, which is step number 5. Before making full and final settlement to equity shareholders, first what should you need to do? You should close the realization account. You should close the realization account. Whatever the profit or loss derived from such realization account, it ultimately belongs to equity shareholders, because equity shareholders are the real owners of the company. Just to make it close the realization account, after closing the realization account, I got the balancing figure of 13 lakhs, which is realization profit. Such a realization profit you can make it transfer to equity shareholders, such balancing figure under realization to equity shareholders, then equity shareholders by realization. Till not final settlement made, just you found the realization profit, make it transfer to the equity shareholders. Now final settlement to the equity shareholders, now you can make whatever the things are available in your company, just to make it pay such resources to the equity shareholders. Whatever the sources are available, equity shares of purchasing company you have to the extent of 30 lakhs. Do you agree, guys? In the form of PC, you are getting preference shares, you are getting equity shares. Out of that preference shares, already you make it transfer to preference shareholders. Now the equity shares of purchasing company with you to the extent 30 lakhs. Apart from that, cash is there with you 28 lakhs. How you know, sir, cash is there 28 lakhs? Opening, we have 5 lakhs. In the form of PC, I am getting 25 lakhs. For incurring realization expenses, 2 lakhs is over. 25 plus 5, 30, 30 minus 2, 28 lakhs I have. This 28 lakhs plus this 30 lakhs, total 58 lakh of resource with me to make payment to the equity shareholders. Just to make it pay that resources to the equity shareholders, cash 28 lakhs, equity shares of purchasing company also 30 lakhs, automatically equity shareholders account got closed. Equity shareholders account, if it is closed, then only the problem is correct. Because as per the double aspect concept, or as per the dual aspect concept, there is a opposite aspect for each and every transaction, both debit and credit aspect. Once if you are making the transferring the available resources to the equity shareholders is the liability account, those are assets account. Assets account should be nullified with the liability account, then there is no balance in the equity shareholders account. Once if you are making settlement the cash, then there is no balance in cash account as well. Once if you settled the equity shares of purchasing company to the equity shareholders, then there is no balance in equity shares of purchasing company account. This is closure of the company. Friends, I am in the session of marathon. I can't tell each and every item by putting here some figures. I already taken certain figures. I am giving my best effort to explain with the available figures. Sir, can you please consolidate? You told through the 5-step approach, right? Can you please consolidate such 5-step approach? Definitely, guys. I'm going to consolidate such 5-step approach with my material. Please, all of you concentrate here. Just now I'm going to explain the 5-step approach here. 5-step approach. Number 1, in the books of accounting treatment, you should not adopt AS 14. You are providing the accounting treatment based on generally accepted accounting principles. Now in the problem, they are directly giving the balance sheet of the selling company. After seeing the balance sheet of the selling company, first you should need to start with dismantling of balance sheet. In case of dismantling of balance sheet, assets and liabilities which are taken over by the purchasing company will be closed and transferred to realization account at book values. I already told the reason. because you are not selling the individual asset and liability. You are selling group of assets and group of liabilities put together. You are selling to the purchasing company for temporarily. I want to club all such individual assets into a single account. That is nothing but realization account. I want to club all the liabilities taken over into a single account, which is realization account. Hope you got it. Next, if any particular asset or liability which is not taken over by the purchasing company opened separately for the purpose of realization in the outside market, because such asset or liability is not taken over by the purchasing company, now we will make it realize in the outside market, but not realize right now, just to open it separately. Next, preference share capital will be transferred to preference shareholders account. Equity share capital, reserves and surplus, fictitious assets should be transferred to equity shareholders account. Now the dismantling of balance sheet of the existing selling company is over. Just now we seen that the entire components of the balance sheet were dismantled into realization and a separate asset account and equity shareholders account and a preference shareholders account. That is step number 1, dismantling of balance sheet, guys. Next, come to the step number 2, purchase consideration due. Now you are selling your assets and liabilities to the purchasing company by passing the entry purchasing company account data to realization account at the rate of PC. First, in the working note, you need to calculate the purchase consideration. How to calculate the PC? What is the meaning of PC? Different methods available for PC. PC is recorded at par value. PC is recorded at issue price. All things are I already discussed. That is the reason why I discussed the components of the PC and the methods of the PC first. Hope you got it. So purchasing company account data to realization account is the entry for purchase consideration due. Calculate purchase consideration by providing separate working note with the amount of purchase consideration, debit the purchasing company account and credit the realization account. Next, step number 3, PC received. In the form of PC, you may receive cash, you may receive preference shares of purchasing company, you may receive debentures of purchasing company, you may receive equity shares of purchasing company, anything you may receive. Okay, I already told you what you're receiving is irrelevant. Whom it is receiving is only relevant to decide whether it is PC or not. That's why purchasing company account will be closed. That is, purchasing account should be credited by debiting equity shares of purchasing company, preference shares of purchasing company, debentures of purchasing company, cash. The entry is equity shares of purchasing company, preference shares of purchasing company, debentures of purchasing company, cash accounted are to purchasing company. Then automatically purchasing company account got closed. If you seen here, we opened the purchasing company here. First, in the second entry, PC to realize purchasing company to realization, I wrote. The third entry is PC received cash, equity shares, preference shares to purchasing company. Automatically purchasing company account got closed. Fine. Next, distribution of purchase consideration. Now, dispose those assets which are not taken over by the purchasing company in the outside market first. Before distribution of the PC among the various stakeholders, first dispose those assets which are not taken over by the purchasing company in the outside market, and any profit or loss derived transfer to realization account. I already told you. Now, with the available cash and PC received by the transfer company after realization, you are getting certain cash. That cash plus PC cash, PC amount total received by the selling company will be distributed among the various parties in a particular order decided by the liquidation provisions. What is that particular order? First, you should need to incur realization or liquidation expenses, then secured creditor, then unsecured creditor, then preference shareholders, then finally equity shareholders. During this process of distribution, any profit or loss is derived will be transferred to realization account. In our problem, we already seen at the time of making payment to the preference shareholders, we got a profit of 5 lakhs, which is transferred to the realization account. So the same fact I mentioned here as well. Then final settlement to the equity shareholders. Before making the settlement to the equity shareholders, first close the realization account. You can close the realization account. Find the profit or loss of the realization account. If it is profit, realization to equity shareholders. If it is loss, equity shareholders to realization. Then find realization profit or loss. Such profit or loss will be transferred to equity shareholders account. Then after closing the realization account, all the remaining resources in the selling company. What are the remaining resources in the selling company? Cash and equity shares of the purchasing company. As per our illustration, just to distribute among the equity shareholders. Then all accounts in the selling company will be closed with this final step. That's it, guys. This is the 5-step approach. Now, to put it simply, in the 5 steps, step number 1, dismantling of balance sheet, assets and liabilities which are taken over by the purchasing company should be closed and transferred to realization account at book value. Asset and liability which is not taken over by the purchasing company separately opened, ready for realization in the outside markets. Sir, preference share capital transfer to preference shareholders. Equity share capital, reserves and surplus, miscellaneous expenditure not written off like any fixed asset, make it transfer to equity shareholders account. Disbanding of balance sheet is over. Step number 2, PC due. Purchasing company accounted are to realization account at the rate of PC. Before that, make a working note, calculate the PC, which method is available. Depending upon that method, you can calculate the PC. If PC is recorded issue price, you can continue. If PC is recorded par value, according to adjust. Then the entry is purchasing company to realization, make it posting. Then PC receipt, you may receive cash, you may receive equity shares, you may receive preference shares, you may receive debentures. What is the entry? Cash accounted are, equity shares of purchasing company accounted are, preference shares of purchasing company accounted are, debentures of purchasing company accounted are to purchasing company. You should need to close the purchasing company at that particular circumstance. Once you receive the PC, purchasing company account got closed. Then step number 4, distribution of the PC. Before distribution of the PC, if any asset available which is not taken over by the purchasing company, realize it in the outside market. Any profit or loss occur due to such realization, make it transfer to the realization account. Then PC amount plus cash realized due to the outside disposal of particular assets. The total amount you can make it distribute in the particular order. What is that order? We already discussed. First liquidation expenses, then secured creditor, then unsecured creditor, then preference shareholders, then equity shareholders. During this process of making settlement to various liability holders, if you derive any profit or loss, again make it transfer to the realization account. Then final settlement to the equity shareholders, which is step number 5. Before making final settlement to the equity shareholders, find out the realization profit or loss. If it is profit, realization to equity shareholders. If it is loss, equity shareholders to realization. Then with the available resources as per the given problem, cash and equity shares of purchasing company, just to make it distribute among the equity shareholders, then all accounts automatically got closed. This is the 5-step approach followed based on the generally accepted accounting principles in the books of selling company. That's it, guys. Sir, still only one is pending for problematic issues. Sir, but for this chapter, we try to do 2 problems for understanding. After completion of the entire theoretical issues, I will try to do 2 problems. Then only you can satisfy with this marathon lecture. Otherwise, the provisions you may know how to apply the provisions. Once the particular problem will comes, you may not appreciate. Okay. So the only one issue is pending, guys. What is that, you know? Which is lengthy chapter, you should bear with me. The another issue is accounting treatment in the books of purchasing company. Except this, everything is over. Now we are in the books of purchasing company. Let us start with accounting treatment in the books of purchasing company. Tell me all of you, in the books of purchasing company, AS 14 is applicable. And the 2 accounting treatment is based on type of amalgamation. If the amalgamation is in the nature of purchase, then method of accounting to be adopted is purchase method. If method of, if type of amalgamation is in the nature of merger, the method of accounting need to be adopted is pooling of interest method. Am I right? We already seen. First, what exactly the meaning of purchase method? What exactly the meaning of pooling of interest method? Let us have a look through journal entries, guys. What is the difference between purchase method and pooling of interest method? But you know one thing, when amalgamation is said to be in the nature of merger, when an amalgamation is said to be in the nature of merger, out of the 5 conditions, that is assets and liabilities, all the assets and liabilities should be transferred to the purchasing company. All the assets and liabilities should be transferred at book values, and the PC should be paid in the form of fully paid up equity shares only, except for a fraction of the shares we can paid in the form of cash. And shareholders holding not less than 90% of share capital of the shareholders of the selling company should become the shareholders of the purchasing company after amalgamation, and the same business should be continued by the purchasing company after takeover. If all such 5 conditions are satisfied, then the amalgamation is said to be in the nature of merger. Any of the condition is violated, then the amalgamation is said to be in the nature of purchase. Am I right? We know that. If any of such condition is violated, then once if it is decided as a purchase, then we need to adopt this purchase method. How the purchase method will be, let us have a look through journal entries, guys. Now all of you please come to purchase method. The first and foremost entry in case of purchase method is At the time of purchase of the business, what is the journal entry we need to be passed? Not the business. If you purchase any goods, what is the entry, guys? In case of purchase of goods, what is the entry? Purchases accounted are to creditor account. Purchases accounted are to creditor account. Now you are not purchasing goods, you are purchasing the business. That's where the entry is business purchase accounted are to liquidator of the selling company. The creditor itself is not the selling company, because selling company already got liquidated. In the place of the selling company, liquidator will be appointed as per the rules of the Companies Act 2013. That's why we need to make it hand over that amount to the liquidator of the selling company. How much amount we need to hand over? At the rate of purchase consideration. That's where the entry is business purchase account to liquidator of the selling company at the rate of purchase consideration. Now, all of you please concentrate. If you are purchasing the business, means what really you purchased? Assets and liabilities. That's why the second entry is with respective to incorporation of assets and liabilities of the selling company. You are incorporating the assets and liabilities of the selling company into the purchasing company books by canceling the business purchase. First, you should need to incorporate all the assets taken over at the rate of agreed value, two liabilities taken over at the rate of agreed values, which is nothing but assets at the rate of agreed value minus liabilities taken over at the rate of agreed value, which is nothing but NAV. As well as you should also need to cancel business purchase, because business purchase is debit in the first entry. Now you should need to cancel by making credit at the rate of PC. Now, what is the meaning of this, sir? By passing assets taken over account debtor to liabilities taken over to business purchase, if you pass this entry, what is the meaning of this? Assets taken over minus liabilities taken over at the rate of agreed value is known as NAV. Is known as NAV. Business purchase is nothing but PC. Business purchase is nothing but PC. You are comparing purchase consideration with NAV. You are comparing purchase consideration with NAV. Sir, PC can be calculated in multiple methods. If the PC is going to be calculated under NAV method, then PC is also equal to NAV. Tell me, guys, in case of NAV method, PC is equal to NAV. If PC is equal to NAV, then there is no profit or loss due to acquisition of the business. Why, sir? Sir, the value of the business we are getting in point of view of purchasing company is, let us assume 1 CR. At the same time, the purchase consideration we are paying to the liquidator of selling company is also 1 CR. Then the benefit we are getting in the form of NAV is 1 CR. The payment we are paying to get that benefit is also 1 CR. That is nothing but PC is equal to NAV. If purchase consideration is equal to NAV, no profit or no loss in purchasing company point of view. Okay. In any other method, if you calculated the PC, I mean, if you calculated PC in case of lump sum method, or in case of net payments method, or maybe in case of intrinsic value method, then there may be a chance of getting PC greater than NAV, or there may be a chance of getting PC less than NAV. What is the meaning of PC greater than NAV? Purchase consideration we are paying is 1 CR, or the NAV. Let me fix the NAV. NAV, the benefit we are getting is 1 CR, but the amount we are paying is 1.5 CR. Excess of amount we are paying, over the benefit we are getting is known as loss, in point of view of purchasing company. Why you are paying the excess of PC, even though you know the value of the business is 1 CR, the excess you are paying for the purpose of goodwill of the other business. The loss you can treat it as a goodwill. Then if the NAV is 1 CR, but the purchase consideration you are paying is 80 lakhs only, that is PC is less than NAV, you are getting the benefit of 1 crore, but simply you are just paying the 80 lakhs, 20 lakhs you are getting the benefit, which is a capital benefit, which should be transferred to capital reserve. So the overall conclusion is, at the time of incorporation of assets and liabilities of the selling company in the books of purchasing company, you need to incorporate assets at the rate of agreed value, as well as to liabilities taken over at the rate of agreed value. Assets taken over at the rate of agreed value minus liabilities taken over at the rate of agreed value is nothing but NAV of the business. It should be compared with business purchase by canceling the business purchase, that is PC. If the PC is under NAV method, then PC is equal to NAV, then there is no chance of occurring goodwill or capital reserve. That is the reason why I made it cross. But if you are calculated PC by applying any other method, then there may be a chance of PC greater than NAV, or there may be a chance of PC less than NAV. If PC is greater than NAV, then excess of PC paid to get the benefit, which is transferred to the capital loss, which is nothing but goodwill. Sir, if the PC is less than NAV, then we are getting the more benefit by paying the less amount. Now the difference is the capital profit, which should need to be transferred to the capital reserve. I mean, if the purchase consideration is under NAV method, then there is no chance of occurring goodwill or capital reserve. But if the same purchase consideration is calculated under other than NAV method, then there is a chance of occurring goodwill or capital reserve. If goodwill is occurred, then you should need to debit. If capital reserve is occurred, then you should need to credit. Only one account is appeared, either goodwill or capital reserve. If PC is greater than NAV, goodwill. If PC is less than NAV, capital reserve. But if the PC is calculated under NAV method, there is no chance of occurring goodwill or capital reserve. But one more special thing I want to clarify here, guys. PC, even though calculated under NAV method, if the same PC is recorded at par value, then there may be a chance of occurring difference between PC and NAV. Do we appreciate, all of you? If PC is calculated under NAV, if such PC is recorded at issue price, then there is no difference between PC and NAV. Both are same. But if PC is calculated under NAV method, but recorded at par value, what is the meaning of recorded at par value? Shares issued as PC multiplied with face value. Sir, PC, in case of PC recorded at par value, means the total NAV divided by issue price, then you will get number of shares issued as PC. Then if it is multiplied with face value, then the PC amount is quite different from NAV amount. The PC amount is quite different from NAV amount, because NAV is at issue price, but PC is at par value. Now, how these both will match? At that particular point of time, PC is not equal to NAV. So then there may be a chance of occurring goodwill or capital reserve. That means the catchy points are, if PC is issued at, if PC is recorded at issue price, then if the PC is under NAV method, there is no chance of occurring goodwill or capital reserve. But if the same PC is calculated under different methods, even though PC is recorded at issue price, there is a chance of occurring goodwill or capital reserve. PC more than NAV, goodwill; PC less than NAV, capital reserve. But if the same PC is recorded at par value, even though the PC method is under NAV method, there is a chance of occurring difference between PC and NAV, because the NAV is at issue price, but the PC is at par value. Then at that scenario, there may be a chance of occurring goodwill or capital reserve. Sir, all these items you can appreciate once. If you can understand the normal procedure, then the different issues you can easily appreciate. Otherwise, it's might confusing. But don't by heart anything. Just simply follow my flow, then automatically you will get everything. Okay, fine, guys. Sir, first entry at the time of purchase of business, I write, sir. Then after that, I cancel the business purchase and I incorporated assets and liabilities. If there is capital profit, then credited the capital reserve. If it is capital loss, then I debited the goodwill. That's okay, sir. Fine. Then where you made the payment, sir, now you can settle the payment to the liquidator. For a liquidator, you may issue equity shares, you may issue preference shares, you may issue debentures, or you may issue cash. Then what is the entry, sir? Liquidator of selling company account at the rate of purchase consideration, right? Because we are making this entry at the rate of PC. So now you should make it debit. At the time of making payment to a creditor, the entry is creditor account at that is liquidator of selling company account at If you issue equity shares, 2 equity share capital. If you issue preference shares, 2 preference share capital. Those equity and preference shares are issued with premium, then the premium amount you should need to make it credit to securities premium account. If you are paying the cash, you can issue cash. Sir, if you issue the debentures, then you can write 2 debentures. Do you understand, all of you? Next, please all of you concentrate, guys. These are 3 entries are normal entries to be passed in case of the purchase method. in case of the purchase method. Apart from that, you should need to pass certain other entries as well, depending upon the information given in the problem. What are such other entries, sir? Sir, at the time of incorporation of assets and liabilities, here one of the liability is debenture of the selling company exist, if at all. Purchasing company is taken over, debentures of the selling company as well. Then out of these liabilities, one of the liability is debentures of the selling company. Now, the selling company itself is going to be liquidated, means there is no value for debentures of the selling company. Now you should need to cancel the debentures of the selling company. You should issue your own company debentures, or depending on the terms and conditions agreed in the amalgamation, how you are making settled to the debentures of the selling company. Depending upon that, you should need to pass the journal entry. That is, under the liabilities, if debentures of selling company exist, then debentures of selling company should need to be debited. That means this liability is there, na? That liability is debited. One of the liabilities, debentures of selling company account at R. At which value? At the rate of agreed value, because all the liabilities are at the rate of agreed value. Now you are issuing your own debentures, that is 2 10% debentures. If your debentures are issued with premium, then 2 premium on debentures account. If your debentures are issued at discount, then discount on issue of debentures account. Only one will come, either discount or premium. No, sir, the as it is value we are issuing, then there is no premium, then there is no discount. That is simply, we are acquiring the debentures of selling company as well. Then you need to cancel the debentures of selling company and you can issue your company debentures. Okay. That's it, guys. These are the normal entries you need to be follow in case of purchase method. And one more special entry is there. One more special entry is there. What is that? I will tell you. Please come down, all of you. Here. Special issue. What is the special issue, sir? Sir, in case of purchase method, reserves and surplus of the selling company will not transfer to the purchasing company. Am I right? Tell me, guys. In case of purchase method, amalgamation in the nature of purchase means we are incorporating assets as well as liabilities taken over by the purchasing company, but we are not incorporated reserves and surplus of the selling company here, right? That means reserves and surplus of the selling company will not be transferred to the purchasing company, no doubt about it. But if selling company reserves and surplus, but in selling company reserves and surplus, if it has certain statutory reserves, then such statutory reserves also need to be maintained by purchasing company as well, as per the statutory requirement. For example, guys, there is a foreign exchange fluctuation reserve is there, which is a statutory reserve. It should be maintained as per the FEMA Act for 5 years. For 5 years, let us assume. Already selling company maintained 2 years. As per the FEMA Act, the purchasing company should need to be maintained for 3 more years. But no reserves and surplus of selling company is transferred to the purchasing company. Then to follow the statute, I need to maintain such statutory reserve by passing an entry, amalgamation adjustment account data to statutory reserve account. This is a simple adjustment to need to be made to maintain the statutory reserve account. Reserve is the balance of credit. Then we should need to give the debit to the amalgamation adjustment account. Sir, for how many years it should need to be maintained? For remaining 3 years, for remaining 3 more years. Now, once such 3 years elapsed, once the time period elapsed, the entry should need to be reversed. What is the entry? Statutory reserve account data to amalgamation adjustment account. So up to the 3 years, that statutory reserve is shown under reserves and surplus of the purchasing company, as well as amalgamation adjustment account is also shown under reserves and surplus as a negative figure. This is the beauty of amalgamation adjustment account. Amalgamation adjustment account is shown under negative figure under reserves and surplus, and anyway statutory reserve shown under positive figure under reserves and surplus. Then positive is nullified with negative. There is no impact in the reserves and surplus, but still we are maintaining the statutory reserve to comply the provisions of that particular statute. Do you understand? Fine. One more time repeating. In case of purchase method, the reserves and surplus of the selling company will not be transferred to the purchasing company, but to comply statutory reserve of that particular statute, it is necessary to be maintained such statutory reserve by the purchasing company by passing an entry amalgamation adjustment account data to statutory reserve account. Statutory reserve will be shown as a positive figure under reserves and surplus of the purchasing company. Amalgamation adjustment account is also shown under reserves and surplus as a negative figure. Once the time period elapsed, the entry should need to be reversed. Then statutory reserves should need to be removed from reserves and surplus, as well as amalgamation adjustment account also need to be reversed from the reserves and surplus by passing the reversal entry statutory reserve account data to amalgamation adjustment account. Is it okay, guys? Fine. This is all about purchase method. This is all about purchase method. Now all of you please come to pooling of interest method. Sir, what is the meaning of pooling of interest? Sir, in case of merger, what happened? All the assets and liabilities of the selling company would become the assets and liabilities of the purchasing company, and all the assets and liabilities should be transferred at book values of the selling company to the purchasing company. That means purchasing company is feeling that there is no difference between selling company and purchasing company. Both are sister concerns. Almost the shareholders of the selling company would become the shareholders of the purchasing company as well, because we are paying PC in the form of fully paid up equity shares only. Do you understand? So in case of pooling of interest method, how the accounting treatment will look now. Please all of you concentrate. Come to pooling of interest method. Purchasing company will take over all the assets and liabilities along with reserves and surplus of the selling company. Why, sir? Just now I told you there is no difference between shareholders of the selling company as well as shareholders of the purchasing company. The reserves and surplus belongs to the shareholders of the selling company, is also belongs to the reserves and surplus, is also belongs to the shareholders of the purchasing company as well, because there is no difference between shareholders of selling company and shareholders of the purchasing company in case of amalgamation in the nature of merger. That is the meaning of pooling of interest. Pooling means you can add simply the total interest of the shareholders simply. That is the meaning of pooling of interest method. So purchasing company will take over all assets and liabilities along with reserves and surplus of the selling company. That too, those assets and liabilities should be taken over at book values only. Now, all of you please concentrate. If this is the balance sheet of the selling company, assets are there, assets are at the rate of book value, and the outside liabilities are also at the rate of book value. Reserves and surplus are also at the rate of book value. Now, please concentrate. Purchasing company is ready to take over all the assets at book value and all the liabilities along with reserves and surplus. Now, purchasing company is taken over assets and liabilities along with reserves and surplus, means at the time of comparison of PC with NAV, NAV is nothing but share capital of the selling company. Do we agree? What is the meaning of NAV? NAV means assets minus outside liabilities minus reserves and surplus. Assets minus outside liabilities minus reserves and surplus here, which is nothing but share capital of the selling company. Here, if you check, NAV is nothing but, sorry, this is not the case. Here, NAV is nothing but assets taken over at the rate of agreed value minus liabilities taken over at the rate of agreed value, which is nothing but NAV. In case of purchase method, agreed value is quite different from book value of the selling company. But in case of pooling of interest method, the book value and agreed values of assets and liabilities and reserves and surplus both are same. That's why NAV is nothing but assets taken over at the rate of book value minus liabilities taken over at the rate of book value minus reserves and surplus at the rate of book value, then which is nothing but share capital of the selling company only. That's why to know profit or loss arised due to the takeover of the selling company, we should need to compare purchase consideration with share capital of the selling company directly. The PC may be calculated in NAV method or under net payments method or under lump sum method or under intrinsic value method. That doesn't change. Method of calculation of PC doesn't change whether you are in amalgamation in the nature of purchase or amalgamation in the nature of merger. There is no relationship at all. The method of calculation of PC is altogether different. It may be lump sum method, it may be NAV method, it may be net payments method, it may be intrinsic value method. Then the question is, if purchase consideration is greater than the NAV, you are paying the more PC, but what you are getting the benefit, that is nothing but NAV. If PC is greater than NAV, which is nothing but PC is greater than share capital of the selling company, which is loss, right? Which is loss, right? That loss you should not transfer to goodwill as like in case of purchase method. That loss should be set off with free reserves and surplus of transferee company after takeover of reserves and surplus of the transferor company. Oh my God. For example, you are in the pooling of interest method. You know, in the books of purchasing company, you will take over all assets and all liabilities along with reserves and surplus of the selling company. Out of the reserves and surplus, free reserves of the purchasing company, first you can take. Free reserves means profit and loss account and general reserve. Those reserves which are freely available for distribution of dividend is nothing but free reserves. You can also consider the reserves and surplus of the selling company, but just you can add only free reserves of the selling company. You cannot add statutory reserves to set off the loss, because it is clearly given that loss should be set off with free reserves of the transferee company, free reserves of the purchasing company after takeover of free reserves of the transferor company. That is free reserves of the purchasing company plus free reserves of the selling company, from where you can set off the loss, due to PC greater than share capital. Then the remaining reserves and surplus only you can shown in the purchasing company balance sheet. Then you may ask one question, sir, if the free reserves of purchasing company and free reserves of the selling company is not sufficient to set off such loss, then what I can do? To that extent, you can set off that loss. Still, if it is not enough to cover, then the remaining amount you can make it debit the profit and loss account simply. Okay, sir. If PC is less than the share capital of the selling company, you know you are paying the less amount, but you are getting the more benefit, which is the capital profit. In the same way, how in case of purchase method you are transferring to capital reserve, in the same way you can make it transfer to the capital reserve. One more time repeating, this is a crucial part of the pooling of interest method. The first and foremost important point you need to remember in case of pooling of interest method is, purchasing company will take over all assets and liabilities along with reserves and surplus of the selling company. In comparison of PC with NAV, to know profit or loss on business takeover, you can directly compare PC with share capital of the selling company. If PC is greater than the share capital of the selling company, which is the loss situation, that loss you can set off with free reserves of purchasing company after taking free reserves of the selling company. That will be work out like this. First, you can consider free reserves of the purchasing company, add free reserves of the selling company, from where you can reduce the loss. The remaining free reserves you can be shown under the balance sheet during the process of amalgamation. Okay, fine. Next, if the PC is less than the share capital of the selling company, which is a pure profit situation, such profit you can make it transfer to the capital reserve. Sir, what about the remaining journal entries, sir? The first and foremost entry, there is no difference. For the first and foremost entry, business purchase to liquidator of selling company at the rate of PC, same. Business purchase accounted are to liquidator of selling company at the rate of purchase consideration. There is no difference. The same entry you can pass. So here also I passed the entries. Just a moment. Yeah. Journal entries, the first and foremost entry, business purchase accounted are to liquidator of selling company at the rate of PC. You know the PC amount depending upon NAV, net payment, intrinsic value, or the lump sum. All assets taken over. All the assets of the selling company taken over at the rate of book value, to all the liabilities of the selling company taken over at book value. Along with that, please all of you concentrate. Along with that, we are considering the reserves and surplus of the selling company as well. In the reserves and surplus of the selling company, statutory reserves are there. First, you can directly incorporate the statutory reserve at the rate of book value. Then, two free reserves. Sir, which free reserves I can only incorporate after set off of losses arised due to PC greater than share capital of the selling company? Still, if any free reserves are there, such free reserves I need to incorporate. That means the entire free reserves of the selling company, you cannot incorporate just as like that. The free reserves of the selling company, you can add with the free reserves of the purchasing company. After that, you can make it set off with the loss arising due to PC greater than share capital of the selling company. Still, if there is any free reserves of the selling company exist, such free reserves you can be incorporate. This is very much important. Then in the as usual, you should need to cancel the business purchase. If it is the loss, that is the situation. No, sir, if it is the profit, then you can straight away incorporate all the statutory reserves, all the free reserves, and the PC is less than the share capital of the selling company, that is PC is less than NAV, then you can incorporate the capital reserve. But you should never incorporate the goodwill in situation of pooling of interest method. Then the remaining all are easy, guys. At the time of making payment, liquidator of selling company accounted are to equity share capital, preference share capital, securities premium, and cash. And out of this, liabilities, if debentures of selling company exist, debentures of selling company accounted are to your company debentures. If you are issued with premium, to premium on debentures. If you are issued with a discount, to discount on issue of debentures accounted are, you may pass. Am I right? Fine. This is the difference between pooling of interest method and purchase method. Now, sir, if you ask what is the difference between purchase method and pooling of interest method, can you please elaborate, sir? One thing, only one is the difference. In case of purchase method, all the assets and maybe the assets, not all, certain assets and liabilities which are taken over by the purchasing company, taken over at the rate of agreed value. But here, all the assets and liabilities are taken over at the rate of book value. That is the one difference. Another difference is reserves and surplus of the selling company should not be taken over by the purchasing company. But here, reserves and surplus of the selling company will be taken over by the purchasing company. Now, at the time of comparison of PC with NAV, if PC is greater than the NAV, then you may treat it as a goodwill. If PC is less than the NAV, you may treat it as a capital reserve. But here at the time of comparison, you should compare PC with share capital of selling company, because NAV of the selling company is nothing but share capital of the selling company here. If the PC is greater than the share capital of the selling company, the loss should be nullified with free reserves of the purchasing company after considering the free reserves of the selling company. The loss should be nullified with free reserves of the purchasing company after considering the free reserves of selling company. If the PC is less than the share capital of the selling company, which is profit, such profit should need to be transferred to the capital reserve. And one more important difference just I want to tell you here. In case of the purchase method, we need to maintain the statutory reserve to comply the provisions of the particular statute by passing the entry amalgamation adjustment accounted are to statutory reserve account. That special entry we already seen here. Amalgamation adjustment accounted are to statutory reserve. Such special entry no need to pass in case of amalgamation in the nature of merger, because in case of pooling of interest method, all the reserves including the statutory reserve we are going to incorporate in the books of the purchasing company. That's why without passing the adjustment entry itself, in the second entry at the time of incorporation of assets and liabilities, we already incorporated the statutory reserve. That's why no need to maintain the amalgamation adjustment account. Amalgamation adjustment account is only going to appear in case of purchase method, but not in case of pooling of interest method. That's it, guys. Still the discussion is not yet over, guys. Please concentrate, all of you. Sir, in examination problems or in the classroom problems, most of the times they will mention the type of amalgamation. Most of the times they will mention the type of amalgamation. If at all not mentioned, if at all they're not mentioned, then in generally we will treat it as amalgamation in the nature of purchase. But certain times you need to check those 5 points. If such 5 points are satisfied, then we can treat it as amalgamation in the nature of merger. Otherwise, we may treat it as amalgamation in the nature of purchase. But most of the times they will directly mention the type of amalgamation. If they are not mentioned, then you can apply such 5 points. If the applicability of such 5 point itself is difficult for you by reading the problem, then you can simply treat it as amalgamation in the nature of purchase. So that information is given in the study material itself clearly. So that's why you can follow as like that. Fine. Next, certain special accounting issues just I want to going to discuss. Please concentrate. What are such special accounting issues? First, let us have a look. Sir, two companies are there. One is selling company another one is purchasing company. Before amalgamation, there is a relationship in between purchasing company and selling company. What is that relationship, sir? Purchasing company sold goods to the selling company. That means both selling company and purchasing company known to each other. So before proceeding with amalgamation itself, they entered into certain transactions with one another. Purchasing company will sell goods to the selling company. Then in the books of the selling company, purchasing company will be treated as a creditor, which is a trade payable. Then in the books of the purchasing company, selling company will be treated as a debtor, which is a trade receivable. So goods sold for 1 lakh. Now the question is, after occurring of this transaction, now the amalgamation is going to take place. As a process of amalgamation, purchasing company will take over assets and liabilities of the selling company, including this trade payable. Now this trade payable, after taken over, after incorporation of assets and liabilities of selling company in the books of purchasing company, in purchasing company balance sheet, one of the liabilities trade payable. Now, if you observe, in purchasing company, trade payable is nothing but purchasing company. It is indirectly telling that we need to make payment to whom? Ourselves. Is it possible? It is meaningless. And one more, we are telling that we need to receive amount from selling company. Where is the selling company? Selling company is already liquidated. That means, to be frankly speaking, there is no meaning to get amount from the selling company, and there is no meaning to pay ourselves. That's why we should need to cancel the asset with liability by passing the entry liability account debtor to asset account. If you make the debit the liability account, it should be cancelled. If you make the credit the asset account, it would also cancel. That's why the entry is trade payable account debtor to trade receivable account. That is debtors account debtor to creditors account, which is the adjustment entry in case of intercompany owings. Intercompany owings means whenever one company need to make payable to the other company, then the adjustment should need to occur. Not only for trade payable and trade receivable, maybe at the time of loan receivable, loan payable, maybe at the time of bills receivable, bills payable, maybe at the time of debtors and creditors, the adjustment entry need to be passed. Next, coming to the second situation. The same situation I'm going to continue. What is that situation? Purchasing company sold goods to the selling company at the rate of 1 lakh. How the purchasing company sold, by adding cost plus 10% profit. Let us assume if the purchasing company cost is 100 rupees and the profit will be 10 rupees, then the selling price will be 110. Now what happened? At the end of the particular financial year, in the selling company books, the stock is there at 25,000. Such stock which is purchased from the purchasing company. The stock which is purchased from the purchasing company. Now, they decided to amalgamate each other. Now, purchasing company will take over all the assets and liabilities of the selling company along with this stock. Now, purchasing company already having their own stock at 1 lakh. This is their own stock. Let us assume in purchasing company, their stock at the rate of 100 rupees. That is their original cost price. Now, purchasing company will take over the stock of selling company as well. Now, stock from selling company is at 25,000 rupees, which is for purchasing company selling price. What is the purchasing company selling price? If 100 is the cost, 10 rupees is the profit, then selling price will be 110 rupees. Oh, can you please tell me, anyone for the purpose of evaluation of the stock in their books of accounts, they will apply the provisions of AS2, right? As per accounting standard 2, inventory should be valued at cost or NRV, whichever is lower. The cost is at 100 rupees, but the NRV is at 110 rupees. At which price I need to record? This is cost or NRV, 100 or 110, whichever is lower, means that is 1 lakh at cost. That's okay, good. But coming to this 25,000 rupees, cost is at 100 rupees, but the NRV is at 110 rupees. We recorded at 110 rupees, but that is not correct, right? We need to reduce the value of the stock by representing it at NRV value. That means I need to reduce 10 rupees out of this 110. Now 25,000 is coding at 110. Then for 10 rupees is how much? Which is 2273. In the form of stock reserve, I need to reduce. Then what is the entry I need to pass? I need to reduce the stock, right? To stock account. I need to reduce stock. That's why to stock account. Because To show that stock at NRV, I need to reduce 2273 means stock should need to be reduced, means stock should need to be created. Then to which component I need to make the debit, which is a loss. Sir, reduction of stock means which is a loss. You can debit the profit and loss account in the normal course, but which is a capital loss, you can make the debit to goodwill account here. You can make the debit to goodwill account here, because in the books of purchasing company, whatever the loss is occurred, sir, PC is more than NAV. Which account you are debiting? Goodwill account. That's why you should always debit the goodwill account. Then the entry is goodwill to, on behalf of crediting, you can add the word reserve as well. That's why the entry is goodwill account data to stock reserve account is the entry, which is elimination of unrealized profit lying in the closing stock of the selling company, which is elimination of unrealized profit lying in the stock of the selling company by passing the entry goodwill account data to stock reserve account. Do you understand? Next, sir, can I directly debit the capital reserve on behalf of making debit the goodwill account? Yes. If at all, in the second entry, at the time of incorporation of assets and liabilities, if PC is less than NAV, then you may derive the capital reserve. Na? For example, if you derive the capital reserve, you can directly debit that capital reserve account. Do you know the reason is? Sir, in the second entry at the time of incorporation of assets and liabilities, PC is less than NAV. If you derive the capital reserve, if you wrote the goodwill right now, you can set off capital reserve with goodwill, capital loss, you can set off with capital profit. So that's why capital reserve is set off with goodwill means, again, you will pass one more entry, that is capital reserve to goodwill account. Why you are recording the goodwill? Why you are canceling again? On behalf of doing that double time, you can directly make it debit the capital reserve. What my point is here, if the PC is less than NAV situation is there, capital reserve already exists, then on behalf of making debit the goodwill account, you can directly debit the capital reserve itself. No, sir, in the second entry, you are deriving the goodwill account, then you can again debit the goodwill account. That is the point I am mentioning. So ultimately, if unrealized profit lying in the closing stock exists, then the entry is goodwill or capital reserve account that are to stock reserve account. Sir, when I should need to debit the goodwill, when I should need to debit the capital reserve, I already explained. If you're already having certain capital reserve balance, you can directly debit the capital reserve. If you're not having the capital reserve balance, then you can debit with goodwill account. Then how you should need to calculate the stock reserve also I explained through the illustration. Next, which is the last situation, which is with respect to the liquidation expenses adjustment. Please all of you concentrate. This also might included in the problems. Guys, this chapter is very much lengthy chapter. I'm giving my best efforts to explain each and everything. You should also listen with lot of patience and by paying a lot of attention as well. Okay, concentrate. Liquidation expenses. Selling company incurred, sir, in generally, actually, which company is going to be liquidated? Selling company, right? Selling company incurred their own expenses. Nobody is reimbursed. Selling company, the liquidation expenses are belongs to the selling company. Selling company incurred their own expenses. Then what is the journal entry, sir? Then in the books of the purchasing company, there is no entry, guys. Because such liquidation expenditure is not at all relevant for purchasing company. Such liquidation expenses are belongs to the selling company. We already done, if you really remember, the entry is liquidation expenses to cash, and liquidation expenditure should be closed and transferred to realization. Then the entry is realization to cash. Do you remember? Tell me, guys. We already done with that. Where it is there? Just a moment. So for realization expenses, the entry liquidation to cash and realization to liquidation expenses, then liquidation cross with another, then the entry is realization account data to cash account. Then the same entry we are passing here. What is that? Realization account data to cash account. Is it okay, all of you? Fine. Sir, if the liquidation expenses incurred by the selling company, but such expenditure will be reimbursed by the purchasing company at later point of time. That means first those are incurred by selling company. At later point of time, those are reimbursed by purchasing company. Then in the books of the selling company, what is the journal entry, sir? First, incurred by selling company first, right? So to cash. Anyway, the credit component is cash. It need to recover such amount from the purchasing company. That's why purchasing company is the debtor. Entry purchasing company account debtor to cash account. This is at the time of incurring expenses by selling company. At later point of time, selling company will be received from the purchasing company as a reimbursement. Now, at later point of time, at the time of getting the reimbursement, the entry is cash account data to purchasing company. To be frankly speaking, there is no impact because one entry is purchasing company to cash, another entry is cash account data to purchasing company. But you should need to write both the entries because both are happened at different intervals, different point of time. You need to record purchasing company to cash as well as cash to purchasing company. Sir, in the books of purchasing company, what is the journal entry, sir? Whatever the amount you are paying in excess of PC, sorry, in excess of NAV you are getting. This is also you can treat like as a PC. If PC is more than NAV, which is nothing but goodwill, which is a capital loss, you are paying the cash for the purpose of liquidation expenses of the selling company, which is a capital loss to you. You can debit the goodwill. Here also, to reduce the stock, we are making the debit the goodwill, right? Because which is a loss to you. The loss you are making the debit to the goodwill by paying the liquidation expenses which related to the selling company, which is lost to you. Again, you are making the debit the goodwill account. Therefore, goodwill account data to cash account is the journal entry. Next, directly incurred by the purchasing company on behalf of the selling company. Now, purchasing company is not at all interfering. That's sorry, selling company is not at all interfering. These expenditure are directly incurred by the purchasing company. That's why in the books of selling company, no entry. But in the books of purchasing company, the same entry they will pass. That is goodwill account to cash account. If entry will come in the books of purchasing company, the entry is same, guys, goodwill to cash or goodwill to cash. But if it is in the books of the selling company, if those are incurred by the selling company, entry is realization to cash. But if those are reimbursed by the purchasing company, it will pass the entry purchasing company to cash and cash to purchasing company. Those points you need to remember. This is with respect to liquidation companies as well. So hope I discussed all things. Sir, what are the different issues you discussed from the initial stage, sir? Through mind map, let us check quickly, guys. In marathon, again, I am telling the mind map quickly. Sir, reconstruction, in the process of reconstruction of financial statements, internal reconstruction is possible, external reconstruction is possible. In case of internal reconstruction, there is no liquidation of company, but in case of external reconstruction, liquidation of company is possible. Sir, in case of internal reconstruction, reduction of capital is there. Section 61 and 66 of Companies Act 2013 is going to deal with internal reconstruction. Section 232, along with accounting standard 14, we are dealing the external reconstruction. One of the classic example for external reconstruction, I given it as amalgamation in the nature of merger. In the chapter amalgamation, we are going to deal totally three concepts. One is amalgamation. One new company is incorporated, two or more companies are liquidated. In case of absorption, an existing company will take over another existing company. And one more thing I discussed, which is external reconstruction. In case of external reconstruction, a new company incorporated to take over the existing company is suffering from the losses. That is the reason why the external reconstruction I told you, which is the classic example for amalgamation in the nature of merger. In case of merger, what happened? The new company incorporated is to take over all the assets and all the liabilities. All the assets and liabilities should be taken over at book value. All the shareholders of the selling company would become the shareholders of the purchasing company, and the PC should be paid in the form of fully paid up equity shares only. All such things are happened in case of external reconstruction also. That's why external reconstruction I told you, which is a classic example for amalgamation in the nature of merger. Okay, just leave it. Then next, coming to types of amalgamation in the nature of merger, in the nature of purchase. In the nature of merger, the method of accounting is pooling of interest method. In the case of merger, which is the method of accounting is purchase method. When which is known as pooling of interest, all assets and liabilities should be taken over by the purchasing company. All are taken over at book value. PC should be in the form of fully paid up equity shares. Shareholders holding 90% share capital of the selling company should become the shareholders of the purchasing company after amalgamation. The same business should be continued by the purchasing company after takeover. If any one of the condition violated, then which is the purchase method. Then coming to the PC calculation, what exactly the meaning of purchase consideration as per accounting standard 14? Amount payable to the shareholders of the selling company alone treated as the purchase consideration. So the method of PC either under lump sum method, either under net payments method, either under NAV method, either in case of intrinsic value method. Lump sum is nothing but ad hoc consideration, which is fixed amount. In case of net payments method of PC is amount payable to equity shareholders, amount payable to preference shareholders. If you make the consolidated amount, which is nothing but PC under net payments method. In case of NAV method, assets taken over at the rate of agreed value less liabilities taken over at the rate of agreed value. The difference itself is NAV, which is equal to the PC. In case of intrinsic value method, number of equity shares in the selling company multiplied with intrinsic value per share in the selling company. But we told you two different issues. If PC is recorded at issue price, this is the method of calculation of the PC. But if the same PC is recorded at par value, then first you need to calculate number of shares issued as PC. It should be multiplied with face value. You will get PC recorded at par value. Am I right? Next, accounting treatment in the books of selling company. AS 14 doesn't applicable. Gap is applicable. 5-step approach. What are the different 5-step approach, guys? Step number 1, dismantling of balance sheet. Step number 2, PC due. Step number 3, PC receipt. Step number 4, PC distribute among the various parties. Step number 5, final settlement among the equity shareholders. In case of dismantling of balance sheet, all the assets and liabilities which are taken over by the purchasing company should be closed and transferred to realization account at book values, which are not taken over separately open. Equity share capital, reserves and surplus, fixed assets should be closed and transferred to equity shareholders account. Preference share capital should be closed and transferred to preference shareholders account. Dismantling over. Step number 2, PC due. In working note, first you should need to calculate the PC. Then you should pass the entry purchasing company account to realization account. Then coming to the PC due, what is the entry for? Coming for the entry for PC receipt. What is the entry for PC receipt? You may receive cash. You may receive preference shares of purchasing company. You may receive equity shares of purchasing company. You may receive debentures of purchasing company to purchasing company account. Step number 4. Then if any of the assets which are not taken over by the purchasing company exist, first realize in the outside market, any profit or loss you are deriving, you can make it transfer to the realization account. Now the PC amount along with the existing resources of the cash, you can distribute in the particular order. First liquidation expenses, next security creditors, next unsecured creditors, then preference shareholders, and finally equity shareholders. During this process, if you derive any profit or loss, again transfer to the realization account. Now, after making all these settlements and before making settlement to the equity shareholders, first close the realization account, find the realization profit or loss, make it transfer to equity shareholders account. With the available resources, just to make it transfer to the equity shareholders. If you are having cash, if you are having equity shares of purchasing company, just to make it transfer to the equity shareholders by passing the entry equity shareholders account are to cash to equity shares of the purchasing company. Then automatically all accounts got closed in the books of selling company. Sir, one point here I want to reveal: whether the amalgamation in the nature of purchase, whether the amalgamation in the nature of merger, the accounting treatment doesn't change in the books of selling company. But coming to the accounting treatment in the books of purchasing company, it may be purchase method or it may be pooling of interest method. The difference in between purchase and pooling of interest method is, while comparing PC with NAV, PC is more than NAV goodwill. If PC is less than NAV, capital reserve. And one more thing, in case of purchase method, reserves and surplus of the selling company would not be taken over by the purchasing company. We need to maintain the statutory reserves of the selling company to comply the statute by passing the entry amalgamation adjustment account to statutory reserve account. But coming to the pooling of interest method, directly you can compare PC with share capital of the selling company. If PC is greater than the share capital of the selling company, the loss you can set off with free reserves and surplus of the transferee company after takeover of free reserves and surplus of the transferee company. Transfer company. If PC is less than the share capital of the selling company, which is a profit situation, the profit you can make it transfer to the capital reserve. Special adjustment, I told you, intercompany owings, trade payables to trade receivables, stock reserve, goodwill or capital reserve to stock reserve, liquidation expenses. Just now we discussed through a special chart, which is, sir, if such liquidation expenditure incurred only by the selling company, then realization to cash. Then in the books of purchasing company, no entry. Initially incurred by selling company, later reimbursed by the purchasing company to cash, and cash to purchasing company. In the books of purchasing company, goodwill to cash. If those are directly incurred by the purchasing company itself, there is no entry in the selling company. In the books of purchasing company, the same entry, goodwill to cash. That's it, guys. Okay, I'll do one thing. We can consider one problem for better discussion, guys. Total we may try to consider the two problems. One, we will complete it based on amalgamation in the nature of purchase, and another one is amalgamation in the nature of merger. Then we can liquidate the topic or liquidate the chapter amalgamation. Now all of you please come to the problems, guys. Let me consider problem number 1 for the discussion. Please all of you concentrate. So little bit speedy manner I want to discuss the problems. We already spent much time. Okay, just a moment. Yeah, right, guys. As I told you, we are going to see total 2 problems. One problem is based on amalgamation in the nature of purchase. Another problem is based on amalgamation in the nature of merger. Please all of you concentrate things related to problem number 1. In very quick manner, we are going to discuss. I don't want to spend much time on calculation part. I will only focus on the conceptual issues. Y Limited acquires the business of Z Limited, which is a purchasing company, which is a selling company, whose balance sheet as of 31st March 2011 is as under. Selling company balance sheet information is given. Under shareholders funds, share capital note number 1, equity share capital is given at 8 lakhs, 6% preference share capital is given at 4 lakhs. The total amount is 12 lakhs. Next, coming to reserves and surplus under note number 2. Capital reserve is there, P&L is there, workman compensation reserve is given at 8,000, but in bracket clearly mentioned that expected liability is 5,000. What is the meaning of that? Workman compensation reserve, right now they are treating reserve as only 3,000. Reserve as 3,000. What about remaining 5,000? Just now they are treating it as liability. Provision, expected liability means reserve, they are treating it as a provision right now. So 5,000 now it is categorized as a liability. It is not treated as a reserve. And one more thing I want to tell here, workman compensation reserve is a statutory reserve, but the statutory reserve balance is now 3,000, but not 8,000. Remaining 5,000 is a liability. That is the meaning of that. Next, come above. Under long-term borrowings, I think so debentures are there. 6% debentures are given. Next, whatever the remaining current liabilities, trade payable given, other current liabilities given, which is interest payable on debentures. Here debentures are there, not 2 lakh. Out of the 2 lakh, 12,000 is the outstanding interest on debentures. Okay, under assets, PPE is there, intangible assets are there. PPE, land and building, plant and machinery, intangible assets, goodwill and patents are given. Coming to current liabilities, what are the different coming to current assets, what are the different current assets are given? Inventory, trade receivable, cash and cash equivalent. Let me read the further information. Y Limited was to take over all assets except cash. By seeing this item, we can easily identify that amalgamation is in the nature of purchase. And liabilities, except for interest due on debentures, except for outstanding interest, remaining all liabilities also taken over by purchasing company, and to pay the following amounts. Rupees 2 lakhs face value, 7% debentures, 100 rupees each in purchasing company. For the existing debentures in selling company, for the purpose each debenture of Y Limited is to be treated as worth rupees 105. This is amount payable to the debenture holders of the selling company, which is not form part of PC. Amount payable to the debenture holders of the selling company is not form part of PC. Okay, this is amount payable to debenture holders of the selling company. For each preference share in the selling company, rupees 10 in cash and a 19% preference share of 100 rupees each in purchasing company we are going to pay. Now in selling company, how many number of preference shares are there? Let us have a look. 4 lakhs divided by 100 means 4,000 preference shares are there. That is in the form of cash, 4,000 into 10. That is in the form of cash. In the form of preference share, for each preference shareholder of selling company will get 19% preference share of the purchasing company. That we are issuing 4,000 preference shares. Each preference share is at 100. Okay, 4,000 into 10, which is 40,000. 4,000 into 100, which is 4 lakhs. So total amount payable to preference shareholders is 4,40,000. Okay, next come to point number C. For each equity share in selling company, 20 rupees in cash and 1 equity share in purchasing company of rupees 100 each, having the market value of 140. Now let us have a look how many number of existing equity shares are there in the books of selling company. 8 lakhs face value 100 means 8,000 equity shares are there. 8,000 into 20 rupees in the form of cash, 8,000 into 20, which is equal to 1,60,000. Am I right, guys? Next, we are issuing 1 equity share for every equity share in the selling company. That is 8,000 equity shares we are going to issue, but each equity share market value is at 140. Now in the form of equity shares, we are going to issue is 11,20,000. Now this is in the form of equity shares. The total 1,60,000 plus 11,20,000, how much it is? The total is 12,80,000. The total is 12,80,000. Now if you observe, amount payable to preference shareholders of the selling company is 4,40,000. Amount payable to equity shareholders of the selling company is 12,80,000. Total amount of the PC in the form of net payments method. By reading the information given in the problem, if you are able to ascertain amount payable to the equity shareholders and amount payable to the preference shareholders, then the method of PC is net payments method. What is the total amount of PC? 12,80,000 plus 4,40,000, which is 17,20,000 is the amount of PC. Next, fine. Expense of liquidation of the selling company are to be reimbursed by the purchasing company to the extent of 10,000, but the actual expense amounted to 12,500. Out of this 12,500, 2,500 incurred and paid by the selling company, but 10,000 are reimbursed by the purchasing company. If 2,500 incurred and paid by the selling company, then what is the journal entry? Realization to cash. That is the entry. Regarding the 10,000, what is the journal entry? Purchasing company. That is purchasing company is Y limited. Y limited to cash and cash to Y limited. Tell me guys, two entries we need to pass. Purchasing company to cash and cash accounted are to purchasing company, which is at 10,000, which is at 2.5 thousand. That is 2.5K. Next, Y limited, that is purchasing company valued land and buildings at 5,50,000, plant and machinery at 6,50,000, and patents at 20,000 of Z limited for the purpose of amalgamation. These are agreed values. Except these figures, remaining all assets and liabilities are taken over at book values only. That is the meaning. That is the meaning of the given sentence. Now, first let me look into requirements. Calculate PC. PC already over. Net payments 17,20,000. Just I calculated. Am I right? But you should need to present in. Uh, you need to make it present in the proper manner. How it should need to be presented, I will show through my power notes. Next, provide journal entries in the books of vendor company, that is selling company, and also provide the closing ledgers. Okay, we will directly work out the ledgers. You can automatically know the entries. Provide journal entries in the books of purchasing company as well. We will look both of these through our power notes guides. Concentrate, all of you. So total 3 requirements. One is PC, another one is journal entries in the books of selling company, another one is journal entries in the books of purchasing company, and type of amalgamation is only relevant in the books of purchasing company. That is, type of amalgamation is amalgamation in the nature of purchase method. Am I right? We already worked out the PC, but how it should need to be presented, we can see through our power notes. Calculation of PC, net payments method. Net payments method, how it should need to be presented, particular amounts, amount payable to equity shareholders in the form of cash, how much, in the form of equity shares, how much. Amount payable to preference shareholders in the form of cash, how much, in the form of preference shares is how much. Then the total amount of PC is 17,20,000. Now coming to the books of Z limited. In the books of Z limited, in the books of selling company, 5-step approach we need to follow. 5-step approach we need to follow. Step number 1, dismantling of balance sheet. After seeing the balance sheet information, what you should need to do, assets and liabilities which are taken over by the purchasing company should be closed and transferred to realization account at book values. All assets are taken over except cash. All liabilities are taken over except interest payable on debentures. It is clearly given in the problem information. So all assets except cash, all liabilities except outstanding interest. You can simply make it transfer to realization. Land and building transferred, plant and machinery transferred, 6% debentures transferred, trade payables transferred. But cash not taken over, separately opened. Outstanding interest on debentures not taken over, separately opened. Next issue is, come here. Open preference shareholder separately, equity shareholder separately. Equity share capital, reserves and surplus. You can make it transfer to the equity shareholders account. Preference share capital, you can make it transfer to preference shareholders account. So under preference shareholders, by preference share capital, under equity shareholder, equity share capital, reserves and surplus. These all are reserves and surplus. But one thing you should need to focus here, we already decided that out of the reserves and surplus, workman compensation reserve is only 3,000, remaining 5,000 is liability. This liability is also taken over by purchasing company, because except outstanding interest, every liability is taken over. That's why workman compensation liability to the extent of 5,000 transferred to the realization. That is under realization account by workman compensation liability. Here actually under the joining the things, actually we missed out. Just a second, I'll open this, then you will get the full picture. Just a moment. Yeah, now you are getting the full picture. Please concentrate. So these all are assets, and the liabilities is 6% debenture, trade payable, and workman compensation liability of 5,000 also taken over. Cash opened by putting a opening balance, and preference shareholders transferred, equity shareholder, equity share capital, capital reserve, P&L, workman compensation reserve only for 3,000. It's not 8,000, only 3,000 is reserve. Remaining 5,000 liability taken over by the purchasing company. That's why transfer to realization. Now come back, all of you. Still we are in step number 1. Share capital transfer to the respective shareholders, reserves and surplus transfer to equity shareholders, long-term borrowings, trade payable, except interest payable on debentures transfer to realization. But out of the reserves and surplus, workman compensation reserve of 5,000 transfer to realization as a liability. Under assets, PPE, intangible asset, inventory, trade receivables, except cash and cash equivalent transfer to realization. Cash account open separately. Outstanding interest on debentures open separately. Dismantling of balance sheet is over. Coming to step number 2. PC due. What is the entry? Purchasing company accounted to realization. In realization by purchasing company, that is by Y Limited at the rate of purchase consideration. We already calculated the PC, which is 17,20,000. In realization by Y Limited, then Y Limited to realization. Coming to step number 3, PC receipt. In the form of PC, what you are total receiving? Cash of 2 lakhs. Equity shares of purchasing company, you are getting 11,20,000. Preference shares of the purchasing company, you are getting 4 lakhs. What is the entry? Cash account are, equity shares of purchasing company account are, preference shares of purchasing company account are, to purchasing company, that is to Y Limited. Now you can go to the Y Limited account first. In Y Limited, by cash 2 lakhs, by equity shares of Y Limited, by 6% preference shares of Y Limited 4 lakhs. Is it okay, all of you? Now in the respective account simultaneous posting also you should need to give. If under Y Limited by cash, then in cash account to Y Limited. As well as simultaneously, you can also open equity shares of Y Limited and 6% preference shares of Y Limited in their respective accounts. Equity shares of Y Limited to Y Limited, 6% preference shares of Y Limited to Y Limited. Is it okay? Next. PC receipt is over. Now you can come to step number 4, PC distribution. But before distribution of PC, you can check that any of the particular asset is not taken over by the purchasing company is available. The only one of the asset is not taken over by the purchasing company is cash, which is already in realized form. That's why no worries. Now, along with the PC amount and the available resources, you can make it pay in the particular order. The first order is liquidation expenses. It is clearly given a point with respect to the liquidation expenses. Out of the 12,500, 2,500 incurred on their own, 10,000 is reimbursed by the purchasing company. Entry, realization account data to cash account. And another entry is Y Limited to cash account and a cash account data to Y Limited. Now realization to cash 2,500, whether it is posted or not, let us have a look. Realization account data to cash, liquidation expenses over. Then Y Limited to cash and cash to Y Limited. Y Limited to cash, Y Limited to cash, and in cash by Y Limited. And another one, cash account data to Y Limited, another entry. That's why in Y Limited by cash. One is inflow, another one is outflow. This is outflow, this is inflow. This is the impact of reimbursement. Do you agree? Next, in the order of making payment, the next entry will be I should need to make payment to the security creditors. Is there any security creditor which is not taken over by the purchasing company? No, there is only one liability which is not taken over by the purchasing company, which is interest payable on debentures. Now you can pay interest payable on debentures. Go to outstanding interest on debentures to cash 12,000. Simultaneous posting also you can give in the cash account, that is in cash account by outstanding interest. Is it okay to all of you? Next. Next, in the order of making payment, you should need to make payment to the preference shareholders. How much amount you are going to pay to the preference shareholders? Cash 40,000 in the form of preference shares 4 lakhs. That's why go to the preference shareholders, give the cash of 40,000, give 6% preference shares of Y Limited also 4 lakhs. In the respect to other accounts also, you can give the simultaneous posting in cash by preference shareholders and in 6% preference shares of Y Limited by preference shareholders. Now, if you observe here, preference shareholder liability is at preference shareholders liability is at 4 lakh, but you paid 4 lakh 40,000, which is the last situation. If any profit or loss arised during the discharging of liabilities of the preference shareholders, the profit or loss you can make it transfer to realization. Then in preference shareholders by realization, then in realization to preference shareholders. That is the distribution of PC among the various parties. Then go to the last step, step number 5, final settlement to the equity shareholders. Before making final settlement to the equity shareholders, close the realization account. I am getting a profit of 3,82,500. Then pass the entry realization to equity shareholders. Then in equity shareholders by realization. Now to make payment to the equity shareholders as a final settlement, what you are having out of the PC, I am having the equity shares of Y Limited at the rate of 11,20,000, and the remaining cash availability was 2,15,500. This 2,15,500 I should need to make payment to equity shareholders, as well as equity shares of Y Limited should also need to make payment to the equity shareholders. Then in equity shareholders account, the entry is to cash to equity shareholders of Y Limited. Then cash account closed, equity shares of Y Limited account closed, then equity shareholders account also got closed. If you check, all the ledger accounts what you open are automatically closed. This is the closure of books of accounts of selling company. Sir, in very quick manner I discussed. I'm not focusing anything on the computation issues. Next, coming to the last one, what is that? Journal entries in the books of purchasing company under purchase method. First and foremost entry, business purchase to the liquidator of selling company at the rate of PC, which is 17,20,000. Second entry, incorporation of assets and liabilities. What are the different assets and liabilities you are taken over? Here, those are exist clearly. Land and building, plant and machinery, goodwill, patents, inventory, trade receivables, all are taken over. All are clearly incorporated, but not at book value, at the rate of agreed value. If you observe in the problem, it is clearly given that agreed value are different for certain assets. If you take the land and building 5.5, plant and machinery at 6.5, and patents are 20,000. So 5.5, 6.5, and 20,000. Remaining assets are same as like the book values. If you check inventory and trade receivables, those are considered at book values only. Inventory and trade receivable 1.5, 1.8, I considered at 1.5, 1.8 only. Do we agree? Next, sir, along with that, goodwill also I am taken over. Intangible asset, one of the asset is goodwill. That goodwill is 2,40,000. Sir, but why you wrote the goodwill at 5,05,000, sir? That is different story. Please concentrate, all of you. If goodwill of the selling company is also taken over by the purchasing company, no need to incorporate goodwill directly, because you can derive the goodwill, the total goodwill, while comparing with PC with NAV. Na? In that goodwill, the goodwill which is taken over from the purchasing company was already included. What my conclusion is, if purchasing company is taken over goodwill of the selling company, then no need to incorporate separately. It will got incorporated automatically at the time of comparison of PC with NAV. That is the reason why now I am not incorporating. That is the reason why I am not incorporating right now. At the time of comparison of PC with NAV, it got incorporated. That means out of this 5,05,000, this goodwill of 2,40,000 is also there. For example, if you are incorporating 2,40,000, then at the time of comparing PC with NAV, one more time you need to incorporate the excess PC over NAV. Double time we may not write now. That is the reason why the goodwill of the selling company I not incorporated at the primary stage. At the time of comparing the PC with NAV, the goodwill what you are getting, which is inclusive of the goodwill you are taken from the selling company. Hope you get it. Just this is a procedural issue, not a special issue. In the same way, you are incorporating the liabilities. Provision for workman compensation liability, 6% debentures of Z Limited, and the trade payables. Sir, 6% debentures of the selling company, you are incorporating at agreed value, not at book value, because in point number 1 it is clearly given that we are taken over the debentures of the selling company, 2,07% debentures of our company debentures. We are making payment to the debentures of the selling company. For that purpose, each debenture is treated as 105. That means 2 lakhs into 105 percentage, that is 2,10,000. At the rate of 2,10,000, we are acquiring the debentures of the selling company. That's why 6% debentures of the selling company we are acquired at the acquisition price. You should not consider at the book value of the 2 lakhs. You should consider at the rate of agreed value of the 2,10,000. Remaining all are book value. Now assets incorporated agreed value, to liabilities incorporated at agreed value. Then you need to cancel business purchase to business purchase. Now you can compare PC with NAV. Purchase consideration, we already know 17,20,000. Total of the assets excluding goodwill minus the total of the liabilities, then you are getting NAV is at 12,15,000. If you want, you can make it calculate, you will get 12,15,000. Here PC is greater than NAV, the difference is the goodwill. Now you are incorporated the goodwill. Note, if selling company having goodwill which is taken over by the purchasing company, then no need to incorporate separately in the purchasing company books. It will be incorporated automatically at the time of comparing PC with NAV. The same fact I already told you. If it may come across in the examination, you can apply the same technique. Then the final settlement to the liquidator of Z Limited account at are 17,20,000. Cash you are paying in the form of 2 lakhs, equity shares 8 lakhs, preference shares 4 lakhs, securities premium is 3,20,000. What is the securities premium, sir? If you observe the PC calculation here, you are paying in the form of equity shares at the rate of 140. Sir, face value is 100, but you are paying excess at 40, right? That 40 is the securities premium. That is 8,000 into 40, which is 3,20,000 is the securities premium. You need to check face value is how much, premium is how much. Then this 6% debentures of Jet Limited, you are issuing your own company debentures at the rate of face value. Now 6% debentures of Jet Limited, you need to cancel 2,10,000. You are issuing your own company debentures at 7% debentures. That is the meaning of the point number 1. You are issuing your own company debentures of 7% debentures, that is 7% debentures, 2 lakhs. Excess amount you are paying, you can make it transfer to the premium, which is 10,000. Am I right, guys? Next. What is this goodwill to cash share? This is liquidation expenses reimbursed. Liquidation expenses reimbursed to the selling company. In the books of purchasing company, what is the entry? Goodwill accounted are to cash account. Tell me, guys. Here itself is the liquidation expenses chart. Liquidation expenses, if those are reimbursed by the purchasing company to the selling company, in the books of the purchasing company, entry goodwill to cash. Out of 12,500, only 10,000 only we are going to reimburse. For that, I passed the entry goodwill accounted are to cash account. Such a simple accounting treatment. Once if you have a good command on the content, you can easily write the answer. Next, one more problem I want to take up. Only the outline only I will tell you, not in depth, just to outline. That is amalgamation in the nature of merger. This problem we see in amalgamation in the nature of purchase. We are going to see in point of view of amalgamation in the nature of merger. Please all of you come to problem number 9. Right, come to problem number 9. What is the issue? Consider the following summarized balance sheets of X Limited and Y Limited. Land and building, plant and machinery, furniture and fittings, investments, inventory, trade receivables, and cash at bank is given. Next, here equity share capital, preference share capital, general reserve, export profit reserve is a statutory reserve. Investment allowance reserve is a statutory reserve. Sir, how you can identify a reserve is a statutory reserve or other than statutory reserve? Simply, if you know a particular reserve already in multiple chapters, which is not a statutory reserve, which is unknown reserves or statutory reserves, like this you can conclude, because we don't know all the statutes, right, at that particular point of time. So which reserve need to be maintained as per which statute, we don't know. That's why all the unknown reserves you can simply put it as a statutory reserve. Profit and loss account given, debentures given, trade payables given, other current liabilities given. X Limited take over the Y Limited. X Limited is a purchasing company, Y Limited is a selling company. Okay, on 1st April 2011, X Limited discharged the purchase consideration as below. Issued 3,50,000 equity shares of rupees 10 each at par to the equity shareholders of Y Limited. Amount payable in the form of equity shares is 3,50,000 into 10, which is 35 lakhs. Issued 15% preference shares of rupees 100 each to discharge the preference shareholders of Y Limited at a 10% premium. If you consider the preference share capital in the books of Y Limited, which is at 17 lakhs actually, am I right? Rupees in thousands, which is 17 lakhs. For this 17 lakhs, we are discharging at 10% premium, means 17 lakhs into 110%, which is nothing but 18,70,000. Amount payable to preference shareholders is 18,70,000. Amount payable to equity shareholders is 35 lakhs. What is the total amount of PC? PC is under net payments method. The total amount of PC is 35 plus 18.7, which is equal to 53,70,000. This is the amount of PC under net payments method. Fine. What they require? The debentures of Y Limited will be converted into equivalent number of debentures of the purchasing company. The statutory reserves of Y Limited are to be maintained for 2 more years. Show the balance sheet of X Limited after amalgamation on the assumption that the amalgamation is in the nature of merger. I only discussed this amalgamation in the nature of merger. Sir, first, if like this the problem is asked, then you need to work out everything in the working notes. Sir, if the amalgamation is in the nature of merger, then what is the requirement you should need to do? In the second entry, that is the only difference in the nature of purchase and in the nature of merger. In the nature of merger, in the second entry, you should need to compare PC with the share capital of selling company. What is the share capital of the selling company here? Come here, all of you. Share capital of the selling company Y Limited is a share capital. Y Limited is a selling company. Y Limited share capital is 30 lakhs plus 17 lakhs, which is 47 lakhs. Share capital of the selling company is 47 lakhs. If PC, which is nothing but NAV, if PC is greater than the share capital of the selling company, which is the loss of how much? 6,70,000. That loss of 6,70,000, you should need to be make it set off with free reserves of the purchasing company after takeover free reserves of the selling company. Am I right? Now, how it should need to be adjusted? Let us have a look through my power notes. Please allow if you come to problem number 9, I think so. Problem is problem number 9. Correct? Fine. PCI work out first, which is coming as 53,70,000. Now, comparison of between PC and share capital of the selling company. PC is 53,70,000. Share capital of the selling company is 47 lakhs. PC is greater than share capital of Y Limited. Loss of 6,70,000 should be set off with free reserves. Am I right? That is the only difference. Now, directly I go with balance sheet. Simple line by line addition of assets and liabilities. Why? Which is amalgamation in the nature of merger. Is it all assets taken over, sir? Why not? Which is a merger. Is it all liabilities taken over, sir? Why not? It is a merger. Is it all assets and liabilities taken over at book values or agreed values? At book values only. That's why simple line by line addition of assets as well as liabilities. Okay, fine, sir. Then what about share capital, sir? That's quite easy. The share capital of the purchasing company existing is 50 plus 22, 72 lakhs. We already know. That is, coming to the share capital, existing equity share capital is 50 lakhs. In the form of PC, we are paying equity shares 35 lakhs. If you want, you can check here. In the form of equity shares, we are paying 35 lakhs. In the form of preference shares, we are paying 18 lakh 70,000. Existing preference shares 22 lakhs. We are paying 18 lakh 70,000 in the form of PC. Now the total share capital is 125 lakh 70,000. You can make it represent that 125 lakh 70,000. Next, come to reserves and surplus, which is the crucial role, which plays the crucial role in case of merger. Please allow if you come to reserves and surplus, guys, one by one. First, statutory reserve, because in case of merger, both the reserves and surplus of selling company and purchasing company all together, we can make it present in the books of purchasing company. But if it is in the case of purchase, we can only consider the reserves and surplus of the selling company, the reserves and surplus of the purchasing company, along with statutory reserves of the selling company by passing the amalgamation adjustment account. But here, no need to pass the amalgamation adjustment account. The reserves and surplus of the selling company should automatically become the reserves and surplus of the purchasing company in case of merger. So that's why first consider the statutory reserves, 3 lakhs plus 2 lakhs, 5 lakhs, and 1 lakh is the investment allowance reserve. Here 5 lakhs is the export profit reserve and 1 lakh is the investment allowance reserve. Next, come to the general reserve. Existing general reserve 5 lakhs plus 2 lakh 50,000 is the selling company. So total will be the 7 lakh 50,000. 5 lakhs plus 2 lakh 50,000. Total will be the, here the same thing is given, which is total will be the 7 lakh 50,000. Now we got loss now. Loss due to comparison of PC with share capital of the selling company. The loss we may set off with free reserves of the purchasing company after taking over free reserves of the selling company. Now we have the enough 7,50,000 balance. You can set off the 6,70,000. Still you are getting the general reserve of 80,000. Then the remaining balance is profit and loss account. You can simply add it 7,50,000 plus 5 lakh, which is 12,50,000. This is the impact of merger, guys. Here the impact of merger is there. You can set off the loss occurred due to comparison of PC with share capital of the selling company. Make set off with free reserves of the purchasing company after taking over of free reserves of selling company. Now you can make it total of the free reserves, which got the 19,30,000. You can just simply make it present here. Remaining all are no need to think. Simple line by line addition. There is nothing. Line by line addition, line by line addition, line by line addition. That's it. So if the question asked in the examination for merger, then your work burden is very much less. The only point you should need to do is you should compare PC with share capital of the selling company. Loss you may set off with free reserves of the purchasing company after taking over of free reserves of the selling company. If it is a profit, you can directly transfer to the capital reserve. Simple line by line addition of assets, liabilities, including the reserves and surplus. You know how much share capital you should need to work out. Existing share capital of the purchasing company plus shares issued in the form of PC, either in the form of equity shares, in the form of preference shares, you should need to add to the respective accounts. Then automatically balance sheet of the merger is over. That's it, guys. With this, the chapter amalgamation, I'm officially liquidating. Now we are in the chapter internal reconstruction. At the time of discussing the chapter amalgamation, we already gave a formal introduction to internal reconstruction as well. But here we are going to discuss the internal reconstruction in detailed manner. You know, when a company is going to conduct the internal reconstruction process, if the company is suffering from huge losses since past few years, the company financial statements are not depicting true picture due to overvaluation of assets, due to overvaluation of assets, and due to occurrence of certain unrepresented assets like intangible assets, there may be a chance of overvaluation of net worth. To show such financial statements in true and fair view, the company can go for, or the company can opt for, internal reconstruction procedure. During the process of internal reconstruction, what activities conducted by such company? There may be revaluation of assets because our objective is depicting true picture of the existing assets and liabilities, and a reassessment of liabilities, reduction in paid up value, because our objective is we need to nullify the existing debit balance under the profit and loss account through profit derived from the process of internal reconstruction. That is the a major objective of conducting the internal reconstruction proceedings by a company. So that's why if any of the equity shares or the preference shares are exist under the shareholders fund, then we need to make negotiation with such shareholders to decrease their paid up value. Maybe the decrease in paid up value may occur in different ways. That is, certain point of times they may sacrifice to the extent of certain portion of their paid up value, then the company may derive profits. Or maybe without making the sacrifice also, the company can decrease the paid up value of the shareholder. That is by making payment to the extent of the decrease made in the paid up value. Do you understand? Or maybe sometimes if any partly paid up shares are there, they can decrease the paid up value by conversion of partly paid up shares into fully paid up shares. Do you understand? In detailed manner, I'm going to discuss below. The reduction in paid up value may occur in generally in three ways. Number one, through sacrifice made by the shareholder, then which creates profit to the company. That profit is ultimately useful or used by the company to knock off the P&L account debit balance. Or in another way, to make payment to the existing shareholders to the extent of decrease in the paid up value. That is another option. One more option is if partly paid up equity shares are there, then the company is decided to decrease the paid up value by converting the partly paid up shares into fully paid up shares. Okay, so if you can't appreciate, don't bother. In below, just we are trying to explain each and everything in detailed manner. Next, and one of the major important activity of internal reconstruction is making compounding activities or making negotiation activities with various parties of the company like creditors, debenture holders, bankers of the company. Due to making such negotiations with such parties, if the parties are ready to sacrifice to that extent of the sacrifice made by such parties, will create profits to the company. Again, such profits are useful to set off the profit and loss account debit balance and the unrepresented assets like intangible assets and any other asset if at all exist. Now, hope you understand why in generally company is going for the internal reconstruction process. Now the entire restructuring of the financial statements is going to occur without liquidation of the existing company. Sir, practically, can you please elaborate how the internal reconstruction procedure is going to be occur as per Companies Act 2013? How it is going to occur? Before a company start the proceedings of internal reconstruction, first the company management or the board of directors will discuss about a scheme. Scheme means what are all the different activities we are going to conduct during this internal reconstruction process. What are the various compounding activities we can make? up to which value we can decrease the existing paid up value of the shareholders. Each and every issue they will going to discuss. Then after large and a huge discussion among the board of directors, then they may derive certain scheme. And such scheme should be available in front of the various parties like equity shareholders, preference shareholders, creditors, debentures, and all other loan parties. They should need to take the approval of each and every party. After taking approval from all such stakeholders, then the company should send such a scheme, the final scheme, to the National Company Law Tribunal. So in the chapter amalgamation itself, we clearly discussed that for the purpose of conducting the external reconstruction, no court approval is mandatory, but for the purpose of conducting the procedure of internal reconstruction, court approval is mandatory. So that's why the scheme is ultimately sent to the NCLT. Once the NCLT provided approval for the scheme, NCLT will visualize each and every provision of that scheme, and if it is best interest of each and every stakeholder, then NCLT will approve such scheme. After approval of such scheme, then the company will start conducting the reconstruction procedures or the reconstruction activities. So in the as per the provisions specified in that scheme. Then after completion of internal reconstruction procedure, then the company will prepare the financial statements by adding the word and reduced. If court make an order, if the NCLT make an order that after completion of internal reconstruction procedure, you should need to add the word and reduced, then the company should need to add the word and reduced at the time of preparation of their balance sheet after completion of internal reconstruction procedure. This is the practical way of conducting the internal reconstruction procedure as per the Companies Act 2013. Sir, then what are the different procedural issues we need to adopt during the process of internal reconstruction, sir? Or I can put it as methods of internal reconstruction. What are the different methods available for the process of internal reconstruction? Total in our syllabus, total 5 different methods were covered. Apart from these, so many other methods are also available, but according to our syllabus, we will only try to cover these many methods. Alteration of share capital, variation of shareholders' rights, reduction of share capital, compromise or arrangement, and surrender of shares. If these 5 methods, if you will try to cover, then you can able to complete any problem which is based on the internal reconstruction chapter. Let us have a look one by one method through our power notes. Now all of you please come to alteration of share capital. As per the section 61 of Companies Act 2013, a company can alter their capital clause. If you know, in memorandum of association of a company, you may seen in the paper company law in group 1, there are various clauses: name clause, registered office clause, liability clause. One of the clause is capital clause as well. Sir, can you alter the memorandum of association? Why not? We can alter the memorandum of association, but there is a particular procedure you need to be adopted to alter the memorandum of association. The same procedure also we need to adopt in case of alteration of share capital as well. That is, the power we have in the articles of association to alter such capital clause, the alteration of memorandum of association power should be there in the articles of association, and the company will conduct a general meeting, and in such general meeting the shareholder should pass a ordinary resolution. I mean, more than 50% of the existing shareholder in that meeting should accept for such alteration, then only the company can go for alteration of share capital. Sir, in case of alteration of share capital during the process of internal reconstruction, what will be going, sir? There may be increase in authorized capital. There is no change in the paid up capital, but during the process of internal reconstruction, if there is any chance of issuing further equity shares to the various parties in settlement, then there is a chance of increase. Then there is a chance of increase in the total paid up capital in the future. That's why before issue of such equity shares further, first you are increasing your authorized share capital. That is also one of the process of alteration of share capital. But there is no change with respect to the accounting treatment at the time of presentation of financials. Just you are putting the authorized share capital with increased figures. That is the only change. Next, subdivision or consolidation and vice versa. What is the meaning of subdivision or consolidation? If existing share is subdivided into numerous shares, then which is known as subdivision of shares. And if the existing shares are shrinked by making a consolidation, then which is known as a consolidation of shares. Let me take one example for better understanding. Sir, let us assume 10,000 shares are in existing mode. Each and every equity share face value is 100 and the total paid up value is 10,000 into 100, which is 10 lakhs. Each equity share is subdivided into 10 shares. So once each equity share is subdivided into 10 shares, then the total number of shares will become 1 lakh and the face value will become 10 rupees. There is no change in the total paid up value. The total paid up value will be again 10 lakhs only, again 10 lakhs only. But what is the change? Now the change is 1 lakh equity shares at the rate of 10 rupees each. Then what is the accounting treatment we need to be adopted at the time of subdivision? Now, first you should need to cancel 100 rupees face value because now the face value is 10 rupees. Now you should need to credit 10 rupees face value without changing the total paid up capital. That is equity share capital account that are 100 rupees face value to equity share capital account 10 rupees face value without changing the total paid up capital. Just you can simply make the presentation like this. Next, in case of consolidation, the same procedure you need to adopt. In case of conversion of shares into the stock, which is also form part of alteration of share capital. Alteration of share capital means not only a change in authorized share capital, not only subdivision and consolidation. Alteration of share capital includes conversion of shares into stock as well. First, what is the meaning of stock, sir? You know, share have a particular denomination. Share have a lowest denomination in the share capital. Lowest denomination in the share capital. I mean, below that, we cannot denominate a particular share in the share capital. That is nothing but share. Share is nothing but share in the share capital. That is the lowest denomination in the share capital. But stock doesn't have any denomination. Stock doesn't have any denomination. I mean, if you want, you can issue 1 lakh worth of stock. If you want, you can issue 55,000 worth of stock. Any of the denomination can be possible through the stock. That is the major difference between share and stock. And one more thing, stock cannot be directly issued by the company to the shareholders in the primary market as like shares. After issue of the shares, if company wants, they can convert the shares into the stock. Do you understand? The company cannot directly issue stock into the primary market. Next. Sir, is it rights attached to the stockholders? Is it different from the shareholders? No, there is no difference. There is no change in the voting rights. There is no change in the dividend rights. As like how the shareholders will get the dividend and voting rights, in the same proportion, stockholders will also get. Next. Sir, can I convert partly paid up shares into the stock? It is not possible. If an existing share is fully paid up, then only you can convert into the stock. So till now, I'm not discussing anything with respect to the alteration of share capital. Just now I discussed what exactly the meaning of stock as per Companies Act 2013. Now, if the company want to decide to convert the shares into the stock, then what is the journal entry? You should need to debit the share capital. You should need to credit the stock. If again company want to convert stock into the share, you should need to debit the stock. You should need to credit the share capital. Where I should need to represent such stock under the balance sheet. You should need to represent such stock still under shareholders funds only. Shareholders funds only. It is shown under form part of shareholders fund only, because for such shareholder they will get dividend as like equity shareholders only. That's it, guys. Sir, this is with respect to alteration of share capital, first method. Now coming to the method number 2, variation of shareholders' rights. What is the meaning of variation of shareholders' right? Shareholders in generally will get either dividend rights or voting rights or any other as per the Companies Act 2013. Now, if there is a change in the dividend right, if there may be change in the dividend right during the process of internal reconstruction, then what is the adjustment we need to give? Let us assume 10% preference shares are converted into the 5% preference shares, which is a change in the dividend right. Then you should need to cancel the 10% preference share capital. Then you should need to credit the 5% preference share capital without impacting the total paid up capital. Then the entry is 10% preference share capital accounted up to 5% preference share capital and a cumulative to non-cumulative preference shares. Then you can debit the cumulative preference share capital and you can credit the non-cumulative preference share capital. Participative to non-participative preference share capital. Like this, there may be a chance of change in variation of shareholders' right with respect to dividend or with respect to voting or with respect to any other right. Like this, you need to provide the accounting treatment in case of the method you followed, that is in case of variation of shareholders' right mechanism. Next. Come to the next method, which is reduction of share capital. As per section 66 of the Companies Act 2013, a company can opt for reduction of share capital, but the company should take the approval from the National Company Law Tribunal and it should pass the special resolution in the general meeting by the shareholders. Hope you know the special resolution. Special resolution means minimum 3/4 of the existing members in the meeting should need to accept for such reduction. Sir, what is the difference between alteration of share capital and reduction of share capital? If you really observe, in case of alteration of share capital, there is no decrease in the paid up value. There is increase in the authorized capital. There is either subdivision or consolidation without impacting the total paid up value, conversion of shares into the stock without touching the total paid up value. But in case of the reduction of the share capital, there may be a chance of decrease in the paid up value. Hope you understand. That is the reason why here National Company Law Tribunal approval and special resolution is mandatory, but here ordinary resolution and the power given in the Articles of Association is more than enough because there is no decrease in the paid up value. Come down. Sir, the reduction of share capital may occur in 3 ways. This one I already given a hint at the time of intro of this chapter. In 3 ways. First and foremost one, conversion of partly paid up shares into fully paid up shares through reduction of unpaid capital. Let me give an example for better understanding. Sir, number of existing shares are 1000, face value is 10 rupees, paid up value is 7.5 rupees. Now what the company want to decide, company want to convert partly paid up shares into fully paid up and the face value will also become right now 7.5. Now there is a decrease in paid up value. You know how? Maybe the paid up value is still 7.5. In future, company is losing a right to ask excess of 2.5 from the shareholder. Then automatically the paid up value is going to be decreased in the future. The paid up value maybe in the future it will become 10 rupees, but that right is sacrificed by the company during the process of internal reconstruction, which is nothing but reduction of paid up value only. Company may not make any call in the future. Now, conversion of partly paid up shares into fully paid up shares through reduction of unpaid capital. Through reduction of unpaid capital, there is a reduction in unpaid capital. There is no reduction in existing paid up value. There is reduction in unpaid value. Now, what is the journal entry I need to follow, sir, here? First, you need to cancel the old face value. Equity share capital accounted are old face value 10 rupees, 1000 into 7.5, 7,500. To equity share capital, you should need to credit the new paid up value, which is 7.5 rupees. That is 7.5 into 1000, 7,500. If you check, there is no change in the total paid up capital, but there is a change in the face value. Hope you understand. Next, come to the second one, reduction through payment made to the shareholders. This is a pure reduction in the existing paid up value. Let me take one example. Number of existing shares are 1000, face value is 10 rupees, paid up value is 10 rupees. By making a payment of 2 rupees, the paid up value is decreased to 8 rupees. Now, equity share capital account at our 10 rupees face value, first you should need to debit. That is 1000 into 10 rupees, total 10,000. You can make payment of cash to the extent of 2 rupees, 1000 into 2, which is 2000. Now, the paid up value of each equity share is converted to 8 rupees. That is 2 equity share capital 8,000. This is reduction through payment of cash. Next, please all of you come to the last situation, which is important situation. Number of times we will come across this situation while resolving the problems. Reduction through cancellation of existing paid up capital. Cancellation means the existing equity shareholder is ready to sacrifice to the extent of certain portion of existing paid up value. Such a reduction may happen in paid up value but not in face value. That is one case. The reduction may be in paid up value as well as face value, as well as face value. Reduction in paid up value but not in face value. Reduction in paid up value as well as face value. What is the difference between the two different situations, sir? I'm going to explain through a small example. Please concentrate. Number of existing shares are 1000. Face value is 10 rupees. Paid up value is 10 rupees. Now, what the situation is? Reduction in paid up value but not in face value. The shareholder is ready to sacrifice to the extent of 2 rupees per share. Let us assume. Now, you are no need to reduce the face value because there is no reduction in face value. Still the face value is continued at 10 rupees. There is only reduction in paid up value to the extent of 2 rupees. That's why you can simply debit the equity share capital. If any sacrifice made by the shareholder which creates profits to the company, to know the entire profits through internal reconstruction, any profit or any loss occurred during the process of internal reconstruction, we may make it transfer to reconstruction account or capital reduction account. The account is a temporary account. So to know the overall profit or losses occurred during the process of internal reconstruction, we are making transfer to a certain temporary account, which is either capital reduction account or reconstruction account, which is simply capital profit account. That's it. So equity share capital account at you should need to debit, that is 1000 into 2 rupees sacrifice 2000, and 2 reconstruction account, which is 2000. There is no change in the face value. Still the face value is 10 rupees, but there is change in the paid up value, which is the paid up value is changed to 8 rupees. That is the meaning of that. Now, there is a reduction in paid up value as well as face value. Then what I should need to do? First of all, you should need to cancel the entire existing equity share capital of 10 rupees face value. That is equity share capital 10 rupees face value, 1000 into 10 rupees, which is 10,000. Now 2 rupees is sacrificed, right? That is 1000 into 2000. You can make it transfer to capital reduction account or reconstruction account. Now the new equity share face value is 8 rupees as well as paid up value also 8 rupees. There, now you can make it credit to the new equity share capital 8 rupees, which is 8,000. Sir, now what is the difference between option number 1 and option number 2? In option number 1, you should only need to make it debit to the extent of sacrifice made by the other shareholder. That is only 2 rupees per share. But in option number 2, first you should need to cancel the entire existing equity share capital. Then you are going to issue the new face value of the equity share. That is the difference between option number 1 and option number 2. Reduction in paid up value but not in face value means you should only need to reduce the to the extent of sacrifice made by the shareholder. Reduction in paid up value as well as face value means entire face value you should need to cancel and the new face value you should need to issue. Sir, then in problems, unless otherwise specifically mentioned, always we can assume that if the shareholder is sacrificed something, then always we can presume that company is going to reduce a paid up value as well as face value. No need to provide a specific information regarding this. Unless otherwise specifically mentioned, there is a reduction in paid up value but not in face value. Simply you can presume that whenever a sacrifice made by the shareholder, there is a reduction in paid up value as well as face value. That means we need to cancel the entire existing face value of the equity shares, and we need to issue the new face value of the equity shares by making transfer to the extent of the sacrifice to the reconstruction account. Hope you understand, guys. This plays the crucial role. Okay. So that means the reduction of share capital can happen total in 3 ways. Number one, through conversion of partly paid up shares into fully paid up shares, through reduction of unpaid capital, reduction through payment of the cash, directly the paid up value is decreased by payment of cash, reduction through cancellation of the paid up value, that is nothing but sacrifice made by the shareholders in 2 ways: reduction in paid up value but not in face value, reduction in face value as well as paid up value. Sir, if nothing is mentioned, we can presume that reduction in paid up value as well as face value, that is option number 2. That's it, guys. Now come to the next mechanism of internal reconstruction, or next methodology of internal reconstruction, which is compromise and arrangement. You are going to discuss, or you are going to learn the concept of compromise and arrangement in the paper Companies Act 2013 in CA final paper 3 in deeper manner. But here, with respect to our accounting perspective only, we are going to learn section 240 to section 250 of the Companies Act 2013 dealing with compromise and arrangement. But most of our problems covers this method only. Most of our problems covers this method only. What exactly the meaning of compromise and arrangement, sir? Compromise and arrangement is an agreement. It is an agreement made or entered in between company and the other party. Company and the other party. The other party may be outsider or insider of the company. Insider means the shareholder, outsiders means any other liability holder. Regarding sacrifice out of the amount outstanding from the company. Compromise and arrangement is an agreement entered between company and the other party. The other party may be the shareholder or the other liability holder regarding sacrifice made by the other party out of outstanding amount payable by the company to the other party. Do you understand, all of you? That means either shareholder or the liability holder is making certain sacrifice during the process of internal reconstruction. Such agreement is known as compromise and arrangement. You may ask certain questions at this point of time. Sir, why shareholders or the other liability holders will ready for sacrifice, sir? Why they are decreasing the amount which is need to be receivable from the company? Because the company is a loss-making company. If the company will going to continue in the same situation, then there may be a possibility of liquidate such company. If the company is going to liquidate, then these liability holders or the shareholders may not fetch the amount payable by company to them. Because in case of the company, the limited liability concept is applicable. If the company, that is, once the company goes for liquidation, on the hands of the liquidator, he will may discharge amount to the liability holders in the particular order up to the time when such a liquidator will have a cash on their hands. If the liquidator doesn't have any resource or cash to repayable or discharge the amount to the liability holders, then such liability holders or shareholders may not get any amount from the company. So rather than going to that situation, it is better to sacrifice certain amount. And moreover, once if they will sacrifice, if the company may be turn up into the profits mode, anyway, those are the stakeholders of the company. At that point of time, company will travel with such stakeholders only. With that objective, the other parties are ready to sacrifice certain portion of the amount payable by company to them. Hope you understand. So then what is the difference between compromise and arrangement, sir? Compromise means there is a small dispute occurred in between company and the other party. What is the dispute means? Company is asking for sacrificing of 20% and the other party is only agreeing for 10%. Then after making so many negotiations, after making the arbitrage, they will come to certain conclusion. That is nothing but compromise. So that's why the word itself is drafted as compromise. After occurring of the dispute, they are under both the parties are under a one roof through that agreement, then that agreement is known as compromise. Arrangement means straight away both the parties are agreed for terms and conditions of one another. That is nothing but arrangement. But in both the cases, sacrifice is mandatory. So let us take up certain examples for better understanding of compromise and arrangement. And what is the accounting treatment we need to follow at this compromise and arrangement? Also, I'm going to discuss through these examples. Let us assume creditors balance is there at 10 lakhs. How much is the creditors balance? 10 lakhs. Creditors clearly told that they are ready to sacrifice 50% of their claim. They are ready to sacrifice 50% of the claim. And the remaining 50% they are expecting the equity shares. For the remaining 50% they are expecting the equity shares. Now, once the creditors ready to sacrifice that out of 10 lakhs, 5 lakh amount we need to make it transfer to capital reduction or reconstruction account. For the remaining 5 lakhs, I need to issue as equity shares. Then what is the entry I need to pass? First, you need to cancel the entire creditors 10 lakhs. Creditors is generally having credit balance. To cancel the creditors, you should need to make the debit. Creditors account data 10 lakhs. Now, to the extent of sacrifice made by the creditors, you can simply make it transfer to the reconstruction account, which is profit to the entity. That is to reconstruction 5 lakhs. And for the remaining 5 lakhs portion, you are going to issue the equity shares. That's why you can make it create the equity share capital. That is to equity share capital. Then the entry is creditors account are 10 lakh, to equity share capital 5 lakh, to reconstruction account 5 lakhs. So passing of journal entries is pretty much easy here, provided you should need to understand the transaction properly. Next, come to the second example. Again, the creditors were 10 lakhs. Creditors ready to sacrifice 50% of the claim, provided company will issue 2 lakhs worth of equity shares. What their demand, we will sacrifice 50%. We are ready to forego 5 lakh worth of amount, provided company immediately should need to issue 2 lakhs worth of equity shares to us. Then how you can call it as the net sacrifice is 5 lakhs. The net sacrifice is not the 5 lakhs. What they are telling, we will ready to sacrifice 5 lakhs provided if company issue the 2 lakh equity shares, then the net sacrifice is only 3 lakhs. Now, how it is 5 lakhs? I am ready to forego 5 lakhs provided if you give 2 lakhs worth of equity shares to me, means the net sacrifice is only 3 lakhs. That net sacrifice amount only you can make it transfer to the reconstruction account. Then what about remaining 50%, sir? This time the remaining 50% they are expecting the cash immediately. For the remaining 50% they are expecting the cash immediately. Then what is the journal entry you should need to pass here? First, the entire creditors account you should need to cancel. That is creditors account that are 10 lakhs. What is the real sacrifice or the net sacrifice or the real sacrifice? Only 3 lakhs. Such 3 lakhs you can make it transfer to the reconstruction account, only 3 lakhs. Then they're expecting 2 lakhs worth of equity shares, right? Then you can make it credit of 2 lakhs worth of equity shares. Then for the remaining 5 lakhs, they're expecting the cash to cash. And the journal entry is creditors account that are to reconstruction 3 lakhs, to equity share capital 2 lakhs, to cash 5 lakhs. What is the difference between example number 1 and example number 2? In example number 1, for the remaining 50%, creditors accepting the equity shares. But in example number 2, to sacrifice the 50% of the claim, they are expecting the 2 lakhs worth of equity shares. This point creates difference, guys. Whenever you are reading the problem, whenever you are resolving the problem with respect to the internal reconstruction, if a particular loan party or the creditors or the debentures are ready to made any sacrifice, then you should need to check due to sacrifice made by them, are they expecting anything? Then you should need to transfer amount with respect to the reconstruction only for the amount of real sacrifice or the net sacrifice, not for the gross sacrifice. They are sacrificing something, sir, but as a result, they are not expecting anything. Then at that particular point of time, you can make it transfer amount to the reconstruction to the extent of gross sacrifice, because at that circumstances, gross sacrifice and net sacrifice both are same. In example number 1, gross sacrifice is 50% and net sacrifice is also 50%, that is 5 lakhs. But in example number 2, gross sacrifice is 50%, that is 5 lakhs. But out of that, again, they're expecting 2 lakhs worth of equity shares. That's why the net sacrifice is 3 lakhs. Do you understand? This plays difference, guys, in between the accounting treatment with respect to example number 1 and example number 2. Next, come to the concept of unrecorded liability and unrecorded asset. In your books of accounts, till now means up to the adopting the internal reconstruction process, if any unrecorded liabilities or assets are exist, but during the process of internal reconstruction, you should need to record such unrecorded assets and unrecorded liabilities, and you should need to discharge such unrecorded liabilities, and you should need to make it realize such unrecorded assets, then what is the accounting treatment we need to follow? This is important concept. If any problem came from internal reconstruction in the examination, they will definitely add 1 or 2 adjustment from this concept. Concentrate. First, please all of you come to unrecorded liability. Most of the times, unrecorded liability is with respect to arrears of cumulative preference dividend. You know, as per the provisions of Schedule 3, unless otherwise, there is a obligation to pay occurs, no need to record the liability. I mean, present obligation arised due to the past event is not exist, then no need to recognize any liability. Coming to arrears of cumulative preference dividend, in any particular year, company profits are insufficient to make payment to the preference shareholders, then if the existing preference shares are the cumulative preference shares, then along with the current year dividend, I mean, the year in which the company is unable to make the dividend is going to make pay in the future dates, in the future years. To put it simply, if company is suffering losses in a particular year, then that year dividend and the future year dividend, both combinedly, they are going to pay in the year in which the company is earning the sufficient profits. Am I right or wrong? That is the concept of cumulative preference dividend. Now, like this, the company is a loss-making company which is suffering losses like anything. That's why the company may have a certain arrears of cumulative preference dividend, but which no need to record it in the books of accounts, because unless otherwise the company have an obligation to pay, it doesn't record it as a liability. But during the process of internal reconstruction, we decided to pay such arrears of cumulative preference dividend to the preference shareholders. Now which I treat it as a liability. Now during the process of internal reconstruction, I treat it as a liability. Previously, which is unrecorded liability, now which should need to be recorded. Previously, it is not an unrecorded liability. Sorry, previously no need to record it all, but now we decided to record it as a liability. That's why we are converting or treating it as an unrecorded liability during the process of internal reconstruction. Now, if such unrecorded liability settled, what is the journal entry, sir? What is the journal entry I need to pass? Let me take one example. What is that example? The creditors is 1 lakh, which is an unrecorded liability. So we are going to make payment of cash for such unrecorded liability. First, which is an unrecorded liability, right? First, you need to record into books of accounts. Sir, to record any liability, what is the journal entry, sir? P&L2 liability. In the normal course, I am telling P&L2 liability. There is increase in liability, it should be created, due to which there is decrease in profit. That's why profit and loss account to liability account is the journal entry. But we are in the process of internal reconstruction. Any profit or loss is arised. Such profit or loss, we should make it transferred to the reconstruction account itself. That's why the entry is reconstruction account to unrecorded creditors 1 lakh. That is the entry, which is the recording of the liability. Now you can make payment to such unrecorded creditors. At the time of making payment to the creditors, what is the journal entry? Creditors to bank or creditors to cash. That is unrecorded creditors to cash. Now, what is the effect of these two entries? Unrecorded creditors credit, unrecorded creditors debit. If it cancel with each other, then the entry is reconstruction account to cash account. That means through settlement to unrecorded liability, the entry is reconstruction account to cash account. I'll tell you another example. Sir, unrecorded liability is for 1 lakh, but we are only settling at 80,000. But the settlement is happened at 80,000 as a full and final settlement. The other party is ready to sacrifice to the extent of 20,000. Now, what is the accounting treatment, sir? Anyway, in the same way, you can follow. First, for the recording of the unrecorded liability entry, reconstruction to unrecorded liability 1 lakh. Now, for unrecorded creditors, you are paying cash of 80,000. Remaining 20,000 is sacrifice made by the such creditors, which should need to be transferred to reconstruction account. Now, what is the impact of passing these two entries? Unrecorded creditors cancel. Reconstruction 1 lakh is debit, reconstruction 20,000 is credit. So you should need to debit the reconstruction only to the extent of 80,000. 1 lakh minus 20, which is 80,000, to cash 80,000. Sir, no need to pass these two entries. On behalf of passing these two entries, you can pass a single entry like this. You can pass a single entry like this. Then how our thought process should be? The conclusion is, if unrecorded liability is settled at book value, that is settled at 1 lakh, or greater than or less than book value, that is less than book value or greater than book value, that is at 80,000, entry doesn't change. Entry is reconstruction to cash only. And the amount is at the rate of settlement value. Here the settlement value is 1 lakh, that's why 1 lakh. Here the settlement value is 80,000, that's why 80,000. So for making settlement of unrecorded liability, the net entry is reconstruction account to cash account at the rate of settlement value. Do you agree? Fine. For example, the entire unrecorded liability is sacrificed by the other party. Then what is the entry, sir? Then what is the entry, sir? No entry. You know why? If you want, first record it. Reconstruction to unrecorded liability. Then unrecorded liability to reconstruction. This is for the purpose of recording. This is for the purpose of sacrificing. Then nullify with each other, then the impact is nil. That's why if the unrecorded liability is sacrificed by the other party, then the impact is nil. That's why no entry. In the same manner, an unrecorded asset is realized. The entry is cash to reconstruction at the rate of realizable value. What is the conclusion you can draw from this concept of unrecorded liability and assets, sir? If the unrecorded liability is settled, then the entry is reconstruction to cash at the rate of settlement value. If such unrecorded liability is sacrificed by the other party, then there is no entry. If unrecorded asset is realized in the outside market, then cash to the reconstruction account. Those are the conclusions we are drawing from the concept of unrecorded liability. Important points, guys. Please, all of you come. Sir, I will try to resolve one problem in this chapter as well. Out of all the methods of internal reconstruction, if you observe, all these four we completed till now, except surrender of shares. Except surrender of shares. Am I right? So we will see the surrender of shares at the end of the chapter, because which is altogether a different concept. Still, based on these issues, first let us check certain important issues. After that, I will explain one problem. Then we'll check the concept of surrender of shares, then liquidate the chapter internal reconstruction. You know, we are in the marathon. Okay. I'm not telling each and every point in detailed manner. The outlines of the conclusions I'm drawing, even though I'm drawing the conclusions or the outlines, the important and the link up points I'm going to take care at the time of discussing each and every concept. You should also follow the same flow for better understanding. So please come to the important points. Sir, reconstruction account. Out of the methods we've seen, reconstruction account is going to made only in two methods: under reduction of capital, under compromise and arrangements. If you really observe, in case of alteration of share capital, we are not using any reconstruction account. In case of variation in shareholders' rights, we are not using any reconstruction account. In case of reduction of share capital also, if sacrifice made by the shareholder, if there is a reduction in paid up capital at that particular scenario, only we are using the reconstruction account. And in case of compromise and arrangement, each and every transaction, we are using the reconstruction account. That is the point, just is the observation. In alteration and variation of shareholders' rights, we are not using the reconstruction account. In the problem also, whenever alteration and variation of shareholders' rights takes place, then no need to use the reconstruction account. There is a reduction in capital and compromise and arrangement takes place, then only you can use the reduction of capital reconstruction account. And one more thing, guys, in reduction of capital through sacrifice made by the shareholders exist, we can presume that there is a reduction in paid up value as well as face value. That point also you can remember, unless otherwise specifically mentioned, that reduction in paid up value but not in face value. Is it okay to all of you? Fine. Next, come here. Sir, after completion of entire reconstruction proceedings, the balance in reconstruction account should be applied to set off the profit and loss account debit balance, whether it is clearly mentioned or not. In the problem, whether it is mentioned or not, the objective itself is the balance in reconstruction account should make it to set off the profit and loss account debit balance. After make it knock off reconstruction account with profit and loss account debit balance, if any balance exists in reconstruction account, it should need to be transferred to capital reserve account, because the profit or loss under reconstruction account itself is capital profits. I told you. So the capital profits, if anything is there after making knock off the profit and loss account debit balance with reconstruction, the amount you should need to transfer to capital reserve. So the entry is also given. Please concentrate. Let us take certain examples. Sir, reconstruction account balance is at 5 lakhs and P&L account debit balance is at 3,50,000. Now reconstruction account at our 5 lakhs. You are knocking the balance in reconstruction with P&L. Na? Reconstruction account is having the credit balance. At the time of utilization of reconstruction, it should need to be debited. P&L account having the debit balance. Now you are cancelling the P&L account. That's why it should need to be created. Still, how much balance is there under the reconstruction after making knock off the P&L account debit balance, which is 1,50,000? It should need to be transferred to the capital reserve. No, sir. If the reconstruction account balance is not sufficient to knock off the P&L account debit balance, then what can I do? To the extent of balance of reconstruction, you are set off with P&L. Still, if there is any P&L account debit balance is there, you can knock off with other reserves and surplus if at all exist in the company. If there are not exist, then to the extent of reconstruction only you can make it set off. The same example I given here. Balance in reconstruction is 3 lakhs. P&L account debit balance is 3,50,000. P&L account debit balance is more than the balance in reconstruction account. Now, to the extent of balance in reconstruction account, first knock off. Then you may utilize the other reserves and surplus to knock off the remaining profit and loss account debit balance. If the other reserves and surplus is not at all exist, then to the extent of balance with reconstruction only you can knock off. Do you understand, all of you? Fine. Next, come to the third important point. Sir, any intangible assets and other unrepresented assets, if specifically mentioned in the problem to cancel with reconstruction, then only we should need to cancel. I mean to say, whether mentioned or not, the balance of P&L account debit, the debit balance of P&L account, you should knock off with reconstruction account. If it is specifically mentioned that you should need to knock off or you should need to cancel the intangible assets and other unrepresented assets during the process of internal reconstruction, then only you should need to cancel with the reconstruction. Otherwise, no need to cancel. Irrespective of the fact whether mentioned or not, you can set off the P&L account debit balance. But with respect to tangible assets and unrepresented asset, if it is mentioned, then only you should need to cancel. Please, all of you remember that fact. But at the time of cancellation, what is the entry? Reconstruction account should be debited. Intangible asset is in generally having debit balance, while cancelling it should need to be created, and other unrepresented assets should also need to be created. It is if specifically mentioned, it is given. If it is specifically mentioned, then only you should cancel. Next, at the time of preparation of balance sheet, after internal reconstruction, you should add the word and reduced. Don't ignore that. At the time of preparation of balance sheet, you should add the word and reduced. So this one you know already, but as a process of internal reconstruction, I'm explaining this one as well, which is revaluation of assets, revaluation of liabilities. If there is an upward revaluation of asset is occurred, which is a profit, then asset should be debited, reconstruction account should be created. If it is a downward revaluation of asset, then which is a loss, reconstruction account should be debited and asset should be created. If it is an upward revaluation of a liability, which is a loss, reconstruction should be debited and liability should be created. If it is a downward revaluation of the liability, which is a profit, reconstruction should be created and liability should be debited. Hope you understand. These all important points you should need to be remember at the time of conducting the problem based on internal reconstruction. Except the concept of surrender of shares, everything I explained based on this concept. Let us take one big problem, guys. Let me take one big problem. So let me take problem number 3 for discussion. Please all of you concentrate here. The balance sheet of A and Company Limited as on 31st December 2011 is as follows. Under fixed assets, freehold property given, plant, patent, goodwill, trade investments. Under current assets, trade receivables given, inventory given, and a profit and loss account is there under asset side, means which is a debit balance, Next, coming to the liabilities, 6%, 4,006% cumulative preference shares at the rate of 100 each, 75,000 equity shares at the rate of 10 rupees each are there. 6% debentures secured on the freehold property. These 6% debentures have the secured on the freehold property. It is clearly given. Accrued interest is there on such debentures. Under current liabilities, bank OD given, trade payables given, director's loan given. This is the existing balance sheet information. The court approved, court means here NCLT, approved a scheme of reorganization to take effect on 1/1/2012, whereby the preference shares to be written down to 75 each, and the equity shares are written down to 2 rupees each. If it is written down to 75 means sacrifice made by the preference shareholder 25 rupees. Here written down to 2 rupees means sacrifice made by the equity shareholder is 8 rupees each. Do you agree? Because the existing face value of preference share is 100 and existing face value of equity share is 10 rupees. I already clearly mentioned a fact that whenever there is a sacrifice made by the shareholder, unless otherwise specifically mentioned, we can presume that there is a reduction in paid up value as well as face value. Now, what are the journal entries, sir? The journal entry is 6% cumulative preference share capital account that are in bracket 100 face value total 4 lakhs. To 6% cumulative preference share capital in bracket 75, that is 3 lakhs. To reconstruction account 1 lakh, that is nothing but 75 rupees. That is 25 rupees is the sacrifice. So let us check the same entry with my power notes, guys. Let me come to the answer. Yeah. So with respect to the share capital, written down to 75, written down to 2 rupees each. Now the entire existing face value was debited. So new face value credited, the balance reconstruction transferred. In the same way, equity share capital entire existing face value debited, the 8 rupees is transferred. 8 rupees. 8 rupees means 80%. 7,50,000 into 80% is 6 lakhs. Remaining transferred to the equity share capital. If you observe, the new preference share capital face value is 75 and the new equity share capital face value is 2 rupees. Do you agree? Next, come to the point number 2. Of the preference share dividends which are in arrears for 4 years, 3/4 to be waived and equity shares of rupees 2 rupees each to be allotted for the remaining quarter. That means that is for the remaining year. Now, first, if you come to the preference dividend, which are cumulative preference shares, arrears of cumulative preference dividend is there, which is unrecorded liability. Now, 4 lakhs into 6% means 24,000 per annum. So the total is for 4 years, which is 4 into 24,000, which is cumulative preference dividend, out of which 3/4 is waived and remaining 1/4 equity shares are going to be issued. If any unrecorded liability is waived or sacrificed, then there is no entry. Just now I explained here through the concept of unrecorded liability. If any unrecorded liability, arrears of cumulative preference dividend sacrificed, then there is no entry. Here also we mentioned the same fact, which is no entry. Now coming to the remaining 1/4, we are settling such unrecorded liability. At the time of making settlement, what is the journal entry? Reconstruction 2. If it is cash, to cash. If it is equity share capital, to equity share capital. So reconstruction account data to equity share capital, that is for the 1/4 at the time of settlement, at the rate of settlement amount, which is 24,000. Do we agree, all of you? Next, come to the next issue, guys. Accrued interest on debentures to be paid in cash. Accrued interest on debentures to be paid in cash. Here it is accrued interest is there. 22,500. You can simply make it payment in the form of cash. That is accrued interest account to cash account, 22,500 rupees. Next, Come to the next point, all of you. Debenture holders agreed to take over freehold property. Book value is at 1 lakh at a valuation of rupees 1,20,000. Now, if you check the freehold property existing book value first, the freehold property existing book value is total is 4,25,000. Out of that, he is talking about 1 lakh worth of book value. If such 1 lakh worth of book value is agreed to accepted by the debentures at a valuation of 1,20,000, that means before acceptance by such debenture holders, first of all, to the extent of 1 lakh freehold property, we should need to make the upward revalue. Now the total freehold property was 4,25,000 book value. Out of that, 1 lakh is making the upward revaluation at the rate of 1,20,000, due to which the revaluation profit is 20,000. Am I right? Now, what about the remaining freehold property? Remaining freehold property balance is there for 3,25,000. After 4,25,000, if 1 lakh is reduced, remaining is 3,25,000. Some other information is given. If you check the below point number 8, please all of you come to point number 8. Remaining freehold property to be revalued at 3,87,500. That means remaining freehold property 3,25,000 is again upward revalued at 3,87,500. Then the revaluation profit is 62,500. Then the total revaluation profit through upward revaluation of freehold property is here 20, here 62,500. Total is 82,500. First, you should need to pass entry for such upward revaluation of freehold property, that is freehold property account to reconstruction account. Just now we seen upward revaluation of the asset. What is the accounting treatment we need to follow? That is asset to reconstruction account. The same entry I passed here, freehold property to reconstruction account 82,500. Sir, now what about things related to debentures, sir? Debenture holders agreed. First, the existing debenture holders, how much? 6% debentures for 3,75,000, which were 3,75,000. Now, out of these 3,75,000 worth of debentures, 1,20,000 we are settling through giving the freehold property. So 6% debentures account that are you can debit to debenture holders, then debenture holders to freehold property, or you can pass the direct entry 6% debentures to the freehold property 1,20,000. Nobody will object. Now, out of this 3,75,000, if I already settled by giving the freehold property for 1,20,000, what about the remaining balance? Remaining balance is 2,55,000. Sir, what I should need to do with this 2,55,000, sir? If nothing is mentioned, then I need to make it represent as a liability after completion of internal reconstruction. But in further information, if something is provided, we are settling that liability by paying cash or by issuing the equity share something, then we will do accordingly. But till now, we don't know what happened to the remaining liability. Just wait for some time. Next, come below. This is point number 4 and point number 8. Both are over. Now come to point number 5. Patents and goodwill to be written off. It is clearly given. We will written off at final stage. Just wait. Point number 5. Just wait for point number 5. Next, inventory to be written off by 65,000. We are going to written off in a single entry. We are going to make a written off entry. Please wait for some time. Amount of 68,500 to be provided for bad debts. Provided for bad debts. That is also written off of the existing debtors only. Okay, we'll make it present 5, 6, 7 at a single transaction. Just wait. Trade investments be sold for 1,40,000. If you observe, trade investments are there under the asset side at the rate of 55,000. 55,000 worth sold for 1,40,000 means huge profit we are deriving. That is 1,40,000 minus 55,000. The difference is 85,000. Entry bank account at are 1,40,000, to investment 55,000, remaining to reconstruction 85,000. The same entry we passed here. Cash 1,40,000, trade investment 55,000, reconstruction 85,000. Next, come below to the point number 10. Directors to accept settlement of their loans as to 90% thereof by allotment of equity shares of rupees 2 each, and as to 5% in cash, and the balance 5% is being waived. First, director's loan is how much? If you observe in the liability side, director's loan is there for 1 lakh. Now such 1 lakh, they are accepting allotment of equity shares for 90,000 in the form of equity shares. From the remaining 5% in the form of cash, 5,000 in the form of cash, remaining 5,000 they are waived. transfer to reconstruction account. The same thing is mentioned here. If you observe, directors loan account at are 1 lakh, equity share capital 90, cash 5,000 to reconstruction 5,000. Next, come to the point number 11. There were a capital commitments totaling 2,50,000. Capital commitment means we already entered into certain contracts. To discharge such contract, we incurred 2,50,000. These contracts are to be cancelled on payment of 5% of the contract price as a penalty. Because we are in the restructuring of the existing financial statements, our all existing contracts are also we are cancelling, because we all together entered into the new type of conducting the business activity. But to cancel such contract, we need to pay the 5% as a penalty. Now, which is an expenditure? At the time of making penalty, what is the journal entry? Penalty to cash. Now, during the process of internal reconstruction, any expenditure or income is come, it should need to transfer to reconstruction. That is reconstruction to penalty. Then penalty is crossed with another. Then the entry is reconstruction to cash. That is 2,50,000 into 5%, which might be 12,500. That is reconstruction to cash account 12,500. Sir, except these three, 5, 6, 7 remaining all over, right? To return off patents, goodwill, inventory, and bad debts, the entry is reconstruction account that are 2 patents, 2 goodwill, 2 inventory, 2 PBD. So that entry is here. Patents 37,500 created, goodwill total 1,30,000 created. Out of the inventory, inventory 65,000 only we created. PBD is nothing but trade receivables. Trade receivables directly reduced to the extent of 68,500. To the extent of 68,500. Whether they mentioned or not, we should need to cancel the debit balance of P&L account, right? How much is the debit balance of P&L account? 5,35,000. You can debit the profit and loss account 5,35,000. Sir, before passing this entry, first what you should need to check, what is the balance under reconstruction account. Now, I developed a reconstruction account where if I check the balance under that reconstruction account before passing this entry, the balance under reconstruction account, I have 8,36,000 because I already passed the various entries, right? In entry number 1, reconstruction profit 1 lakh. In entry number 2, reconstruction profit 6 lakhs. So by making with all such entries, if I prepare a reconstruction account, I have the balance of reconstruction account to the extent of 8,36,000. Out of this 8,36,000, 37,500 is knockoff with patents, 1,30,000 knockoff for goodwill, 65,000 knockoff for inventory, 68,500 knockoff for trade receivable, remaining knockoff with 5,35,000. Now there is no balance in reconstruction. Reconstruction account debit also 8,36,000. If after knockoff all these things, if there is any balance in reconstruction account, excuse me, you may would transfer to capital reserve. But here there is no balance in reconstruction account, so simply no need to transfer any amount to capital reserve. And one more thing, if you observe in this problem, the requirement is actually you are requested to show the journal entries reflecting the above transactions, including the cash transactions, and prepare the balance sheet of the company after completion of the scheme. You need to prepare the balance sheet as well. Sir, in very quick manner, just I want to check the balance sheet. Please all of you concentrate, because presentation of the balance sheet in case of internal reconstruction is the different art. Okay, how you need to follow to draft the entire balance sheet in the proper manner. Please all of you follow the mechanism which I followed during the marathon. Now, sir, first share capital, right? Please all of you come here, start with your calculator. First equity share capital is how much? Entry number 2, which is 1,50,000, right? Plus in entry number 3, 24,000, plus entry number 4 nothing, entry number 5 is also nothing, entry number 6 is also nothing. Next come to 7 nothing, 8 nothing, 9. In 9, 90,000 is there. Add you can 90,000. So total I got 2,64,000. Nothing else further. So 2,64,000 is the equity share capital. That is 1,32,000 equity shares at the rate of 2 rupees each. Preference shares only one time issued. That is in the first entry. That is 3 lakhs only. Out of 4 lakhs, 1 lakh sacrifice. Na? So total is 5,64,000, which I shown under equity share capital. Reserves and surplus straight away you can show under nil, because P&L account debit balance is there. That itself is nullified with the reconstruction account. There is no P&L account balance. Next, come to non-current liabilities. Here debentures are there, guys. Out of 1 lakh, 3,75,000, 1,20,000 already over. Remaining is 2,55,000. One more, actually, I forgot to tell you. Further debentures also you issued for 8% debentures, which is for 1,30,000. So total 2,55,000 plus 1,30,000. 2,55,000 plus 1,30,000 worth of debentures, which are 3,85,000. Do you agree? Next, if you see the existing balance sheet, so what are the remaining all liabilities we have? Accrued interest was paid. Do you agree? Under current liabilities, bank OD for the time being you can ignore, because we know whether we have a positive balance of bank or negative balance of bank after completion of all the transactions. For the time being you can ignore. Trade payable. Trade payables is there for 3 lakhs. The same trade payable I represented here. Director's loan we already discharged. Except bank OD, every liability is over. Okay, fine. Next, come to asset side. Under assets, come to PPE. Freehold property, so many adjustments made. What are the adjustment happened for freehold property? Please come to the freehold property. Now, out of the existing freehold property, the 4,25,000 plus after completion of upward sacrifice. So only you can talk about this, because this one already given to the debenture. Only let us talk about this. So after making the upward revaluation, the balance become 3,87,500 na. So freehold property we can consider it as a 3,87,500. Yes. Next, one more PPE is there, which is planned. There is no adjustment. Directly you can add 50,000. The total is 4,37,500. That's why PPE is represented the same. Intangible assets, the total intangible assets, patent and goodwill is knock off with the reconstruction. That's why there is no balance in patents and goodwill as well. Next, come to current assets, trade receivables. So trade receivables, there is a decrease. How much decrease with the PBD is there na? How much decrease? 68,500. That's why you can reduce 68,500. Inventory 65,000 decrease is there. So these are the figures. Now, if you work out the cash and cash equivalents, there are various entries are there, right? From first entry onwards. If there is cash inflow minus, if there is cash inflow plus and cash outflow, there is a minus. First entry, there is no inflow, outflow. Third entry, no inflow, outflow. Fourth entry, outflow, minus 22,500. Come to the fifth entry, no inflow, outflow. Sixth entry, no out in. Seventh, inflow is there, plus 1,30,000. Eighth, inflow plus 1,40,000. Ninth, minus 5,000. 10th, minus 12,500. 11th, nothing. Now I have 2,30,000 cash with me. There is a bank OD exist, right, which is 1,95,000. So 2,30,000 minus 1,95,000, you are ending with a positive cash balance. So that's why in the balance sheet it is clearly mentioned 2,30,000 minus 1,95,000, which is a positive bank balance. That's why no need to show the bank OD under the current liabilities when the total of balance sheet is matching. Then how we should need to present the balance sheet? By taking the effect of each and every transaction in the calculator, you should need to make it the totals and the respective heads. Along by seeing the opening balance sheet, you should need to adjust accordingly. You should take care each and every line item at the time of presenting such item in the balance sheet, guys. Fine. Only one last concept is pending from my side, which is surrender of shares. Please allow you come to the concept of surrender of shares. Then with this, we can liquidate this chapter, internal reconstruction. Right. All of you come to the concept of surrender of shares, which is the last method or mechanism of internal reconstruction. This is one of the method of internal reconstruction. Am I right? Sir, you know the concept of forfeiture of shares, right? Sir, we are in the concept of surrender of shares. Why you are talking about the forfeiture of the shares? Just I will tell you the reason later. I will tell you the reason later why we are discussing about forfeiture of shares. Can you please tell me when forfeiture of shares concept is applicable? If any existing partly paid up equity shares are there, company make a call. If such shareholder is unable to repay such call, then it is the right given by the Companies Act 2013 to such company to forfeit such shares. If partly paid up shares are there, and shareholder unable to pay the call money at the time of making call by the company, then it is the right given by Companies Act 2013 to such company to forfeit such shares. Later, the company may cancel the forfeited shares or may can reissue such forfeited shares. You know such things already. Okay, in your graduation level or in your foundation level, you already learned such things. Am I right? Why I mentioned this concept, forfeiture of the shares concept is a right given by the Companies Act 2013 to a company. But surrender of the shares, there is regarding surrender of shares, there is no provision in the Companies Act 2013. There is even a single provision was not established in the Companies Act 2013. But if shareholders voluntarily surrender their shares as per the decision of the court, then company can accept such shares was given in the Companies Act 2013. One more time repeating. As per the Companies Act 2013, no company can pressurize their shareholders to surrender their shares. As per the Companies Act 2013, no company should pressurize their shareholders to surrender their shares. To be frankly speaking, company does not have any right to ask such shares from the shareholder in the concept of surrender of shares. But if shareholders voluntarily surrender their shares to the company as per the decision of the court, the scheme was already approved by the NCLT, then company can accept such shares. That privilege is given to the company. That fact was mentioned in the Companies Act 2013. So if shareholders voluntarily surrender shares to the company, then the company can accept. As like in the process of internal reconstruction, if the shareholders voluntarily surrender their shares, then the company can accept such shares. Now, the next question coming into my mind is, what is the difference between sacrifice made by the shareholder and surrender of their shares to the company? Literally speaking, there is no difference in company point of view. If sacrifice is made by the shareholder, then we are decreasing the paid up value and the remaining amount we are automatically transferring to the reconstruction account. If the entire amount is sacrificed by the shareholder, then the entire paid up value is going to be cancelled, entire amount is going to transfer to reconstruction. Due to which what happened, existing equity shares are cancelling. Now, due to surrender of shares, what happened? Once the shareholders decided to surrender his shares to the company, which is also a profitable situation to the company. But the only one difference is company is not cancelling such share. Company may utilize such shares which are surrendered by the shareholders for the purpose of making settlement to the various parties like debenture holders, loan providers, or the creditors. But in case of sacrifice made by the shareholder through the reduction of entire paid up value, company will immediately cancel such shares. But if at any point of time, if it required further shares, then they can issue such further shares, then only they can settle such equity shares to the debenture holders or the loan providers or the creditors. That is the only difference in between surrender of shares and sacrifice made by the shareholder. In both the cases, company is getting the same profit. But without cancellation of such share happened in case of surrender of shares, by cancellation of share through sacrifice made by the shareholder happened in case of the normal course. Till now, what we seen. Hope you are understand. Now, company may use surrender of shares for the purpose of reissue as payment to creditors, debenture holders, or any other liability holders during the process of internal reconstruction. That means surrender of shares happened without cancellation of existing share. Company is getting profit. Then coming to the accounting treatment, hope you understand the concept of surrender of share, how it differs from the normal reduction in the paid up value through sacrifice made by the shareholder. Now come to the accounting treatment. Let me explain the entire accounting treatment through this illustration. Sir, I can't take up a specific problem because the same accounting adjustment what you are going to learn are going to repeat in the problems as well. I don't want to duplicate, and our time is very much precious. We are in the marathon. That's why please all of you concentrate for this adjustment itself. If you're able to appreciate this adjustment, then you can able to write answer for any problem, because the problems will like as discussed previously in the same mode, the problem will be there after adding the certain sentences with respective to surrender of shares. Is it okay, guys? Concentrate. Number of equity shares are 1 lakh. Face value is at 10 rupees. Paid up value is at 10 rupees. Out of 1 lakh shares, 80,000 shares are ready to surrender their shares to the company. Once the shareholders voluntarily surrender their shares to the company, then the entry should be the existing equity share capital should be debited to the extent of surrender of shares. Face value is 10 rupees and the total amount is 80,000 into 10 rupees, which is 8 lakhs. To share surrender account 8 lakhs. One more thing, actually, I forgot to tell you. When a company can accept the shares surrendered by the shareholder, if such shares are fully paid up equity shares, if such shares are fully paid up equity shares, I mean fully paid up shares, partly paid up shares cannot accept in the form of share surrender concept. So that's why I mentioned that fact as well, I think so. Where okay, just leave it, maybe I forgot to add. So yeah, here it is there now. All the shares should be fully paid up. All the shares should be fully paid up before entering into the surrender of shares concept itself. Okay, come down. So now the entry is equity share capital account at R2 share surrender account. Now the entire 80,000 shares are there under this share surrender account. This share surrender account without cancelling such 80,000 shares. But you may ask one doubt, sir, you are telling that once the shares are surrendered by such shareholders to once such shares are surrendered by shareholders to the company, which leads to the profit to the company now, because whenever sacrifice made by the shareholder, we are recognizing it under reconstruction account. But where you recognize that profit, sir, this is the beauty of concept. We are not recognizing the profit through share surrender at the time of share surrender. We are, one more time repeating, we are not recognizing profit due to share surrender, not at the time of surrender of shares made by the shareholders. We are recognizing the profit occurred due to share surrender at the time of utilization of such share surrender to the various parties. That will prove in the next step. Let me check one case, guys. Case number 1, creditors for 5 lakhs. Creditors how much? 5 lakhs. This entire creditors we are settling in the form of equity shares by using the share surrender account. By using share surrender, we are discharging these creditors. Then what is the journal entry, sir? At the time of utilization of share surrender, the entry should be share surrender to equity share capital. Just you can simply reverse the entry. To the extent of 5 lakhs, the entry is share surrender account at R2 equity share capital account. I told you, right, sir, till now, we are not recognizing the profit for the purpose of share surrender. Now you should cancel the creditors. You can recognize the profit. That is creditors account at R2. Reconstruction account is the 5 lakhs. Sir, what is happening? We can't appreciate, sir. It's quite easy. First, you should learn two things. What is that? At the time of surrender of shares, or at the time of shares surrendered by the shareholder, the entry is share capital to share surrender account. There is no doubt about it. But we are not recognizing the profit. We are not recognizing the profit at this time. When we are recognizing the profit due to shares surrendered by the shareholder at the time of utilization of such share surrender. Now, this is the time for utilization of share surrender. We are having a creditors of 5 lakhs. We are issuing equity shares to such creditors by utilization of share surrender. Whenever you are utilizing the share surrender, the entry should be reversed. That is share surrender account to equity share capital account. Now you can recognize the profit. I already told you, right? Now you are utilizing the share surrender. You can recognize the profit. You are recognizing the profit means you are transferring such amount to the reconstruction. Even though shares surrendered were 8 lakhs, but out of such share surrender, we are only utilizing 5 lakhs. That's why I'm only recognizing the profits to the extent of 5 lakhs only by debiting the creditors. That is creditors accounted are to reconstruction account. Still under share surrender, how much balance is there? 3 lakhs. When such 3 lakhs I am recognizing as a profit, if such 3 lakhs also I am utilizing for any other party payments, then again I will recognize. For example, such 3 lakhs are issuing to the debenture holders. Then what is the entry? First, at the time of utilization of share surrender to equity share capital and debentures to reconstruction account. Do you understand? Okay. Conclusion. At the time of utilization of share surrender should cancel and a share capital should be created. That is the first entry. The real profit due to share surrender will be recognized at the time of settlement to the other party. That is at the time of utilization of share surrender. At the time of utilization of share surrender. That is at the time of settlement to the other party. Okay. Come to the next case, guys. So please, all of you apply your mind. Once if you understand, then everything is easy. Otherwise, it might confusing. Next, come down. Creditors is at 5 lakhs. Creditors ready to forego 2 lakhs. 2 lakhs is the real sacrifice, guys. Real sacrifice. And for the remaining means 3 lakhs. Company is going to issue equity shares out of share surrender. I mean, one entry, one entry is creditors to reconstruction, which is the real sacrifice, 2 lakhs. 2 lakhs, 2 lakhs is over. There is no confusion regarding this. This is not related to share surrender concept. This is related to a compromise and arrangement agreement in between creditors and a company, that is creditors to reconstruction 2 lakhs. And the remaining issue is only for 3 lakhs. For the remaining 3 lakhs worth of creditors, we are issuing in the form of equity shares by utilizing share surrender. Whenever you are utilizing the share surrender, entry is share surrender to equity share capital, that is 3 lakhs. Now, to the extent of utilization of share surrender, you should need to recognize as a profit. Now, for that entry is creditors to reconstruction. For that entry is creditors to reconstruction, 3 lakhs. Now, on behalf of passing this entry and creditors to reconstruction 3 lakhs, I can combine this 2 lakhs here itself. Na? That's why creditors 2 lakhs debit, 2 lakhs reconstruction credit 2 lakhs. Here also creditors debit 3 lakhs, reconstruction credit 3 lakhs. Now you can add 3 lakhs plus 2 lakhs. Therefore, creditors to reconstruction account 5 lakhs. Then no need to pass this entry once again. That means for utilization of share surrender, this is the entry. And to recognize the share surrender profit 3 lakhs, and the real sacrifice made by the creditors profit is 2 lakhs. Total 3 lakhs plus 2 lakhs is 5 lakhs. You can debit the creditors 5 lakhs. Then the entry is share surrender to reconstruction. Share surrender to equity share capital 3 lakhs for utilization of share surrender. Creditor to reconstruction. Real sacrifice is 2 lakhs. Share surrender profit recognition is 3 lakhs. Total 5 lakhs. Debit the creditors. Next, come to case number 3. All of you, please concentrate. This is quite, I'm not telling it as a difficult. I mean, a lot of things are involving here. But once if you appreciate, it is that much easy. Concentrate, guys. Creditors are given at 5 lakhs. Creditors ready to forego 2 lakhs. Provided if company issue 50,000 worth of equity shares. What creditors is telling to the company? We will ready to sacrifice 2 lakhs, sir, but we required 50,000 worth of equity shares, sir. Then what is the real sacrifice? 1.5 lakh is the real sacrifice. And for the remaining 3 lakhs, we are issuing the equity shares. So total 5 lakhs are there. For the remaining 3 lakhs, we are issuing the equity shares out of share surrender. This is straight away told. Then out of this 2 lakhs, real sacrifice is 1,50,000. And they're expecting 50,000 in the form of equity shares we are going to issue out of share surrender. Now my question is, my first question is, how much amount you are utilizing for share surrender, sir? For the settlement of remaining 3 lakhs, I am utilizing the share surrender. And in sacrifice of 2 lakhs, they're expecting 50,000 worth of equity shares. We are issuing such 50,000 worth of equity shares are also out of share surrender. The total amount required for the purpose of issue of equity shares out of share surrender was 3,50,000. At the time of utilization of share surrender accounted are to equity share capital 3,50,000. Now, real sacrifice made by the creditors 1,50,000 you can transfer to the reconstruction account. Plus, for utilization of share surrender, how much amount you are utilized for the share surrender? 3,50,000. 3,50,000 plus 1,50,000 you can make it credit the reconstruction account. You can debit the creditors 5 lakhs. That means if the sacrifice is the real sacrifice, or if the payment made to creditors by utilization of share surrender, there is no difference for me, because the real sacrifice I make it credit to the reconstruction, and for utilization of share surrender I am discharging the creditors, that amount also I make it credit to the reconstruction account. I doesn't differentiate if even though real sacrifice made by the creditors or the liability holder, or if I am making settlement to such party by utilizing the share surrender, there is no difference for me. Both the things I ultimately transfer to the reconstruction account. Even though such a shares are issued to the loan party for the remaining portion, or as a result of sacrifice made by such loan party, even though I am issuing, there is no difference. Sir, we can't appreciate all such things, sir. You can simply think like this: utilization of share surrender to equity share capital. To the extent of share surrender, you can recognize the profit, and the real sacrifice also you can transfer to the reconstruction, debit that liability account. Over. That's it, guys. Next, one more point I forgot to tell you. Sir, after utilization of share surrender, if there is any balance in share surrender, what I should need to do, sir? Because here in this case share surrender is 8 lakhs, I utilized it for 5 lakhs. Still, if there is share surrender account, 3 lakhs balance is there. What can I do, sir? Now the balance in share surrender, now you can recognize it as a profit. The balance in share surrender, you can simply make it transfer to the reconstruction account, because we are not utilizing now. That's why the unutilized amount of share surrender, you can make it transfer to the reconstruction account. After utilization of share surrender, if any balance exists, it should be transferred to the reconstruction account. Then from reconstruction, the balance of P&L should need to be knock off. If still there is balance in reconstruction account, you can make it transfer to the capital reserve. That is normal things only. So like this, whenever the share surrender concept exists, you should need to think like that. So problems based on share surrender also in the same manner. If you want, you can complete from your end, guys. This is the end of internal reconstruction chapter.